been, of course, on holiday, 2 days of the weekend, Saturday, Sunday, and Friday, of course, was markets shut. So he's basically warned. The latest and the most important consequential thing is he's warning Iran that he will significantly escalate the war if the Strait of Hormuz remains closed. And he put this post up, and I just want to sort of, put this up, of course, has been roundly and fairly criticized by all and sundry for the language and, of course, what it does say. Destruction of civilian infrastructure. He's saying, well, power plants, bridges, everything. I mean, I think it's a bit crazy, if I can put it bluntly, but that is where we are at. It does, of course, at some level, sort of reek of desperation. At another level, of course, this has to be read as a threat. And that, by the way, the deadline for the threat is Tuesday, or rather actually Wednesday early morning. But, you also had the U.S. Central Command, which said that it is continuing its strikes on Iran. This, of course, happened in the last 24 hours or so. There was, this U.S. service member who was in Iran. He was rescued. And then, the U.S. Central Command said that strikes have begun once again. There's a press conference as well by President Trump. This is on Tuesday at 10:30. That is tomorrow night at 10:30 p.m. So the press conference tomorrow night, and the deadline essentially for Iran for them to actually open the Strait of Hormuz sometime our time, early Wednesday morning. But these deadlines and these timelines, etc., have kept shifting. A few days, 48 hours, 5 days, 8 days, etc., etc. We'll see where this really goes. But for all practical purposes, the situation is largely unchanged. The strait, of course, is closed. Some ships are passing, oil markets, of course, are reacting and watching this very closely. There was a response from the Iranian side as well, and this is what he said. It was basically directly addressed to President Trump. He said, "Your reckless moves are dragging the U.S. into a living hell." That's the full quote of it. Make no mistake, you won't gain anything through war crimes. So this back and forth between both sides continues. I'll just touch upon price action for a bit. So S&P last week closed just a smidge below its 200-day moving average. That number is 6,644. We left off about 100 points away from that level. First quarter earnings in the U.S. kick off from Wednesday. We'll see where that really goes. But, U.S. markets have sold off. They're, I think, about 3.5% from all-time highs, but we've not seen a very large correction or anything yet. Here in India, the RBI sort of MPC kicks off today. The decision is on Wednesday. Most likely rates are going to be left unchanged, but the commentary after everything that the RBI has done. Some big moves last week, by the way, on the Rupee, and the Rupee went up very, very sharply, about 2% on Thursday, which was the last trading session. I think it'll be interesting to see RBI's thoughts on that. TCS will kick off earnings season. That is on Thursday. Some of the other IT companies are not kind of sort of reporting right after TCS. They are kind of spread out through the course of the month. Actually, they report later in the month, in April. And I'll just sort of leave off with levels, since not very much has changed and we are in a status quo with regards to where we really go from here. Those are the levels. 22,941. We left off at 22,713. The resistance is 22,941, which is the swing high. Then you go to the channel resistance, which is 23,110. And then you got to be open to the possibility of 23,500 or so as well. So those are levels on the upside. The near-term support, the very near-term support, stands at about 22,040 or so. GIFT Nifty up on your screen. We saw, by the way, on Thursday, which is the last trading session, this remarkable pullback from the lows, and we ended absolutely flat. So this morning, GIFT Nifty indicating an implied open of about 90-odd point cut. So that's the picture. Let's take it with the F&O cues and the positioning. Nigel, take it away.
Well, the geopolitical tension globally is still very much uncertain. The market's guessing what the US as well as the Iran leadership will do next. Though we witnessed a very good recovery actually in our markets on Thursday, the bigger positive though was finally we see some kind of stability and some solid strength in the Indian rupee, and that was really heartening to see. However, the FIs, well, they continue to remain big sellers in the cash market. But hope is that the rupee finally stabilizes, and since the Nifty in dollar terms is back to 2021 levels, this massive FI selling gradually eases out a little bit. There was no sign of short covering, though, from the FIs. They added, in fact, more shorts than long positions on index futures, while they added positions both on the long as well as on the short side on stock futures itself. The positive, though, was that they wrote more puts than calls. That was actually heartening to see. On the option side, there was a fair bit of addition on the 23,000 call. And on the downside, the 22,300 put, both of them did see a fair bit of addition. The broad sense in terms of the range, well, on the downside, 21,700 to around 22,200. That's the crucial support. That really, that mark is the Liberation Day low, as well as the recent low that we saw. Well, the resistance level comes in at around the 23,200, which is the recent high. And even the options data suggests that maybe that 23,200 will be the first hurdle for the bulls on the upside. My gut feel is we don't breach the Liberation Day low and we move on from here on. The India VIX, well, it's cooled off from around 29 odd that we saw in the past week. That number, though, gradually needs to correct to around the 20 odd mark. Also, the rupee holding on to the gains that we saw in Thursday's trading session. That's going to be extremely important. As I said, the FIs have been big sellers. In dollar terms now, the Nifty is at the same levels that we saw in 2021. So if that selling can ease out a little bit, it'll be good news from a bullish perspective.
All right, let's just quickly take stock of the Asian markets this morning. As Nigel was saying, many Asian markets are shut today. You've got China, Hong Kong shut on account of Qingming Festival. Taiwan is shut for tomb sweeping. And later on, France, Germany, UK all shut on account of Easter. In fact, even Australia and New Zealand are shut. So the ones which are trading today, we've got the Nikkei. That's up close to about 2%. And we've got the Kospi. That's up 2.5%. So just two markets in Asia to track this morning. Conrad Saldana, Managing Director, Portfolio Manager at Neuberger Berman, is here with us in the studio. Conrad, it's so good to see you in person. It's always, across Zoom, but great to have you. What brings you to India and what's the key agenda here?
I'm just seeing companies and also had a nice little break out in Rajasthan. I think it helps with the weaker rupee too. But Jenny, just trying to get an update on the markets.
And have you got an update? What's been the key sense so far? Or
It's still early. I think people are reasonably optimistic, but I think the global backdrop is not conducive. And I think the external factors, whether you're thinking of oil sustainably above $100 and seeming to be sticky and moving higher, is an issue. You're talking about external factors, including the Treasury yields that are flirting with 450 basis points. You're seeing mortgage rates also in the U.S. right well above 6%. So there's a little bit of a fear factor and risk on that receded right early in the year prior to the invasion, and it's not helpful that you're having the market deal with constant tweets on the current geopolitical crisis. That's not helpful. So a lot of external factors pressuring. When we came into this year, we were talking about the earnings cycle needs to start to inflect. You saw FI selling because you're seeing better opportunities elsewhere. We were talking about AI loser bucket for India, and I think that's just been compounded now with the whole oil factor and the pressure on the rupee as well.
Conrad, good that you had a nice break and with the weaker rupee helping. But I mean, if you're taking a holiday out, you're at a bit of a disadvantage, right? I mean, with the weaker rupee. So I just want to stay with rupee for a bit. Fridays, you saw last Thursday's big recovery, right? The rupee was stronger by 2%. And the market also pulled back up. Just a technical question. When foreigners bring and put money in India, I mean, they hedge some portion of it, right? Yeah, go on. So, Prashant, I'm just trying to understand what happened on the rupee on Thursday and the very sharp recovery in markets. And I mean, was there a connection or what?
Yeah, I'm not sure fully there's a connection. There's potentially behind the scenes, there's potentially the RBI trying to do a backstop on the rupee. And currencies is a bit of a mug's game because you see traders pile on very aggressively and then they start to unwind some of those positions. So all of those could be a confluence of what happened on Thursday. You get into an oversold territory and there's a bit of paring back, right, of those exposures. Usually for long-only investors, there is no hedging. So the index itself, when you look at it, whether it's the local index or the MSCI or FTSE, those are unhedged indices. So long-onlys would not hedge those exposures, especially on the equity side. Now, you would have hedge funds and others that would be trying to hedge out the rupee exposure if they want to get just idiosyncratic risk into equities or on the fixed income side. But by and large, for long-only investors, there is no hedging.
Passive, active, both. I mean, there's...
Correct. 100% on
This doesn't make that much of a difference. And
That's correct.
In terms of signaling effect, I'm not sure. I mean, typically a stronger rupee is on the back of stronger flows, FDI, et cetera, right? This is not that confluence. This is essentially the RBI trying to cut people out and sort of, push back against speculative positioning.
You're setting a floor, right? I mean, you're moving from 90 to 95. You're like, what's the next stop? And then you see the market starting to draw a straight line, extrapolated out to 100. And so at some point, I think there's a putting a floor on it.
Yeah.
All right. Hi, Conrad, and belated Happy Easter to you, your family, and hope you had a good one here in India.
Same to you, Nigel.
Well, Conrad, I wanted to ask you about, the sectors that we were talking about last time around. You made this point, post the global sell-off, tech names, whether it was Cognizant, Accenture, they were trading at 10 to 15 times, or some of them even in single-digit PE. And I think you made this point that you liked Persistent, Coforge. I think so. Both those two stocks were on your list. That call actually has worked out fairly decently in the last 1 month because tech has outperformed. Would tech be a sector that you'll be looking to load up on post the sharp underperformance that you've seen in the last 18 months or so?
Now, I'm not sure in the next week or few weeks, Nigel, but my belief on tech earlier one was that how do they get beyond the time and material, right, billing cycle? And you can't have a confluence of where software is going to be entirely dead and AI, every company is going to do their own software stack without any services. So my view is that the companies that are well positioned for it, some of the smaller names, more nimble, provided more services, engineering services, are going to do well. You've seen even deals with the likes of Infosys, right? And so I do think that valuations are supportive for the sector. Obviously, in the nearer term, the rupee depreciation has helped, and there's a little bit of flight from people moving away from domestic sectors, including the banks, and moving it to IT services. But if I take a longer-term view to it, IT services, right now, there's not being much priced in for it. So the better players' growth has been lackluster. They're going to start to inflect positively. So I think the worst is priced in. And what I look for from a longer-term investment standpoint is where is the valuations totally misaligned with the fundamentals, right? And I think IT services was one of them. I do think some of the financials, to be fair, in the sell-off also look attractive at the moment, though.
Private banks?
The private banks, and you've seen that disparity really condensed. Now, HDFC had a little bit of drama, I would say, whether it's communications or miscommunications, but that had a role to play in it. And, you're owning a solid deposit franchise at 1.7 times book. I think that looks attractive longer term.
So this drama is providing a good entry opportunity.
I think so. I think there was the volatility that it created in the share price, whereas the banks started to kind of base out a little bit and pick up. And people were still about the merger, right? The ROE compression of that. And the ROA compression, I think that's headed in the right direction. It's got a fantastic deposit franchise.
So a few ideas where as you said, things are completely misaligned. Not misaligned, but completely misaligned, because that's where the sharper, in that sense, value lies. So there's HDFC Bank, as you said. In IT, it's Coforge and...
I keep them just because they've grown through this period of where the bigger companies have had a little bit more of a challenge in terms of growth. So I'd stick with those as the growth bucket.
Okay, what else, Conrad?
I would say the travel side, given the headlines in the news every day or every minute of the day, it's an ADR, but Make My Trip seems mispriced. Yes, they do have on the international side a fair bit coming from the Middle East, but now you're finally getting that stuff.
Anything in India listed names here?
Yeah, in India, I like the infrastructure, like GMR would be a nice solid
same aviation kind of GMR airports.
In that, Indigo too is a good franchise, and I'm not sure on the regulation side how that moves out. They've had their issues, and maybe they ran too tight. You've had the whole aircraft issues. You had the engine issues. So a lot of that stuff is getting behind you, right? If you ask me something, you're looking out longer term, and what's created an opportunity is, the likes of Larsen & Toubro, a big Middle Eastern exposure, right? So that's an obvious one. Sell on the news. Once this is behind us, there's going to be a massive build that's going to happen. Those order books are going to explode. So if we pause short-term noise and think out longer term, those are attractive opportunities.
Have you rebalanced your portfolios, gotten out of stocks where there is a lot more uncertainty to enter into these names where you are seeing
So Rima, like I said before, we probably don't change the portfolio as much, but I would say that in terms of dialing down the risk, I was just worried about the euphoria, and this was probably September, October of 2024. So a lot of the smaller mid-cap names, we just dialed back the exposure because you started to pay a growth premium, no liquidity discount. Now those have sold off significantly. So at some point it's going to look super attractive, but the larger caps are obvious ones in your face that, I think makes a lot more sense.
And India was about 14% of your portfolio in terms of an allocation?
14, it has declined now when I think of it on a global basis. And I'll just take MSCI emerging markets. India has shot up to over 20-odd%.
Yeah.
A lot of folks who were long-term India bulls probably own significantly above that. I would say probably a third of their portfolio. That benchmark has shrunk dramatically. So we're down to about 10-odd points in MSCI. Our exposure would be somewhere in that vicinity.
10%.
10-odd% of the portfolio.
So you've dialed it down from the earlier
So
levels.
it's two factors. One is like I mentioned, we took down some of our smaller mid-cap exposure early on. Secondly, it's also the depreciation of both the rupee and the stocks, right? So in dollar terms, that has rebalanced down.
Final question before we let you go. March was an absolute horrific month from an India market perspective with the kind of selling that we saw from the FIs, more than 110,000 crores in Indian rupees. Do you think with the rupee likely to hopefully stabilize at these levels, the Nifty, if you look at it in dollar terms, is the cheapest in the last 5 years. If you look at it in gold terms, it's the cheapest ever. Would you think that the time is right for FIs actually to gradually start loading up India? We've gone through a period of underperformance, valuations relatively better.
I'd agree with that, Nigel, but I cannot pinpoint today what's an absolute catalyst or trigger for people to come right back in. So I do think that India needs to stand up historically with its own domestic engine starting to come through. And yeah, GDP growth is great, but domestic CapEx, right, has to really step in. Some of those, I think the EMS stuff was, the China Plus One was nice marketing material. Right, but I think in absolute terms, you've got to start to see these EPS come through.
GDP growth is not looking all that great, right?
It is.
Just saw Moody's has brought I think real growth numbers for FY27 to 6%. And I think from one of the larger rating agencies, they're at the lower end of the range. I've seen numbers in the 5 handle. I mean, it is crazy.
So it is coming down, right? Globally, it's coming down. I think globally, you're looking at stagflation, right? Inflation's high. Now, may not be the worst thing on a nominal GDP growth basis if inflation is picking up. Now, that puts the RBI a little bit on a back foot. But if inflation is picking up while real growth is down, and you're still getting, call it 9-odd%, right? Plus on nominal, that's not a bad number for revenues.
Corporate earnings, yeah.
For corporate earnings, right?
Yeah.
So I think there's a little bit of a silver lining in that respect, Prashant.
Well, Conrad, we'll leave it there. Thank you very much. Great conversation, and thank you for dropping by.
Thank you for coming.
Thank you.
Cheers.
All right, we'll take a quick commercial break here. We'll just run you through the interactions which are lined up here. 9 o'clock, we'll have Nitin Agarwal of Motilal Oswal Financial Services. And Conrad was talking about opportunities in the banking financial services space. So a bit of a deep dive with Nitin in terms of what he likes. 9:20. We have Amish Shah of BofA Global Research. We talk markets and what he's telling clients to do at this point. 9:35. Supreme Industries joins us on the full customs duty exemption on critical petrochemical products. And we'll get an industry perspective as well on that. Following that, we bring you a conversation on SEBI's consultation paper on reintroducing open market buyback of shares. So that's an interesting chat with Pranav Satya of EY and Bhavesh of Equirus Capital. And towards the end of the program, Latha discusses the steps to basically push back against excessive rupee speculation. It's yielding results and whether it'll stay that way. Pranjul Bhandari and Mithul Kotech join her for that. That's later at 10:15. That's the lineup.
All right, time to slip into a quick break, but we've got plenty of stocks that we're going to be discussing post that break. For the time being, I give you a sneak peek into the top 10 segment. Axis Bank, HDFC Bank, Wipro, Bajaj Auto, Tata Motors, PV, Avenue Supermarts, L&T Finance and NMDC. They'll be reacting to positive news flow. Kotak Mahindra Bank will be reacting to negative news flow. We'll have a neutralish stance on Bajaj Finance. We'll explain all that to you on the other side of the short break.
Welcome back. You're watching Bazaar Morning Call. It's a Monday morning and we begin the earnings season with a lot of Q4 updates. So our entire research team is standing by. This is CNBC TV 18's list of top stocks for the day. First up, Ritu, I think there were more than 10, 15 updates that came through over the weekend, but let's run through the big ones. HDFC Bank, Axis Bank and Kotak Mahindra Bank.
Well, Reema, more than 20, I'd say maybe even more than 25, but who's keeping count at this point? The updates overall, though, are stronger than expected at a system level. Loan growth seems to be holding up. There is some pressure on deposits on individual banks, and LDRs, of course, are quite high. Now, within private banks, HDFC Bank, it can do with some good news, and some good news has come in. A clear green signal. We're going with green because business growth is above expectations. Advances are up 12% year-on-year, 4.1% quarter-on-quarter. Although keep in mind, this is a tad lower than the system-level loan growth that we've seen, which is closer to 14% as per RBI's latest data from Friday. Now, the deposit growth was quite strong, more than 14% year-on-year, which is higher than the system. And the credit deposit ratio, and that's something the market will focus on, that is cooled off to about 95% from about 99% in the previous quarter. And CASA has also inched higher. Axis Bank also showing good momentum. Loan growth of more than 18% year-on-year, more than 6% quarter-on-quarter, well above the system average. Deposits up nearly 14%, steady improvement in CASA as well, and their CD ratio at just over 93%. But Kotak Mahindra Bank is a bit of a laggard compared to some of these. Loan growth and deposit growth are both below expectations. Net advances growth of about 16%, deposit growth of 15% overall, though, is strong, even though CASA is healthy on a sequential basis.
Thank you very much for that. Let me take it on to Wipro now. Because Wipro has done an interesting deal. So for one, they have secured a multi-year strategic contract, which is worth $1 billion from Olam. Now, the total potential of the deal is $1 billion. What is committed from Olam is a minimum of $800 million, and this is spread over 8 years. But as a part of this deal, Wipro will also be acquiring Olam's IT, the captive IT services business, which is called Mindsprint. For that, Wipro will be paying $375 million, and this acquired IT company had revenues of $135 million as of last year. So basically, what Wipro is doing is that they're buying a long-term relationship, which is worth $1 billion, and they're using M&A to secure that long-term growth. So there are some positives of this deal. For one, you get a sticky contract, you get a sticky customer, you get guaranteed revenues of $800 million going up to $1 billion plus. Olam is big in the food and agri space, so it opens up that vertical. But on the other hand, generally, when you acquire a captive unit, you take on the employees. So in this case, Wipro will take on about 3,200 plus employees. Margins are typically on the lower side. So that is the risk. And the question really is that you're using M&A to acquire growth. So organic growth really could be a problem, which is why you're resorting to getting this deal and using M&A to get that contracted $800 million to $1 billion. So let's see how Wipro reacts in terms of performance today.
All right. Thanks a lot for that, Reema. Well, let's go across to Vinny, who's here to tell us about Bajaj Auto, Tata Motors PV, and Avenue Supermarts. Morning, Vinny.
Hi, good morning. So first up, in terms of Bajaj Auto, the sales numbers have come in largely in line with what one was expecting. Domestic as well as export growth had been more than 20% YOY. Overall exports healthy, but sales have slipped below 2 lakh units. So that's the only thing that's a bit of a blip there. Double-digit growth for 4 months is what one has seen in the domestic two-wheeler space as well. So overall growth for FY26 is expected to be decent. Fourth straight month that one is seeing 20+% growth for export of two-wheeler vehicles as well here. So mild green is what we're expecting. We have other than that, Tata Motors PV, that's going to be in focus as well. JLR has released their volume number for Q4 as well as FY26. Healthy volume growth number that has come in. Q4 volumes are up by 61% on a quarter-on-quarter basis. Year-on-year basis, we're seeing a decline of around 14%. Range Rover Sport and Defender form around 77% of their total revenue. Now, overall for Q4, the contribution continues to be at that versus Q4 FY25, it was at 66%. So we're seeing a growth versus last year in terms of contribution coming in from this as well. For the full year, there's an impact that one has seen here for US tariffs. China market has been a bit challenging. They've planned to wind down the legacy Jaguar models as well, and this is ahead of the new Jaguar launch that will come in. So these are some of the factors that have been impacting the company. But all in all, at least for Q4, the numbers are quite healthy, so green here as well. Demand, good Q4 update that's coming from the company. Revenue growth of around 19%, 17,000 crores is what the revenue is coming at. Growth rate has been, quite good for this quarter, and in the last 2-3 years as well, it's done very well. The number of stores they've added, overall 85 stores now standing at FY26, and total stores are at 500. So they are continuing to expand in the tier 2, tier 3 cities, which they've been talking about, and managing to see a good growth as well. So we'll see green here as well.
Thank you very much for that. Back to Ritu for Bajaj Finance and L&T Finance.
Well, Reema, it's a mixed bag for Bajaj Finance. The growth numbers are good, but deposit is where there's a bit of a negative. So AUM growth is in line with expectations and also within the management's guided range of around 20%. It has crossed the milestone of 5 lakh crores with a book over 22% growth year on year. New loan bookings are also strong, up more than 20%. And the customer franchise has expanded by about 4 million in the fourth quarter, although that's a tad lower than what the street was factoring in. The pressure, however, on the negative side, that's on the liabilities. The deposit growth, book has declined both year on year and sequentially, which is something we'll watch out for closely. So going with a mix for that. But L&T, on the other hand, that's the standout this quarter. Retail disbursements are up 62% year on year, driving a 39% growth for the full year. This was supported by expansion in rural, business finance, farmer finance, SME book, all of that. And the retail book overall is up about 26%. And importantly, asset quality also seems stable with realizations improving to 98%.
Okay, all right. Thanks a lot for that, Ritu. Well, focusing on NMDC, they'd come up with the quarterly numbers last week, but over the weekend they went ahead and they increased prices. They normally give, the pricing on their Baila unit, Baila Dila unit, that is. And out there, the revised prices come up for you on the screen. So the lumps are priced at around 5,300, while fines at around 4,500. What this means is the current hike with this particular new rates that have come out, the hike is close to around 450 on fines to around 500 rupees per ton on lumps. And the cumulative increase is quite large, between 600 and 700 rupees between early January till now. The quantum of the hike is a little bit surprising, and the street will be pleasantly surprised with that. There was expectations of a hike, but this quantum will be taken well. Well, let's do a quick recap then of all the top stocks we just discussed with you. We're looking at Axis Bank, HDFC Bank, Wipro, Bajaj Auto, Tata Motors, PV, Avenue Supermarts, L&T Finance and NMDC. They'll be reacting to positive news flow. Kotak Mahindra Bank will be the only one to react to negative news flow that could open up in the red, while we have a mixed view coming in on Bajaj Finance. That's about all the equity market action. Well, let's hop across to Manisha, who's here to tell us about what's going on in the commodities market. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, which are holding around that $110 a barrel mark. Well, U.S. has issued fresh ultimatum given a Tuesday 8 p.m. deadline as well, and has threatened to hit civilian infrastructure if Strait of Hormuz is not opened. In the meanwhile, what is keeping the prices in check perhaps is the OPEC Plus, which has approved a rise in output quota in their meeting in the month of April therein. But we do understand that most of the OPEC members are currently unable to export significant volumes. So it's a bit of a mix that we are getting to in sense of crude there. But the point being that we are making higher highs on chart. First, it was about holding $100 a barrel. Now it's about holding 110 on the higher side, with most banks and brokerages telling you that 120, 25 is what you could be looking at by the end of April, or if there are more attacks on energy facilities there. Well, that said, there is a bit of a profit-taking that we have seen in metals as a space, with U.S. threatening attacks on Iran power plants. There's post-liquidation yet again that we are seeing in markets here. So gold is slipped towards 4,600. It's down 12% since the West Asia conflict began, and silver is down 20% in the same period. So both trading in negative in Asia right now.
All right. Thanks very much, Manisha, for that. That's oil and gold in focus more later as we go forward. We'll take a break. We are back. We have Sandeep Agarwal of Sovelo Investment Managers. We'll talk about, of course, Wipro, the structure of the deal in terms of what that perhaps may mean for the stock, but of course also a quick run through of his view on IT stocks now. Stay tuned.
Welcome back. Let's invite Sandeep Agarwal, fund manager at Sovilo Investment Managers, on the show now to talk about Wipro, to talk about the IT sector ahead of earnings. So Sandeep, let's begin with Wipro. Now, Wipro seems to be using M&A to buy growth. So they've struck this $1 billion deal with Olam. But it comes with Wipro having to buy Olam's captive IT unit called Mindsprint for $375 million. And if you just look at the way the deal is structured, so Mindsprint's revenues were $135 million as of last year. The contract runs for 8 years, which means $135 million into 8 years is $1 billion, which is what the deal is about, a $1 billion deal. So there's no revenue outside of what they're paying per se for the acquisition. What have you made of this particular transaction, and what do you think? There is revenues, but what would it mean for Wipro's margins?
Hi, good morning, Rima. So I generally avoid commenting on company, but since we don't have this in our portfolio, nor we recommend. But let me put it this way, as a tech expert, that, if you take 15-17% IT services margin where, Wipro has been operating, then it means 175 million in the next 10 years, right? So basically they are paying $200 million, and this is not a NAV, right? Because you have to discount it. So then, it boils down to the fact that you are paying around almost 250 million or something like that for getting either entry into the markets, entry into the clients, or entry into the FMCG and agro clients globally. So that is what you are paying for. Now, I don't know Wipro itself has such a strong capability in consumer side, whether they really need to go for the capabilities. So it looks more like, multiple factors, including that, to get a large deal, and also to get some of the clients which they may not have, or maybe some of the geographies, the Middle Eastern market or some other geography. Because if you see, Olam operates mostly in Singapore and Middle East. So maybe because of that reason. Otherwise, on pure commercial, yeah. No, so I would not comment bad or good, but I would say that I don't know real rationale behind it, because on one side you are taking, you are paying 375 million. Even if you make 15-17% margin, it is very tough to, find out what all benefits you will get. But let me put it this way, that if you see the global talent chart and the cost of execution chart, you will see that after India, the highest amount of tech resources in the world at lowest price are available in Singapore. So that is the second country with which we closely compete, and their prices and their cost is almost 7-8 times of us. So, in that sense, maybe, the second best option of acquisition was in that geography, and maybe they would have gone ahead and done with that purpose. Generally, most of the IT companies, when they acquire in Europe and others, there is a loss at the EBIT level. We don't know whether there will be loss or profit, but that is what my understanding is. I would not put it as a great deal or a bad deal because of insufficient evidence or data. But yes, this is what it is. It is a cost takeout kind of deal.
But is it signaling that organic revenues and growth is difficult to come by, which is why we need to get these $1 billion deals, but it's attached to conditions, buy the M&A arm, use M&A to buy the captive IT arm?
So, Rima, if you see the financials of Wipro, for example, last few years, they have not been able to grow much. That is a fact. They have, in fact, not grown well in last 2 years or quarters. So from that perspective, they don't have a choice. But so right now, the isoquant which they are doing is that the money which they keep as cash, what they make on that, and versus that, if there is a higher ROI on an acquisition, along with strategic benefits, maybe that is the way they are evaluating, and that is the way most of the Indian IT companies are doing. So if you would have seen that a large tech company, one of the largest one, announced data center, and that business, again, the rationale there will also be that, the margins and the ROI in that will be much more superior to the benefits which they are getting by keeping that money in bank. So that is the way now things are happening. That is a mature business cycle, and that remains like that.
Okay, now let's get to the IT view. Sandeep, because you were very bearish on IT through 2024, 2025, and now you've turned extremely bullish on the IT sector. Take us through. What's changed?
So, Rima, the simple change which has happened is that, 1.5 years back, the stocks were at 5-6 times PEG ratio. You take the large cap, you take the mid cap or small cap. That was insane in my view. Now, what has happened? One, the index has corrected 40%, which was in line with my expectation 14-15 months back. And the stocks, some of them have corrected even more than that. So that slashes down your PEG ratio, let's say from 6 times to 3 times. Now add on that, 1.5 year, they have made some money, right? So that if you do that mathematics, they are at 2.25 times PEG ratio. And now with rupee depreciating almost 13% in last 1.5 month, we are talking about 1.2, 1.3 times PEG ratio. So just for your information, the earnings of most of the tech company will at least grow by 15% to 25% depending on the margins of the company only because of rupee depreciation, which I don't think people are taking into account now. So if you are going to get, let's say, a CAGR of next 2 years earnings of even 15, 17%, then the multiple are 13, 15 times. There is no case for being bearish on this. And see, I don't believe that AI will take away the IT services piece and all that. I think there is a 20% reduction in effort spread over 5 years. So you have a 4% deflation annually and you make 5, 6, 7% new business, you are home. And I think we are in that situation. So paying a 1.5, 1.2 times PEG ratio versus 6 times is a very good correction in my view. While stock may look at 50% correction, actually the multiples have corrected, the PEG ratio is corrected by 75, 80%. So it makes a strong case for all the tech companies. I will not name out anyone. Only caution which I will say is that I will not buy still the ER&D companies. I will buy ER&D companies after 6 to 8 quarters of, once that Ukraine and Russia war gets over. After that, 5, 6 quarters later, I will start buying ER&D company, not now. But other than ER&D, whole IT service space, I love the space. Now with the correction, I think that there is a good money to be made. Again, this is not a sector which is structural in nature.
Yeah. Sandeep, hi. Morning. Prashant here. So just to wrap up, so you're saying the last point is important. Sometimes valuations get attractive and then they can remain attractive for a long time. So you kind of sort of buy in and then you wait and hold on and it's dead money for a long time. This is not that case. You're saying there are triggers and these earnings will come through which markets are not anticipating, and hence over the next 1 year, you will make good money. That's what you're saying. So if you have 100 rupees to put in, where would you put it in? I mean, and the thing is, you're not just focused on, you track IT, but you look at everything. So and in markets, opportunity is all relative, right? So IT would be top of the list. So how would you allocate it, Sandeep?
So Prashant, very good question. So let me put it this way. This is a trading sector with a 5, 6% growth for large cap and 8, 9% for mid cap for next 5, 7, 10 years. And you add rupee depreciation benefit, whatever it is. So I think that now is the time when, because of rupee depreciation, suddenly 13, 14% return additional. And last 2 years, there has been no return. So I think broadly 30, 35% kind of return in the sector can be made from here. If it happens in 2 years, it will be 15% annual return. If it happens in 1 year, it is 30% in 1 year. If it happens 6 months, great. So I don't know in what duration it will happen. Generally, I have seen that, mispricing get corrected very, very quickly. So I was almost zero weight in IT in our PMS for last 15, 16 months. I think now the time has come where I will go at least equal weight, whatever is the weight of the index in the of IT in the index, or maybe 1, 2% overweight. That is the way I am looking at it.
Okay. All right. Thank you very much. Good speaking with you, Sandeep, and always useful to talk about the IT space, and of course also about how to approach things. And once this Iran thing fades away, we can maybe we were having all those conversations around AI, and Sandeep is a keen watcher of everything AI and impact on IT software companies and elsewhere. So we'll sort of get him back on more regularly. Thank you. Well, Dharmesh Kant is with us, Head of Research at Chola Securities. Dharmesh, good to have you with us here. Okay, Nanji, you want to take that? Sorry, my mic is...
Okay, all right. Let's get in Dharmesh Kant on the show. Hi, Dharmesh. Good to see you in Monday morning. We've got a lot of quarterly updates that have come in. Avenue Supermarts, that's a stock actually that's seen a fair bit of correction from the top. Valuations had gone through the roof. Now it's cooled off a little bit. And there are signs of green shoots. Are you interested in the stock at these levels?
Yeah, good morning, Nigel. I mean, yeah, incrementally the numbers have come better for Avenue Supermarts, but the valuations are still, if not through the roof, it's near the roof as of now. So I think tactical bounces can still happen. Most of the retailers, even V-Mart Retail, came out with a very good set of numbers. And so there can be some tactical play, setting in, but I don't think it's a structural, again, story in the making. So just on the basis of valuation multiples, we are not comfortable with holding it for a long period of time. Maybe for 10 or 8% kind of a gain, one can enter into as a tactical play. Our own sense is going forward, this entire space will settle down around 15 to 17% kind of growth rate, but that too will come through only when you have a new store addition. Same store sales growth it's hard to get 10-11% kind of a growth on a annualized basis or for a long-term basis. So that's the reason why we have been avoiding this space.
Got that. So Avenue Supermarts is an avoid. Dharmesh, in the banking space, Innocent Bank is a stock that you like. It's work in progress. It's a potential turnaround candidate. But we have a lot of other banking updates that came out. For Chola Securities, is there any banking update that stood out for you, which is now, therefore, the bank is on your watch list?
Yeah, good morning, Rima. I mean, most of the banks came out with a stellar set of updates for Q4. So I mean, advances growth were on an average in line with 14 to 16% kind of an advances growth. Deposit growth incrementally has picked up. I mean, there has been a advancement in the deposit growth. However, different banks have different set of inter deposit growth. The CASA ratio for some banks have not gone that fast as opposed to the time deposit growth. So time deposit are a bit expensive than the CASA ratio. So ideally, the CASA should be better out there. So I mean, we liked Kotak Bank update quite a bit, though advances go to 16.5%. This was again in continuity with Q3, a good set of growth numbers. And the CASA base grew far better than if you compare that with, say, HDFC Bank. So HDFC Bank CASA grew by 12.5%, whereas Kotak reported around 15% kind of a CASA growth, which will help them in getting a better yields. So, but what we are concerned about banks as of now is not Q4 numbers. There would be definitely a good set of numbers, but how the treasury book plays out and how much of that is priced in Q4 numbers, how much they do it, how much goes into Q1 and Q2 FY27, and what's the commentary on the entire credit cost space with regard to MSME and SME segment. So, but that's what will keep a lid to strong price action in banking space. So we are watching it, but fundamentally from a long-term perspective, we are holders in IndusInd Bank, followed by Axis Bank from the private banking space and Bank of India and Bank of Baroda in the public sector banking space.
All right, we have spoken a lot about tech since morning. Dharmesh, how are you positioned over there? We had Conrad Saldana who joined us earlier, and he was saying that maybe in fact risk reward is fairly okay from here on. Even Sandeep, if you heard the conversation Rima was having earlier, he's been negative on the tech pack and he's turning relatively positive. Do you think the worst is in the price? In the last 1 month, by the way, the index has outperformed the Nifty.
Yeah, I mean, everything has a value at a particular price. And I think tactically, tech does look to be a tactical play rather than a strategic play to my mind. I think most of the deal wins which I have noticed, it's more of a replacement kind of a deal win to keep the revenue flow intact. So if you're expecting a degrowth in the revenue going forward, so maybe that gets arrested with tie-ups happening with most of, I mean, all the companies have done AI player tie-ups. So we would be watching very closely about the commentaries. However, I mean, as far as the management commentaries are concerned, they have been, quite stable to bullish kind of scenario. They have been painting, but numbers are not, matching up to the same level. Our own senses, even I heard the conversation, 2.5 peg ratio is expensive for, a sector which is likely to grow mid-single digit, and a lot of, confusion and uncertainty still prevailing as regards to how much margin dilution will AI bring into play. So there's already a third party into play for AI products to be rolled out. So that is our sense on the tech space. So largely we are watching on the sidelines. Tactical play can be Infosys or TCS. One can go long on. However, with one exception of Orion Pro Solutions Limited, which we have an initiative coverage, we are holding on to that company as a buy rating till now.
So Dharmesh, the argument that Sandeep was making is that while the top line growth, maybe say mid-single digits for large cap IT companies, the EPS growth is going to be 15-16% purely on account of the rupee depreciation. And then EPS growth is not getting, adequately captured by consensus expectations. That coupled with the fact that valuations have come down post the correction makes the IT sector attractive for a tactical buy. So the revenue may be muted, but the EPS growth will be quite solid. So would you look to go tactically long on any stock, or it's still not compelling enough, the argument?
Yeah, precisely. I mean, that was my precise point as well. It's a tactical play. And see, we buy a business for the business growth and not for because of some currency tailwind playing out. So but that's the only, problem area or a gray area which needs to be addressed to our mind. And I definitely, I mean, currency tailwind will play out. So for tactical purpose, as I just mentioned, TCS Infosys, one can stick to for tactical purposes. Mid and small cap will give you a better alpha, but it's dangerous. I mean, if something goes wrong, some other, AI development comes through, and the rub-off can be far, severe than the run-up to the stock price. So, I mean, the ideal advice would be to keep your stop losses in place. They are already floating at bottom levels. No new selling is coming in from the fund side or, large groups, which we have noticed. So that's a positive trigger. Tactically, yes, definitely. I mean, one can play it out. Infosys TCS from the large cap space.
Dharmesh, do stay on. We need to slip into a very short break. For this quarter itself, in Q4, the rupee has depreciated by 2.5–3% on an average against the dollar. And point to point, that's 31st March to 31st December closing, the rupee has fallen by nearly 5.5%. So Q4 will also see the benefit of rupee depreciation. Get into a break. On the other side, we'll continue chatting with Dharmesh. We'll also focus on some volume buzzers. We'll connect with Mitesh Thakkar and Sudarshan Sakhani for some technical trading ideas.
Okay, welcome back. We've got the big movers from last Thursday, volume and price-wise. Hormuz is here with that list to refresh our memory. Hormuz, take it away.
Good morning, Prashant. And some underperforming names to start off first. Pine Labs is one such name. It was among the top shares on the delivery front on Thursday. It has declined in 7 out of the last 10 trading sessions over the last 10 sessions. One of the underperformers in Thursday's session as well. And the Friday's volumes, though, were double of Thursday, but continues to remain below what was the daily average over the last few trading sessions. 15 lakh shares were traded. The 20-day average is around 11 lakh shares. The delivery percentage was the highest in the last 2 months. 80% of those shares were marked for delivery. 12 lakh shares for delivery, 20-day average of 5.2 lakh shares. And from its IPO price of 242, the stock has corrected almost 40% from those levels as Pine Labs. Now, LG Electronics has been another underperforming stock over the last 3 sessions. It was the 3rd straight day of losses for the stock. It has declined 15% during this period. The 6th straight day of volumes in a single session being above 10 lakh shares for LG 18 lakh shares were traded, 20-day average of close to 8 lakh shares. 56% of those were marked for delivery. So around 10 lakh shares, the 20-day average on the delivery front is around 4.5 lakh. And the stock is down 23% from its listing price, which was over 1700 rupees, but continues to sustain just above its IPO price, which is close to 1140. And lastly, an outperforming name in the recent past, Page Industries. Now, this was second straight day of gains. 4 out of the last 6 sessions, the stock has done well. Now, up 9% in the last 6 sessions. The volumes on Thursday were the highest in over a month. The volumes are close to 80,000 shares traded, 20-day average of 22,000 shares. The delivery volumes, though, were the lowest in almost close to 2 months. There are only 21,000 shares were marked for delivery, the 20-day average of around 10,500 shares. And the stock from its 52-week high, which is well over 50,000 rupees, is down by a third, almost 33%.
Okay, all right, Harmas, thanks a lot for that. Well, we're still in conversation with Dharmesh Kant. Dharmesh, I recall you making that call, I think, on Hero MotoCorp, if I remember correctly, a few months ago. And then I think you advised booking some profits as well when that stock had moved up. How are you viewing the auto sales numbers, and what's the pick of the pack from there?
Yeah, thank you so much, Nigel, for that. I mean, definitely the auto sales numbers were very stable and a lower set of numbers which came through for Q4. Almost all the companies reported a good set of numbers. Hero MotoCorp stands out again, 20% plus kind of growth numbers, almost 6 lakh units sold put together. So 5 lakh run rate for the year on a monthly basis has been attained by Hero MotoCorp. Price has corrected quite significantly. I think at 18 times on a trailing basis. Price to earnings multiple is quite attractive as compared to, I may say, a Bajaj Auto, which also delivered good set of numbers. But to my mind, the valuations of Bajaj Auto is a tad higher than that of Hero MotoCorp. At the same time, if you look at other numbers like TVS Motor, the numbers are good, but again, the valuations are a bit expensive. Eicher Motors was a muted kind of a number. So the top pecking, in the pecking of the top, buy remains Hero MotoCorp. We are again, recommended it for again structural play in the making into the monsoon season and wedding season going on. So Hero MotoCorp from the two-wheeler space, four-wheeler space, M&M looks pretty attractive. And again, a very good time to re-enter into that company. 23% kind of a run rate is likely to be maintained for going forward on the sales, both farm equipment and the passenger vehicle space, followed by Maruti. So these are the top 3 picks from the entire automobile space. We have again reinitiated buy on all 3 of them.
Okay, Dharmesh, we'll leave it there. Thank you very much for joining us with that. There's 4 minutes to go for the pre-open session to kick off. We'll take a quick commercial break here. We'll come back. We have Nitin Agarwal of Motilal Financial Services to talk about the banking update. By the way, there was a banking update coming in on Yes Bank just 5 minutes back. So, we'll address that along with the other stuff with Nitin. Stay tuned.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. Well, it's that time of the show when we get, our tech analysts back on the show. Midesh Thakkar as well as Sudarshan Zakani join us on the show. Good morning, gentlemen, and good to see you all in. Well, Sudarshan, let me come across to you first. On Thursday morning, you made this bold call. It's time to show guts. Go in there, buy the Nifty, and you'll make some money. Well, congratulations on that call because it didn't seem very, very rational to go and buy the Nifty on Thursday morning, but you made good 500 points if you got the bottom, and if you bought it during the course of the day as well, it was pretty good. What's your call now? We ended with some gains. For this morning, we're like to start off 100 points lower thereabouts. Buy the dip?
Yeah, good morning. Thanks, Nigel. No, it's not buy the dip today. See, we need a large dip to buy. 100 points is not a dip. It's a small correction after that big move. So the buy the dip trade still exists, but we need very big dips like the ones we got, and we'll get it again. When the markets start building a base, there is a lot of uncertainty. In that uncertainty, there are many days when the markets say, okay, I'm going down 200, 300, 400 points. Those are days when we want to show courage. Today, the markets are likely to be choppy. If you still have long positions, take profits and step aside. I don't think there is a very reasonable trade today. Just watch it.
Wait and watch on the Nifty. Mitesh, what would you go with?
Oh, good morning. So I think there is some sign of a sign of market trying to at least find a base. If you look at the Nifty chart for the last about 8-9 days, around this 22,300, 22,200, and while there have been intraday declines below that, the 2-3 hour charts have got multiple closing in this zone. So I think I would watch for this level of 22,250 thereabouts very closely. To me, I think that's becoming a small fulcrum. And as Sudarshan also rightly said, in case we have a big dip, we are closer to about 22,250, which is around, if you're at about 22,400 or thereabouts, you have a 150 point kind of risk. I think that's the time when I would want to start getting into some kind of a long bias positions. I think we have had a good decline. Now, most of the indicators are trying to reverse on the hourly charts from extreme oversold levels. In that reversal, if you get a dip and then, the rebound could be very fast. So the idea is that on the Nifty, I think wait and watch. But if you get a slightly bigger dip, I would also be on the buying side.
By the way, the rupee started 93 compared to 93.10, which was Thursday's close. The big recovery, the 2% recovery, of course, by the end of it was the dollar rupee. The rupee strengthening after additional measures from the Reserve Bank of India came through this morning. The gains are being held, and this is a much stronger and steadier kind of rate up on your screen. Gentlemen, morning. Sudarshan, what would your trades be?
Well, it's Vedant, which is a buy with a stop under 675. Marico is a buy. Actually, other FMCG stocks are also opportunities. I just selected Marico. It's a buy with a stop under 745. Laurus Labs is a buy with a stop under 1025. And Concor is a short with a stop above 445. But apart from avoiding the Nifty, it may be worthwhile looking at stocks individually.
Okay. And Mitesh, what about you?
I have a buy on Kalyan Jewellers. I think, it's one stock which did not make a fresh low in the last 7 days as Nifty did, and is on the verge of a reversal. The first pivot is around 396, 397, and the stock closed at 394. So buy about 397, keep a stop at 389 for targets of 411 to 415. Then I also have a buy on Aurobindo Pharma with a stop at about 1309 for targets of 1380. Sell on Biocon if you get the stock around 356, 357. Sell with a stop at 363 half. Look at targets of 340. And the final buy call is Cochin Shipyard. Buy with a stop at 1286 for targets of 1365.
I'm glad you mentioned Oro and maybe Pharma as a pack, because I think that clarification, if we can have the Pharma index, Oro, of course, saw that big recovery from the day's low, but I think so did more stocks because the market recovered as a whole. But Oro, Cipla, Lupin, Sun maybe to a lesser degree, but I mean other names as well. Maybe the news was, the fear rather was that tariffs from the US on pharma, right, on patented products, whether it'll have an impact on Indian companies, etc. And that clarity started to come through early on in the morning. Well, this was not about generics and Indian and mostly Indian exports to the US are largely generic. This is for patented drugs. And there are lots of exemptions. So we'll see if this shows up. Aurobindo, of course, also has a buyback, which they have announced, and the details of which we were carrying a little earlier. So,
800 crore buyback is what Aurobindo has approved at a price of 1475. So that's the two important details. 800 crore and 1475 is the price.
All right. Well, I think more on this with that buyback discussion coming up a little later. But Sudarshan and Mitesh, thank you very much, both of you, for joining us with that. With those specific trades right now. Well, let's just go back to banking and let's quickly revisit the top numbers that you need to pay attention to. This is the updates for the quarter which came through. Ritu is here with a quick run through. Ritu, take it away.
Well, Prashant, it's a seasonally strong quarter, typically fourth quarter. But that said, the loan growth has actually been above estimates for most banks. And even deposits growth is not too poor. There are a few misses here and there. But at a system level, it seems growth is holding up. LDR, of course, remains elevated, because credit growth is still outpacing deposit growth. Now, within private banks, HDFC Bank stands out. Clear green signal, business growth has beaten expectations. Advances are up 12% year on year and about 4% quarter on quarter. But keep in mind, this is a tad lower than the system level growth that we're seeing. And as per RBI's latest data, the system level loan growth is about 14%. So it's a bit below that. The deposit growth is also quite strong, more than 14% year on year, which is higher than the system. And most importantly, the credit deposit ratio for HDFC Bank has cooled off to 95%. So the street will take that positively. For Axis Bank, for instance, there is solid momentum as well. Loan growth of more than 18% year on year, 6% quarter on quarter, well above the system average. Deposits growing by nearly 14% year on year, and a steady improvement in CASA. The CD ratio at just over 93%. Kotak Mahindra Bank, loan and deposit growth, net advances growth of about 16%, deposit growth of nearly 15% year on year, CASA growth healthy on a sequential basis as well. So overall, it's looking good for the banks with a few exceptions here and there, like IndusInd Bank, for instance, which has seen a degrowth in the quarter.
Thank you very much for that, Ritu. And looks like some of these banks may support the markets today. So that GIFT Nifty was suggesting a downtick of 100 points at the start, then it came down to 90 points, then 50. But in the pre-open, it's absolutely flat, but with the positive buys. The Nifty is up 65 points. Sensex seems to have settled with a gain of 160 odd points. Nitin Agarwal, Senior Group Vice President and Head of BFSI Institutional Equities and Motilal Oswal Financial Services, is now joining in. Nitin, great to have you on the show today. Let's begin with your opening thoughts on the Q4 update. And then tell us 2-3 banking stocks that stand out on the positive side and negative side.
Yeah, hi, thanks for having me. So several updates have come on the bank side, and most of them are on the positive side, and many of them have gone on to beat our estimate for the quarter. While we definitely had an idea already that the loan growth will likely be strong as reflected in the system numbers from the RBI, but many banks have gone on to report a high single-digit loan growth on a sequential basis this quarter. And within that, even the larger banks, if you look at the HDFC Bank reporting a pretty stellar kind of a deposit growth, and even Axis, which reported, again, it has been doing well as given that their guidance to beat the system growth by 3% over a 3-year basis. But the bank has done quite well over this year, and therefore it's pretty much on the right track. And amongst mid-sized banks, RBL clearly stands out with a double-digit growth that they've reported on the business front, and kind of a precursor to how the growth numbers can change once the deal concludes. And the other bank that stands out clearly is AU Bank, which has also reported a very strong business growth both on advances and deposit side.
Okay, so RBL and AU Small Finance Bank on the mid-cap banking side. Any misses?
I will say that IndusInd, which has been reporting a slight decline quarter to quarter, that trend has continued, and probably it's in the last leg of that, as the focus remains on cleaning up the balance sheet and improving the net NPA ratios. And hopefully things will start to turn the corner from FY27, but this quarter there is again a marginal decline that the bank has reported. So it's more like a flattish, I will say. And the other is like IDFC, wherein the Q on Q with the deposits have been broadly flat, given the recent developments.
Yeah. Nitin, good morning, Prashant here. We had Jairam of Piramal with us on Thursday, and he was basically making the point that, when there is a shock, it's not as if people immediately stop paying, right? That comes a little later. And he said this will, whatever is happening, and we don't know how long this will last, and that's the critical question, how long this will last. The longer it lasts, I mean, I guess there is more pain across the board. But he said, well, expect all of this to show up in the second quarter. He said July, August is when he would expect, some spike in NPAs in those segments. He said it's small. It's not very large at this point. These are smaller segments, MSMEs, etc. Any thoughts on this, Nitin?
No, I agree to that point. And while going into the preview, we have just cut numbers by around 2% for PSU banks and marginally 1% for private banks. And that is a reflection on how the bond yields have gone up, how the deposit rates have not been able to come down to the extent that one was looking at 3 months back. And now the wholesale deposit rate, the CD rates, they've all gone up quite considerably. So all of that will have a bearing on the margin expansion that you were earlier looking forward to. So which is where we have toned down our numbers, but we have mentioned that the risk to the earnings is more on the downside. Going into Q4, most banks have indicated a pretty steady asset quality, and our numbers therefore reflect continued strength on that front. But yes, if this crisis, the geopolitical situation which is going on, remains like this for another month or so, then yes, there is a implication that it will have on both the loan growth and the asset quality. And you will see cut, yes.
Yeah, he also said that the first 10 weeks, and we've heard this from others as well, he said, he said, we don't know what changed, but the first 10 weeks of this year were incredibly strong in terms of loan growth and disbursements, etc. And then, of course, I mean, this entire thing only started about a month ago, late February, right? 27th, 28th of February. So, I mean, even you think this credit cycle was looking like it was starting to pick up. That gets punctured a little bit, Nitin?
That's a possibility, yes. So far, for this year, we are looking at a 13.5 to maybe range bound to 14% kind of credit growth for this year. And our estimate is that the growth will sustain at 14% CAGR over the next 2 years. But if we see this scenario playing out with the resultant impact of elevated crude prices, some problems around the supply of the gas availability, and businesses seeing some interruptions, there will be an impact on the overall system growth, because this pickup in credit growth so far is pretty broad-based. It's just not any one segment driving it. It's like the retail, industry, services, all the segments are going at a healthy run rate and then seeing some pull-up. And so there will be some moderation, and the overall GDP growth also may see some cuts if the scenario goes on for another month or so. So there is a risk that we see clearly that is there on the downside.
Nitin, do you look at Bajaj Finance? The AUM growth at 22% is in line with their guidance for the full year. But deposits are down 4%, so clearly facing some pressure on deposit mobilization.
I think deposits has been a challenging area, not for the entire system, I will say. And most banks are finding it difficult to raise deposits given how the overall credit momentum has been. And Bajaj Finance, in particular, I think might have deprioritized raising that much of deposits, because the yields, the deposit rates have hardened quite significantly. The wholesale deposit rates, the CD rates have gone up very sharply in the last few months, and there is a possibility that the company might have deprioritized raising deposits, especially in this quarter.
Have you had a chat with some of these smaller banks or NBFCs on account of the stress that's building up in the MSME sector? It may not be pronounced in the Q4 numbers, but it will show up at some point. Credit costs, maybe banks are turning cautious on lending to MSMEs. What has been your takeaway, the feedback on this issue?
I think investors are watching out the composition of SMEs across lenders, and therefore to make a sense as to where the vulnerability is more. We have historically seen that in any macro shock, SME, MSME are the segments which get interrupted firstly, and they have limited resilience to showcase. And which is where there might be asset quality implications if this crisis goes on. But for now, till maybe where we are till now, it is still manageable. It may have an impact on your profitability or the revenues, but not as much on the asset quality side. But if this goes on for another few weeks, I think then this will have a bearing on both the loan growth and asset quality. That's what most lenders have indicated to us also.
Okay, all right, Nitin, a good chat. Thank you very much, and hope you come back after the numbers in the fourth quarter as far as BFSI is concerned. Well, 9:10 calls. It's actually 9:13. 2 minutes to market open. Sudarshan, what do you have?
Marico, buy Marico with a stop under 745.
Okay, Marico, and Sudarshan doesn't likes Marico, but he likes other FMCG as well. But that's a call. Marico from Sudarshan. Mitesh, what about you?
Yeah. I'll go with the buy on Kalyan Jewelers.
Kalyan Jewelers, got it. Well, let's just quickly run through Aurobindo. There's that buyback which has been approved. Ekta is here with the details. Ekta.
Thanks for that. Well, yes, Aurobindo has approved a buyback. It is up to 800 crores. The buyback price is 1,475 odd rupees and will be via a tender offer. The record date is 17th April. They will begin the buyback on the 22nd of April and they expect to complete it by month end. Remember that Aurobindo had completed a buyback worth around 600 crores around 2 years ago. And separately, the company has around 200 million plus dollars in terms of cash on books. Now, the Lanet acquisition, which is basically something that the street is watching out for, which is in the US, is expected to be completed in the next 2 weeks. So the street will be watching out for that trigger in particular.
All right. Let's just run through market open, Ekta. Thank you very much for that. Oro stock will come up as well. The Nifty is starting absolutely flat. It's about 10.5 point change, 22,700. The Sensex is coming up as well. It's kind of flattish as well, blinking red and green. Small cap index is flat. Mid cap index will come up on your screens in just a bit. So 1,140 stocks are higher, 760 stocks are lower. We are, I mean, in a way, in no man's land, neither here nor there. But of course, from the lows on Thursday, we were able to sort of latch on and hold on to those gains. Trend, Wipro, Power Grid, that's the Nifty heat map, are the top three gainers. Kotak, Sun, and Adani are the top three losers at this point in time. So, I mean, it's a, disinterested kind of open, 10 point, 11 point, sideways kind of start. But I guess there'll be more action as far as single stocks go with all those fourth quarter updates from companies coming through. Rima.
Well, Trend is your top gainer, so that straight away opened up with a gain of about 3% after the company reported a 20% jump in their Q4 revenues as per the business update. So that's driving the stock higher. Other consumption names like Avenue Supermarts, again, the business update with a 19% top line growth was better than expectation, higher than their run rate over the last couple of quarters. So stock has opened up in the green. Wipro is reacting positively to the deal with Olam, a $1 billion deal. And for which the company will be acquiring Mindsprint for $375 million. So Wipro has secured its top line, and that's helping the company, the stock, move up by nearly 2%. But generally, there is green on the screen when it comes to IT. So Infosys, TCS, HCL Tech also up between 0.5% to 1%. Tech Mahindra is quickly moving up to the leaderboard chart. Power Grid is another stock that deserves mention. That's opened up strong. Aurobindo Pharma, Ekta was just talking about the buyback, 800 crore update. The stock has opened up mildly in the green. Bajaj Auto, where the March sales growth has come in at 20%. That looks good. So that's helping the stock open up in the green. But on the flip side, Tata Motors passenger vehicle has been impacted this year on account of the war, the China issues, the cybersecurity, etc. Tata Motors passenger vehicle stock has opened up in the red. On the way down, you've got Interglobe Aviation weak in trade, Kotak Mahindra Bank, where the business update was lower than expectations. Tata Steel, Sun Pharma, Eternal, Ciplas, Dr. Reddy's. Actually, quite a few pharma names are on the back foot today.
Well, that's right, Rima. A few stocks that deserve special mention. You have Senco Gold. The quarter 4 update came in there. Revenue growth of around 46%. Same-store sales growth at around 34%. That stock is bursting away in trade, up close to around 7%. So good green out there. Another stock that's reacting positively is Vikran. Vikran, I think they had an order win that they had announced. So I think the street likes that. That stock as well has opened up well in the green in today's trading session. You have GR Infra, that's the other stock. Vikran Engineering, they have received an LOA of around 530 crores from MSE DCL for power distribution work. GR Infra, they have signed an EPC agreement worth around 1,900 crores with the Central Railway. So that stock as well up and about. We're down close to around 100 points on the Nifty. Individual stocks doing a thing of their own. For the time being, the number of stocks declining are in the ratio of 2 stocks declining for every 1 stock that's advancing.
The top loser, Nigel, is Chennai. The biggest volume-led loser is Chennai Petro at about 990. So, there are news articles this morning saying that oil companies are capping refinery payouts to refineries because Input prices have surged. Refinery spreads are very, very high. I mean, and so on and so forth. We've seen action there with regards to limited price pass-through for things like jet fuel, ATF, etc. So refineries are under pressure. You know, defense all went up sharply last week. Garden Reach and Mazgaon are lower. Indigo is down about 2%, so 41.12 or so. Loris is down 2. Hyundai is down 3. Indusin is down 1.75%. Cochin Shipyard. So yeah, I mean, some of these shipbuilders, which all went up like rockets last week. BDL is another one. So defense generally taking a bit of a step back. Voltas has had it tough. 2.33% lower on Voltas, 1,200 or so. Blue Star is down another 2%. But I think Blue Star was down last week as well, by about 5-6%. Glenmark is another one which is down about 2% or so. 2:1 down, what is down to what is up at this stage. Well, Amish Shah is with us, Head of India Research at BofA Global Research. Amish, great to have you back in the program. Thanks very much for joining us. Appreciate it. Prashant this side. So lay it out for us in terms of how you've changed your earnings estimates, Amish. And that seems to be a moving target with all the headlines which seem to be constantly moving around. And then what is the view on markets themselves, Amish?
Sure. Morning, Prashant. So look, I think from an earnings perspective, stagflation risks are now real. If I look at the macro, we are already forecasting that the GDP growth will come down from 7.4 that we were estimating earlier to 6.5. Similarly, fiscal deficit is going to go up, inflation is going to go up. We are already forecasting for a 50 basis points interest rate hike this fiscal. Similarly, on the commodity side, we are now working with $92.5 per barrel of crude for the year as a whole on an average, $100 for the remainder of this year. So when we incorporate all of these things in, we do think that there is one more round of earnings cuts that we had to incorporate. So the conflict started in the end of February. On the 2nd of March itself, we had brought down our earnings growth from 14 earlier to 11, and now we are taking it down from 11 to 8.5.
Okay. And where are the biggest earnings downgrades coming through? From 14 to 11 and now from 11 to 8.5%?
So, Rima, most impact is for rate sensitives because if we are pricing in for 50 basis points of interest rate hikes, then NBFCs, real estate, REITs, passenger vehicles, everything that's rate sensitives gets impacted. And obviously, if you're working with a higher crude, then downstream energy and the consumers of crude and crude products, those are the ones that get impacted the most.
Yeah, got that. By the way, how much of all of this, Amish, is on that assumption, that basic assumption that oil stays at 100 for the rest of the year, Amish? I mean, say, for example, if oil were to come off, say it's not 100, but say, whatever, 80. Will everything change? All these assumptions change dramatically?
Absolutely, Prashant. Because crude, as we know, feeds into fiscal deficit, current account deficit. As a result, has an impact on growth, inflation, rates, all sorts of assumptions. So if the crude indeed were to come down lower, we would look to, there would be a reason to upgrade our numbers. But as of now, we do think that even if the conflict ends, given the damage to the energy infrastructure already, crude will stay higher for longer. That's our base case commodities view right now.
So give us the market view then. Amish, where are we? Are we in a bit of a no man's land with all of this?
So Prashant, I would say that what we also did is look at the last 15 years. Indian markets have seen a total of 6 crises over the last 15 years. Iran conflict that we are going through right now is the 7th such crisis. So by crisis, I mean that any event in the world that has impacted Indian markets, so it was Eurozone crisis in 2011, 2012, then you had taper tantrum, then you had demonetization, Russia, Ukraine, Liberation Day, so on and so forth. What we learned is quite interesting, that when the crisis is ongoing, Nifty typically trades between long-term average and -1 standard deviation. That's the valuation band that it goes to. And once the crisis is over, it shoots higher than the long-term average. Now, currently on our numbers, which as we just discussed is much lower than Street is at 15, we are at 8.5. On our numbers, Nifty is already at long-term average. So we are on the higher end of the band during the crisis period valuations. And if these valuations sustain, we do think that there is a 15% upside to the markets from current levels. But in the bear case, if the valuations do go to the lower end of the band, which is -1 standard deviation, then we could potentially see a 8% downside. So even if we work with a -8 plus 15, we think that the risk reward is now favorable. So our tilt for the market is now more optimistic rather than looking at the bear case side. Having said that, even with the 15% upside, Nifty would end the year with 26,200, which is our year-end target, which is a flat market for the whole year. And therefore, we believe that India will continue to underperform the emerging markets this year.
Okay. Got that. So now, simple question, Amish. For investors sitting on cash, what is the advice? Invest right now, and
the advice is that they should. I would argue, to my point, that these are attractive levels. One should start deploying. You may not want to deploy all because clearly till the time the conflict goes on, there could be a bear case, there could be a worst case. What if there is an actual further impact to the energy infrastructure? So those are events that we cannot predict as of now. But clearly, these are attractive levels. There are pockets, so the other thing that we are arguing is that we cannot yet comment that India is deep value, but India's valuations is now definitely reasonable. So at reasonable valuations, if you're okay to take some downside risk, and if you're genuinely in for 1 year, 3 year long-term kind of investments, I think it is time to start deploying.
All right. Hi, Amish. But if I got that correct, you're saying India continues to underperform the emerging markets, right?
That's right, Nigel. Because from current levels, we are talking about a 15% upside. But 15%, or in other words, markets like China, Korea, Taiwan would probably do better than 15. And 15, remember, is a rupee return. Adjusted for the rupee depreciation, we do believe that the other markets would outperform India.
Okay, got that. Got that. In fact, if I look at the underperformance from India and we plot it in dollar terms, India is at the cheapest levels or at the same level that you saw in absolute terms in 2021, what we saw because of the kind of depreciation we have seen in the rupee. That said, there'll be a few top sectors that you continue to like, right? If you could name the top 2 themes that will outperform from here on.
So I think, the interest rate sensitives play both sides. So the ones that are beneficiary of the rate hikes, which is, banks or the large private banks as well as the PSU banks, we think they benefit. But obviously, the ones which are at the receiving end of the interest rate hikes, like NBFCs, mid-sized private banks, passenger vehicles, real estate, all of that are going to get impacted. So that's one theme. The second, we are of the view that governments will have no choice but to focus on energy security. And from an energy security perspective, the entire power value chain basket, which includes transformers, cables, power generators, coal, so on and so forth, even power financiers. So all of that we think is going to benefit. Biofuels is another energy security that we can work on, and that I think will benefit. So those two. And outside of that, we always were of the view that the well-off Indian consumption basket is going to outperform the mass consumption basket. So that as a theme stays. And then finally, within CAPEX, broadly we are bearish. There are only some pockets of opportunities within CAPEX like defense, shipbuilding, power that we spoke about. So minus some pockets of CAPEX, we are by and large bearish on CAPEX as well.
Yeah, Amish got that. And we'll put those sectors up out for our viewers as well in terms of sectoral views. Just wanted to get a sense from you on what the feedback from foreign investors is really, Amish. Both on equity and the rupee has seen so much action, right? The RBI coming in heavy with measures, actually measured and then another measure to make sure it works. The first measure was worked foolproof and it did on Thursday. So just your thoughts on both.
So Prashant, I guess, at the start of this year, when AI was the main theme, clearly most investors, foreign investors that we spoke to, wanted to play more Korea, Taiwan, which is a direct play on AI from a memory and a chip perspective. India was not so much on radar. And obviously the common complaint was India's valuations are too expensive. So if I can get a Korean market at 7 times PE multiple, gives me 100+% earnings growth. If I get Taiwan at 18 PE multiple, gives me 35% growth. Then why should I bother about India with a 14% growth and a 20+ PE multiple? So that was a debate. Since that time, I would say, as we know, Indian valuations have got much reasonable. So India is now starting to come up in discussions. Most investors are again warming up to India. They are trying to look at subsectors and themes and sectors which have become value. So I think interest on India is coming back, but it's not as if that they are giving up on Taiwan, Korea, China completely. So I think now India is in the mix versus being out of the mix is the way I would think about it.
And the rupee thing, Amish, any feedback?
So rupee, large part of the depreciation has already happened. Again, obviously, unless there is a massive impact on the energy infrastructure because of the war, most believe that a large part of the rupee depreciation story is now coming to an end, especially with RBI being so proactive. So rupee was a concern that if I, to my point, if I make a 15% return, but if rupee depreciates by 5, then I've only made 10% that I take back home. So with rupee depreciation story mostly coming to an end, there is some comfort on that side as well to look at India favorably.
And that $100 oil was what India, your assumption, what India will pay to buy oil for the rest of the year, right?
No, so this is the global commodity forecast, meaning as we all know, India pays a bit of a premium for the kind of crude that we purchase. But then given that Russian crude is allowed again, some part of that premium gets offset with the Russian discount as well.
Yeah. So, and the rupee, you're saying that if it stays at 100 and we pay whatever, I mean, last week, we spoke with, I think it was an oil company, said our cost right now is about $115, $120. So say 100 to 115 or so. I mean, you're saying if it stays here, and that's the largest variable, the rupee, we've seen the worst for the dollar rupee, according to you, Amish?
Yeah, so our house view, meaning I'm not an expert on rupee, Prashant, as you know, but our house view or our forex analyst view is that rupee will end at 93 by the end of this year, which is broadly where we are today. So that's why I was making a comment that large part of the rupee depreciation problem seems behind us.
Okay. Amish, just a quick couple of questions on your calls on individual sectors. Given the rupee depreciation, is IT looking attractive to you now? Tactically, what is the call?
Rima, till the time the conflict goes on, I think IT is a great hedge, and that is a good sector. If I'm a foreign investor, I would want to hide in, because even if one believes that there is a disruption coming, disruption is not coming in the next quarter. It is coming over a period of time. But in the near term, obviously because of rupee depreciation, earnings growth has more visibility, and earnings growth will get upgraded for IT. So I think IT outperforms till the time the conflict goes on. But as a house, we are of the view that the disruption of AI is for real. First, there will be a growth impact because of AI disruption, and the benefits of AI-led growth will come with a lag. So IT, by and large, we are underweight, even on a bottom-up stock basis. Obviously, there are a couple of stocks on a bottom-up basis that we like within IT. But broadly, within from a strategy perspective.
Got it. So structurally, you're still underweight on IT, but it will do well. It'll be resilient, good hedge till the conflict is ongoing. And you were, when we last spoke in November, you were overweight on rate sensitives. And now you're saying rate sensitives like banks, autos, etc. will see the biggest earnings downgrades as the RBI looks to hike rates. So what is the call now on rate sensitives, and where do you see a valuation disconnect now?
You're absolutely right, Rima. So back in November, the view was that large part of the fiscal stimulus that the government could give in terms of direct tax cuts and GST cuts was already given. We did not see scope for growth stimulus coming from fiscal. We did think that there is plenty of stimulus that can come from monetary, and therefore our view was that there will be more rate cuts. However, because of the Iran conflict, clearly there is inflation. Inflation is now a real issue. And on the back of inflation, we do think that there could be 50 basis points of rate hikes now. And therefore, we have switched our call to being bearish on rate sensitive versus what we were in November last year.
Okay, bearish and rate sensitive versus being overweight towards the end of last year. So that's a dramatic cut in the view. Even on banks where there is valuation comfort? All right.
So banks actually, Rima, benefits from a rate hike, as you would agree, because NIMs expand. So we are positive on the private banks and the SOE banks that actually benefit. But we are negative on the mid-sized banks, which have a higher exposure to MSMEs, MFI, etc., which could be problematic as the rates go up, and NBFCs where NIMs compress because of rate hikes. So NBFCs, mid-sized banks, insurance, housing finance is all in our bearish camp or cautious camp, and the PSU banks and the large private banks is what we prefer.
Amish, great conversation. Thank you very much for joining in. That's the call coming in on BofA, lowest on the street when it comes to earnings expectations for FY27 at 8.5%. Let's talk about Pharma, 100% tariff on branded Pharma. Ekta joins in with more. Ekta.
Thanks for that. Well, yes, it was definitely a busy weekend when it came to the entire pharmaceutical space. So the US government has announced a couple of announcements with regards to pharma. So the first is that the US government has announced a 100% tariff on imports of branded pharma as well as its ingredients. It is applicable where companies have not entered into a prior agreement with the US government. The branded imports from countries such as Japan, Europe, Korea, Switzerland, etc. are subject to around a 15% tariff only. So it's lesser than that 100% tariff. Secondly, generics, associated ingredients for generics and biosimilars are exempt from tariffs as of now, but they will be reassessed in 1 year. Now, the impact for the first, which is the 100% tariff on branded pharmaceuticals, for Sun Pharma, it is expected to be an impact. But remember that significant portion of Sun's manufacturing of branded generics could possibly fall under the exempt jurisdiction. So, for example, a couple of drugs such as Zelpros as well as Sezaby are manufactured in India, so those could be impacted. But overall, the other ones are manufactured in exempt jurisdictions. So the estimated impact could be around 1 to 2% of revenue for Sun due to the branded tariff situation. Now CDMOs, Divi's, Loris, Syngene, OneSource, minimal implications for Indian CDMOs because the tariff burden is absorbed by the innovator companies. And lastly, generics such as Cipla, Lupin, Dr. Reddy's, Glenmark, Biocon, as well as Sun Pharma, the overhang continues because the US government will be reassessing tariffs in a year's time.
All right, thank you very much for that. Let's move on and invite the management of Supreme Industries on the show now. The government on 2nd of April said that they're granting full customs duty exemption on critical petroleum products. This is on account of the conflict in West Asia, but this is a temporary measure. It's going to be in place only for 3 months. MP Taparia, MD of Supreme Industries, is now joining us on the show. Thank you very much, sir, for joining in. This is Rima here. Can you tell us how this news directly benefits Supreme Industries? Which are the products that you use, which are now exempt from this import duty?
I can talk about the general Indian plastic industry. The import duty reduction is for the critical plastic raw material required for packaging, agriculture, healthcare, housing, and infrastructure. And the polymer prices last month of March, after the 20th February attack, has gone up more than around 50% of the commodity polymer international price. So as they are very critical raw material, the government in their wiseness have given a relief for 3 months of making import duty zero on all plastic imports. How it affects our company, that we will talk when we adopt the account, our annual account in the month of April.
So I understand you'll give, you'll explain to us in greater detail once the numbers are out in a month or so. But can you give a broad indication of the kind of benefit? And after this has been passed, have we seen a reduction in polymer prices?
Broadly, it will benefit element in our plastic industry and we are also part of plastic industry. So we will also benefit because the country has to import plastic raw material. Unfortunately, for this critical material, country is short. 20 to 22% of polyethylene and polypropylene required from imports, and in PVC, 68% required from imports. So import duty reduction for 3-month period is to just give some relief from the international price increase. The problem continues that Gulf market is very much affected, and so they are not able to export anything to the world market.
All right. Hi, Mr. Taparia. Good morning. Good to see you in. So prior to this notification, what was the import duty you were paying on some of these raw materials?
On all the raw materials, the duty was 8.25%.
8.25%.
Okay.
Is that correct, sir?
That has been made zero.
All right. Got that. A couple of other questions, sir. As you have been saying that the prices have moved up, but you as well would have been taking some price increases, right? So what is the quantum of the total price increase you have taken on the selling product in the last quarter?
That we will discuss when we adopt the accounts.
For the industry, sir, for the industry on the whole.
Now, overall, anyway, the country has to increase the product prices. But on my company, I will discuss only in the last week of April.
Okay. Can you give a broad indication, sir, how Q4 has been for you in terms of volumes, in terms of margins?
We are talking more about Supreme Industries. What
Yes.
I can tell you.
Okay. All right. So we'll...
Reduction in import duty gives relief for the cost of raw material. No?
Agree, sir. Agree, sir. But you're unable to share the quantum of relief right now, for your company at least.
Now, my company, I can talk only last week April.
Okay, all right. So one more quick point. You know, in the past quarter, that there has been that removal of China's VAT export rebate on PVC. Many believe that this is a structural positive for the domestic industry here in India. How do you read this?
Well, yeah, PVC is a very critical situation. The country is too much dependent on imports. Country requires today 68%, 70% imports.
Okay.
PVC is very vital raw material, but India's own production is very small. We are all dependent quite a lot on imported product.
Yeah. Mr. Taparia, and so for PVC, good morning, sir. Compared to 1 month ago, how much are imports down by? Are they down?
No, I can say the PVC price here internationally gone up by 48% in the last 1 month.
48%?
Yes.
Right. And availability is not an issue at all?
Availability not at all issue because you are able to import. China is a big supplier to Indian market.
Yeah. There was an import duty which was imposed as well, right, sir, for PVC?
Sorry?
Was there an import duty which was imposed as well for PVC sometime back?
Import duty 8.25% all plastic raw material.
Okay, that's the standard. So my question was, across the petrochemical value chain, and this is not a question about Supreme, but we are constantly hearing of disruption across that value chain in producing countries. China, of course, has been, in a way, insulated so far. And they're a large producer of most of these things. But is there any disruption in the value chain, sir, for things that Indian industry imports? And where is that the most severe, if it is so?
Disruption is mostly on the import coming from Gulf countries and from Far East Asia and Southeast Asia. They were also dependent for their feedstock, so their production has been very much affected. But China is a big producer, not based on crude oil. They make a lot of polymer based on carbide, that is from coal base. So China is not affected in PVC and polypropylene because they make quite a large volume from carbide, which is coal-based feedstock.
Wow. So
but other countries are very much affected.
Yeah. No, point taken, sir. We'll leave it there. Thank you very much for joining us, Mr. Taparia. It's always a pleasure, and appreciate your time here on CNBC TV 18. As always, we'll take a quick commercial break here. That's the color on what's happening right now. And you know, that's something we've heard from others as well. In the midst of all of it, you know, China kind of sort of, in a way, emerging as a bit of a anchor for stability with regards to supply, because they've got so much excess capacity across a range of things. So, you know, they're able to sort of supply markets here in India, in other affected markets as well. And maybe their share in each of these industries perhaps also higher compared to about a month ago. We'll take a break here. We are going to come back and we will focus on that other big story which came through, which is the reintroduction of open market buybacks. I mean, the industry has welcomed it, market participants have welcomed it. Pranav Satya of BofA India and Bhavesh Shah of Equirus Capital with us in just a bit.
Welcome back. You know, a couple of stocks that Prashant had pointed out as well earlier were CPCL that's under some pressure because OMCs are likely to pay discounted rates to refiners. Sonal joins us to run us through that data point. Sonal?
Thank you so much for that. Well, it is an important update which is coming by. It is a deregulation of sorts which OMCs are implementing for whatever fuel they buy from refiners. It is first of a deregulation that we are seeing since the time these prices were regulated. Fuel will be sold below cost to protect consumers from price spike. This is something that we've seen already. There's been an excise cut, but now all marketing companies will be buying petrol and diesel or other fuels from refiners at a discounted price. And the discount go to as much as 60 rupees a litre on fuels, and that means that would be a big margin pressure for standalone refiners, the likes of MRPL, Chennai Petro, all of them, because they're standalone refiners. Their gross refining margins will be hit because of the discount that they're giving to all marketing companies, because they're already taking a big cut in terms of marketing margins. And that is the reason these stocks are under pressure, and they will be in focus because it is largely an impact on private refiners, which are taking a hit as far as their selling price is concerned.
Yeah, so Sonal, and this is like an official notification which has come, or this is kind of sort of happening now?
It is. There is no official notification for this. Usually you don't see notifications for pricing cuts unless they are coming from the government. So this is decided internally by all marketing companies, and this is a PTI story, a report which suggests that this has been happening, and it floated back in February last week when the war started as well. But now they have given numbers of a 60 rupee discount that has come by, but no, there is no official order that has come for this.
Yeah, I mean, it kind of, it was to be understood in that sense, right? Because jet fuel prices, for example, the hike was capped, although the actual cost had gone up quite a bit more. So somebody has to take that knock, and that somebody, right, for now seems to be refineries and refiners.
That is correct. That is correct. It will be, and mostly because standalone refiners only had refining segment with them, right? Yeah. For all marketing companies, they have two segments. So it's largely on those standalone refiners like MRPL and Chennai Petro.
Yeah, yeah. Okay, all right. Sonal, thanks very much for that. So that's an important story, which we continue to track. And I think it's an unusual situation, and there are some unusual measures which, of course, are being put into place. I mean, the basic aim seems to be to prevent the complete pass-through of everything, all these price increases to the end consumer. So somewhere up someone up in the value chain, the government or the PSUs, or will have to take the hit, and we'll see how it continues to get distributed over a period of time. Well, there are some big shifts in the capital market regulation. SEBI is considering revival of open market buybacks, and I think that news was received very, very positively. Pranav Satya is partner and national leader, International Tax and Transaction Services at BofA India, and Bhavesh Shah is managing director and head of investment banking at Equirus Capital. Gentlemen, great having both of you here. Appreciate your time. Bhavesh, I can ask you to comment on this first. As I said, news was received with, if I can say, loud cheering. Otherwise kind of dull environment all around. What's your sense, Bhavesh? How consequential can this be?
Hey, good morning, Prashant, and thanks for having me here. I think, as you rightly said, this is a very positive move, and I think the timing of this is also immaculate. It aligns with a lot of stars because, one, of course, there was a good amount of change which was done on the tax side of which, and then even the market conditions, given the volatility in the market right now, this provides one, way where companies can actually use their surplus cash to not only efficiently buy shares, but also at a good price, and which effectively, creates a good amount of, increase in the EPS and the long-term value creation for the companies. This is, it's globally accepted method of buying shares on the open market, which India was kind of, getting deprived of because of various tax regime, the way the buybacks was done. I think the government has taken, including the finance ministry, including the SEBI, they have taken very proactive measures to kind of get this implemented. So I think, kudos to the governing bodies to get this thing done. I think now it is for the companies to kind of take advantage of it, and even from a retail investor, this is a great. Earlier it used to be a panic selling which used to happen in the market. Now there's someone in the market out there to kind of really, I would say, buy the shares at good price. So this is a really win-win from both company standpoint as well as the investor standpoint.
Pranav, sort of first thoughts from you, and just in terms of how this will give the shape of how this will work. Do we go back to how it was before this was disallowed in the same shape and form?
So my sense is that SEBI is talking of having good checks and balances and safeguards. So we will have many of the safeguards that they have put in place when they put in place the glide path, so to say, back in motion. But I think overall what it does is it enhances liquidity. It ensures that so far as companies are concerned, they are able to absorb the selling pressure which might unreasonably come through at certain points in time, maybe as at the present. So it's something that is internationally well accepted, open market buybacks. And in India, it was possible till 23. Thereafter, there was a glide path, and it was completely discontinued from April 25. I think the key is that the taxation regime has changed quite a bit. And that was the major reason for SEBI trying to, so to say, have a glide path and then completely discontinue open market buybacks. And that was because it was very difficult to identify the shareholders who had sold shares which were bought back by the company. And in such cases, the taxation regime provided that the shareholder will be exempt from capital gains tax and the company will pay a buyback tax. That regime continued till September 2024, after which we had the dividend taxation regime. The challenge with the buyback regime when it existed was that while shareholders who tendered shares or sold shares on the open market and were bought back by the company were capital gain exempt, the other shareholders whose shares were bought by not the company but other buyers in the market were subject to capital gains tax. So it resulted in some form of inequity. And that's where this whole thing was discontinued by SEBI as not being equal and fair for all the shareholders. So I think now there is a clear regime where shareholders, other than promoters, are subject to a long-term or short-term capital gains tax, as the case may be, as per the normal capital gains tax regime, irrespective of whether the shares are bought back by a market participant or by the company itself as part of the buyback process. So therefore, this new tax regime certainly facilitates it. My sense is promoters, persons in control, like in the earlier regime, will not be allowed to tender shares in the buyback process under the new regime. The exact rules have yet to come. This is more for public comments that SEBI has released these particular guidelines. I'll pause there, Prashant.
That is one safeguard. Anything else? Any other important ones you would imagine, Pranav?
Oh, yeah. So for example, they are very likely to say that in the first 30 minutes and the last 30 minutes, buyback cannot happen, which again, I think is an important safeguard in as much as it prevents any form of price signaling or closing price manipulation by a company. And this is internationally also quite well prevalent. The time, whether 30 minutes or whatever, can be debated, but otherwise, yes, opening, closing, companies will not be allowed to participate is the sense I'm getting. Also, they will not allow the company to be price setters. They will allow the companies to be price takers, which means on any given day, not more than 25% of the shares traded in the past few days, average trading volume for the past few days can be done through a buyback, so that the company is a price taker, it does not become a price setter. Similarly, they will, I think, provide that more than certain percentage cannot be bought back, so that it does not crowd out private acquirers who want to acquire on the market, and so on and so forth. So there will be all kinds of restrictions, plus minus 1% of the last traded price, and so on. So there will be all of these safeguards, I assume, in order to ensure that there is a fairness and transparency built into the process or the mechanism of open market buybacks.
Bhavesh, or as you heard Pranav, anything you want to add in terms of safeguards or how this will finally look? This is a consultation paper for now.
Yeah, absolutely. It's a consultation paper, and as I said earlier, I think SEBI is very, very conscious about whether this new regimes are taken being taken advantage of by certain set of shareholders. What SEBI wants to do and what the regulators want to do is to make sure that it's completely equitable, it's completely fair, it's completely transparent, without impacting prices in the market. And it should be true to what the spirit of the buyback should be, and rather than being manipulated. So I think these safeguards, which were highlighted earlier by my colleague, I think they are very, very important. They make sure that there is no, and for example, there is something known as an order matching system. So order matching system is not allowed. So you basically you're ensuring that you cannot use the stock exchange route for one buyer to buy from another buyer in a targeted manner. So that I think is a very important consideration. Plus the timing changes and the 25% rule in terms of trading. This makes sure that there's no price disturbance which is created through this, and it is done in a very nice and efficient manner. I think this is what SEBI has been trying to do.
In your sort of interactions, etc., Bhavesh, is there going to be taken up quite if this goes through, it's going to be taken up quite aggressively, and by who? Which lots of cash-rich companies out there. So just give us a flavor of what you are sensing.
So I personally feel, yes, I think this will certainly, it's a very positive move, and is certainly being considered very actively by a lot of companies. Of course, it's a consultative paper right now. It has to convert into a proper framework before this is actually implemented. But you're right, absolutely, Prashant. The cash-rich companies which have good frequently traded shares, which basically, the stock price has been has come down significantly, so there is a value in the stock price. I think these companies will definitely want to take up. I think if you were to, without naming companies, broadly sectors which could take really advantage of this could be, IT sector where the stock prices come down. They're cash-rich businesses, very frequently traded shares, large caps, and then a lot of the sectors. Pharma could be another one where again, there's good cash reserves, and the prices may have been corrected, and there's scope to kind of do a buyback there. But a lot of companies who generally need cash, so broadly in the financial services sector or some of these companies will not consider this, like in the real estate companies, the new age companies who always need cash, and some of the the businesses which always need cash to grow. It will be more considered by some of the FMCG companies, the consumer companies, the high tech services companies who generally throw out cash, and wherever they see value in the stock price to buy back. I think those are the companies who will go in for this.
Is it possible, Bhavesh, to recollect at a point in time in the past when you had an episode of markets panicking, and when the open market buyback was allowed? I mean, what's the what was the size of this route that companies use? I mean, how much was bought back through this route?
Yeah, no, I think it's just jogging down the memory lane, Prashant. I think when this was done earlier, I think, many times just the signaling of the buyback, by the companies ended up stabilizing the prices. So there was always a buyer in the market who would buy the shares when the prices had cracked. And just that signaling that, yes, companies there to kind of, buy the shares at lower price, that itself kind of, created some kind of cushioning. So I remember some company, I can't remember, I can share the names, but some of the companies already had, whatever, buyback mechanism that, or the buyback amount they had earmarked, they were not able to use that. And which is why one of the regulations came then subsequently, which, that so much money has to be used. But there was a time in the past when just the signaling itself really helped the stock prices.
Yeah, no, absolutely. Pranav, anything you want to add to it?
So India does have some unique features, like, for example, very large promoter holdings in many companies, large retail, small shareholder base. So in a tender offer, for example, there is a 15% earmark for small shareholders holding up to 2 lakhs. All of those are not available. Companies which want to show a signal of a premium being paid for the price will still go through the tender offer route, because the buyback through open market is normally at the market price. And companies where the stocks are not very liquid will still have to go through the tender offer route, because I don't think, unless the shares are very frequently traded and very liquid, the open market would work well. But otherwise, the speed and simplicity with which this gets implemented, the kind of pricing is not premium, and therefore the company is able to buy back shares at the ruling market price, and so on. So those are really good features of permitting open market through buyback. So I think there is place for both, but the flexibility, speed, and simplicity of buyback through an open offer on the stock exchange is much, much better.
Yeah, absolutely. We'll see, as the final guidelines come through, and but great conversation and good insights, both of you, Pranav and Bhavesh. Appreciate your time here on CNBC TV 18, and we'll have you back once we have the final guidelines from the regulator. But much desire, and of course the regulator now moving forward with that consultation paper. 140 points, by the way, down on the Nifty. We're at about 22,570. Nagaraj Shetty is with us with what he wanted to do with regards to trades. We're at the day's low. Nagaraj, just thoughts on the index trades and your stocks?
Hi, good morning, Prashant. The way market has reacted on the recovery in the last two sessions is indicating that buying seems to emerge from the lower levels. 22,200 seems to be important bottom as of now, and the current consolidation is likely to end soon. And very soon, I'm expecting Nifty to reach up to 22,800, 23,000 levels, which are the next important hurdles in the next, at least by this week.
Okay, looking at higher levels. Got that, Nagaraj? What about individual stocks?
Yeah, I have two stocks from long side. First one is Coal India. Coal India has been in a sharp uptrend over the last few months. What we observe is higher tops and bottoms and consolidation patterns from the higher levels recently. And after the showing some consolidation, it has started to move from the lower levels from the important sub.
Okay, thank you very much for that. Senco is a stock which is surging now. Senco Gold is up 12%, very large volumes. The Q4 update, the street likes. The company is guiding for a 46% revenue growth in Q4, led by a strong wedding season. Same-store sales growth, according to the business update, is 34%. And the total stores have also now crossed 200. So Senco is reacting very positively to that update. And in the large cap space, its trend 5% up now on trend. If you look at the revenue growth this quarter at 20%, it's the best that they've seen compared to the prior few quarters. So that's keeping the stock excited. 5.5% up, but it's still down 40% from its 52-week highs. Get into a break on the other side. Manisha will talk commodities. Welcome back. Let's talk commodities. As promised, Manisha Gupta is now joining in. Hi, Manisha.
Thank you for that. I'm looking at crude oil prices because we are holding around that $110 a barrel. Earlier, 100 was a mark that you were following. Now it's 110. So we're making higher highs when it comes to the crude oil prices. This is after there's a deadline for Iran to reopen Hormuz, and there's an extended time till 8 p.m. Tuesday is what the U.S. president has come out with. So markets clearly reacting to that in sense of a geopolitical premium coming in there. The U.S. also is threatened to hit civilian infrastructure if Hormuz is not opened. And Iran, in the meanwhile, is known to have rejected the U.S. demand. So we'll know what the day-to-day looks like. But at this point in time, as you can see, just about holding that 110 and below that right now. Interestingly, the markets also seem to be reacting to the OPEC Plus statements that came in over the weekend. OPEC Plus says that the war-related damage to energy infrastructure could have lasting repercussions. OPEC Plus also said that they are looking to increase output going forward in sense of their member quotas. And once Hormuz reopens, that is, because at this point in time, most of the OPEC members really are within the Middle East. So whether you talk about Russia, which actually is facing sanctions, but then you also have Saudi Arabia, you have UAE, all of those countries are able to just about get out very limited crude oil from Strait of Hormuz or to the rest of the world. And that really has an impact there. Interestingly, you also have the war removing almost 12 to 15 million barrels per day, or 15% of global supply, and that's what the street is reacting to. There also is prices trading in the premium right now. So when you look at the U.S. crude, we are looking at 2025. The U.S. produced nearly 21.7 million barrels per day, and that is inclusive of 13.6 million barrels per day of crude oil, and it also is about 8.1 million barrels per day of natural gas, and of course biofuels, etc. So when you look at the overall U.S. numbers therein, You're looking at US producing 21.7 million barrels per 2.8 million barrels per day of light sweet crude is what US exports. The reason you're looking at WTI trading higher than Brent is exactly this, because the US is exporting 2.8 million barrels, but US also is importing a much higher quantity at around 6.2 million barrels, which is heavy crude. This comes in from West Asia, Canada, Venezuela, Mexico. So the reason you have the crude prices in US and Middle East, both of them trading on the higher side. Now, there are various reports suggesting that a lot of government rationing is happening when it comes to fuel consumption. Indonesia, for one, daily fuel purchase is capped at 50 liters per car for the private consumers. For the government workers, they have been told to work from home. It's a similar situation also coming in from Thailand, where there are reports that they're preparing for fuel rationing plans. And then you have Bangladesh, where there are a lot of rations in effect already there. The universities are closed, and Bangladesh also is a country which imports 95% of its consumption, doesn't have too much crude oil remaining, and we're looking at prices surging there. Slovenia, one of the first European countries to start setting 50 liters daily limit for private drivers there. And there are various reports also suggesting that EU's Energy Commissioner to FT has said that rationing is being considered as an option if this continues going forward. So that's exactly, pardon me, what the markets are reacting to. Higher crude oil prices, with JP Morgan to Goldman Sachs and MS all saying that if this continues for the next couple of weeks as well, we are perhaps looking at 120, 135 kind of levels.
Right. Manisha, thank you very much for that. That's commodities and focus oil in particular. We'll take a break. We're back. And we discuss RBI steps so far in terms of reining in the, excessive speculation around dollar, rupee, INR, derivative contracts. Success, of course, on Thursday with that sharp appreciation in the currency. This morning, of course, holding on with those gains. We'll, of course, also talk about the upcoming policy, the RBI policy decision on Wednesday. Latha speaks with Pranjul Bhandari of HSBC and Mithul Kotecha of Barclays, coming up in just a bit.
Welcome to It's the Economy. The rupee has gained 0.2% today and has gained over 2% since the March 28 low of 94.83, indicating that the Reserve Bank steps cutting the link between the NDF and the offshore markets have been very effective in stopping the run on the rupee. However, the bond market shows no sign of recovery and yields are now touching new two-year highs of 7.11%. So the stage is set for a very crucial monetary policy statement that comes out on April 8th from the Reserve Bank. To understand both these markets better, Mithul Kotecha, the head of FX and EM Macro Strategy Asia at Barclays, and Pranjul Bhandari, the chief economist and strategist at ASEAN economist at HSBC joins us. I'm sorry, Pranjul, I hope I got your designation right. But first, let me start with you, Mithul. This is a fairly 2% rally. You think the Reserve Bank steps have squeezed out shorts and we can see this rally continue?
Well, I think the rally can extend further in the short term. It has squeezed out some of the long dollar positions that were onshore, but I think what's happening is we still have the deadline coming, I think, for April 10th, and there is still probably a great deal of unwinding to come of some of these long dollar positions to get down to this $100 million end of day position that the RBI has set earlier last week. And so you add that, of course, to the second set of regulations that were announced towards the end of the week, which is obviously the stopping of the NDF trading by onshore entities. And that clearly is having a significant impact. So perhaps over the short term, we may see some more gains as these positions are unwound. But I think the question is what happens thereafter. And for now, I think the jury is still out. We still think there are a number of structural downward pressures on the rupee that may not abate very quickly, which we've highlighted for some time and on this program, which is clearly about the fact that, there's oil, as you mentioned, oil prices remain elevated and higher oil import demand. The trade picture is worsening, as is the capital flow picture in terms of the portfolio, the financial and capital account, and that could still put some underlying downward pressure on the rupee after some short-term respite.
You have I guess by April 10th, the banks have to bring down their positions. So as you say, there would be a downward pressure on the dollar until then. But do you have a number for, say, June 30th or something like that? I know it's a tough question going by the onslaught of tweets that we are subjected to. But regardless, we know the BOP position. We know the CAD position with crude at 110. So what are you expecting? 95 back?
Well, look, our original forecast was at least for that sort of level to be hit by middle of the year because, this is obviously set before we had these RBI measures. And so now, obviously, we'll see whether we get there. But as I said, look, given, as you said, we know these underlying structural issues that still are in place. And look, when no one's really talking about growth, Indian growth is still very, very firm, still one of the fastest growing economies in the world. And at that, from that perspective, things are not where, we're not talking about a crisis here, even on the balance of payments, with a deficit on the current account, it's sort of barely around 1% of GDP. It's not a structural problem. But at a time when you've had massive capital outflows, when you look at the equity outflows in particular that have been so significant and have continued into April, it is a bit of a worrying picture in that sense. And of course, as you said, the longer that oil remains elevated above $100 a barrel will cause more pain for India's balance of payments position. So I think, look, these measures have clearly had an impact and will clearly continue to have an impact in the short term. It will mean that the rupee will trade much more on underlying structural factors rather than these arbitrage trades or more speculative trading. And I think the RBI has succeeded or will succeed on that front. But, even these underlying trade pressures will keep perhaps the rupee under downward pressure in the months ahead.
Fair enough. Pranjul, as Mithul referred, we are not really seeing a hit on growth just yet. The worries are more on inflation. First up, what are you expecting from the Reserve Bank? Do you expect a hawkish statement? Because the bond markets, look at that, they're pricing hikes, 7.11, as I told you, the 10-year, and likewise, the OIS rates are high.
Yeah, thanks, Lata. So I want to take a step back, and my sense is that we'll soon realize that this could be as big a growth shock, if not bigger, as people are perceiving it to be an inflation shock. And I say that because this is not like your regular oil price shock that we saw in 2022. This time it's not just about prices, it's also about quantity constraints, all the quota systems, sharp cuts in production across several sectors. And my worry is that if this continues for a few more weeks, it may start looking a little bit more like the pandemic than like the 2022 oil price shock. And I do think that's something that the RBI has at its back of its head, especially when it, announces its policy on April 8th. Now, remember, the policy in April 8th is going to come with this MPR, the Monetary Policy Report, as well, in which they have a lot of space to really talk about different scenarios. And I think that's going to be their strategy. They won't make any sharp changes in their growth or inflation forecast yet. Instead, they'll outline several scenarios. What if oil is at 80 for the year? What if oil is at 100? What if oil is at 120? So that people know the different sort of possibilities that there are as this sort of crisis unfolds. But for now, my sense is that because a growth shock could actually be bigger than the inflation shock because all of these quantity constraints, my sense is the RBI will not sound very hawkish on the inflation front. And they have some good reasons, Lata. My sense is that this is the time you really utilize the space you get in flexible inflation targeting. At the end of the day, a 4% target is there, but in a supply shock year, inflation can be between 4 to 6%. We have that band out there, right? The 2 to 6% band. So as long as inflation remains under 6%, and you have a sense that 1 year down the line, inflation will asymptote towards the target of 4, I don't think the RBI will prematurely become very hawkish.
Okay. Well, we are carrying your table, Pranjul. The hit to CPI baseline of 4%. If crude is at $100, only then you're expecting a 1.9% increase, which would still bring it to 5.9, sub 6. So it's only if crude went to 125 and remained there that the Reserve Bank would be faced with an above 6% inflation. Otherwise, it's definitely going to stay within their flexible range. Let me come to Mithul. Mithul, do you track rates also? The Indian yields have gone up to 7.11. Now, do you expect the majority view I'm getting is exactly what Pranjul said. We had our own mock MPC, and there the overwhelming noise was, message was, Reserve Bank has to sound pro-growth in that policy because it's a supply shock, as she said, more COVID-like. So do you think that yields will soften? Have we seen the worst of the yields, or do you think yields are going to climb because of crude?
Yeah, it's a good question. Yields, when you look at what the market's pricing in both at the front and the back end of the curve, pricing in rate hikes at the front end of the curve seem overdone in this environment. But it's been a case across Asia and, to be fair, across global markets where front end rates have been selling off because of inflation pressures. If we do start to see this shift into a demand shock and worries about growth, then you could see some of that pressure being alleviated on the front end of the curve. And in terms of, as you said, where 10-year yields are and the move in the back end of the curve, look, some of that perhaps is related to some fiscal concerns, and it's not just in India, but perhaps governments may have to absorb some of the shock from higher oil prices. But again, at these sort of levels, so much is already in the price. And it does seem like we're extended in some of these moves in the rates markets in India in particular. And so I think, look, the shock is there. We've seen that across the curve in terms of India rates. Realistically, I would agree. I think it's unlikely that the RBI will tighten even this year unless oil prices sustain at a higher level for longer. And, this is still not our base case. But if we say get to an average, just an average of $100 a barrel this year, there is a chance that the RBI may have to hike later in the year, perhaps in Q4. But like I said, that's not our base case at the moment. But we will see. Oil has been persistently high for now. We know even if there's a ceasefire or some sort of a deal done, oil prices may not come down very quickly because of the transport issues, the refinery issues that could still take some time to get back on board. But look, arguably Indian rates markets have seen such a big move already. And when you look at some of the issuance numbers, when you look at what's really likely on the deficit, it still seems that we're not seeing a big fiscal problem developing at this point in time, which would seem that rates move is unjustified.
Okay. Well, actually, that's not what I'm picking up. I am picking up that the base case for no one is a rate hike in 2026 calendar. but people are definitely worried about the fisc. And that is seen as more the reason why yields are rising. The first of the borrowing auction has not started. And as it is, the appetite is so not there that, there is a worry about yields. But before I come to the yields question to you, Pranjul, what's the growth expectation? Do you think Reserve Bank will not bring down the GDP forecast? Because if they don't, if they do bring it down, then perhaps yields will fall if growth is about to fall. What do you think they'll do?
So, Lata, it's a toss-up at this point of time. I think there's two things they can do. One is that they don't change any of their forecasts, but they outline a number of scenarios, which makes it clear that, if oil prices were to fall...
1 minute, Pranjul. Pranjul, 1 minute. They already have given us, not MPR, but the policy itself has told us 6.9% GDP for April, May, June, and 7% for the second quarter. Surely they should bring down the first quarter. You don't expect that also?
Yeah, so look, one is that they say that we don't want to touch anything because we don't know where things are going, but here are the scenarios. That's one possibility. And the other possibility is that they make small adjustments. So if they go for the second one, I would say that perhaps they decrease their growth forecast for the first half from about 7 average to 6.5 average. And they increase their inflation forecast from the 4 target to 4.5. So make a 50 basis points adjustment in both the inflation and the growth target. That's one thing they could do. And then they would have to give some oil assumptions, and then they can provide that oil assumption that, look, assuming that things settle over the next couple of months and oil averages $80 to $85 a barrel. So they could go for a scenario like that. But another one could be that they don't make any changes for now. And they say that, look, we're not accustomed to making changes in every policy meeting, and we'll hold on. And until then, you have all of our scenario analysis in the MPR. So I think that's what they are going to go for right now. But I do agree that one of the things that they'll have at the back of their mind is how to comfort the bond market at this point of time. Because I think what is happening is that wherever changes happen with the FX market, the fear in the bond market is, what if the RBI comes up with the next big step, which is huge interest rate defense on the FX. So from that perspective, I think the RBI will be sounding a little more comforting to the bond market. I think that would be a priority of the RBI on April 8th.
What's the in-house view? I mean, maybe being unfair asking you, but are your rates guys expecting, if the Reserve Bank were to talk soft, which seems to be the base case with most economists, they expect the Reserve Bank to sound pro-growth, actually. If that were the communication, you think yields will fall? Is that the expectation, Pranjul?
I think there would be some comfort on the margin, and we could see some reaction on that day. But eventually, all the other problems that the bond market is facing will continue, which is uncertainty on the fiscal front, uncertainty on where the dollar goes, and the possibility that at some point an interest rate defense is used, a big borrowing calendar starting again. So I think all of these will be shadows on the bond market. But yes, if the RBI sounds softer for the bond market, I think at least on the day, things might look a little better.
Okay, on the day. Yeah, my sense is the Reserve Bank will have enough reasons to sound pro-growth on April 8th itself, but I don't know how the borrowing will go. Mithul, very quick two answers from you. June 30th, approximately where do you see dollar-rupee range? I know it's an unfair question. And approximately where do you see the 10-year, Indian 10-year?
Look, so our forecast, I mean, look, for the rupee, as I mentioned, we have currently rupee weakened 95, and again, that was ahead of the RBI measures, which have seen, as you mentioned, the 2% rally in the currency. So we will see whether we get there. But I do think, as I mentioned, the underlying pressures won't change, even if the speculative pressure has been eroded. And on yields, again, look, it's hard to see. I agree with the fact that we will still be waiting the fiscal numbers and the borrowing numbers, and clearly markets will start to worry about fiscal pressures. But as I mentioned, a lot is in the price, and I would say that across the curve. So at some point, investors will look at the curve and see some value here, and I don't think we're far off that, right? And unless we really see a blow up in oil prices or a much more sustained move higher in yields, there will be some value emerging in yields, even perhaps with a greater borrowing program.
Oh, is that what people are telling you, that the FPI bond investors are likely to see value?
Well, look, FPI bond investors have been marginal. We've seen not really big inflow. Even this month, we continue to see outflows from the FAR channel. So I think this is more about what domestic investors are doing, and whether, I don't think on the margin they're going to have foreign investors are going to move this. It's really about the domestic confidence in bonds, and whether, as it was just mentioned, whether we see rate hikes being used to defend the currency, which I think is unlikely, to be honest. I think RBI has other tools, or whether we see some fiscal challenges emerge, and that's still up in the air at the moment.
Fair point. Thank you very much. Completely out of time. Pranjul and Mithul, thank you very much for giving us your perspectives. It looks extremely unlikely that the Reserve Bank is going to sound hawkish. It's more likely to sound pro-growth. And definitely, their stance has always been, we will not use interest rates for exchange rate. Those are two separate markets. Interest rate is a tool for inflation. I assume that message will be rammed down on April 8th, but let's see. Thank you very much. We'll have you thereafter for your views after the policy is announced. Thank you very much for joining us. Wrap up on Bazaar. Chartbusters coming up.
The Indian market trades with cuts following mixed signals over another escalation in the West Asia war. The Nifty is down about 0.5%. Midcaps trade with gains, while banks, after opening with gains, have slipped into the red.
Financials in focus on the back of the fourth quarter business updates. HDFC Bank outperforms peers on loan as well as deposit growth. Axis Bank also reports strong business momentum in the fourth quarter. IndusInd Bank, meanwhile, sees business contract in the fourth quarter.
Wipro signs an 8-year transformational deal with the Olam Group with a revenue potential of over $1 billion. The deal contours include a $375 million acquisition of Olam's IT arm Mindsprint. The stock surges.
Trend surges 6%. The stock is a top gain on the Nifty as it delivers 20% growth in the fourth quarter, its best in FY26. Nykaa too is buzzing as it delivers the 14% straight quarter of over 20% growth.
And Senco Gold surges on a stellar fourth quarter update. Same-store sales rise 35% and revenue grows over 40%, aided by the wedding season sales. Metropolis too trades higher after reporting an over 20% revenue growth in the fourth quarter.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel D'Souza and with me is Ekta Batra. Well, Ekta, the markets are down but not out, and good to see a bit of a recovery from the lows. I think the biggest positive today is the number of stocks advancing have actually outpaid the number of stocks declining. So portfolios will actually be feeling pretty good.
Hi, Nigel. Yes, absolutely. You know, we've started off the week on a positive note. We have the Midcap index, which is showing some amount of momentum on the upside. So maybe the Midcap index should come up for you just about higher by around 0.1%. And like Nigel mentioned, it is the advanced decline ratio, which is in positive terrain. So over 2,300 stocks advancing to around 1,700 stocks declining on the Bombay Stock Exchange. Good time then to get in a technical check. We have Shivangi Sarda of Motilal Oswal Financial Services. She's joining in to tell us what she's tracking this Monday morning. Shivangi, thanks very much for taking the time out. 22,632 is currently where the Nifty is at. The mid-caps are clawing back a little bit at this point. How would you trade today?
Very good morning, Ekta and Nigel. Thank you for having me. So we've seen that the indices have been, witnessing a lackluster move since the opening, but of course we are kind of overpowered by the global concerns as well. Now, of course, we might like to think that the market is taking cues from your blazer, but overall we are witnessing some bit of call writers that are still present in the market. Now, looking at the current levels, 23,000 still stands as a strong resistance on the immediate front, and we are looking at the support base at 22,400 marks. So this would be the range for the Nifty index, but a tug of war between the bulls and bears to continue till the time India Wix kind of, slightly cools off. Now, talking about Bank Nifty, we have been seeing underperformance here, and the PSU banking stocks are also kind of giving up a little bit of strength, which were holding up the entire index. Now, Bank Nifty is, we could see a negation forming on the weekly basis, but then again, we are seeing pressure is still intact over here. We could head into a consolidative phase, but 52,300 is the next resistance that we're looking out for Bank Nifty with a support of 51,000 levels, which will also act as a make or break zone for the next dance for the, April series.
Got it. Okay. All right. You want to fill us in with a couple of interesting individual stocks, though?
Yes, absolutely. The first up on my radar is Titan, which is, buzzing today. We've seen that there has been consistent long build-up from the last 3 trading sessions. And on the weekly basis, we could see a good follow-up action as well after it rebounded from an important retracement level. Now, we've seen that stock is now trading above its 50-daily exponential moving average, and the RSI is also showing signs of positive divergence. Overall, it has surpassed its previous cluster zone of 4170 zones as well, and is holding quite well above the same. So, this is a good risk reward at these levels. So recommending a buy here with the next target of around about 4,400 levels and a support of 4,070 zones. The second pick on my radar would be Nalco. This has been one of the strongest names in the entire metal pack. And of course, the kind of movement and the strength that we've seen here has been quite remarkable. The stock is now trading above its immediate resistance levels. And we have been seeing that on the monthly basis as well. It is forming higher top, higher bottom formation from the last 7 months. With good rollovers in this name, we've seen that the follow-up action is also quite strong. So recommending a buy here. And the next target, what we're looking out for Nalco is around about 425 with a support of 400 levels.
Okay, all right. Thanks very much, Shivangi, for that. So Nalco as well as Titan on Shivangi's list. And hopefully, Shivangi, I'll be wearing this green jacket for many more days if it rubs off positively on the markets. Thanks very much for taking the time out and joining us this Monday morning. Well, we need to take a short break with the news that the mid-caps are now higher by around 92 odd points. So let's see whether it builds on those gains. We'll be back and joined by the management of Sharda Cropchem on the impact of the ongoing West Asia war on their business. Stay tuned. Welcome back. Well, for the markets, we are seeing the Nifty just about lower by around 0.24% at this point. We have the Bank Nifty also, which is seeing some amount of buying at lower levels. So higher by just about 25 odd points currently for the Bank Nifty. So maybe this is turning out to be a day where we are seeing buying coming through at lower levels. Let's see whether that sustains. But as of now, as you can see, just about flattish for the Nifty Bank. Well, let's get talking to one particular company. We have Mr. R.V. Bubna of Sharda Cropchem joining in on the show to decode the business impact of the ongoing West Asia war. Mr. Bubna, thank you very much for taking the time out. If you could just start by telling us, we've seen shortages when it comes to gas. We've seen increase in freight and container prices. How exactly is that impacting your business at this point?
First of all, I would like to lead with you that now we are in a silent period and I'm not supposed to speak about the company till our board meeting, sometimes in the next month.
Okay.
Sure. But if you could just give us an overarching sense in terms of what the company might be going through when it comes to the impact of the West Asia conflict and maybe even your industry, your peers.
Madam, I had appeared for similar interview on 25th of March, where I had given you the information of the impact on the Sharda Cropchem. I can only repeat that to some extent. This West Asia conflict has not affected our business at all. Our business has been doing very normal. Neither the tariff imposition of the US government has impacted our business because we were able to pass on all the increase in the tariff to the customers. Our products are not freely tradable products. They have to be registered in every country that we export to.
Okay.
And the registration process is very complicated, highly capital intensive. and a lot of certainties, and not many people go into that process of registration. Our company is investing about 400 to 500 crores every year in the process of registration, and we have registered our products in about 75 countries around the globe. And with this situation, the competition is very limited, and the customers are also aware they can only buy the products which are registered. They cannot buy from any other source.
Right.
So we have been able to pass on the increase in the tariffs to our customers who have gracefully accepted it. And the entire cycle, they pass it on to the farmers, and farmer passes it on to the citizens.
Got it.
So we have not had any adverse impact either of the tariffs or of the West Asian war.
All right. Hi, Mr. Bubna. Good to see you in, sir. A couple of more queries. You know, since you're export-oriented, the supply side hasn't got impacted for you at all. Could you clarify on that? And what about the routes? Because there's a lot of problem with regard to shipping of products. You haven't faced any challenges even on that front?
See, we cover our requirements about 2-3 months in advance. So we have covered our supplies till second quarter of this year already, and the goods are there in our warehouse or there in the transit.
Okay.
Okay.
There was an exhibition in China of agrochemical products about 2 weeks back, where the suppliers were a little quiet because they were waiting for the impact of the oil price rises and many raw materials not available. And after the exhibition, and they were not quoting anything during the exhibition, after the exhibition they started quoting, and the prices are hardly about 10% more than what they were prevailing before the exhibition.
Okay.
Our industry has not been very much impacted because of these factors. So coming to the transportation, yes, we will have to face increase in the time as well as the cost of the transportation. But again, these will be also gracefully passed on to our customers.
Okay. So you're passing on, what is the extent that you're passing on to your customers?
More or less 100%. It's very difficult to say. It could be 80%, 90%, even 110%.
But majority of it is already undertaken in terms of price hikes?
Yes, madam.
Okay. Got it. So what about the currency move? If you could help us out with that. The dollar is showing some signs of strength against the euro. Most of your revenues come in from Europe. So would it have an impact on your business?
Yes. If dollar strengthens against euro, then it gets affected. But even that variation has not been much in the last 1 month. The euro-dollar exchange rate is fluctuating between 1.15 to 1.17.
Okay.
Not been a very sharp increase or decrease.
Okay.
So on an overall level, this has also not impacted our business either.
All right. But otherwise, the strength in the dollar against the euro has an adverse impact on the business. As you're telling us, you're not seeing too big a change, so it won't impact you negatively, right?
But it has not happened.
It's not happening.
The euro-dollar exchange rate has not gone below 1.15.
Okay.
So that has not happened. If it happens, then naturally we will have to face the effect.
Okay. Just quickly, you know, in terms of the geographies that you're supplying to, if you could just break up where exactly your biggest market is, and for FY27, are we going to see any kind of change in the mix of your exports?
Not much. Our biggest market is Western Europe, and that constitutes about 40% or 45% of our total turnover. And that market is very stable and very responsive.
Okay. All right. Quick words, sir, with regard to the guidance that you've given. Earlier, you were talking about an 18 to 20% growth for FY26 with 35% margins. And I think for the following year, you were talking about 15 to 20% top line growth with margins at around 35%. Sticking to both those two?
We feel very confident that this will continue in the next year.
So no revision in the guidance?
No, sir.
All right. And the US markets, how is that shaping up? How has the season been?
it is also the same level, steady. There's not been much variation. In fact, the demand has been very good, and we'll be able to match up the volume of last year in this year also, and we expect some growth in the year FY27.
Got it. So to sum things up, you have not been impacted by either the tariff tantrum that was taking place or the crisis in the Middle East. Is that correct, sir? And your guidance is maintained.
It's a crisis in the Middle East so far.
So far.
But we do not know. Nobody can predict what will happen in the next 4 days.
Got it. But for the time...
catastrophe happening, then naturally everybody will be affected, and we cannot avoid that effect. But it is difficult to predict as on today.
Okay, Mr. Bobna, we appreciate you joining in and giving us all of those details. For the time being, it appears the market is listening to what you had to say with no revision in guidance and no negative impact either of the currency or the various global headwinds that are there. Stock currently moving to the high point of the day. Thanks a lot for joining in.
Thank you, sir.
Time to shift focus then to our special segment where we get you a few ideas for profit from Money Control Pro. Anand Chaudhary of moneycontrol.com joins us to talk about a stock that is tracking closely. Anand?
We will be discussing today Jyoti Labs Limited, leading home and personal care FMCG company. You might know it for its popular detergent brand, Ujala, but now it has many other brands like Henko, Maxo, Margo, Exo and Prill. They are into detergent, dishwashing and other categories. After many quarters of subdued performance, the company has shown a very strong volume-led recovery in Q3 FY26, posted a 7.2% volume growth. Fabric care and household insecticides segment remain the star performer for the company with double-digit value growth, while the personal care business, it has successfully bounced back, which were facing some challenges due to weak product portfolio. Management is now steering the company towards a double-digit volume growth for FY27, backed by a massive rural push to reach 1.4 million direct outlets. Jyoti is also expanding its liquid detergent range, not just Ujala and Henko, but also More Light and Mr. White, which were placed at value for money pricing. The company is also working to grow pan-India in dishwashing brands like Exo and Prill, which were earlier more focused in the southern region. The stock has corrected by more than 60% from its all-time high and currently trading at 17 times on FY28 earnings, which gives a very strong margin of safety and a good potential for upside.
Okay, all right, Anand. Thanks very much for joining in and giving us that perspective. We need to take a short break with the news that the mid-caps are definitely building on gains, so up around 0.5% currently for the mid-cap index. To put it into perspective, it was just about higher by around 0.1% when we started the show. So as you can see, there is a spike which has taken place for the mid-cap index at the high point of the day. We'll take a short break, but on the other side, we'll get you a lot more on the market. Stay tuned.
Welcome back here to Indian Chartbusters here on CNBC TV 18. Well, India's state-owned oil companies will now pay discounted rates for petrol, diesel and ATF as well as kerosene to limit the mounting losses from the self-imposed freeze on retail prices. Let's go across to Sonal. She'll break it down for us. Sonal?
Thank you so much for that. To just give you some perspective, oil marketing companies have two segments, refining and marketing. While standalone refiners, all they do is refine the crude oil to make petrol, diesel, ATF. And that is something that they transfer to oil marketing companies, which is sold in the market to retailers and industries as well. Now, what oil marketing companies have done it is the first time that there's some sort of regulation of prices after deregulation back in 2014, where they've told the refiners that they will be paying them discounted price for fuel and petrol. And reports indicate that the discount goes up to as much as 60 rupees per litre. So when refineries pass on these fuel and these fuels to marketing companies, it is called as refining transfer price. It's an internal pricing benchmark which is set up by these companies, and this has been cut now by oil marketing companies. The indication is they want to basically ensure that the losses that oil marketing companies are taking are equally distributed across the sectors and not only on oil marketing companies. Remember, Ministry of Petroleum had indicated that PSU OMCs are incurring under recoveries of 24.4 rupees per litre on petrol and almost 105 rupees per litre on diesel. So that's a big chunk of loss that these companies are making, and they are trying to pass it on to other participants in the industry as well, and that's why this cut has come by. However, there's no official order for this. It's a PTI story, but this has been in talks for a while, and this is how they're trying to cut down on losses that only oil marketing companies have been facing to ensure that more participants are there in this particular loss.
Okay, all right, Sonal, thanks very much for that. So that's a quick update on the rupee, which is appreciated below 93 now, so 92.84, so good going currently for the rupee. But let's talk about other stocks now. Senco Gold has zoomed around 10% on the back of a robust quarterly update, largely led by the wedding season. Vinny is here to tell us more. Vinny, over to you.
Hi, good morning. So absolutely right. 46% growth in this quarter is what we're seeing for the revenue. Wedding season supporting the growth. SSSG growth, that's coming at 34%. They've added 7 stores. Total store count goes up to 201 for the whole year. Valentine's Day, International Women's Day, all of that came in. What did that lead to? Because of that, there was gifting that happened. And because of that, we saw lightweight jewelry, which led the growth for the company. The company's management has also highlighted that they expect this trend, maybe for lightweight jewelry, to continue going forward as well. So they're going to be focusing a lot more on lightweight jewelry, a lot more on everyday wear jewelry as well. FY26 overall revenue growth also 35% plus is for FY26, while FY25 the growth was 21%. So good growth is what Senco Gold is seeing even in FY26. What is the outlook for FY27? They plan to launch around 20 to 25 stores in FY27. They aim to achieve 20 to 25% value growth, so value revenue growth of 20 to 25%, as well as an EBITDA margin target that they've given from themselves. It's going to be somewhere in the 7.5 to 7.8% range. So no complaining on that front. And Senco Gold passing a win trade on the back of this. Along with that, even Kalyan Jewellers has started seeing a run up today. But today we have only the update so far for Senco Gold.
Got it. Thanks a lot for that, Vinny. That's one of the big movers in today's trading session. By the way, I think the key for the market to track from here on is going to be Reliance Industries. If Reliance Industries can get its act together, it's currently at the low point of the day, stock at around 1,300 rupees or thereabouts. If that can turn around, that's going to be the big booster shot that the Nifty is looking forward to. So in terms of contribution, it's contributing maximum on the downside. It's at a very crucial level right now. So we'll keep an eye out on Reliance Industries. Make or break for the Nifty will depend on Reliance Industries. The good news is number of stocks advancing has moved to close to 1,900 stocks. That's up from around 500 stocks at the start of today. The crisscross lines will tell you the picture. Well, we'll wrap up on this edition of Chartbusters. That's it from Ekta and myself. You stay with us. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Patakia. Joining me from Bangalore is Ritu Singh, and it has been a very, very choppy start to this all-important week that lies ahead for the Indian markets. We have the RBI policy coming in. We have the start of the earnings season. We are reacting to a slew of business updates from the banking and financial space that has kept Ritu busy all the long weekend long. But it's been a very volatile start for this day. The index has swung between gains and losses of 100 points down to a 50-60 point uptick as well. The broader markets have recovered from the lows of the day. They have now moved into the green, but otherwise it's been extremely choppy when it comes to the benchmark index, Ritu.
That's right. The only pockets of green, good morning, Hormaz, of course, are the broader markets. You also have the bank Nifty that is just about recovering. It's up about 3 to 4 points as we speak, but we'll take what we get. It has been a volatile session after that near 500-point gain that we saw on the frontline index last Thursday. And we're coming back from this long weekend with a bit of a volatility. You also have, despite the overall index dip, there are some pockets of strength that are emerging. For instance, the PSU banking pack, that is doing well in trade today. The Realty, IT index, metal index also doing okay. But the laggards, of course, are Pharma, energy, FMCG, auto, all of them under pressure in trade. The advanced decline ratio, though, it's worsened a bit from the start of the trading session, but you still have about 2 stocks that are advancing for every 1 stock that is declining on the National Stock Exchange. As we speak, the Bank Nifty again has slipped back into the red, now trading at 51,500 odd levels. So that's where we're positioned, on the overall markets. A lot of banking numbers that have come out, yes, over the weekend that we will be reacting to. There are updates from the FMCG space as well. So lots of fourth quarter updates, that the markets are taking into account as we trade today. But Hormaz has walked by over to the wall to give us a sense of the top movers and shakers in today's trading session.
Now, it's been a busy start to this important week, but there is no clear directional trend that has emerged so far. The dips, yes, they are seeing some buying interest at lower levels, but any recovery is getting sold into as well. You can see this on the chart as well. Any recovery is getting sold into. 22,500 is that the lows of the day are getting protected, but the highs of the day are not getting held on to either. And the banking index was the one to be watched out for, considering the amount of updates that we have seen, and it has been equally volatile, swinging between gains and losses. At one point, the index was down almost 400 points at the start of trade, still managing to see some recovery from lower levels, managing to hold on to that 51,000 mark on the downside. That's the more important bit. The other important bit is the fluctuation in oil prices as well. At one point, WTI was close to 115 this morning, but now they've cooled off slightly, still at above 110. Brent too is at 110. So oil prices remain elevated, no let off there. But the bigger talking point has been the business updates that came in over the quarter, over the long weekend, and take a look at the reaction that you're seeing. Most of these consumption-oriented names have done well in the fourth quarter. Senco is up 12%. Trent is the top Nifty gainer today, 6% higher, seeing the fastest growth in FY26 that it saw in any of the 4 quarters. And Nykaa too projecting healthy growth for the quarter and for the full financial year, 3% higher there as well. The banking stocks, we lost count of the number of banks that have reported results. So Ritu will tell you more about that. But look at the reactions as well. Bank of Baroda doing fairly okay, but IndusInd Bank, after the decline seen in its advances and deposits, and Kotak Mahindra Bank has continued to remain lower among the top laggards on the banking index. The unseasonal rains and the decline in the heat across the country has not boded well for these consumer durables companies. Voltas at one point was down 2.5%, is still recovering some of those losses. PG Electroplast continues to remain lower, as the Symphony, that too is down close to around 2%. But what is extending its gains though is V-Mart Retail. They had a very healthy business update last week. We spoke to the management as well. This stock is up 10% today as well. A beaten down name, Ola Electric, continues to see some bit of rebound from lower levels, and BSE too is seeing gains of around 2% in today's trade. And stocks that are at 52-week lows in today's session, even in a market like this, you have Syngene that's at a 52-week low, as is the Nifty constituent Max Healthcare and JSW Infra above its IPO price but at a 52-week low. And lastly, the stock to address is the top gainer in the broader markets today. Zydus Wellness is up 13%, the top gainer on the small cap index, on the Nifty 500 as well. the biggest single day gain that the stock has seen since December of 2014. So lots of things to react to. There are pockets of strength, but as of now, the markets continue to remain very choppy in the first couple of hours.
All right, Hormaz, thanks very much. Choppy markets it is, but let's focus on a couple of counters that are buzzing on the back of the updates that they released over the weekend, their fourth quarter updates. Some of these consumer discretionary stocks in particular are up and about. Trent and Nykaa are the two ones we're going to focus on, and Vinny is joining in with the details of that. Vinny, starting with Trent, one of the best quarters it has had in this financial year.
Hi, Ritu. Good morning. Yes, absolutely. One of the best quarters that Trent has had. 20% growth this time. 4,900 crores approximately is what the revenue for Q4 will come in at. FY26 revenue growth also is at 18%. Total stores added as on 31st March 2026 for the full year. The total store count stands at 1,286. West Side stores for FY26 that they were added are 52 stores. Zudio also 198 stores. So strong store addition that's come in for West Side as well as Zudio. So that is also something that will be leading the growth for the company. Now overall, obviously, like I mentioned, best quarter for FY26. So if you just look at the trend, Q1 was 19%, then Q2, Q3 was 17%, and Q4 is 20% growth. So good growth overall for Trent, and that is why the stock is buzzing. Top Nifty gainer as well. Nykaa, on the other hand, also good quarter that's coming for the company. Consolidated gross merchandise value growth that we would talk about, the GMV growth, that's in the late 20s. NSV, net sales value growth, that's in high early 30s. Early 30s is the growth there. Net revenue growth, late 20s as well. So overall, beauty segment, that's leading to the good growth for the company in late 20s. Fashion segment, which is a smaller segment relatively compared to beauty segment for the company, but that has also continued to see growth, and this time also they are expecting to see around early 40s growth that would come in for the fashion segment as well. So strong growth there, and this is the 14th quarter that the company would report a more than 20% growth in terms of revenue. So that is why positive there for Nykaa as well.
All right, 14 quarters of over 20% growth. Vinny, thanks very much for bringing us those updates. But we'll now shift focus to what is clearly our big story of the day, and that is the updates coming in from banks and NBFCs closing out the fourth quarter with a fairly strong operating print. But the divergence between growth and funding is becoming a bit more clear in these numbers. Starting with banks, loan growth clearly was the highlight of the quarter across the system. You had advances growth come in strong at about 7 to 27% growth year-on-year, 2 to 11% sequentially, with most banks beating what the street was factoring in, starting with HDFC Bank, RBL Bank, Ujjivan, Bank of Baroda, AU Small Finance Bank, Yes Bank. They all stood out in their loan growth numbers. But on the flip side, you had IndusInd Bank, which saw a degrowth both year-on-year and sequentially, and then smaller private banks like Karur Vysya lagging expectations. Deposits is where the picture is a little more mixed. You have deposit growth ranging between 1 to 16% sequentially and up to 25% year-on-year. RBL Bank, Bank of Baroda, AU, HDFC, Yes Bank, Union, Kotak, they all saw strong traction there. But IDFC First Bank, Karur Vysya again, Equitas, Punjab National Bank, they underperformed. Overall, also what you're seeing is stronger traction on the loan growth front, little mixed picture on the deposit front. Because of this, it is also getting reflected in the credit deposit ratio of banks. The credit deposit ratio, or what we call the loan deposit ratio, or LDR as well sometimes, that has inched up sharply about 11 percentage points year-on-year overall. The system-wide LDR, as per RBI numbers, is at an all-time high of more than 83%. That tells you there is funding tightness building in the system. IDFC First Bank reporting one of the highest LDRs across the system at more than 102%. HDFC Bank, Yes Bank, and RBL Bank, though, saw their CD ratios decline quarter on quarter. The CASA trend was also seasonally supportive. The growth came in at 4 to 26% quarter on quarter. Most banks there also saw improvement. Kotak Bank, RBL Bank, Yes Bank, HDFC, all reporting healthy CASA ratios on a sequential basis, though structurally, CASA ratios remain under pressure for some of the lenders. For instance, IDFC, AU Small Finance Bank, CSB, they saw a contraction during the quarter. Let's also now shift focus to the non-banks, the NBFCs, where the fourth quarter was steady, largely in line with expectations for most, and it was supported by the seasonal strength we typically see in the fourth quarter. So Bajaj Finance reporting an AUM growth of more than 22% year-on-year. But keep in mind, this is one of the lowest growths that we've seen in Bajaj Finance sub the COVID years, and the deposits also declined year-on-year year and sequentially as well. On the other hand, L&T Finance saw retail loans grow more than 25%. You had M&M Finance, which saw improving asset quality trends, with stage 2 assets coming down, collection efficiency improving, disbursements and AUM growing 10 to 11% year on year. And in the housing finance space, Aavas Financiers reporting a strong disbursement growth, improving asset quality, higher repayment rates as well. So overall, good, strong show across most banks and NBFCs, but the pressure is shifting to funding and to liquidity. That's a space we will keep our eye out on. Now, earlier on, we caught up with Nitin Agarwal of Motilal Oswal Financial Services to decode these numbers from the financial sector. Listen in to what he had to say.
Several updates have come on the bank side, and most of them are on the positive side, and many of them have gone on to beat our estimate for the quarter. The HDFC Bank reporting a pretty stellar kind of a deposit growth, and even Axis, which reported again, it has been doing well as given that their guidance to beat the system growth by 3% over a 3-year basis. But the bank has done quite well over this year, and therefore it's pretty much on the right track. And amongst mid-sized banks, RBL clearly stands out with a double-digit growth that they've reported on the business front, and kind of a precursor to how the growth numbers can change once the deal concludes. And the other bank that stands out clearly is AU Bank, which has also reported a very strong business growth both on advances and deposit side. Into the preview, we have just cut numbers by around 2% for PSU banks and marginally 1% for private banks. And that is a reflection on how the bond yields have gone up, how the deposit rates have not been able to come down to the extent that one was looking at 3 months back. And now the wholesale deposit rate, the CD rates, they've all gone up quite considerably. So far, for this year, we are looking at a 13.5 to maybe range around 14% kind of credit growth for this year. And our estimate is that the growth will sustain at 14% CAGR over the next 2 years.
Back at the day's low now for the index at 22,550 is where we stand. 22,542 is the low of the day, and Reliance Industries is the key determinant for that. Nigel just spoke about that a few minutes ago. At the lowest point of the day now is Reliance Industries, 4% lower on the stock, now below the mark of 1300. Take a short break, continue our conversation on the markets, but focus on the bonds on the other side with Manisha Gupta.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome back. The markets are extending their losses as we speak. It's about a 150-point cut on the frontline index. 22,566 is where we're at. But as promised, let's shift focus to the bond markets. And Manisha Gupta is joining in with the roundup of all of the action there. Manisha.
Well, thank you so much for that. When you look at the markets overall, yes, they are quite jittery and taking cues clearly from the Iran conflict. Therein, the US dollar index is back again 100, and that seems to be putting a bit of a pressure when it comes to Indian markets. The crude oil price is also holding around that $110 a barrel mark, is about stoking inflation, and all eyes, of course, would be on the RBI meeting in this week itself. RBI in the recent days clearly has supported the Indian rupee with the liquidity injections. We also have seen RBI take some very strong steps in sense of foreign exchange rules in the previous week itself. So RBI not just has curbed arbitrage and speculative trading against the Indian rupee, but we also have seen the rupee react to that. So the 2% gains that we saw in the previous week was the best weekly gain that the rupee has put in since November 2022, and some more support, as we can see on our screens, coming in for the Indian currency. For the bonds, the 10-year yield jumped up to 7.1%. We are looking at those levels therein as well. This has been the biggest weekly jump since May 2022. So big moves coming in for the money markets therein. Interestingly, the RBI is expected to hold interest rates and policies stand steady in the meeting this time. That is at least what the MPC meetings at least seem to be putting out. Also, the monetary policy, of course, is going to be announced on Wednesday, but RBI may show readiness to support the rupee and, of course, inject liquidity to contain the bond yields. RBI in its paper on Friday has said that the 7 states will raise nearly 181 billion rupees. This is on Tuesday. And this is the first scheduled auction of state bonds that we are listening in for 2026-27. The state and union territories are expected to borrow something like 2.55 trillion through bonds in this current quarter between April to month of June. RBI also has revised optional or operational guidelines when it comes to floating rate saving bonds for 2020. The 2026 is improvised in sense of investor services and streamlined processing as well.
Manisha, thank you for those updates there. Continue to hover around the lows of the day. Take a short break. Back with Market Technicals with Soumit Mehta of Mirae Asset Sharekhan on the other side. Stay tuned.
CNBC TV 18 and India Bonds presents Bond Street.
There's a 50-point recovery from the lows of the day, and it's continuing to remain very volatile, as has been the case all through the morning. Back above 22,600 now for the index, still 100 points lower. Saumil Mehta of Mirae Asset Share Khan joins in for a quick chart check. Saumil, good morning. Thank you for joining in. This is very, very volatile market. Do you assume that the higher levels will not sustain, considering the uncertainties that surround us? Your call on the index, more importantly, the Nifty Bank as well, and your stock recommendations for the morning.
Good morning to everyone. See, the overall trend in the medium-term outlook still remains negative. We're forming low tops, low bottom on the monthly, weekly chart. So the entire trend is negative. However, we have a very, very strong support around 22,000. So I'm expecting a good bounce here. In fact, even the last week, which we have had a good volatility between 300, 400 points, I'm still expecting the bounce to continue. And I think from here, the bounce would be till the 20 daily moving average, which is 23,350. And the next target on the upside would be 23,850 levels, which is the previous swing high in the weekly charts. So these are the two targets I have for the bounce. And I'm absolutely positive on, for this bounce. However, the overall trend still remains negative, and I'll be expecting more downside targets in the medium-term outlook. Now, on the bank side, Bank Nifty, very similar. We've seen a very sharp decline. Now, from the last, 4 to 5 trading sessions, we are trading near 50,000, 50,100 lows, and we've taken support at those levels. Now, I'll be expecting Bank Nifty to, hold these supports and give us a very good bounce from here till 54,000. And if we sustain around 54,000, which is 20 daily moving average, then the next target would be 55,200 levels, which is the 38% retracement of the entire fall. So I'm expecting a good bounce. I'll be positive. The crucial support would be 50,000 for Bank Nifty, and crucial support for Nifty would be 22,000. So positive for a short-term bounce.
All right, Saumil, thanks very much for joining in with those views. We'll now shift focus to the pharma space, where the US President Donald Trump has signed an order to levy 100% tariffs on patented pharma products. Ekta is joining us for more on how this could impact the Indian pharma market. Ekta.
Well, yes, I'll start with the news. And there are 2-3 pieces of news with regards to this, announcement from the US government. First is that the US government has announced a 100% tariff on imports of branded pharma as well as their ingredients. It is applicable where companies have not entered into prior agreements with the US government, and branded imports from certain countries such as Japan, the European Union, Korea, Switzerland will be fined at 15% tariff only, and hence will be lesser than that 100% tariff. Now, separately, generic drugs, which are and their associated ingredients, as well as biosimilars, which are basically the similar versions of biologic drugs, will be exempt from tariffs. However, this will be reassessed in 1 year. Now, the impact is, for example, for Sun Pharma, there is a sentiment overhang. Now, that is because they have a significant portion of their drugs coming in from branded generics. Around 20% of their sales comes in from branded generics, branded pharmaceuticals globally. Now, however, a significant portion of what Sun manufactures, in fact, falls under the exempt jurisdictions, and hence they are unlikely to be impacted that much. So there are certain drugs, however, such as Zelpros as well as Sezaby, which are manufactured in India and hence could be impacted, which are a part of their branded drug portfolio. The estimate is around 1 to 2% of their revenue could be impacted due to these 15% tariffs that we are seeing in these exempt jurisdictions. Now, in terms of CDMOs such as Divi's, Laurus Labs, Syngene, OneSource, etc., minimal implications because the tariff burden is absorbed by the innovators. And remember, around 13 innovators have already signed up with the Trump administration in terms of deals. For generics, while there is relief at this point in time, the overhang continues because the US government has said that they're going to reassess tariffs in the next 1 year.
Ekta, thank you for those updates there. Take a short break. On the other side, we talk market fundamentals with Sunny Agarwal of SBI Securities. Welcome back. The other stock that has been doing well today has been NMDC, and that's because of the fact that it has hiked its iron ore prices. Nigel is here with more details on this. Nigel.
Well, that's right. NMDC has gone ahead and they have hiked their prices on both lumps as well as fines effective April 5th. Now, this is important because the total quantum of the increase is around 400 to around 500 rupees or thereabouts. And all of this is being done at one shot. That means effectively that in percentage terms, the price hike is to the tune of closer around 10%. Remember, from January onwards, prices have steadily been increased. So if you just want to plot a chart out there, you'll see that on fines from January till date, it's moved up by close to around 600 rupees. And on lumps, it's close to around 700 rupees. This is for the Bailadila mine that they normally report out there. So a hike was something that the street was working with. However, the quantum is something that the street is pleasantly surprised by. And that's why you have the stock that's buzzing in trade today. Back to you.
All right, Nigel, thanks very much for joining. And with that, we now shift focus to Wipro. The IT bellwether is in focus after the company bagged an 8-year billion-dollar deal with Olam Group. Rima is here with the details of the significance of this and what it means for Wipro. Rima.
Thanks so much for that. As you rightly pointed out, Wipro has secured a large multi-year deal with Olam Group. The total potential of the deal is $1 billion, but the guaranteed assured revenues are $800 million plus, spread over 8 years. As a part of this deal, Wipro has also said that they will be acquiring Olam's captive IT arm. It's called Mindsprint, and for that, Wipro will be paying $375 million, and the acquired company, Mindsprint, had revenues of $135 million. So basically, what Wipro is doing is that it has secured revenues of $135 million at least for the next 8 years on an annual basis. That's $1 billion, which is what the street perhaps is reacting to. So at a time when organic revenue growth for the IT companies is weak, this is an assured revenue, plus they get a sticky customer, a long-term revenue potential, and it opens up avenues in the food tech agro space where Olam is pretty big in. The only negative when I speak to analysts is that, many of these deals, when they come with acquiring the captive IT unit, also perhaps imply lower margins because you're taking on those 3,200 plus employees from that IT arm. So we'll have to wait to see, what the margins are. But, why the street is reacting positively, because at a time when growth is slowing down, they have got assured guaranteed revenues, a long-term deal, which is, where the potential is nearly $1 billion. Back to you.
Slightly off the highs of the day is Wipro, still holding on to gains of 1%. Rima, thank you for that update. You take a look at some of the losers from the small cap space. The RB Infra is down 6%, and the stock went ex-bonus last week. And that day the stock went up, but it was down on Thursday. It's extending those losses in today's session as well. So another 6% shaved off on IRB Infra. The other one that's not doing well today is Latent View. Now, these couple of stocks are seeing some profit booking. Latent View was up 20% on Thursday, as down around 5% in today's session, seeing some profit booking today. And the other one that's seeing some profit booking today is Zaggle. It came out with its update for the quarter and for the year, and also shared its outlook for FY27. That stock did well on Thursday, and now seeing some profit booking in today's session. So 4.5% down on Zaggle as well. Let's get in Sunny Agarwal from SBI Securities, who is joining in on the show. Sunny, good morning. Thank you for joining in. We've had almost 30 odd banking and financial updates that have come in from over the long weekend, and as we head into the earnings season, what do you make of most of these updates? HDFC Bank, one major issue that was plaguing the bank was its CD ratio. That has been addressed as well this time around. So let's just go with HDFC Bank for now, and then we get on to the others. With all of that negativity around the stock, is everything now priced in? The stock down almost 30% from its 52-week highs. Your call here.
Good morning, Harmur, and thanks for having me on the show. Yeah, definitely very strong provisional update by all the bank across the board. In fact, a small finance bank, public sector as well as private. And as you rightly pointed out, especially for HDFC Bank, where we have seen a deposit growth outpacing the credit growth. That was a key concern for the bank, and that is something which should help the bank to report a healthy growth in FY27 and FY28. And as you rightly pointed out, valuations have done a very comfortable post the recent correction. So we believe it's the right time if somebody is a long-term investor, as we believe FY27 is a year where bank may report growth at par with an industry, and then FY27 is a year where FY28 is a year where we may see an HDFC Bank outpacing an industry growth. So I think the momentum is likely to build up over the period of next 4 to 8 quarters. We believe the fair value of the business is closer to 1100 rupees, keeping that price target in mind. Definitely HDFC Bank can be accumulated. In addition to HDFC Bank, we see a very strong provisional updates from banks like AU Small Finance Bank, Bank of Baroda. Again, a very strong update by both these banks. Overall, even on a small finance pack side, we have seen a very strong update by Equita. It seems that the problem on MFI seems to be getting resolved, and going forward, the smaller ticket size loan like MFI should also do well. So I think it seems that if Q4 is likely to be a very robust quarter for a bank in terms of earning growth. NIM is definitely an area of concern, which we believe should be taken care in FY27.
Okay, so another year of wait for HDFC Bank shareholders before we see any returns from the stock. But Sunny, fourth quarter, let's keep in mind it's structurally a stronger quarter for banks anyway. What I thought stood out was PSU banks actually losing share in the deposit space. They're gaining on the loan side, but they're losing share in the deposit space compared to some of the private peers. What do you make of that development? And specifically in the PSU side, what are the names that stood out for you?
Among the PSU, what we believe is that key outstanding name are Bank of Baroda. Bank of Maharashtra again stood out very clearly in terms of asset quality, and Indian Bank in terms of the quality of growth which we are going to see. In terms of loss of share on deposit side, definitely it's an area of concern for both public as well as PSU, as the investors are finding a better investment opportunity going forward. And obviously during the time of uncertainty, we believe that investors usually tend to shift towards a private bank in terms of deposit, as we have seen the recently smaller banks like IDFC, where we have seen some concern on 1 or 2 branches. But overall, it seems that overall banking as a sector is facing a problem of mobilizing deposits going forward. But as we have seen that equity markets have given a very muted return during the last 12 to 18 months, we are hopeful that going forward, maybe gradually deposits should start coming back to banking sector.
Okay, Sunny, on IT, you say the worst is priced in terms of valuations. You see favorable risk reward in names like HCL Tech and Persistent. Apart from that, what do you think will drive the re-rating from here? Is it just the, the AI risk that is on one hand playing out, the Rupee tailwind that is coming in? And what do you specifically, if any, views on the Wipro stock, given what we heard on the Olam deal coming in?
I think what we feel is that worst in terms of growth or any deflationary pressure because of likely AI taking over a lower end of a job is priced in, and that is the reason we have seen a valuation compression. As we speak, most of the IT companies are either trading at par with a Nifty 50 valuation or at discount to a Nifty 50 valuation. And now going forward, obviously, the companies which are able to scale up on AI-related services, they can outpace in terms of growth. And those are the pocket where investor can look forward to invest from a medium to long-term perspective. As we have seen, most of the IT companies recently, even during the Global AI Summit in India, they have tied up with a global AI service provider. And in a regulatory environment, I believe that the well-established IT services player are those who will win the deal going forward. And within that pack, we have seen that companies like, for that matter, recently the Wipro, they have done one deal, or for that matter, TCS have tied up with Anthropic. What we feel is that Q4 commentary on growth guidance for FY27 and 28 for IT services, especially on AI side, will be a key monitorable. But having said that, overall, it seems that downside is very limited. If somebody want to start accumulating IT stock from a medium to long-term perspective, few stock which we feel can outperform are HCL Tech, Persistent, and Coach.
Sunny, the one business update that has stood out in terms of stock reaction today is Senco Gold, and a lot of these jewelry companies will come out with their business updates soon enough. But in this sector, with the fall in gold prices from higher levels, the upcoming wedding season, and multiple triggers that lie ahead for these companies, do you stick to pedigree like Titan, the tried and tested, or do you bet on the emerging horses that would become the Titans going forward, say the Sencos or the Kalyans? Where do your preferences lie?
I think, Hormuz, I would like to bet on mid-sized players which are expanding on a pan-India basis, as they have got a tailwind in terms of penetrating into a new geography, and at the same time, they are adopting an asset-light franchising model that should help them retain their margin going forward. But having said that, one has to keep in mind that this year has been a year where we have seen a significant value growth on account of a magnificent rise in gold and silver prices. And as the lower base effects start to wane in second half of FY27, at that point of time, the growth should normalize for the entire jewelry as a pack. Till that time, maybe a quarter or two, we may again see a very robust value growth for all the jewelry major. What we feel is that players like Senco, which has reported a very solid set of provisional updates. In addition to that, companies like Kalyan and PN Gadgil should continue to gain the market share from unorganized player. Maybe shift from unorganized to organized is something in a very higher pricing environment is something which is clearly imminent. Would like to stick with the mid-sized players.
Sunny, the war has also put the spotlight on the one major segment that has been the oil marketing companies, the HPCL, BPCLs and the IOCs. All of them were down 25 to 30% in the month of March. There is no let-off in oil prices still. And the uncertainties of the war continue to persist as well. So within this basket, do you choose to stay away considering until more clarity emerges, or do you believe that this 25-30% odd correction is enough for a long-term investor to start nibbling into these names?
I think, again, wait and watch approach is the right way, because we don't know till what time the crude oil will continue to hover above $100, and till what time the retail fuel pump prices will continue to be retained at the current prices. So I think slightly an area of dilemma of situation is slightly fluid. Definitely the valuations have turned comfortable. Seeing that quarter 4 will be again a bumper quarter, because Jan and Feb month were a normal month for all the oil marketing companies, and March is the month where we have seen a spike in crude oil prices, and hence the impact of losses on account of marketing will be very limited to the month of March. Yes, definitely in case this higher crude oil prices sustain for 2-3 months, then maybe June quarter is the quarter where we will see a significant impact in terms of earnings. So would like to wait and watch, but definitely if somebody, the long-term investor, maybe over the period of next 3 to 6 months, HPCL is the one stock which one can look forward to in terms of adding to the watch list and then gradually accumulate.
All right, Sunny, thank you so much for sparing time and joining us today with your views on all of these stocks. We'll take a short break. On the other side, we'll be joined by Prakash Pandey of Fitch Ratings to discuss their outlook for banks amidst the liquidity crisis and the margin concerns.
Welcome back. Fitch ratings is set that the rupee volatility and global risks can constrain the Reserve Bank's liquidity support and weigh on bank margins. Prakash Pandey, who is Associate Director of Financial Institutions at Fitch Ratings, joins us now to decode this latest report they've come out with and the impact on the financial space overall. Prakash, thanks very much for being here. You know, in your report, you say there's about a 20 to 30 basis point NIM contraction you're looking at below your 3.1% baseline for FY27. You know, if these pressures persist. But I wanted to start by clarifying, what do you mean by persist? Are you factoring in a 3-month window, a 6-month window for these conflict-related pressures? And what happens beyond that?
Thanks, Ritu, for the opportunity and a very fair question at the outset. So, yeah, let me address that to begin with. What we're really saying is we've seen some tightening in the funding conditions in the system, despite RBI's efforts at increasing liquidity in the system, which they have been for the last year and a half. What we're saying is funding conditions remaining tight as they have been in the last month or so. If that's how it persists for another year, we see the margins going down by roughly around 20-30 basis points. That said, I'd also like to caveat it that margins are still pretty close to cyclical highs. Margins peaked around FY 23-24 at around 3.5% for the system. We still see them sustaining close to 3%, you know, probably a 2.8, 2.9% mark. So it's by any means a reasonable number to go with. All we're trying to flag is if the funding tightening persists, because RBI hands relatively get tied because of its, you know, having to manage the funding conditions in the local banking system and also managing the pressures on the rupee, then this is what we expect the margin impact to be.
Prakash, just to follow up on that, on margins, you say only about 44 basis points of RBI's 125 basis point rate cut has been passed on the deposit side. You know, isn't that to say then in a scenario where we're going to see a pause and then hikes from the central bank, we've not seen the deposit rate cuts fully passed on yet. At the levels that margins are currently at, have they peaked? And do they only go down from here, at least in this cycle?
Well, before this Middle East crisis happened, we expected that margins will start to stabilize and potentially rise marginally. Now we see some tightening from where we are, given what we've published, but it's by no means going to be a structural decline as we see as of now. You know, so even if the tighter funding conditions as we see now are sustained, the downside is roughly that 20-30 basis points impact, and after that things should stabilize. This is also considering the fact that despite some pressures, you know, in terms of managing local liquidity by RBI, the banking system is still largely local currency denominated, which still leaves meaningful flexibility with the RBI, if necessary, through open market operations and other operations to keep injecting liquidity into the system, and which supports the banking system margins.
Prakash, the one risk that you have highlighted in your note about higher energy and input costs leading to a potential weakening of SME repayment capacity. Now, there have been reports about a lot of these SMEs being impacted already a month into the war. Now, let us assume on a base case that oil prices continue to remain higher for a prolonged period, as has been anticipated as well. What kind of an impact do you see on the bank's asset qualities? And also, if they are well funded, the banks, and their balance sheets remain strong, would their provisions be adequate to cover up for any slippages that come in from the SME front?
So fair questions. I mean, let me give you at the outset, our economic growth assumptions factor in oil at roughly $90 to $100 a barrel. So a fair bit of an uptick was factored in there. If pressures persist, the cost side pressures would lead to moderate impact on the SME credit profile. But let me give you some context in terms of how far the banking sector has generally come in terms of where it used to be in the last cycle. So the asset quality has improved from around 11 to 12% on the NPL in March 2018 to around 1.9% in December 2025. So given the improvements, banks have significant buffers on the asset quality. There are also meaningful buffers in terms of their profitability. So yes, there'll be moderate impact on the SME books, but we believe banks are reasonably placed to absorb that, given their provisioning buffers are close to the 75% mark at a sector level. They also have contingent provisioning in order to prepare for the potential application of Ind AS in FY28. So we do see the sector as reasonably prepared to absorb downside risks at this point.
Prakash, what about the RBI directive on capping the net open positions on the forex side at 100 million starting the 10th of April? What is the best and worst case scenario on the hit to profitability? Which are the banks that are more vulnerable? And also with bond yields, we're seeing them at multi-year highs. I mean, 7.13, 7.11. For treasury books as well, we are expecting to see a hit in the fourth quarter. So what is the best and worst case scenario, and who are the best and worst placed banks?
Well, first on the forex measures, frankly, for the P&Ls of banks, as we look at them, the contribution from their FX revenues, FX trading revenues, is not particularly significant. While in absolute terms it may be large, but as a proportion of their risk-weighted assets or total assets, it's a very small quantum, so we don't see it impacting their earnings. The second question on treasury, we've factored in some degree of tightening of the long-term yields in our current forecast, so we don't see meaningful downside there. That said, if the yields were to tighten meaningfully from current levels, which is 7.1% roughly, there could be some moderate downside. Again, thinking from a credit analyst point of view, as we do, earnings buffers compared to where we assess our earnings and profitability scores of Indian banks, there are meaningful buffers that they keep. So I think that I don't think that that's going to be an impact on how we look at the standalone ratings. And if I might add one bit, the bank ratings are all driven by support or backstopped by support. So even if there were to be moderate pressures on the standalone profiles, which we do not see in our base case, but potentially in case of sustained much higher than expected pressures due to Middle East conflict, I believe the final ratings of the banks would likely remain where they are nonetheless.
Okay, on that positive note, no downside pressure, but perhaps stay where they are. On the ratings front for the banking sector, not much of a hit because of these forex rules. Prakash Pandey, thanks very much for joining in with those views. We appreciate your time here on CNBC TV 18. On that note, we're going to slip into a short break, but up next, we'll put the spotlight on the macro signals and more in the market, so stay tuned. Welcome back. Let's get you the macro signal of the day. The markets, of course, still in the red. The Nifty is down about 40 points as we speak, and the Sensex is down about 170 points as we speak. The Rupee, though, has strengthened for the second straight session. It is now trading at about 93.07 is where it's at, which has appreciated by about 3 basis points. From Thursday's close of about 93.10 to the dollar. Remember, Rupee had posted its sharpest single-day gain since 23 last Thursday, when it rose by almost 2% as markets reacted to the measures that were taken by the Reserve Bank of India. Now, on the bond market side, the 10-year benchmark yield is trading at about 7.12 as we speak this morning, easing slightly from the previous close, which was about 7.13 on Thursday, which was a multi-year high. The yields have seen a modest recovery after state governments announced a borrowing plan of about 2.5 lakh crore rupees for the April-June quarter, which is a tad lower than what the market was penciling in at about 3 lakh crore. So that's helping a bit, but higher oil prices are stoking inflation fears, and that continues to exert pressure, of course, apart from the oversupply concerns. Now, speaking of oil prices, they've surged sharply because of what's happening in the Gulf region with the Iran war continuing now into its 5th week. Importantly, WTI, interestingly, is trading at a rare premium to Brent, which is seen as a sign of extreme market stress and immediate delivery concerns. The Brent crude trading at about 109.7 per barrel, up about 0.7% as we speak. The WTI crude also is up about $112 a barrel. Prices reacting to U.S. President Donald Trump last setting a Tuesday deadline for Iran to reopen the Strait of Hormuz, threatening strikes on the country's power plants and bridges if they do not comply. So all of it linked to what's happening in West Asia. But Hormuz, the markets remaining quite volatile.
They are indeed, and we started off a couple of segments into the show. The Nifty was down 150, 160 points, and now we are down 50 points. So that's the kind of choppiness that you are seeing on the market today. There has been no clear trend, no clear direction, and as we head into the weekly expiry tomorrow, then into the RBI policy on Wednesday, TCS's results on Thursday, there is a lot that the market has to look forward to as we go further into the week. And look at the Nifty Bank as well. It has been swinging constantly between gains and losses. Pull up Reliance Industries as well. At one point, the stock was down almost 4%. At the lows of the day, and that was dragging the Nifty lower. No let off there, at least. It's still 3.5% lower on Reliance Industries. What has surged to the highs of the day, though, is Newland Laboratories. That is now up 7%. Is the second best performer on the Nifty 500 as we speak, and good going for Newland Laboratories. Most of that spike coming in over the last 30 minutes or so. Godrej Properties has now moved to the highs of the day, 4.5% higher there as well. Vishal Megamart is up 4%. So good going for a lot of these beaten down broader market names that are doing well in today's session. Let's now listen in to Bank of America's Amish Shah on the stagflation risks in India, the cut to their growth expectations, oil prices, earnings downgrades, as well as India potentially underperforming as an emerging market this year.
Stagflation risks are now real. If I look at the macro, we are already forecasting that the GDP growth will come down from 7.4 that we were estimating earlier to 6.5. Similarly, fiscal deficit is going to go up, inflation is going to go up. We are already forecasting for a 50 basis points interest rate hike this fiscal. Similarly, on the commodity side, we are now working with $92.5 per barrel of crude for the year as a whole on an average, $100 for the remainder of this year. On the 2nd of March itself, we had brought down our earnings growth from 14 earlier to 11, and now we are taking it down from 11 to 8.5. NBFCs, real estate, REITs, passenger vehicles, everything that's rate sensitive gets impacted. And obviously, if you are working with a higher crude, then downstream energy and the consumers of crude and crude products, those are the ones that get impacted the most. We believe that India will continue to underperform the emerging markets this year. Street is at 15, we are at 8.5. On our numbers, Nifty is already at long-term average. So we are on the higher end of the band during the crisis period valuations. And if these valuations sustain, we do think that there is a 15% upside to the markets from current levels. But in the bear case, if the valuations do go to the lower end of the band, which is -1 standard deviation, then we could potentially see a 8% downside. So even if we work with a -8 plus 15, we think that the risk reward is now favorable.
Well, that we take a leave on this edition of Trading Hour from Ritu and me. Thank you for watching. We leave the market in a very volatile state for the team of Halftime Report on the other side.
And stocks drag while mid-caps eke out gains after Trump sets a Tuesday deadline for reopening of the Strait of Hormuz. His words up the ante in the West Asia war, but also signal an urgency to end the conflict, keeping investors on edge.
Wipro inks a nearly $1 billion multi-year transformational deal with food and agri major Olam Group, entailing the acquisition of Minceprint with 3,200 employees for $375 million. The acquisition growth move could kick off a trend in the sector.
And a rush of business updates from banks and NBFCs revealed strong growth in advances in Q4, but many struggle to raise deposits, driving up the system loan to deposit ratio and signaling a likely pressure on margins going forward.
Retail majors, Avenue Supermarts and Trend point to strong near 20% growth in Q4, even as online beauty and fashion retailer sees growth in the high 20s. Mature FMCG businesses Dabur and AWL Agri also point to healthy volumes.
Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC TV 18 Motilal Oswal Studios. I'm Vinny Motiwala. With me are my colleagues Sonal Bhutra as well as Ekta Batra. Good afternoon, ladies. And today a bit of a volatile day is what we're seeing for the markets. Though about the 22,000 mark, 22,600 managing to hold on to that as well. Recovered from the day's lowest point as of now is what we're seeing for the Nifty 50, but still red on the screen is what we're seeing for the markets today. When we're seeing in terms of the mid and small cap, let's look at the Nifty mid-cap. Still, Nifty mid-cap is managing to do better than the Nifty small cap. The benchmark indices, Nifty mid-cap is holding on to gains of 0.4% in the trading session as well. In terms of sectors, we have PSU banks, IT, which are managing to hold on to gains in the trading session as well. Losers coming in from Nifty Pharma as well as FMCG, a bit under pressure as well, down almost 0.5%. Just a couple of names that I would like to highlight. We have Physicswala, Urban Company, as well as Meesho. These are some of the names that are buzzing around in the trading session as well. So let's pull those charts up as well, around 2-3% gain coming in for these platform names. So it'll be interesting to watch out for any update comes in here as well. But as of now, these platform companies are managing to hold on to gains.
Hi, Vinny. Hi, Sonal. Yes, absolutely. And you did mention sectors, so I just want to take that point forward, that I was just looking at how exactly the Nifty's performed as compared to various sectors since the West Asia conflict. So with the Nifty declining around 10-odd%, the biggest hit sectors have been rate sensitives, and this comes into play especially because we have the RBI policy this week. So the Nifty Bank is down around 15%, autos, realty declining anywhere between 14 to 15-odd%. What has been fairly in line in terms of losses as compared to the Nifty has been the entire consumption space. So the Nifty FMCG index itself is down around 10-odd%. The India consumption index, which basically reflects how exactly the consumption trends are panning out within the consumers, is down around 9-odd% as well. What has been fairly resilient at this point has been the Nifty IT, though it is down around 19-odd% on a year-to-date basis because of the entire AI trade. If you look at it from the West Asia conflict to now, it's been fairly resilient, along with the Pharma index, which is down around 6-odd%, which have relatively done better as compared to the Nifty. So that's basically the setup in terms of sectors at this point in time. Rate sensitives really taking the brunt of all of the losses.
They are, and RBI commentary will be very important to watch this week. And other than that, if we look at some of the moves that we are seeing on the markets, again a recovery which has come by. So watch out for that. We are above the 22,650 mark comfortably. Some of these consumption names also at the day's high. But let's tell you what we do have on the show today. It's a power pack show. In our What's Trending segment, we put the spotlight on Q4 FY26 business updates from FMCG sector. We'll also connect with Abneesh Roy of Nuvama Institutional Equities for more insights. And in our Movers and Shakers segment, we put the center stage on a whole host of financials, standalone refiners, and talk about Senco Gold as well. We'll then connect with Mukesh Sahadev of Zenalists in our Commodity Corner segment. We'll get you an excerpt from our conversation with management of OneSource Specialty Pharma on the semaglutide opportunity from their Bengaluru facility. Okay, then it's time for our Movers and Shakers segment where we'll track a whole host of stocks buzzing in trade. First up, Ritu is joining us. So many updates coming in from banks and NBFCs. Ritu, take it away.
Well, banks and NBFCs closing out the fourth quarter with a fairly strong operating print, but the divergence between growth and funding is getting more visible. Now, starting with banks, the loan growth clearly was the highlight this quarter. Across the system, advances growth came in at a strong 7 to 27% year-on-year and 2 to 11% sequentially. Most of the banks beat estimates like HDFC Bank, RBL Bank, Ujjivan, Bank of Baroda, EU Small Finance Bank, Yes Bank, they all stood out. But on the flip side, IndusInd Bank saw degrowth both year-on-year and sequentially, while Karur Vysya Bank lagged expectations. Now, deposits, that's where the picture was a bit more mixed. Deposit growth ranged between 1 to 16% sequentially and up to 25% year-on-year. RBL Bank, again, Bank of Baroda, EU Small Finance Bank, HDFC, Yes, Union, Kotak, they all saw strong traction, but IDFC First Bank, Karur Vysya, Equitas, Punjab National underperformed. So what you're seeing is loan growth continuing to outpace deposits, and that is reflecting in the LDR or the credit deposit ratio as well. The CD ratio has inched up sharply, up about 11 percentage points year-on-year overall. The system-wide LDR is also now at an all-time high of around 83%. That tells you funding tightness is building in the system. IDFC First Bank reporting one of the highest LDRs at more than 102%, but HDFC Bank, Yes Bank, RBL Bank saw their CD ratio decline quarter on quarter. CASA trends were also supportive. Seasonally, growth came in at 4 to 26% quarter on quarter. Most banks also saw an improvement. Kotak, RBL, Yes Bank, HDFC Bank all reported healthy CASA ratio expansion on a quarter-on-quarter basis, though structurally, these ratios are under pressure for some lenders. The likes of IDFC, AU, CSB, they saw a contraction in the quarter. Let's also look at NBFCs now, where the fourth quarter growth was steady overall, largely in line with street expectations, supported by seasonal strength. Bajaj Finance reported an AUM growth of more than 22% year-on-year, but their deposit growth saw a decline both year-on-year and sequentially, which has worried the street. L&T Finance saw retail loans grow more than 25%. M&M Finance saw asset quality improving, stage 2 assets coming down, collection efficiency improving, while disbursements and assets under management grew by 10 to 11% year-on-year. In the housing space, Aavas Finance reported a strong disbursement trend, improvement asset quality, and higher repayment rates. So overall, good show across both banks and NBFCs, but the pressure is clearly shifting towards funding, margins, and liquidity.
Take that point. Thank you so much, Ritu, for bringing us all those details. Banks are something which are leading to the recovery in the markets as well. But let's talk about standalone refiners and the entire oil marketing company space, because there is a step away from the deregulation norms that started back in 2014. And now reports suggest that oil marketing companies have asked refiners to sell them fuel, that is petrol and diesel, at discounted rates, considering that they have not been able to pass it on to retail investors, despite the fact that crude oil prices have gone above that $100 per barrel mark. The report also suggests that retail fuel prices have been frozen despite global crude crossing $100. That is something that we saw, which led to excise duty cut, which gave a relief to oil marketing companies as well. Now, let me make it simpler for you. Refiners transfer fuel oils like petrol, diesel, and ATF to oil marketing companies at refinery transfer price. This is a price which is set internally, and now there is a cap on RTP. There is an indication that discounts could be as much as 60 rupees, which is a very big number as far as discounts are concerned. This, of course, would mean that there is a lot of pressure on refining companies like MRPL, Chennai Petro. There is some on oil marketing companies as well, but they're already taking a hit on the marketing side, right? So this refining discount that will come by will impact MRPL and Chennai Petro, to name a few companies. Now, remember, Ministry of Petroleum and Natural Gas on 1st April had indicated that on petrol, these companies are making a loss of or under recoveries of around 24.6 rupees, and on diesel around 105 rupees a litre. So they are trying to bifurcate, or at least expand the losses, or distribute the financial burden across the sector, and that's the indication why there is a big discount that is coming in on refining transfer price.
Okay, all right. So that's the entire oil and gas space, which is in focus, and that index also is corrected around 13% since the West Asia conflict. But let's talk about pharmaceuticals companies now. Remember that the news over the weekend is that the US government has announced 100% tariff on imports of branded pharma as well as their ingredients. Now, this is applicable where companies have not entered into prior agreements with the US government, and branded imports from certain geographies such as Japan, European Union, Korea, Switzerland are capped at around 15% tariff only. Now, separately, generics as well as their associated ingredients, which is basically the APIs, etc., as well as biosimilars, which are the biosimilar version of biologic drugs, are exempt from tariffs. This, however, will be reassessed in 1 year. Now, the impact is negative for Sun Pharma because it is a sentiment overhang. Now, however, it is important to note that analysts say that significant portion of the manufacturing of Sun's specialty portfolio falls under exempt jurisdictions. For example, a couple of drugs such as Cezazbi as well as Zelpros are manufactured in India, so they could be under the scanner, but there are majority of their specialty products which are in these exempt jurisdictions. So the estimated impact, according to analysts, is around 1 to 2% of their revenue due to this 15% tariff, which is on these exempt geographies. However, remember that we don't know what Sun Pharma's plan might be in order to possibly increase onshore manufacturing in the US or maybe strike a deal with the US government in order to secure themselves better. CDMOs, a minimal implication for Indian CDMOs such as Divi's, Laurus, Syngene's, OneSource, etc., because the tariff burden is going to be absorbed by the innovator companies. Generics such as Cipla, Lupin, Sun Pharma, Dr. Reddy's, Glenmark, Biocon, the overhang continues because the US government says that no tariffs right now for generic companies, but we'll be reassessing this in the next 1 year. But Vinny, you're watching Senco Gold.
Absolutely, and it's shining bright as gold as well today. We saw an uptick of more than 12% at one point of time. Now today also looking at the revenue growth for the company. Q4 update shows a 46% revenue growth. Wedding season, that led the growth for the company. SSSG growth that came in at 34%. While lightweight jewelry, that was trending. The gifting segment, that was trending. So they saw improvement in terms of footfalls, mainly because there was Valentine's Day as well as International Women's Day, which was supporting the growth for the gifting as well as lightweight segment. The company also said that they'll be focusing more on the lightweight segment going on from here on as well as everyday jewelry and everyday wear jewelry is what they'll focus on. For FY26 as a whole, they managed to see a good 35% growth this time. FY25, they've just seen a 21% growth. So improvement in terms of growth rate versus last year. Outlook for FY27 seems to be good as well. They aim to achieve a 20 to 25% value growth in FY27. They're expecting EBITDA margins to be in the range of 7.5 to 7.8% as well. And overall, they plan to launch 20 to 25 stores. So all that glitters is gold today, with that maybe Senco Gold also buzzing in trade.
It's been decent in terms of updates from the FMCG space in general. Of course, we'll discuss that in greater detail. But a lot of stocks which are on our radar, other than the ones that we just discussed. Vivek is here to take us to the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. You know, it's a sharp recovery from the intraday lows as far as markets are concerned. Advanced declination, the broad end of the markets, quite strong. In terms of the consumption pack, something that Vinny just highlighted, you know, most of the names that are doing quite well. Nykaa almost 2.5% higher after a good performance in the week gone by. DMart continues its move higher. Senco, like you mentioned, and Trent after a while seeing a 20% kind of growth. That stock seeing significant short covering high by over 6%. In terms of banks, PSU size, you know, quite a few banks came out with a strong set of numbers in terms of pre-quarterly updates. So look at Bank of Baroda, RBL Bank higher by almost 4%, and Axis Bank growth well above the system average. That particular stock trading higher by almost 2%. The other stock that did quite well or doing quite well is the NBFC pack. Within that, L&T Finance holding, that particular stock doing quite well. Bajaj Fin high by 0.5%, L&T Finance up by almost 3.3%. Both of the exchanges today, and you could add even an IEX to that particular list of BSE as well as MCX, both of these stocks moving higher quite significantly. MCX up by almost 4%. And the Defense Bank, after a brief bout of profit booking in the week gone by, most of the names continue to trend higher. Hindustan Aeronautics, Mazagon, Bharat Dynamics, Cochin Shipyard doing very well. On the other hand, quite a few stocks seeing a little bit of selling pressure. Kotak Mahindra Bank, soft loan growth over there. IndusInd Bank, muted growth. Both of these stocks seeing a bit of profit booking. The entire cooling solutions pack, you know, unseasonal rainfall across the country. So most of the cooling solution companies named like PG Electroplast, Voltas, Symphony, all of these stocks under pressure today. Capital goods stocks, you know, in the last hour or so, I've seen have slipped up quite a bit. So names like BHEL, Cummins has recovered a little bit. Siemens, this particular stock seeing selling pressure at high levels. Paytm, one of the top laggards as far as the FNO pack is concerned. And lastly, IRB Infra, a lot of news flow regarding payment delays, but we've got quite a lot of clarifications for the management despite that stock languishing as the top NSE 500 laggard today.
Okay, all right, Vivek. Thanks very much for that. So a lot of buzzing stocks in today's trading session. And we have the Midcap index, which is managing to hold its head above the water. It's a volatile session, but as of now, we have the Midcaps up around 0.3%. We'll do one thing. We'll take a short break, but we'll focus on the FMCG space, the FMCG Q4 business updates, and connect with Abneesh Roy of Nuvama Institutional Equities. That's our What's Trending segment and halftime report just after a short break. Stay tuned. Welcome back. Well, for the markets, it's turning out to be a volatile but stable session, you'd have to say at this point. So the Nifty is just about lower by around 47 odd points. The advanced decline ratio is the key parameter which has been holding on the positive side from the get-go today. So that's definitely positive. So 2,800 stocks advancing to around 1,565 stocks declining on the Bombay Stock Exchange. But let's track one particular segment, and this is our What's Trending segment on Halftime Report. We're tracking FMCG and retail stocks today, which are reacting both to early Q4 updates and the evolving impact of the West Asia conflict on input costs and demand trends. Let's go across to Vinny first for a quick snapshot of what she's tracking in terms of specific stocks. And after that, we'll have with us Abneesh Roy of Nuvama Institutional Equities, who will take us through the key takeaways, what the Q4 commentary is possibly signaling, and how the sector could shape up going ahead. Vinny, over to you first.
Hi, so we have a lot of FMCG as well as retail that have come in with their Q4 updates. Some of the retail names, Trent first up, good show today coming in from Trent in terms of a stock move as well. Growth of 20% is what they've reported this time. Best quarter in FY26, because previously they've seen a 17 to 19% growth from Q1 to Q3. So 20% growth this time. So best quarter there. Zudio stores, they've added good growth for Zudio stores overall in FY26 as well. 198 stores. West side, they managed to add good number of stores as well. Total store count at 52, and total stores overall for Trent stands at 1,286. Overall, all in all, good performance that's coming from Trent, led by Zudio as well as Westside store additions. Apart from that, Nykaa, good show there coming in from the company as well. This is the 14th quarter where the company will report a revenue growth of more than 20%. NSV, that's a net sales value, that's an early 30s growth for Q4 FY26. GMV, that's a gross merchandise value growth, is at 20% as well. Late 20s actually is what they're saying. So high 20s is what we could expect there. Beauty vertical doing well. Fashion vertical, smaller segment versus the beauty segment for the company. Still, that's also seeing a good growth. Avenue Supermart, again, over the weekend reported the numbers. Good growth on that front as well. Growth momentum has continued. They highlighted some improving consumer demand trends, sharp in-store execution that has improved as well. And pantry loading, that was a trend because of the US-Iran war, is what something they highlighted as well. Apart from that, Dabur, a good show coming in from Dabur also this time. In terms of the numbers, Dabur has managed to see good growth in terms of their overall HPC segment as well as in terms of the healthcare side of the business, food side of the business, which has managed to do well for the company. So Dabur also managing to do well, in line largely with what maybe the street was expecting, but no complaining in terms of the growth front as well. Middle East also, they said, did highlight some bit of an impact coming in on that front. AWL Agri, that's another one also which reported their Q4 numbers. That's more on the FMCG side. So overall volumes, 13% volume growth. Edible oils was supporting the growth as well. And Marico last week reported their numbers overall. Good show coming in from Marico as well. So these are the three important FMCG side companies, Dabur, AWL Agri, as well as Marico, which have reported a decent show so far in terms for Q4 FY26. But on that note, let's bring on board Abneesh Roy, Executive Director, Nuvama Institutional Equities, to take this conversation forward. Abneesh, good afternoon. Thank you so much for joining us on the show. Let's start by talking about these FMCG names, right? Today, Dabur is the latest one. Overall, with what you were expecting, in line with expectations, but for the... Okay, I believe we've lost Abneesh. We'll reconnect with him. But it'll be interesting to see, because Marico reported a very good show, while Dabur did highlight some bit of a concern coming in on the Middle East, Iran front as well. And what Avenue Supermart highlighted on the flip side was that they saw more people buying more goodies from the pantry point of view, loading more on that. So that is interesting to see, that we'll be seeing, maybe different companies reporting different set of numbers. A wide range maybe we could see coming in terms of the numbers as well, but we'll be seeing majorly the impact in terms of prices for raw material for them, or how is that going to be moving?
And I think Q4 will be the key determinant, and whether or not they need to take, price hikes Q1 onwards. But maybe we do have Abneesh back with us. Hi, Abneesh. Thanks very much for joining in. If you could just begin by giving us a sense in terms of what you made of all of the Q4 updates, Marico, Dabur, Avenue Supermarts, Trent also, and which one do you like the most and why, and do you think which one do you think is possibly the most resilient?
Yeah, I think we have seen good consumer updates. So good afternoon, first of all, to all the viewers. So we have seen good update from Marico, AWL, Dabur was in line, slight impact in the Middle East business clearly there. India business has seen recovery for Dabur. Even for the retail companies, DMart has really scaled up significantly in Q4 in the store addition, and overall growth of 19% is a good number. Even in Trent, 20% growth is slightly ahead of street expectation of 18 to 19%. Nykaa again strong growth. So generally good updates from most of the players. What we are seeing is clearly price growth will pick up now. Already pricing growth has come in edible oil companies. It has come in paint companies also. We expect that in Q1 we should see pricing growth come back in detergent, soaps, and overall FMCG. We expect 3 to 4% price growth, which is a good thing if the raw material scenario corrects. But currently, clearly, raw material is quite inflationary, so that's a challenge.
Absolutely, that's the challenge there, Abneesh. But what I also want to understand, Dabur has highlighted some bit of an update coming in from that Middle East front, some impact on that front. Which other companies maybe in Q4 will see a major impact versus other FMCG companies?
So good question. If you see most of the FMCG company, the exposure to Middle East is quite limited. It is in the low single digit. Two companies are on the slightly higher side, Dabur and Emami. So even in case of Emami, you will see that March month has been severely impacted in Middle East. So you will see the international business getting a high impact because 1 month out of 3 months, there is hardly any business in 6% of Emami. So for both Dabur and Emami, 6% of the console comes from Middle East. So the demand is there in Middle East. The manufacturing in India is there, or say even Dubai, but because of the Hormuz channel being closed, the shipments are not happening. So that is the challenge. For most of the other consumer companies, it is in the low single digit. So it doesn't really impact too much currently at least, but Dabur, Emami are the significant ones.
So Abneesh, when you spoke about price hikes and how Dabur and Emami are impacted, at what level of price hike will demand remain insulated? Because we're in April and the war is still going on and raw material prices are still hiking, are higher. Do you think at some point it will start impacting demand when these companies raise prices?
Yes, absolutely. Some impact can be there. For example, in paints, slightly discretionary, but customer paints once in 5 years. So the impact may not be too much eventually. Second bit is, yes, we are seeing Marico report and the high single-digit volume growth. So we are betting on companies like Tata Consumer, Marico, Nestle, Pidilite, etc. Even for paint companies, I think FY27, we should see mix of pricing growth and volume growth. Yes, some level of demand destruction can happen because FMCG companies will reverse the promotions, which will impact the volumes because some bit of growth comes from there. So yes, it is a monitorable. So higher promotion reversal will be in detergent, soaps, palm oil, biscuit related edible oil, and of course paints. But I think most of the other players should also be able to skate through. So as of now, not a big impact. But we'll be monitoring how much is the impact in terms of how much timeline, how much is the pricing growth. It's a concern, not a big concern currently.
Not a big concern currently. So you're not tweaking any kind of margin estimates as well as EPS estimates right now?
A bit early because geopolitical is so volatile. One day, the person who started it, he says that it's ending. So I will say there is a risk. So the risk is there more on paint companies, edible oil companies, and bhujia snacks companies. So we'll bet on companies in which slightly deflation is also there. For example, Marico, clearly copra is big deflation. So we like that company. We also like Tata Consumer because tea is deflationary. Apart from that, Nestle and Britannia will see wheat as deflationary. So these 4 companies, Nestle, Britannia, Marico, and Tata Consumer, are safer bets. But in rest of the companies, you are absolutely right. There can be some EPS downgrade. But as of now, a bit early to cut because we are on the 6th day of the FY27. So a bit early. But yes, there is slight risk currently.
Abneesh, just a quick one. Overall in the consumption basket then, discretionary will do better or FMCG is expected to do better this time in Q4 FY26? Trent, Avenue, Supermart, that retail side has done much better in terms of Q4 update versus maybe a Dabur or AWL Agri.
Eventually, if inflation comes back in economy, obviously consumer will cut down. But what will happen? Avenue Supermart, Trent, etc. have added very strong addition of stores. That is helping them in Q4 and FY27 also. Plus, what will happen? Suddenly, inflation in edible oil and some of the FMCG will make the growth optically look higher also for the retail companies. So as of now, near term, my sense is because the impact of the palm oil or even the packaging cost is a bit more on FMCG. Near term, I think discretionary can do better, but eventually if inflation risk comes, I think second half even the retail companies will see that impact, but currently retail is looking slightly better than FMCG because of these two reasons.
Hey, all right, Abnish, always a pleasure speaking with you. Thank you so much for joining in today. That's a roundup on whatever happened with Q4 updates in the FMCG and consumption space. Time for a break now. Ajit Mishra will join in with some trading strategies on the other side. Stay tuned. Welcome back. For the recovery from the lows of the day, we do have the Nifty, which is absolutely flat with some negative bias, though it is above the 22,700 mark. And even the Midcap index has made an extension from the lows of the day. So it's a good time to understand what's happening on the F&O side. Nigel is joining us now with all the F&O cues. Nigel.
Well, good afternoon, Sonal. You know, if the markets were down even 20, 30 points right now, even 50 points, still it'll be a very, very good trading session. It appears just looking at the screen that the street is factoring in that bulk of the negative news with regard to the geopolitical issue, that is behind. That at least seems to be the cue that you're getting out there. And the biggest positive is that the advanced decline ratio, started with only 500 stocks that are advancing. That number has moved to more than 2,000 stocks are, and you like that. If you look at the India VIX, that's cooling off gradually. At least it's not making that move towards 30. Last week, it went all the way to around 29, and from there, it cooled off. You want that number actually to cool off closer to around 20, but with the kind of geopolitical issue, it could continue to remain fairly elevated. The Nifty, the biggest cue for the Nifty to actually turn into the green and sustain out there is going to be Reliance Industries. That holds the cards for at least today's trading session. because if you look at a contribution, Reliance Industries is dragging the Nifty by more than 100 points or thereabouts. So if the markets need to turn and we need to see that move towards 23,000, Reliance Industries, that's the one to track from here on. Even when the markets were down at around the 22,600 put, you saw the premium that actually was eroding. Remember, you have that expiry that will play out tomorrow. And in today's trade itself, you have the 22,600 put where the premium has crashed down to 160 rupees. It started off at around 240 rupees. First sense that there is writing at that particular strike. While at a higher level as well, 22,700 call, the premium has come down to around 190 rupees from around 270 odd. So both these two seem to be the near-term goalposts that you're working with. Since you're seeing some writing on the put as well as on the call side, around 22,400, that appears to be the first reference point on the downside and 23,000 on the upside. The Nifty, the 20 DMA, that's going to be the next trigger, but that's very far away, more than 23,400 or thereabouts. Individual stocks that are coming for focus, you have Bharat Dynamics. That's clearly the big short covering candidate of today. The stock has corrected a fair deal from the recent top, but that's seen a bit of a short covering bounce. We're seeing fresh buying on Adani Power, while on BHEL, unusual move out here. There is a big surge in open interest while the stock is under pressure. So put all the cues together at the halfway mark, you'll have to say actually, this morning's Monday trading session is actually more good than bad, and you like what you see on the screen with regard to the breadth of the market. Reliance Industries, that holds the key for the second half of trade.
Okay, all right, Nigel. Thanks very much for that. So that's on the entire F&O space. We have Ajit Mishra, who is the technical analyst at Religare Broking, joining now to discuss the technical setup of the market. Thanks very much for joining in, Ajit. Well, it's turning out to be a good resilient session for us. We're building on the gains. Midcap index is up 150 odd points, up around 0.3%. Tell us how you would approach today's trading session as well as specific stocks. Does today's trading session give you any kind of confidence, at least in terms of the kind of resilience we're seeing?
Yeah, good afternoon, Ekta. What we are seeing, what Nigel was also sharing, that a bit of strength across the board means the broader markets are strong. We have roughly around 2,000 plus candidates trading in green, despite crude still hovering around $110 mark. So definitely it's a positive sign, but we need to see that Reliance, which has slipped below its critical support of 1,300 mark, that is adding to the pressure. So it means the intraday sessions seems like the sideways tone might continue. So we might not see any decisive trend unfolding during the day. Means 22,800, 22,400 broadly could be the range, and probably tomorrow being the weekly expiry day, we might see some bit of a decisive action. But as of now, it looks good, means the private banking majors are holding strong. So a move above 23,000 would be critical for the next leg of the up move towards the 20 EMA mark. So as of now, 22,800, 23,000 is still a hurdle area, and close around 22,000, 22,300 is something that we see as a support. So around the extremes, one can look for buying opportunity in case if we test the lower band, and around the resistance zone, one can look for shorting opportunities. In the interim, stock-specific moves are ample. Means if you see that metal and mining counters, they are doing exceptionally well. Not only today, in fact, the last week also, most of the names were holding strong. Coal India, after this recent consolidation, is basically offering a fresh buying opportunity. 485 is what we are eyeing as the immediate target. So with stop at 448, one can go long in Coal India. Then we have Titan also, wherein the stock is inching towards its record highs after the marginal dip towards its short-term moving averages. So 4450 is what we are eyeing in Titan, with stop at 4080.
Okay, any other names that you're looking at specifically? Buy call, sell call, what is it in terms of strategy for today?
So apart from Coal India and Titan, some of the names from the platform stocks like BSE, MCX, wherein we see strength. So BSE, there was hardly any kind of correction, this entire move, and the stock is still holding strongly above its short-term moving averages. So we expect our next leg of momentum towards 3,200 in the near future. So here also one can look for long position with 2,800 as a stop loss.
Ajit, thank you so much for joining in today with your individual trades and levels on the Nifty as well. Time for a break now. On the other side, Manisha Gupta will join in with the commodity markets. Stay tuned for that.
Welcome back, and joining us on the show now is Mukesh Sahadev. He's founder and CEO as analyst. Joins us live here. Mukesh, hi, thank you so much for joining in. First question really is about the difference that we're looking at in WTI and Brent, where WTI is trading at a premium. We do understand that what US exports, it imports more than that, the different crude variety, of course. But then US crude is landlocked, perhaps more secure crude availability right now. Are those some of the reasons that we're looking at WTI trading at a premium right now?
Manisha, good to be on the show. Well, it's hard to interpret some of these numbers, but indeed the WTI barrels and the US barrels are, I guess, less risky barrels. So I think because of what we are seeing, shortage of the crude and also the product side, there is this premium coming on the US barrels. And US is really, I would say, standing on very high stocks. The crude stocks have been building as well. So there is availability of the crude in the US. So some more, I would say, premium is being paid because the US crude is probably less risky crudes. Plus, we have the rollover of the Brent and WTI. So I think sometimes the comparisons are not right. So I would not pay too much attention. It's very hard to also understand at this point.
All right, get that point. How are you, though, reading the various statements that we are hearing from the US president? The next deadline now is Tuesday evening, 8 p.m. The next 24, 48 hours, would you say, are going to be very, very important for this and other asset classes?
Yes, Manisha, I don't know how to read other than to say Hormuz fatigue. I think we have seen this is the 7th time probably the deadlines have come. But I would, take our attention a little bit away from the epicenter, which is the Hormuz, towards some of the actors. If you look at the big actors who have the power to resolve this conflict, possibly China, US, and Russia. And if you look at China, China has been buying almost in March 400 million barrels of crude, despite having 1.3, 1.4 billion barrels already stored. So China is buying is probably aggravating one of the problems. And on the other hand, China is not exporting or restricting its exports. If you look at Russia, Russia has been selling crude at higher rates. Plus, of course, the prices have been so good. US has been selling records amount of crude, records amount of jet and all the products going out of the US. And US has been also retaining a lot of the higher Canadian barrels, Venezuelan barrels within the Western Hemisphere, which is making, I believe, the Asian problem more, tougher. So these actors are probably winning at this point of time from a commercial standpoint. And that's why I see that resolution of this Hormuz crisis or the whole conflict is a little bit down the lane. When it will start to pinch US, when it will start to pinch China, I think that stage has not come yet.
That is very well explained, Mukesh. So what is your sense on the prices going forward? Because we are holding around 110 right now. 100 seems slightly far away right now. I mean, are you looking at further gains? Is that where we are heading for?
I think gains is probably the right way from a directional point, because I don't see that there is an exit plan available. And neither Iran is allowing an exit plan, neither the US has a militarily exit plan. So from that point of view, I think these escalations will continue. And in some ways, the Hormuz crisis, as I said, is commercially good. LNG, US has been selling huge amounts of LNG. So who is interested to resolve this soon? The big actors probably are not. And with that basis, I don't see, and the oil prices to stay elevated. Yes, in between, US has to calm the market. So we will see again those statements. Well, we extend the deadline by another, who knows, that can happen. But 100, these 110 levels are kind of becoming a norm.
Yes, they are. How are you also looking at the various rationings that we're looking at from the government? I mean, from Indonesia to Bangladesh to a couple of countries in Europe now, and then India, of course, has an LNG rationing as well. 25 days it has to pass before you can book another LPG cylinder here. Do you see these rationings getting more frequent going forward?
There is no other choice. I think the countries which will accelerate, in my view, the demand side measures probably will be better winners out of it, even if it is a tough decisions. I'm here in Sydney in Australia. I think here also some relief has been given, but indeed these rationings, these checks needs to happen because we are not in COVID. In the COVID, demand side fell very fast and supply resisted. I think we have a reverse of it. Demand will be difficult to fall and you have to do hard measures. Supply has fallen faster than demand. So I think the better the countries start implementing these kind of measures, I would say with some seriousness, even if Hormuz resolves, we all know that the world has lost about 10 million barrels of the oil, and a big part of that, about 3 to 4 million barrels, is refined products. And with the assets damaged, if no well was impacted, no refinery was impacted, it was just a case that a choke point is blocked, and the moment it opens, we get back to normal. We are not in that situation. The assets, the refineries have been damaged.
Mukesh, let me come to you with a flash that we are putting in on your screens. This is coming in from Reuters right now. But a two-stage deal is envisaged, ceasefire, then final agreement. And this is final deal could come in 15 to 20 days with nuclear curbs, sanctions, reliefs. This is as of now coming in from Reuters, and it seems to be coming in from Iran, US, Israel war, proposed Islamabad Accord for settlement. So those flashes are still coming in. If that was to happen, if that goes through, what are we looking at in the markets now? So the one flash that I can read is that Iran, US received plan to end hostilities. Immediate ceasefire could be on cards.
Hey, well, we just talked about it, that there might be another deadline increase, and we have got it already, I guess. So yes, that might bring the prices calm for some time, but I'm sure that there might be some more things that might come. And again, it's not a one-way street now from here that resolution has happened and prices would go down. I think we will come back to the same street going upwards again, Manisha. That's all I can say. There is a long way to go, and even if it resolves, the flows are not getting back to normal very easily.
Absolutely. Still a long way to go. Flows are not going to come back that easily. But Mukesh as well as Manisha, thank you so much for taking us through that conversation as well. And thank you so much, Mukesh, for joining in on the channel. But on that note, we're actually going to slip into a very short break, and we'll get you more on stock-specific action, more market-related data points after the break as well.
Welcome back. Well, there is definitely buying from the lows which has come in. So we have the Nifty which is up around 44 odd points, and that is on the back of all of the statements that were flashing on your screen from reports at this point in time that maybe there could be a ceasefire on the cards. But remember that we've heard all of these news pieces before. But as of now, the markets are reacting positively. We have the Bank Nifty, which is up around 0.8%, Midcap Index, which is up around 0.7%, and the Nifty, which is up around 60 points at this point. Remember, low point of the day was 22,543, and currently the Nifty is at over 22,770, giving you an indication that reacting positively to the flashes on your screen. But we'll keep getting you more details. Let's move on at this point in time as the massive shake-up in India's obesity and diabetes drug market continues following the recent patent expiry of semaglutide, the key molecule behind Ozempic and Wegovy. I did catch up with Neeraj Sharma, who's the MD and CEO of OneSource. OneSource is a CDMO that manufactures this particular drug for several companies and is launching and supplying to generic versions across India and global markets. I did catch up with Neeraj Sharma at their Bangalore plant, the semaglutide manufacturing unit, as well as their biologics unit. Here's an excerpt of that conversation.
We are the only supplier to Dr. Reddy's.
You are the only suppliers to Dr. Reddy's. They're still waiting for that approval from the Canadian market. It was expected possibly by May. So are they manufacturing for the Canadian markets? Have they built up inventory? Where does things stand?
So yes, indeed, that's what they have said very publicly, that they are expecting approval by May. And we are also working with the same assumption. Yes, there is manufacturing happening, at risk for some inventory buildup. But also it depends, Canada has a peculiar requirement that every single pen has to carry what we call a DIN number, which only you get once the approval comes. So after the approval comes, we have to do the full packing. So it's not the finished product. It's not that the approval comes in and we can start shipping tomorrow, because everyone requires a DIN number on.
Oh, okay. So there's a certain amount of inventory build-up which is allowed.
Yes.
But there are many other emerging markets which are going off patent as well. So how is that working out in terms of manufacturing and business?
That's the benefit of having a global customer base. Because we've got customers who are global companies, we've got customers who are regional champions, we have customers who are country-level champions, including you saw our announcement of approval in Saudi Arabia with our partner Hikma. So, because we have got this multiple customer base, yes, our customers will be launching in all markets as and when the approvals keep coming in. And some of the largest markets, for example, Brazil, which is the largest market outside of North America, is going to be opening up. Turkey, very large market. Saudi Arabia, very large market. And of course, India. So as the approvals start coming in, you will see our customers launching in multiple markets.
Yeah. What is the price difference you think that would exist, or the sort of demand that would exist between, say, an emerging market in India?
So what I would say at two separate points. When it comes to demand, obviously, as you see, Canada is today the largest market outside of US. So from a purely volume driver, because the penetration levels are now significantly higher, and if once the generics come in, it'll even go up. So from a pure volume driver, Canada will certainly be the big market, followed by Brazil, Turkey, and the others. As far as the price is concerned, Ekta, as I mentioned to you, as a CDMO, we are geography agnostic. We supply to our customers at the same price. It depends volume based. As the volumes go up, there are different pricing for us. But the geography is immaterial to us.
A very interesting conversation, and more interesting is what you're wearing, Ekta. So cool, and made me think that we should do more of these on-ground interviews because you looked fantastic.
This is the semaglutide facility where I wasn't as covered as the biologics unit, where you had to wear gloves and you had to wear, a lot more in terms of protection when you go into that facility.
It's good to know that, though.
Yeah. Yes, it was really interesting to see that entire plant, and we're definitely going to play much more of that through the day as well as a special show. As of now, we need to take a short break with the news that the markets are reacting positively to all of those flashes on your screen. We'll be back. Stay tuned. Welcome back to a halftime report on CNBC TV 18. And since those flashes that we've been addressing for a while that have come in, we're seeing that the markets now are at the day's highest point, recovered comfortably from the day's lowest point. Even the Nifty Bank more than 800 points recovery from the day's lowest point. Nifty 50, 22,785 around that level as of now. But with that, we're going to wind on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Frontline stocks have surged to the highs of the day. The mid-caps are also eking out gains, and this is ahead of Donald Trump setting a Tuesday deadline for the reopening of the Strait of Hormuz. His words up the ante in West Asia, but also signal an urgency to end the conflict, keeping investors on the edge.
Wipro inks a near $1 billion multi-year transformational deal with food and agri major Olam Group, entailing the acquisition of Mintsprint with 3,200 employees for $375 million. The agri growth move could kick off a trend in the sector.
A rush of business updates from banks and NBFCs reveals strong growth in advances in the fourth quarter, but many struggle to raise deposits, driving up the system loan-to-deposit ratio and signaling a likely pressure on margins going forward.
Retail majors Avenue Supermarts and Trent point to strong near 20% growth in Q4, even as online beauty and fashion retailers sees growth in the high 20s. Mature FMCG businesses Dabur and AWL Agri also point to healthy volumes. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan, and with me as always is Hormaz Patakia. Good afternoon, guys. Good afternoon, Hormaz. You know, quite the recovery from the low point of the day, right?
And I actually feel bad for our colleague Juviraj, who's running the market blog for our website, because it's impossible to write a headline at this point, because every time you write a headline, the market changes course the next second. But that has been the story of the day. But as of now, the bulls will be the happy campers because the index is at the highs of the day. It's 250-odd point recovery from today's lows. More importantly, it's an almost 600-point recovery from the lows of Thursday, which was 22,182. So an impressive recovery that we are seeing from the lows. So at least the one conclusion that you can come up with as of now is that the bulls are not willing to give up that 22,000 mark on the downside just yet. They are not willing to throw in the towel. Every time there is some fall, that dip is getting bought into, and it's a very important week for the markets as well, right? We have the policy on Wednesday, we have TCS's results on Thursday. There is a lot to look forward to, and the banking index is the one that was supposed to be the one to be watched out for, and you can look at the recovery there as well, and that is also contributing to the recovery seen on the Nifty. There you go, an 850-point recovery on the Nifty Bank, now heading towards the levels of 52,000. So good going there as well. There's a slew of banking updates that you have to react to, or the banking stocks are actually reacting to. So as of now, the tide has turned in favor of the bulls. We'll see how the day unfolds.
Absolutely. Right now in favor of the bulls. We don't know what will happen through the rest of the day. But, you know, as Hormaz pointed out, markets are recovering from their lows. You know, Nifty IT showing resilience. It has been showing resilience since the start of the war. We've got Wipro gaining over 1.5% in trade after that big order win, which was a boost for the stock. Persistent gaining nearly 2%. Tech Mahindra near 1% higher. As Hormaz pointed out as well, the bank's doing really well. Big recovery on that front. Lots of updates to react to. PSU Bank's in the green, and, you know, it has seen some good business updates, positive for the sector. Bank of Baroda up nearly 2%. Indian Bank, Bank of Maharashtra gaining over 2%. However, in the red, we've got those oil and gas names, IOC, BPCL, HPCL, all of them down a little over 1% in trade. And the pharma names also seeing some pressure. We've got Sun Pharma, Lupin, Dr. Reddy's, all of them in the red as we speak. But Hormaz, the top focus this evening?
Oh yes, the banks and NBFCs, there's no doubt. And we've lost count of the number of companies, the lenders that have come out with their updates. And Ritu is here to summarize all of that for us. Ritu, take it away.
Well, banks and NBFCs closing out the fourth quarter with a fairly strong operating print, but the divergence between growth and funding is getting more visible. Now, starting with banks, the loan growth clearly was the highlight this quarter. Across the system, advances growth came in at a strong 7 to 27% year-on-year and 2 to 11% sequentially. Most of the banks beat estimates like HDFC Bank, RBL Bank, Ujjivan, Bank of Baroda, EU Small Finance Bank, Yes Bank, they all stood out. But on the flip side, Innocent Bank saw degrowth both year-on-year and sequentially, while Karur Vysya Bank lagged expectations. Now, deposits, that's where the picture was a bit more mixed. Deposit growth ranged between 1 to 16% sequentially and up to 25% year-on-year. RBL Bank, again, Bank of Baroda, AU Small Finance Bank, HDFC, yes, Union, Kotak, they all saw strong traction. But IDFC First Bank, Karur Vysya, Equitas, Punjab National underperformed. So what you're seeing is loan growth continuing to outpace deposits, and that is reflecting in the LDR or the credit deposit ratio as well. The CD ratio has inched up sharply, up about 11 percentage points year on year overall. The system-wide LDR is also now at an all-time high of around 83%. That tells you funding tightness is building in the system. IDFC First Bank reporting one of the highest LDRs at more than 102%. But HDFC Bank, Yes Bank, RBL Bank saw their CD ratio decline quarter on quarter. CASA trends were also supportive seasonally. Growth came in at 4 to 26% quarter on quarter. Most banks also saw an improvement. Kotak, RBL, Yes Bank, HDFC Bank all reported healthy CASA ratio expansion on a quarter on quarter basis, though structurally these ratios are under pressure for some lenders. The likes of IDFC, AU, CSB, they saw a contraction in the quarter. Let's also look at NBFCs now, where the fourth quarter growth was steady overall, largely in line with street expectations, supported by seasonal strength. Bajaj Finance reported an AUM growth of more than 22% year on year, but their deposit growth saw a decline both year on year and sequentially, which has worried the street. L&T Finance saw retail loans grow more than 25%. M&M Finance saw asset quality improving, stage 2 assets coming down, collection efficiency improving, while disbursements and assets under management grew by 10 to 11% year on year. In the housing space, Aavas Finance reported a strong disbursement trend, improvement asset quality, and higher repayment rates. So overall, good show across both banks and NBFCs, but the pressure is clearly shifting towards funding, margins, and liquidity.
All right, Ritu, many thanks for those details. Now, the other sector on our radar is the FMCG stocks. Trent, Nykaa, Avenue Supermarts, all of them are surging in trade on the back of their Q4 business updates. Vinny joins us now with all of those details. Vinny?
Hi, afternoon. So yes, we have all these retailers on the consumption side that are buzzing away in the trading session. Trend obviously among the top Nifty 50 gainers in the trading session as well. In terms of Q4 update for Trent, they're seeing 20% growth in terms of revenue for Q4 FY26. 4,937 crores is what the revenue is expected to come in at. Best quarter in FY26 for the company in terms of revenue growth. Q1 was 19%, Q2, Q3 was 17% growth, and now Q4 is coming at a 20% growth. For the full year also, their revenue stands in at around 19,700 crores approximately, which is a growth of 18% and good growth on a year-on-year basis. Total store count stands at 1,286 crores. They've had a good store addition for Zudio as well as with Westside during the year. So yes, we're seeing good growth for the company in terms of store addition and good growth in terms of revenue as well. So the expansion plan is working for them. It's a good up move that we're seeing coming in for the stock as well. Nykaa, that's another one. The consolidated gross merchandise value growth has come in at around late 20s for Q4 FY26. NSV, that's the net sales value growth, that's coming at around early 30s is what the company has seen. Beauty segment that continues to do well. Growth of revenue growth of late 20s is what they've highlighted, as well as fashion segment has seen a growth in its early 40s. So good growth across both its segments. Fashion segment is a relatively smaller segment. Nonetheless, 14th quarter that the revenue growth for Nykaa will be about 20%. So positive there as well. Lastly, in terms of Avenue Supermart, they also reported a good, healthy revenue growth, aggressive store expansion that they've seen. Growth momentum mainly was supported by improving consumer demand. In-store execution was improving. Households have started stocking up because of pantry loading that we saw due to US-Iran war. Some bit of a positive benefit that they had on that front as well. Revenue growth of 19% on a year-on-year basis. Good growth overall for the company, so positive there for Avenue Supermart as well.
Indeed, good going for a lot of these FMCG names. Avenue Supermarts leading the way, continuing its outperformance from the recent times. Trent, of course, now the top Nifty gainer, 7% higher now on the stock. Of course, a beaten down name from almost 8,500 levels down to 3,500 and seeing a bit of a recovery in today's session. But the other major announcement that came in besides these banking and FMCG updates was from Wipro, and that's after the company bagged a $1 billion plus deal with the Olam Group. Reema is here with more details on this. Reema.
Thanks so much for that. Let's get the news first. Now, Wipro has secured a multi-year strategic deal with Olam for $1 billion. That is the estimated potential of the deal. $1 billion in terms of revenues for Wipro. The guaranteed revenues are $800 million plus, spread over 8 years. As a part of this deal, Wipro will also be acquiring Olam's captive IT unit, which is called Mindsprint, and they will be paying $375 million for this. And this acquired company, Mindsprint, the IT business of Olam, had revenues of $135 million as of last year. But basically, what the takeaway is that at a time when organic growth, the growth for IT companies is weak, Wipro perhaps is using the M&A route to bolster the top line and get the revenues. The street is reacting positively right now because it's $1 billion of revenues over the next 8 years, at least minimum of $800 million. That is a positive. Olam is also strong in the food and agri supply chain, so they get a large client. So there is assured revenue, there is stickiness of revenues, which is what the street likes. But the negative, the potential negative of such a transaction is that it signals that growth is on the weaker side, which is why you need to use M&A to boost the growth. And plus, we don't know the kind of margins. Typically, when you take on a captive center, you will take the employees on board, and therefore the margins could be on the lower side. But for now, the IT sector itself is doing well, and Wipro has got $1 billion of a deal.
Absolutely, and that stock is 1.5% in the green as we speak. All right, Rima, many thanks for taking us through those details. But before we slip into a short break, markets move in cycles, and for 26 years, we've been tracking them closely. Because in volatile times, what investors really need is insight, not just information. And above all, perspective, not panic. If you have a question about your investments, we're here to help with guidance from experienced market experts who understand today's fast-changing market environment. So join our special market editors on Your Stocks and MF Corner every day at 2 p.m. and stay one step ahead of the market. Welcome back. You're still with us on Business Lunch. Let's get you the latest on the war in West Asia. Sources are telling Reuters that Iran and the United States have received a plan to end hostilities and engage in an immediate ceasefire. Shireen Bhan is joining us with the latest. Shireen?
Well, thanks very much. Yes, the markets are reacting to the reportage that's coming in from Reuters, which suggests that Pakistan has proposed a two-step framework that has been sent to both Iran as well as the United States of America. The proposal has been sent overnight, as per Reuters quoting sources. Now, what does this plan envisage? It envisages an immediate ceasefire and then a long-lasting peace deal between Iran and the United States. This will also mean that Iran will be asked to reopen the Straits of Hormuz. Now, if you go back to President Trump's post, which was, by the way, profanity-laced on Truth Social, making it very clear that if Iran did not comply with the decision or with the demand to open the Strait of Hormuz, that they would go after power plants, they would go after bridges, and that it would be a living hell for Iran if they didn't comply with what President Trump was demanding. Now, since then, we have seen a deadline extension by President Trump himself. The deadline, as per President Trump's own tweet or post on Truth Social, ends on Tuesday. And Axios and Reuters now both reporting. Axios had reported that a 45-day ceasefire period was being contemplated, was being negotiated, but also pointing out that if it didn't happen today, then the chances of it going through were slim. Reuters also seems to suggest so, but is saying at this point in time that the Pakistan army chief has been working the phones overnight. This is as per Reuters. I'm quoting what the Reuters report says, has been working the phones overnight, speaking with Jared Kushner, Steve Witkoff, and others to try and see if some kind of a negotiated arrangement can be arrived at. Now, we will have to wait to see whether this is going to result in something or this is just another round of talks that end up with more threats rather than de-escalation. But the markets for now seem to be reacting positively. We've seen the Sensex and the Nifty move back into positive territory. They're trading in the green at this point in time. And, one, of course, is the possibility of a ceasefire. The other is some sort of de-escalation. Remember what President Trump had threatened Iran with was we will go after your bridges, we will go after power plants, and it will all be done and wrapped up in a day. Now, that would mean significant escalation. So at least the hope is that if talks are ongoing at this point in time and haven't reached a complete impasse, that is giving the markets reason to hope that perhaps there could be some sort of a negotiation that is put forward, put together. It's being called the Islamabad Accord. That is what Reuters is reporting at this point in time, that the proposal that's been put together by Pakistan is under review now. Iranian officials are being quoted by Reuters to say that, look, we will not comply with any deadlines. We will not be forced into doing anything that we don't feel is fair to Iran and to the Iranian people, but also pointing out that the proposal is being reviewed at this point in time. We haven't heard from the U.S. Representatives officially or unofficially on what Reuters is reporting. So keep a track on this. This is going to be an important development. Let's see if it eventually leads to something or not. But the markets at this point in time certainly hope that this is a sign of de-escalation and not escalation.
Hope is the only constant, and that's where the markets are pinning their hopes on. Shireen, thank you for that update there, and leading this recovery now 150 points higher on the index, even as it's one of its biggest constituents, Reliance Industries, is at the lows of the day. The leading recovery is coming from the banks and, of course, HDFC Bank. At one point, the lender was down almost 1% and a quarter. That has also now surged to the highs of the day and is now trading with gains of almost 2%. And look at the moves on the Nifty Bank now, 700 points higher on the Nifty Bank. So that makes it almost an 1100 point recovery from the lows of the day. HDFC Bank now up 2.25%, continuing its rebound from a 52-week low. And the Nifty Bank is what is taking the Nifty higher currently. Take a short break. Back with more on the other side. Stay tuned. Welcome back. Now, the Supreme Court has refused to stay the implementation of Adani's resolution plan for JP Associates. Ashmit is joining in now with more details on this. Ashmit.
Well, this is a tussle between Vedanta and Adani as far as JP Associates and its insolvency proceedings is concerned. And to that end, what we're given to understand is that the Supreme Court, for now, has refused to grant any interim injunction or stay as far as implementation of the Adani resolution plan is concerned. That was the interim relief that Vedanta had been seeking. But having said that, the Supreme Court has also managed to slip in a caveat. The Supreme Court has also said that the monitoring committee of JP Associates, should it decide on taking any major decisions with respect to JP Associates, with respect to implementation, will require the nod of the NCLAT. So that caveat has been slipped in. This caveat is something that Vedanta's counsels had been pressing the apex court to include. So effectively, as of right now, while the implementation plan of Adani can continue, it is subject to that caveat that in case of any major policy decision, the NCLAT nod will have to be taken. And the NCLAT will, of course, be important to watch. April 10th is when the next hearing will take place. Vedanta's application challenging the selection of Adani's resolution plan. Vedanta's argument is quite simple. What they're saying is that the IBC roots for maximization of value. And to that end, Vedanta is likely to argue that their bid, their total cumulative bid, is closer to 18,000 crore rupees, that the Adani bid was 14,500 crore rupees. They're likely to argue that in substantive terms, their bid is higher by 3,500 crore rupees. In net present value terms, Vedanta claims its bid is at 12,500, which is 500 crore rupees more than the Adani bid. So what they're saying is that why would the COC leave money on the table? That Vedanta is bringing in more money, and that is something that should weigh on the minds of the lenders. That is the prayer relief they will be seeking. The Supreme Court has asked the NCLAT to ensure urgent, fast-pressed hearing into this matter. April 10th is when the next hearing will take place before the appellate tribunal.
All right, Ashmit, many thanks for those details. Now, India has diversified its sourcing of energy, importing from over 40 countries as per the oil ministry. India is a large consumer of diesel, and despite the diversification of sourcing, India may find it difficult to meet its diesel needs. Sonal Bhutra tells us more about why it is also important for India to find the right kind of oil along with more sources of oil. Sonal?
Thank you so much for that. Now, about 45% of India's oil imports have been disrupted due to the ongoing Gulf conflict. Refiners are now looking for alternative sources to replace this supply. But the real issue is not just finding more oil, it is finding the right kind of oil. Not all crude oil is the same. Different types of crude produce different fuels when refined. Some produce more petrol, while others produce more diesel. India's fuel demand is heavily dependent on diesel. Diesel makes up to around 40% of the total fuel consumption in the country. Indian refineries are designed to produce a high share of diesel. This is why crude from the Gulf has been so important. Supplies from Saudi Arabia, the UAE and Iran are well suited for India because they produce higher diesel yields and match refinery configurations as well. Now consider the alternatives. Crude from the United States is mostly lighter. It produces more petrol and less diesel, which does not really suit India's demand pattern. African crude also has limitations. It is either too light, which again leads to higher petrol output, or it has too much sulfur content, making it less efficient to process. Russian crude comes closest to what India needs. Grades like Urals have similar characteristics to Gulf crude and are better suited for producing diesel. The key risk is this. Even if India is able to replace the lost crude volumes, it may still not be able to produce enough diesel. So the challenge is not just about supply, it is about a mismatch in crude quality, which could create pressure on diesel availability in the coming months.
Sonal, thank you very much for summarizing that for us. And with that, we take your leave on this edition of Business Lunch with an update that the index is nearing the mark of 22,900. There has been a recovery in the bond yields as well. The rupee has appreciated past the mark of 93. So good going for the bulls over the last half an hour. A swift recovery from the lows of the day. Midcap radar on the other side.
afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. What a stellar rally on the markets from the lows of the day. We are above the 22,850 mark. Midcaps are surging too across the board. There's big buying which is coming by from the lows of the day. We'll discuss that and a lot more. But so much to talk about when it comes to West Asia war yet again.
That's right. Those particular headlines refuse to die down. And in fact, a news agency recovering or stating that there could be a proposal for a ceasefire is something that has added to the sharp market recovery that we've seen. Some of the names that were beaten down the most staging the sharpest recovery. But a lot lined up on the show. We'll discuss the impact of the likely ceasefire as well as we head along into the shows. But let's start off with the top headlines. Market stages a smart recovery from lows. Nifty surges past 22,800. The mid and small caps clear outperformers today.
Stocks swing to quarterly updates. Mature FMCG businesses Dabur and AWL Agri point to healthy volumes in the fourth quarter. Meanwhile, Nykaa eyes GMV growth in late 20s.
IEX shares are surging after the company reported record electricity volumes in FY26. March trading volumes also rise 23.5%.
A rush of business updates from banks and NBFCs revealed strong growth in advances in Q4, but many struggle to raise deposits, driving up the system loan-to-deposit ratio and signaling a likely pressure on margins going forward.
Senco Gold extends gains on the back of a strong Q4 update. Strong business update sends shares of peers Kalyan, Tangamail, PC Jewelers to higher.
Okay, those are the top headlines that we are tracking. A 160-point uptick on the Nifty. We have the mid-caps, which are surging 510 points. And also, it's about the Bank Nifty, which is leading a lot of these gains. So that one is up around 1.4%. Across the board, be the mid-caps or the small caps, they are surging in trade. The small caps are up 1%. We have the mid-caps, which are sitting with gains of 1%. And the advance decline ratio comfortably in the favor of advances. So it's a good time to get a technical check on the markets. Rajesh Palvi of Axis Securities is joining us now. Rajesh, a stellar rally from the lows. Do you think that we could build onto this? Is the momentum chartically also very bullish?
Yeah, hi, good afternoon. Yeah, so looking at the recovery from the lower point of the day is clearly giving sign of that, yes, there is a confidence in this pullback action. And the way Nifty is able to defend 22,500 put-based concentration, which clearly shows that, yes, till we are trading about 22,500, 550 zone, trend is likely to exhibit on the bullish side, and we could see further more recovery from the current level also. And looking at the call writers data, 23,000 would be the next level where Nifty can continue further more upside from the current level. So 22,550 to 23,000 would be the range for some more time. And any breakout about 23,000 can, lead to a further short covering action, and we may see rally to extend further. Looking at the broader market action, Midcap Nifty is also showing a sign of recovery, and lot many beaten down stocks are also recovering in this pullback. So we believe that, as broader market is also showing sign of strength, so this recovery may extend further. Bank Nifty can scale to the level of 52,600 to 700. That's the next area where we may see Bank Nifty to move. So at this juncture, both indices are looking attractive. One can carry their long position with trailing stop losses.
Okay, so you continue to have a positive bias. Rajesh, what are the individual picks for the day? Mostly longs?
Yeah, definitely. So long side trades are looking promising, like RBL Bank managed to give breakout on the near-term chart. And looking at the breakout, we believe that, if its stocks continues to trade above 315, here we could see another leg of rally towards 325 to 330. So RBL Bank, one can go for long with stop loss of 315. Another stock where we are focusing at this juncture is from, L&T is also showing sign of strength. This is the third week where stock is showing a sign of, buying interest. The way near-term charts are placed, we believe that, if stocks manage to sustain about 3,600, there is a possibility of 3,800 to 3,850 could be the next target for L&T.
Take that point. Thank you so much for joining us with those stock picks and the market levels. But this is our segment, Midcap Movers. We have Ria to take us through the midcaps that are moving around in trade. Ria?
Well, absolutely. Let's start off with the gainers first. We have Zydus Wellness, which is up by roughly 17% in today's trading session on the back of very strong volumes as well. There's EIH as well, which is up almost 12%. Trent is up roughly 7% on the back of its Q4 update. Adani Green also trading with gains of roughly 7%. And even Senco Gold up by almost 12% today on the back of a very strong update for Q4. In terms of the top sectoral gainer, the realty index is performing well today, up roughly 1% today. The top gainers include Godrej Properties, Sopa International, as well as Aditya Birla Real Estate. On the flip side, if you look at the losers in today's trading session, there's IRB Infra, Reliance Industries, Astral, Chennai Petro, as well as PG Electroplast, all trading with losses of anywhere between 3 to 4%.
Well, thank you so much, Ria, for joining us and giving us a list of all of the stocks that are doing quite well, as well as some of the stocks that are losing in the session today. Well, we'll now slip into a short break. We'll get you Sanjay Pulipaka and Gurmeet Chadda to discuss the latest on the war in West Asia after the break. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. The big story that's trending is a possibility of a ceasefire between Iran and the US in the West Asia war tensions that have been brewing. Let's get in Sanjay Pulipaka, who's the chairperson, Politia Research Foundation. Mr. Pulipaka, good afternoon. Thank you so much for joining in. Well, these are reports from Reuters which suggest that there is a plan to end hostilities and immediate ceasefire, and a two-stage deal will be followed by a final agreement, and final deal in 15 to 20 days with nuclear curbs and sanctions and relief will come by as well. How credible do you think is this two-stage ceasefire plan, given the history of negotiations that we've seen so far in the West Asia war and between US and Iran so far?
Thank you for this invite. I think it is little too early to talk about a ceasefire deal based on a few reports. But it appears that a lot of diplomatic activity is happening behind the scenes. Yes, as you pointed out, there has been a proposal for a two-stage deal where initially there will be ceasefire and subsequently there will be a full-fledged negotiations that will be taking place on host of issues such as nuclear issues, sanctions relief, and subsequently there may be an expansive political agreement which may result in complete stoppage of the war. But at the moment, it appears that the core of negotiations team seems to be Straits of Hormuz. It appears that Iranians are reluctant to open Straits of Hormuz for a temporary ceasefire. They are saying, the reports are stating that if there is a complete and total cessation of hostilities, only then will they be able to open the Straits of Hormuz. But it appears from the tweet that the US President has given yesterday that opening of Straits of Hormuz seems to be the most critical element. But I doubt whether Iranians would give it up so easily because Straits of Hormuz is the pain point on which they are playing and trying to discredit President Donald Trump. What kind of opening it will have is something that needs to be seen. There could be a partial opening up, allowing a lot more ships to go through, especially of countries such as India and host of other developing countries and Southeast Asian, Japanese and others. But we don't know whether the other Gulf countries would be amenable to such an idea of partial opening of Straits of Hormuz, because we have seen some of the United Arab Emirates officials stating that any deal, any ceasefire should have complete opening up of Straits of Hormuz because it has a direct impact on the economies of United Arab Emirates, Saudi Arabia, and host of other Gulf countries who have shown remarkable patience in not responding to the rocket attacks, missile attacks, drone attacks coming from Iran. But they are insisting that Straits of Hormuz should be the first point in the agenda on any ceasefire. We have to wait and see whether Iranians will agree to that, because once they give it up, they feel that they will lose the leverage on the war and tuning or fine-tuning the responses to American and Israeli attacks on Iran.
Right. Mr. Pulipaka, take your point completely. So the key bone of contention continues to remain the Strait of Hormuz. In your opinion, what is the best case scenario in terms of a likely ceasefire that both USA as well as Iran could reach? Does that mean that India would now be able to get its own ships across that particular strait?
See, if this report if this report turns out to be true and we have an immediate ceasefire, it is good for India and host of other countries in the region and also developing countries. And we would welcome such a ceasefire agreement if it happens immediately. But we need to wait and see whether they will actually open up the Straits of Hormuz. In my opinion, both Americans and the Iranians are having serious conversations about Straits of Hormuz. But there is another important dynamic here, is Israel at the table, because Israel is also part of this war and it has been collaborating, cooperating, or they are working together with the Americans in bombing Iran. So what are the Israeli requirements? They have specific requirements with reference to enrichment of uranium, the missile stock that the Iranians have, and also how will Iran use any of the sanctioned wealth that has been, or the financial assets that have been sanctioned, if they are released, how will Iran use those things with reference to Israel? These are some of the things that Israel will also be very keen on. So therefore, there are a lot of players in this. It is not just a conversation between Iran and Americans. A lot of players have to be taken along this conversation. On one side, you have Israelis. On the other, you have Iran. At the same time, there are a lot of Gulf countries who have patiently sitting on the sidelines without joining the conflict, but taking in a lot of missile attacks, and they have their security concerns. So it is going to be a very complex negotiation, though it is just Americans and Iranians through intermediaries such as Egypt, Turkey, and Pakistan who are facilitating the conversation. There are reports saying that the current proposal of a two-state ceasefire has been facilitated by Pakistan. We don't know how far that is true, but again, so many players have to be involved in this, and we need to get the consent of so many other players. So it is going to be a very challenging exercise.
You're absolutely right. We are talking about US and Iran, but there's Israel in the equation as well, and an important part of the entire equation. So do you think if maybe US and Iran agree between that next 15 to 20 days for a final ceasefire or a final deal, Israel could be a possible risk. If not Israel, what are some of the risks that could derail these conversations around de-escalation?
One, as you pointed out, Israel sees any nuclear weapon or a possibility of revival of a nuclear program. Forget about a weapon. Revival of a nuclear program in Iran as an existential threat. So therefore, Israel will insist that there should be complete rollback of Iranian nuclear program with verifiable measures and other steps taken into place. Then there is, of course, a host of other players in the region, such as Middle East, in the Middle East, as I pointed out, whether it is Kuwait, whether it is Qatar, Bahrain, and host of others who have their own interests in ending this war, but ending it on terms so that their business interests, their economic interests, their security interests are taken care of. For Israel, as you are asking, it is a rolling back of nuclear weapons program, and including, in my opinion, they will be very strict on in their negotiations on any civilian nuclear program that Iran may have, and also ensuring that Iran does not rapidly rebuild its defense forces, missile forces, and curtailing the capability of Iran from targeting Israel with greater intensity. So those are some of the things that Iran will be looking at, in my opinion. Sorry, Israel will be looking at.
Absolutely. So one last question. Want your quick view on that? We've discussed, both of the countries, their nuclear capabilities. We've discussed the Strait of Hormuz. How big of a play or impact will oil prices have on the entire discussions? In whose interest is it to reach a ceasefire quicker as oil prices continues to rise?
Ideally, Iran would benefit from a quick ceasefire because it will be able to sell its oil and host of other resources that it may have, because Iran requires a lot of resources to rebuild the country, and also it has been taking sustained bombardment for more than a month now. Does it have really the capability to continue for one more month of aerial warfare against both Israel, United States, and host of other Gulf countries? That is something that needs to be seen. Rationally speaking, Iran would also benefit from the opening up of Straits of Hormuz and creating a ceasefire agreement. But in addition to that, we have seen that the Gulf countries, in addition to oil, have not been able to trade significantly because of the curtailment of movement across Straits of Hormuz. And they would also benefit from a ceasefire and a subsequent long-term political settlement of this issue. Iran, in my opinion, has been, while its response has surprised many, in my opinion, it has also taken a big economic hit now, and it needs to recover quickly if it wants to play some role in the region. So therefore, a ceasefire agreement now would be beneficial to all the countries in the region, including Iran. See, ceasefires or political agreements will work when both the parties or parties in the conflict feel that they have reached a stage where they can no longer inflict more pain on the other, and there is some amount of an exhaustion that creeps in.
Correct.
We need to wait and see if there is really an exhaustion that is creeping into Iran and also into US and Israeli forces.
Take that point, Mr. Pulipaka. You're absolutely right. War has an impact on economy, having a bigger impact on Iran right now, but across the board, across the major economies, as we've been talking about it regularly. Thank you so much for joining us with your thoughts on what is an ongoing story, and we'll keep getting you more updates as and when there are more updates on this one. We'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back to Midcap Radar. Well, the recovery continues as far as the markets are concerned. The small cap and mid-cap end of the markets continue to outperform. Well, one particular stock that stands out is an exchange. It's IEX, which is the Indian Electricity Exchange. The company has given an operational update for the month of March, Q4 as well as FY26. So the company has managed to end FY26 with record high volumes. Looking at Q4 FY26, the company's total electricity volume that was traded on the exchanges was 39.4 billion units, which is up almost 24.3% on a year-on-year basis, indicating significant volume thrust. While the main exchange of the market, which is the day-ahead market, did see some tapering off of volumes due to a bit of market share loss. Other segments stepped up and performed very well in terms of the RTM. Now, in terms of the monthly traded electricity volume, it was up almost 23.5% on a year-on-year basis. And when you're talking about the market clearing price, the market clearing price came in at 4.2 rupees a unit, which was down 6% on a year-on-year basis, indicating that liquidity on the exchanges was very high, especially sell-side liquidity. So on the back of that, IEX, a very good quarterly update coming in, stock high by almost 4.5%. But remember, the worry in terms of market share loss continues due to market coupling that's going to be implemented soon.
And that continues to be the big focus point for IEX. We've been discussing it for a while. But quarter four updates, very close to quarter four earnings season. When he's joining us now about all the FMCG updates, Nykaa, Dabur, there's AWL, Agri as well. Vinny, take it away.
Hi, so firstly, Nykaa, good numbers that have come in terms of Q4 update. Consolidated GMV growth of is expected to be in late 20s is what the company highlighted. Net sales value growth for Q4 expected to be in higher or early 30s, that we could say. Beauty segment expected to do well as well. They've seen a growth of around the late 20s this time as well. Fashion segment, smaller segment for the company, nonetheless, early 40s is what the growth is expected here. This is, again, the 14th quarter that Nykaa would see a more than 20% growth in terms of revenue. So positive there, and that is why the stock is holding on to gains of 2.5%. We have Dabur. Good inline numbers is what we could say in terms of an update that's come in here. Consolidated revenue to grow in the mid-single digit growth, operating profit growing ahead of the top line. India business is likely to record the single high digit growth. HPC segment, that's the home and personal care segment, to grow in mid-teens. Healthcare is expected to report a low single digit growth. So all in all, inline decent number that's coming from Dabur as well. Nuvama also said that it's largely in line with their expectations. There were some concerns that came in on the Middle East front that they've highlighted, which was a bit of a business that was impacted, but overall in line. Lastly, we have AWL Agri. They also reported decent in terms of Q4 FY26 numbers, the update that came in. Overall volume growth 13%, led by strong growth that one saw in edible oil as well as industrial segment. So edible oil volumes grew 17%, the revenue grew 21%, and analysts like Nuvama also maintaining a buy rating, unchanged target price for AWL as well.
Well, thank you so much for taking us through the trends as far as the consumption pack was concerned. But jewelers continue to shine bright. Vinny, the entire pack is up. Senco Gold coming out with a good update.
Absolutely, Vivek. Sectoral Gold, a great update coming in from the company. 46% revenue growth in Q4 FY26. Mainly wedding season is something that supported the growth. But apart from that, even the same-store sales growth came in at 34%. They added 7 stores. Total store count now about 200. Valentine's Day, International Women's Day, all of that came in Q4. Now, that led to more gifting this time. And lightweight jewelry was the trend that they saw coming in. So lightweight jewelry, gifting, that's our trend. And that is why the company said that, they are going to have a higher focus now on lightweight jewelry and everyday wear jewelry as well. For the year FY26, revenue growth also came in at 35%, which is much better than last year's revenue growth for FY25, which was at 21%. FY27 outlook now. That also the company has said a 20 to 25% value growth is what they're aiming to achieve over here in FY27. EBITDA margin in the range of 7.5 to 7.8%, as well as the store addition plan is expecting around 20 to 25 stores in FY27. So strong commentary in terms for the next year as well, but a good quarter in Q4 this time.
Good quarter. Senco Gold rubbing off its impact. We are seeing a rub-off impact on Kalyan Jewellers as well. That stock is up around 6.5%. We do have other names like Zydus Wellness, which is up 15% in the broader markets. V-Mart Retail. It was a good quarter for update last week. The stock continues its up move. It's up around 10.5%. Confidence Petroleum is a stock which has been very volatile. It's up 58% this year to date. It's up another 10% in trade. Very close to 22,900 mark on the Nifty. The mid-caps are doing well as well. But, you know, what happens in the broader markets continues to be an important story because the advance decline ratio comfortably in the favor of advances. But we'll have to see whether we continue that in the last 1 hour of trade as well or not, because it's been quite volatile from the word go. With that, we'll take your leave on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC TV 18 Motilal Oswal studio. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, a very good afternoon and surely a good afternoon coming in for the markets as well. We had a lot of commentary that came in actually 12:30 around.
Absolutely.
From Reuters, which was saying maybe a possibility of a ceasefire, and that cheered up the market, right? Look at the run-up that we're seeing in the stock now. The markets, 0.7% of gain that we're seeing coming in for the Nifty 50, comfortably above 22,800 levels. And the broader end of the market anyways was holding on to better gains.
Absolutely.
So that also continues to do well.
Absolutely. And you know that recovery that we saw in the Nifty Bank as well has boded well. You know, all of those positive business growth updates that have been coming in are boding well for the markets. We're seeing the PSU Bank Index that's doing really well. Private banks doing really well. But on the flip side, we've got those oil and gas names that are not doing so well today in trade. We've got IOC, BPCL, HPCL, all of them down over 1.5%. And those pharma names as well seeing some pressure today. Sun Pharma, Lupin, Dr. Reddy's, all of them seeing a little bit of pressure in trade. But overall, it's been a sharp recovery for the markets in trade in the afternoon. But let's move on. Joining us now today for the show are Rahul Sharma, the Director and Head of Technical and Derivatives at JM Financial Services, and Gaurang Shah, the Senior Vice President at Geojit Financial Services, to answer all of your stock queries. So the first query coming in from Shubham Srivastava, who's writing to us from New Delhi. He holds 500 shares of ONGC at 100 rupees a piece. He wants to know if he can add more shares. He's clearly making a profit on it. Gaurang, let me come to you first, right? What do you make of the stock, and should he add more shares?
Thank you, Arundhati, for having me on this show. Good afternoon to all the viewers of CNBC TV 18, to Vinny and to all of you all. A small disclosure, Arundhati, all recommendations that I'll be sharing with you this afternoon on your show, they are a part of our fundamental research team recommendation. Our company, Geojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar recommendations with our clients. They might have their investment interest. So first of all, I think the investment is at a very comfortable zone of 100 rupees, if I read it right. Secondly, rising crude oil prices always has a tailwind positive impact on oil exploration companies or gas exploration companies like ONGC, GAIL, etc. As a disclosure, we do have a positive coverage from a long-term point of view. Hold, or if you want to even add a little bit more, possibly at these levels and on dips, you can definitely add a little bit more. These recommendations are from long-term point of view.
Okay, recommendations from the long-term point of view. Let's also get in your view on this one, Rahul, as well. Shubham Srivastava, who's writing to us, and he's, like we've said, he's holding ONGC right now. So 100 rupees, what should they be doing on the technical front?
Yeah, so, technically speaking, the stock is in a uptrend, and any dips, if they present themselves, can be good adding opportunities. I think there is more, a few left in the tank for targets of around 320 to 350 over the next 1 month or so. So our outlook remains positive on ONGC. Can look to add in dips around 250 to 265 levels. And, along with the overall uptrend, which continues in crude oil prices, we expect the sentiment to remain upbeat in ONGC as well.
Okay, let's move on then to the next query. We have Madhav, who's writing to us from Chennai. He's holding 200 shares of Pondy Exides and Chemicals at a price of 1,040, not one which we normally get as a query, or we cover too much as well. But he wants to know if he should continue to hold or he should sell right now. Gaurang, your view coming in, either specifically on the stock or any view on the sector as well?
Well, so we remain positive on the sector, Vinny, but the near-term headwind is in terms of input costs. That could create a little bit of disturbance in the earnings season because of short supply of raw material and inputs. This company happens to be one of the stronger players and a stronger balance sheet, Pondy Exide, in the sector. I won't be able to give you specific in terms of buy, sell and hold since we don't have a coverage, but we are overall positive on the sector.
All right, overall positive on this sector. Rahul, what about from a technical perspective? He's making a profit on the stock. So should he continue to hold this?
Yeah, so, the stock has come down along with the weakness in the broader market. And as far as volumes are concerned, it doesn't seem like any of the big institutions have exited out of the stock. So our view is this is a correction which is in line with the market, and especially given the last couple of weeks of price action, it seems like at least the short-term bottom is in place and the stock could head higher from these prices in the coming weeks.
All right, could head higher from the coming weeks. Now let's go on to our next query. Ashwini Mittal is writing to us from New Delhi. She holds 1,000 shares of Raymond Lifestyle at 1,153 rupees a piece. She wants to know if she should continue to hold or sell. She's making a loss right now. So Rahul, let me ask you, should she sell the stock or continue to hold it at this point?
Yeah, so this stock has been in a bear grip since a while now, in all the time frames, whether it is short term or long term. And, it doesn't make sense to hold on to it at this point in time unless and until some consolidation happens, maybe look to re-enter. But as of now, this is a clear exit.
Okay, clear exit for Raymond Lifestyles. Gaurang, I know you don't cover this stock, but textiles as a play, is there anything interesting you find here?
So there is a lot that has happened in terms of government policies and promote the Indian textile sector overall. And there has been policy decisions also from the government to support the sector. Unfortunately, things don't seem to be picking up for the textile sector overall. And of course, you have the overhang of tariff as well, which may turn out to be headwind in terms of earnings visibility. We don't cover, like I mentioned, we don't have a specific coverage on Raymond Lifestyle. But my sense, Vinny, is that if you can make a shift, if the investor is willing to make a shift, banking sector looks very attractive, and whatever Q4 business updates that we've got so far, they look very, very promising. One mid-cap or a large-cap public sector bank, because they have been buzzing quite a lot. Then two alternatives could be there. First one would be State Bank of India, and the second one would be Indian Bank.
Okay, so yes, actually it's a sell call coming in from, to sell is an opinion coming in from Rahul as well. And if you're willing to switch, Gaurang has given you a couple of names as well. PSU Bank side is maybe something you all can look for better interest or better returns as well. But let's move on. Next query for today is coming in from Mayur Shah, who's writing to us from Jaipur, holding 20 shares of Bosch. This is at 18,000 rupees. Currently the stock is at 33,000. Wants to know the future prospects of the stock for the next 5 years. So long-term investor there. Gaurang, do you have a view on Bosch?
We do have a view, Vinny, but the targets are in place and we have a sell recommendation. Okay. And looking at the acquisition price and the level where the stock is trading at 33,000, our advice is to book profits and take money.
So your advice is to book profits and take money. But Rahul, coming to he's making healthy profits on this. He's a long-term investor. He wants to know if he should continue to hold this. What's the prospect for the stock in the next 5 years? Or do you believe he should book some profits at this point?
Yeah, so 5 years from a technical perspective will be difficult to say. But, the overall fundamental outlook on the stock is, although the revenues are expected to grow at a steady rate, but the margin pressure could be there in the near to medium term. So our advice would be to sell on rise, look to, take profits. As of now, 35,000, 36,000 is a very strong resistance area for the stock. Look to sell, whenever these rises have happened. So in the last 3 days, stock has done well. Maybe some profit booking can be done at these prices, and then another chunk can come in around the 36,000 mark.
All right, so some profit booking now and maybe another chunk at the 36,000 mark is what you're saying. But gentlemen, on that note, it is time for us to head into a short break, but we'll answer more of your stock queries on the other side. Stay tuned. Welcome back. You're still with us on Your Stocks on CNBC TV 18. The markets are doing well, all of them in the green. Comments coming in on a de-escalation in the war has helped the market see some recovery. And if you take a look at the sectors, we've got consumer durables, which is doing really well, 2.3% in the green. We've got all of those banking names, right? Nifty Bank, which is in the green. That recovery there has helped the markets also go higher. The realty pack also doing really well, 1.8% in the green. Private banks, PSU banks, autos. IT has also shown quite a bit of resilience since the start of the war. That index today is about 0.5% in the green. So that's how the markets are shaping up today in the afternoon. But still with us on the show today is Rahul Sharma of JM Financial Services and Gaurang Shah of Geojit Financial Services to answer all of your stock queries. Now, the next query is coming in from S. Kaushik, who's writing to us from Nagpur. He holds 200 shares of CAMS at 715 rupees. He wants to know the long-term outlook on the stock. So, Gaurang, let me come to you. He's making a loss on the stock right now, but what's your long-term view on the stock?
Well, so I think the problem with the market right now, when the markets are down 15-20%, most of the portfolios would be also down and out, right? My personal portfolio also in mutual fund is down and out, to be very honest. So if you invested in a strong company, fundamentally strong company, I don't think short to medium term downticks in the market should upset your investment philosophy. As a disclosure, we are positive on CAMS. It's a services-related company to the Indian capital markets. We have a positive coverage. First of all, hold on to it. And if you have investable amount, you can add some more at current levels, and add-on dips would be the strategy.
Okay. That's about coming in on the fundamentals. On the technicals, what's your view coming in there, Rahul? Last 6 months, the stock has seen a decline of around 13%. But we're seeing a bit of an up move that has come in for the stock in today's trading session. In the last 5 days also, it's seen a bit of a jump up. Is this a story that we'll see a further run up now from here on for CAMS?
Yeah, so the stock has been in a bear market even before, the broader, the bigger indices turned bearish. So this is early January 2025. And, what it seems like is a long road to recovery. So, it would be prudent to look to sell on rises. At this point in time, we're seeing resistance for the stock place around 700, 715. Look to reduce or look to exit, once the rally happens. And, in such a market, there are better large cap ideas to be had, which are Nifty 50 stocks. They're down by about 20-30% as well. These are the stocks which can be considered, to go on the long side once, the market stabilizes and turns around.
Mm-hmm. Okay, that's a view coming in on the technical fronts for CAMS. Let's move on then to the next query for today. We have Rahul, who's writing to us from Navi Mumbai, holding 1,000 shares of Asian Paints. This is at a price of 3,100 rupees per share. Wants to know if you should continue to hold or sell at current levels. He's making a loss on this one. The stock is currently trading at 2,100. He's bought it at 3,100. Gaurang, your view for Asian Paints, right? We've spoken about so much of competition coming in first. Now we have again the issues of increase in crude prices, which affect its raw material cost side as well, right? What is the view now on Asian Paints? Is it better to book out your losses, maybe average? Is that an option, or what should they do?
No, I wouldn't advise book out and book your losses. Vinny, we have a positive coverage. First of all, hold on to it. The only problem with this investment is the acquisition price of 3,100 on Asian Paints, and currently the stock is trading at 2,180 odd levels. First of all, hold on to it. The prudent strategy would be add maybe about 25-30% at current levels. And due to uncertainty in the markets, though there are talks about a peaceful resolution and a diplomatic dialogue being opened up in the Middle East with Iran and US, things are still a little bit uncertain. And when it comes to President Trump, it is not done unless it is done. So you might get an opportunity to add a little bit more, but hold on to it. At 25-30% or even more if you have an elevated risk appetite. Bring down your cost of investment and stay invested from a long-term point of view. Crude oil does play a little bit of havoc in case if there is a boil in the crude oil prices. But over the past many years, Vinny, paint companies have shifted in terms of technology from oil-based to water-based paints. So that's a positive.
All right, so stay with the stock and add, if possible, 25-30% is what you're saying. But Rahul, if I can come to you, as Vinny pointed out, rising competition, rising input costs, all of them, pose a worry for the sector, right? So he holds 1,000 shares at 3,100 rupees of Asian Paints. So what should he do? Any technical levels to watch?
Yeah, there is one. So last year, the stock made a low of around 21.25, which is just 50 rupees below from here. If it were to break that level, that is when I think a technical fresh breakdown is expected and the stock could go down further. However, we'd be optimistic over here because there is also a bullish divergence which is building on the daily charts. And as long as 21.25 is intact, we expect the stock to see a rebound. And once the rebound happens, I think the first target for the stock would be around 2400 odd, post which around 2600. So these are two levels to keep in mind once the recovery starts. As of now, advice to keep the stop loss placed at 21.25 for Asian Paints.
All right. So those are the key levels to watch for Asian Paints. Now, the next query is coming in from Puneet Saxena, who's writing to us from Ghaziabad. He holds a few shares of ICICI Prudential at 2,900 rupees. He wants to know if he should continue to hold or sell, and also wants to know the target price for the next 3 to 6 months. So, Rahul, let me come to you first. Why don't you give us a sort of a technical view and what the targets are for this stock and what he should do?
Sorry, I didn't get the stock.
ICICI Prudential is the stock that he has right now.
Yeah, so the stock has sort of gotten hammered in the recent past few days. I think a bounce back is expected somewhere around 7-8% bounce back can be expected from these levels. So somewhere around 3,300 is what the eventual target for the stock is. But in between, I think it's better to see a staggered exit at these levels. So our view is to sell on rise in ICICI Prudential.
Sell on rise is the view coming in on the technical front over there. Gaurang, do you have a view coming in for ICICI Pro?
So it's one of the stronger players, one of the larger players rather, Vinny, in the AMC pack. And this is also straight away related to the Indian capital markets. And if the Indian capital markets are going to do well, I think AMC stocks, platform providers, services providers would definitely do well. We are positive on the sector, that is asset management companies. We have coverage on HDFC, MC and Nippon India. No specific comments on iPro AMC since we don't have a coverage, but it's one of the stronger players in the AMC category.
Okay, let's move on then to the next query. We have Farhan, who's writing to us from Bangalore. He's holding 405 shares of Ola. Electric price is 58 rupees per share. Wants to know if he should continue to hold or buy more at these levels. Obviously, given that this is a stock which keeps facing its ups and downs, more of downs that actually come in here. Gaurang, from 58 now it's at 28. Is it a good level maybe to look at averaging, or maybe just get out of the stock, or just hold and just be there?
Honestly, Vinny, with the kind of wealth destruction this particular stock has given to investors, even for traders, I think it has been a nightmare, to be very honest with you. We don't have coverage on Ola Electric, and I think the number of complaints that are there, issues with servicing, electric scooters getting piled up once they go for servicing or repairs and they don't come back to the customers. It's a very sad story out there. And of course, the net bottom line is also deep in the red, if I'm not mistaken. My sense is that there are better players, to be very honest. And he's already taken a hit of almost 50%. He got in at 15.8 and currently the stock is trading at 28 or 29 rupees. We're positive on the two-wheeler electric segment, and some of the established players are Hero MotoCorp, TVS Motors, Bajaj Auto. These are the names that one should be looking at in terms of long-term investment.
All right, so you've given us some options for long-term investments for this sector. But Rahul, if I can come to you, this stock has been plagued by a lot of issues. And over the last few days, we've seen it go up, but not by too much. So what's your view? What's the technical view? Should he continue to hold it, or should he sell at this point?
Yeah, it takes a lot of courage to be asking to be buying this stock, especially with the kind of wealth erosion that has happened. There is a technical bounce back which is happening in the stock. Last 3 days, volumes have been quite strong, which means that this current bounce back could extend in all likelihood towards 40 rupees, maybe 45 as well, if overall market sentiment remains positive. Purely from a trading perspective, this is that kind of a stock where in the next 1 month or so could be around the 40-45 mark. But beyond that, whether it sustains, whether it continues the rally is a question mark. There are relatively better names. Speaking of alternatives, Ather Energy is another stock which is looking very good on the charts. As a disclaimer, we've recommended this to our clients. The stock is at a multi-month breakout. Even in this kind of a market, the stock has actually gone on to hit new life highs, and the stock still looks good for a 15 to 20% upside from these levels as well. So, alternatives can be considered as far as Ola is concerned. Look to reduce on rallies around 40-45 mark.
Okay, next query then for today. We have Mahi, who's writing to us from Mumbai, holding 1,000 shares of Centrum Electronics, prices 3,040 rupees per share. Stock is currently trading at 2,795. Future prospects of the stock, levels that you should keep an eye out on, Rahul.
So Centrum Electronics is again one of those stocks which has played on its own in kind of a bear market that we've had. The stock has done consistently well. The trend remains positive, trading above all its key moving averages. I think the possible target is somewhere around 3,200, 3,300 on the upside. One can look to hold on to their investment and ride this up move in the coming couple of months.
Okay, thank you so much for that, Rahul. Rahul, as well as Gaurang, thank you so much for joining in on the show as well. But Arundhati, since we started the show also, we've seen a further up move that's come in with the markets as well. And now Nifty, 22,900, about that mark. So there's some cheer coming in on the street, hoping that ceasefire talk or reports that are suggesting that actually go through. We need more peace across the globe, more than markets running up as well.
Absolutely.
But yes, recovery, surely 376 points recovery from the day's lowest point is what we're seeing coming in for the Nifty 50 as well. And I think sectors continue to do well, mid and small cap continue to shine, as well as banks.
Absolutely. So good news for the markets there. We're seeing some recovery today. It's looking good, all green on the screen. But with that, that's all we have for you on the show today. But do remember to email us your queries and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of trade today.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Nifty implied open right now is indicating a 147-point decline for the market.
Destruction of civilian infrastructure. He's saying, well, power plants, bridges, everything. I mean, I think it's a bit crazy.
The total potential of the deal is $1 billion. What is committed from Olam is a minimum of $800 million.
Trend, Wipro, Power Grid, that's the Nifty heat map, are the top three gainers. Kotak, Sun and Adani are the top three losers.
We always were of the view that the well-off Indian consumption basket is going to outperform the mass consumption basket.
The US government has announced a 100% tariff on imports of branded pharma as well as its ingredients.
This is, it's globally accepted method of buying shares on the open market, which India was kind of, getting deprived of.
One of the best quarters that Trent has had. 20% growth this time, 4,900 crores approximately is what the revenue for Q4 will come in at.
The system-wide LDR is also now at an all-time high of around 83%. That tells you funding tightness is building in the system.
Retail fuel prices have been frozen despite global crude crossing $100. That is something that we saw, which led to excise duty cut.
Pakistan has proposed a two-step framework that has been sent to both Iran as well as the United States of America.
What a stellar rally on the markets from the lows of the day. We are above the 22,850 mark. Midcaps are surging too across the board.
Okay, I think, that last bit of the wrap, the day's wrap with Shireen outlining the proposal is the reason why markets are jumping. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi. Afternoon.
Hi, afternoon. Around 12:30, 12:45 is when we had reported, citing Reuters about a potential ceasefire, and that's when we had the markets jump. The Nifty was at 22,700, moved straight away 200 points up to 22,900. The advanced decline ratio turned positive. The Midcap index moved up nearly 1%, and crude oil prices cooled from levels of 110, now down to 108.
Well, that's right. And that's the biggest positive, right? The number of stocks advancing in comparison to the number of stocks declining. Even when the markets were actually down, the Nifty was down 100 points, 120 points. Still, you had the breadth of the market that was more or less even, Steven. So you like what you're seeing on the screen. Reliance Industries, that holds the key for the next 60 minutes or so. That's the one that's relatively underperforming today. But otherwise, a good-looking screen. The question is, can you believe him this time around?
But believe who is the question? Because this one is coming in from... so this, by the way, the latest move in the market is not due to President Trump. It's not one of his Truth Social posts. It's not one of his tweets. This is basically a Reuters report where, the news is that Pakistan has sent out proposals to both the US and Iran to act as an intermediary. And the proposal is basically, in a nutshell, ceasefire now and a permanent end to hostilities in a negotiated way. No nuclear weapons for Iran and, sanctions removal from America. So, but of course, the same report, Reuters, also said, and quoting Iranian sources, that Iran is opposed to any temporary ceasefire. It's got to be complete end of strikes and hostilities. It won't open the strait on a temporary basis, on a temporary ceasefire. So in any case, I think markets are, and rightly so, sort of reading this as some sort of a road to de-escalation. And I've been saying this at least for a week, more than a week now, that, irrespective of what everyone is saying publicly, both sides are hurting. And Iran, of course, with all the devastation and pain, it would also want to end this conflict on its terms, of course, not to give in or anything. And of course, we know what President Trump has been saying. So the last we've heard from President Trump, of course, is threats and more deadlines. But this, of course, coming in through with regards to that proposal for a ceasefire and then a settlement sort of soon. So we'll see how this goes because, you know, will we hear from President Trump on this story at some point in the day? It's possible. You know, it's fast-paced moves on the back of headlines and stories, etc. But directionally, the market wants to believe it. 22,900 or so is where we are at the day's high as we begin this particular trading session. All right, let's just quickly get to Mitesh in with what he wants you to do with regards to trades. Mitesh, good afternoon. Good to have you with us here. Thanks for joining in. So your perspective and you know, will gains hold, and should you trade this long now from here?
So two things, Prashant. One, we don't have confirmation of an absolute bottom being made, but today morning also you're talking that in case we get a good decline, you know, my level was around 22,450, 400 zones, and we got a low of 22,540. But the intraday charts, the 2-hour, 3-hour charts have started, you know, that process when the indicators start turning up from oversold level. So I think a strong bounce back at least is first thing which should be on the agenda. Now the first target was around 22,950, which we have nearly met. But once we start getting past that, 23,300 to about 23,400, 5,500 is my zone. So I think that's where we could head. Though this 22,950 remains a pivot. So if somebody's bought in the morning, take some profits off, trail your stop loss and hold. And once you get past that, fresh entries can happen beyond 22,950. So let's say if it goes to 22,980, 23,000, take a 100-point stop and take long positions for targets of 23,300, 500. So if not a big turnaround, at least a short-term relief definitely looks like to be on the cards.
What about Reliance Industries, Mitesh? That's crumbling, 3.5% gone on that. And other than that, what are the stock ideas?
You know, the good thing is about the Nifty is that this is happening, you know, despite the fact that Reliance is breaking down. The bad thing is that Reliance is in heavyweight, so eventually it will have some pressure on the Nifty going forward. See, Reliance, you know, it was having a very good support pivot around this 1350, 1355 to about 1340 zones, and it's broken below that today. So one, now I think any pullbacks to 1350 would be some kind of a selling opportunity in the short term. And two, I think, you know, this breakdown could suggest targets in vicinity of 1250 to about 1235.
And your stock ideas for the last hour?
So I have Oberoi Realty as one of the recommendations. That's a stock which I would recommend buying with a stop below levels of 1500 for a target of roughly around 1560, 65. And the second stock which I have is PNB Housing, you know, which is also reversing very nicely today. So PNB Housing is a buy. Keep a stop below 800 levels and look for targets of 845, 850.
Thank you. We'll come back to you, Mitesh, with some more ideas around 310. For now, let's talk about the oil companies. India's state-owned oil companies will now pay discounted rates for petrol, diesel, ATF and kerosene to limit mounting losses from the self-imposed freeze on retail prices. Sonal joins in with the details.
Well, it is an important update which has come by. It has been in works for a while since the time West Asia war broke out, and crude oil prices, they crossed that $100 per barrel mark, and at the same time oil marketing companies were not able to pass it on to consumers, and hence this step has been taken by them. There's no official order. This is a PTI report which is suggesting that a deregulation which happened back in 2014, there has been some tweak to that, and now oil marketing companies have told refiners that they will be paying discounted rates for refined crude oil, which is in the form of petrol, diesel and ATF as well. Now remember, oil marketing companies have two segments. One is refining, the other is marketing. Well, standalone refiners only process the crude oil and they make petrol and diesel, and then it is transferred to oil marketing companies for them to sell it across to retailers and industries as well. And the price at which it is transferred is called refining transfer pricing. This pricing is seeing a discount right now to as much as 60 rupees per litre as well on petrol and diesel. Now this is done in order to ensure that all the losses which these oil marketing companies are incurring, there is some cap on that, because as per the latest update from the Ministry of Petroleum and Natural Gas, the indication is that on petrol these companies are making under recoveries of around 24 rupees, and on diesel it is to the tune of 105 rupees a litre. So big losses in their marketing segment right now because they're not able to pass on the hike in raw material prices. And the idea behind behind this is to evenly distribute the losses across the sector in order to ensure that, yes, there are losses, but the losses are narrowed down, especially for oil marketing companies like HPCL, IOCL and BPCL. And this would mean a hit for standalone refiners like MRPL and Chennai Petro.
Thank you very much for that. You can see that in the stock prices. Chennai Petro down 4%, MRPL is down 1.5%. And some of these oil marketing companies will also come up for you on your screen. HPCL is holding up in the green with a gain of about 0.5%. Dipan Mehta, Director, Elixir Equities, is now joining in. Dipan, hi, afternoon. You had a complete wait and watch, just let the volatility play out approach when it came to investing in the market since the conflict began. Are you now getting the sense that even if the war simmers on, there is still some bad news, it's priced in, and therefore prices may not drop anymore? Is it time to start investing?
Good afternoon, Rima, and thank you for having me on your show. No, I still maintain that it's better to do wait and watch, and let us have a formal understanding as to how the war is going to progress, whether there's actually a peace treaty in place, and then what is the effect thereafter, and how much it is being honored. That is also important. So I think that uncertainties prevail, and this kind of volatility certainly will tire out traders and investors. So I think it's best to just conserve cash for the time being. And although I think we have got very good indications for the March quarter from whatever we have heard from the banking companies, the retail companies, FMCG companies, I'm not buying into those positive news flow, because the crunch quarter will be the March quarter, and let's see how that, sorry, the June quarter, and let's see how that plays out, because right now we're not seeing the effect of the Iran war on India's economy, on consumption, but that will happen sooner rather than later.
Okay, got it. Dipan, hold on to that thought for a bit. We have a few more stocks that we're going to discuss. A number of stocks, they are buzzing on the back of the fourth quarter updates that came over the weekend. Vinny joins us to fill us in with all of those details. Vinny?
Hi, afternoon. So first up, let's talk about trend, right? Among the top Nifty 50 gainers today, good Q4 FY26 update, 4,937 crores is what the revenue came in at, 20% growth on that front. Best quarter for the company in FY26 that one is seeing. Q1, they saw 19% growth. Q2, Q3 was around 17% growth, and now Q4 is a 20% growth. For the year, full year FY26 as well, 18% growth that came in here. Total stock counts, that also has seen an improvement, mainly led by a good store addition that came in from Zudio as well as Westside. So that led to the growth for the company in overall FY26. All in all, good numbers from the company in Q4. Apart from that, we also have Senco Gold that reported their numbers. Strong performance coming in the stock move of the company. Overall, they've seen a good demand trend that came in for the company because of wedding season. Apart from that, Women's International Day was there. There was Valentine's Day, which led to more gifting and which led to higher demand or better demand and footfall for the lightweight jewelry segment for the company as well. So 46% growth in terms of revenue, SSSG growth 34%, and overall for FY26, 35% revenue growth is what the company has seen. Outlook for FY27 also is quite strong. 20 to 25% revenue growth is what they're seeing in terms of value. EBITDA margins expected to be in the range of 7.5 to 7.8%, as well as in terms of new launches. They're talking about 20 to 25 store launches that they'll be looking at in FY27. Also, do not forget we have Nykaa that reported their update as well, Q4 update. Strong update coming in from Nykaa as well. Whether the beauty segment, fashion segment, all of them expected to see strong growth. The GMV for Q4, consolidated GMV is in the late 20s growth there. Net sales value growth is coming at around in early 30s. Apart from that, total revenue growth for the company this time will be more than 20%. So that's going to be the 14th quarter where the company will see more than 20% growth coming in. So all in all, a good update coming in from all these three companies.
Thank you very much for that. All the gold jewelry companies are actually higher following Senco's updates. Senco, of course, is up 12-13%, but Titan has gained nearly 3.5%. You've got PN Gadgil holding up in the green. Kalyan Jewelers has also been a pretty big mover today. Kalyan is up 6.5%. Q4 wedding season intact despite the rise in gold prices broadly. Dipan Mehta is still with us. Dipan, any thoughts on these Q4 updates which stood out for you, whether it's in the banking space or Senco, Nykaa? Lots of consumption names and they look pretty healthy.
That's right, Rima, I think, but that's the March quarter, and it had got only 1 month of the war. And when the war started, it was expected to be quite quick. and over and done with, but it's getting extended and extended. So let us see how the consumption plays out in the June quarter. So I don't think that just because of the positive news flow for March quarter, one should extrapolate that to the June quarter and expect that growth rates will be normal. At some point of time, we will get increase in petrol, diesel prices, and we are seeing very strong inflationary pressure at the retail level, at the wholesale level as well. Companies are saying that cost of input has gone up for them, and EXIM trade, of course, has got disrupted as well because of what is happening in the Middle East. So I would just like to be a bit cautious at this point of time and not get carried away by this flow of positive news. That's all in the past, but coming quarter will be very challenging, and let's see how companies cope with that before making an assessment on whether to go ahead and buy based on the March quarter numbers.
All right. Deepan, what about some of these other names that are reacting in today's trading session? You have Nalco, that's 400 rupee plus stock. You have Hindalco as well, that's doing well, in Vedanta. Do you like any of these?
I think both Nalco and Hindalco have been rallying on the back of sharp increase in aluminum prices. Actually, aluminum had been lagging copper and some of the other industrial metals, but now it has, last 2-3 months, it has done even better than those non-ferrous metals. And that should aid the higher realizations for these companies. Also, rupee depreciation benefits such metal producers, including Vedanta, because their realizations are typically their pricing is in dollars and then they convert to Indian rupees. So I would expect that next few quarters to be very good for the Indian metal industry. And as such, I think a lot of the positives have got discounted. But nonetheless, I think from my perspective, it's better to remain invested and look for corrections to enter into these stocks. Nalco in particular looks quite cheap and attractive. And let's see, there could be a play for a PE rating over there if you compare to what is trading, what Hindalco and Vedanta are trading at. And massive expansion also going on stream for Nalco, but execution is a big risk factor.
Okay, all right. Let's talk about the other material then that is more domestic facing, that is cement. I've been making some calls, speaking to experts on ground. I expect maybe there could be some kind of inorganic move as well in the coming months after taking a bit of a break for a while. But these cement stocks have got badly beaten out of shape. Q4 was shaping up very, very well before this war broke out. Do you like any of these names? They've all corrected big time, 20, 30% odd from the top. And the mid-caps names, well, some of them are close to half of what it was at its peak. Any particular name you like, Deepan?
I think that if you want to be in cement, I would go with the large companies, Gujarat Ambuja especially, which is doing a merger into ACC, and now JP Associates also will come into the fold. So size is a great, I would say, important point when you look at cement companies. Ultratech, She Cement also look very interesting. But one thought that comes to my mind is that with so much of subsidy going into oil prices not being, these companies will pass on, and government finance is also in a bit of a flux because of the Iran situation. Is it possible that government expenditure may slow down in the coming few months or quarters? That certainly may affect cement companies. And overall, I think if there is softness in capex, softness in real estate market, then that could also impact cement. So as I said, the picture is getting very, very murky and very confusing. And although stocks may have fallen 30-40% from their peaks and their attractive valuation, I do feel that it's better to just wait and watch, conserve the cash. Who knows, these stocks can be available 10-50% cheaper even from these levels. And then we have to deal with the entire June and maybe quarter beyond that, where there could be more bad news on the actual earnings front. So that's the reason for my just staying put at this point of time and not being aggressive or adventurous.
Dipan, if one thing we've learned in the last 4-5 years with the Russia-Ukraine war or Middle East is that I think every nation needs to be secure on the energy front and independent. And if this entire energy independence is going to emerge as a structural theme, what is the best way to play it? And if, take us through, a top-down approach to this theme.
That will take a lot of time, but you asked a
in short, question. In summary, give us a summary.
You asked a fantastic question, and something is playing on my mind. And if I can just extend a little bit, there are 6 things the government can do. One is diversify the supply chain. Second is go for increased production of oil, crude oil, that means more exploratory activities. Give even more incentive to renewable source of energy. give a push to electric vehicles, particularly two-wheeler companies, Ather, Ola Electric. And then there is new age technologies, which is like, gasification and green hydrogen. So companies like Reliance Industries, Larsen & Toubro, BHA, which have technologies. And of course, Coal India as well, I think, because coal may become the focus area. So I think this energy security is going to be a theme bigger than even defense and railways, what we saw, in the last 4 or 5 years or so. So that's one particular investment theme that we are working on very hard. And there are no direct plays, but a lot of winners may emerge, over here.
That's the problem, right? No direct. I mean, some direct, but mostly indirect. There's nuclear as well, Deepan. India is one of the few countries, even before all of this, which is building, a number of nuclear reactors. That's the other thing. I mean, I think it's a lesson from Europe, Germany especially, complete rollback of all nuclear energy. And now, of course, I don't know if they're repenting, but a tough spot, no Russian gas and no oil as well. I mean, lesser oil from the Middle East in that sense. But yeah, by the way, I just want to take you through a few movers. It's a pretty broad-based move. It's a pretty long list of volume-led gainers today, which is coming up. Newland Laboratories is jumping about 7%. So the point is, overall, as the market comes up a little bit, everything looks constructive. I mean, it's not as if each and every stock has to have some news flow behind it. It's just that, people get a little bit more courage, a little bit more emboldened when the tide is with you rather than when the market is crashing and burning. So I suspect that is what is happening with a bunch of these names today. So don't go looking for reasons for each and every move. It's just that, there are those who are interested in this name and that name. Bosch, for example, look at that, 4% higher. Ather Energy has got a very large, actually, it's a big volume day for it. Price move is up 4%. Look at LG India, right? I mean, LG India is up 5.5%. Policy Bazaar is up about 3%. If you can have these names up. Lenskart is at about 500 odd rupees or so. So that's coming up with a decent sized move. Titagarh is up. I think Titagarh, there was a brokerage upgrade today, which came through. Gravita India is up about 6.5%, 7%. Nelco is coming up with about a 7.5% pop. So it's a pretty varied list of moves, which is coming through. So, things looking a little more constructive for now. It's all one headline could ruin it, but directionally looks like those much awaited off ramps, at least people are trying to build them. Will they be used or not by both sides is the question. Deepan, thank you very much for joining us. Good speaking with you. And thank you for being here on CNBC TV 18. We'll take a quick commercial break here. We come back in just a bit. But here are some sound bites from Conrad Saldana on where he sees value in this market.
I take a longer term view to it. IT services, right now, there's not being much priced in for it. So the better players, growth has been lackluster. They're going to start to inflect positively. So I think the worst is priced in. And what I look for from a longer term investment standpoint is where is the valuations totally misaligned with the fundamentals, right? And I think IT services was one of them. I do think some of the financials, to be fair, in this sell-off also look attractive. The private banks, and you've seen that disparity really condensed. Now, HDFC had a little bit of drama, I would say, whether it's communications or miscommunications, but that had a role to play in it. And, you're owning a solid deposit franchise at 1.7 times book. I think that looks attractive longer terms. If you ask me something you're looking out longer term and what's created an opportunity is, the likes of Larsen & Toubro, big Middle Eastern exposure, right? So that's an obvious one, sell on the news. Once this is behind us, there's going to be a massive build that's going to happen. Those order books are going to explode. So if we pause short-term noise and think out longer term, those are attractive opportunities. Indigo too is a good franchise, and I'm not sure on the regulation side how that moves out. They've had their issues, and maybe they ran too tight. You've had the whole aircraft issues, you had the engine issues. So a lot of that stuff is getting behind you.
Welcome back. Holding above 22,900. So now let's talk about stocks. Hormus joins in as always to put the spotlight on the top movers in the market. Hormus, take it away.
Another day and another recovery that has come in from the lows of the day, and leading that recovery is HDFC Bank. As a second day that you have seen the stock make an intraday low and then recover from those levels. And from the intraday lows, the stock has recovered almost 3.5%. The lows were somewhere close to around 740 odd. And since then, now we are at 770. Volumes, though, in today's session are below average compared to what they were earlier on. We've had around about 3.5 crore shares that have been traded. The 20-day average is around 4.5 crore shares. And despite this recovery that you are seeing play out over the last couple of days, the stock is still below the key moving averages because the 50 DMA on the upside is at 874 and we are still at 770 on HDFC Bank. And 55% of shares traded today are marked for delivery, and from the 52-week low of 730, the stock has recovered almost 6% from those levels. The big mover today, though, has been Zydus Wellness, and the stock has continued to move higher in today's session. At one point was up almost 18-19%. The intraday gain was the biggest in a single day since 2009, and this is the third day of gains for the stock. The volumes, though, are still much lower compared to what we saw on the 13th and the 14th of March. So still higher, but not as high as they were back then. The close to 3 crore shares have been traded today. The 20-day average is around about 30 lakh shares, and the stock is sustaining above its key moving averages as well. Among the top 10 traded stocks on the Nifty 500 in today's trading session is Zydus Wellness, but only 8% of the total shares are marked for delivery, and the stock is nearing its 52-week high, which is around 530. And the last one is a big business update reaction, and the stock had already started moving in anticipation of such an update. Avenue Supermarts is fourth straight day of gains for the stock. In fact, in the last 7 sessions, the stock has gained in 6 of them, and during this 7-day period, the stock has gained almost 25%. So, in outperforming much before the business update, and it is continuing that outperformance in today's session as well. Then the 6th straight day of volumes being above 10 lakh shares in a single session. The premiums on the 4500 call option have gone up almost 65%, and the stock has now moved above all of its key moving averages. In today's session, 17 lakh shares have been traded. The 20-day average of around 6 lakh shares, 42% of those marked for delivery, and the stock from its 52-week high is still down around about 8%.
Interesting list as always, Hormus. Thanks very much for that. Nikhil Ranka is with us, CIO Equity Alternatives at Nuvama Asset Management. Nikhil, good afternoon. Good to have you with us here as always. You've been constructive, I think, for a few days now, right? That things have bottomed out and maybe it'll get better. It's playing out, at least. From the lows, we saw that sharp recovery on Thursday, and today we've seen something similar, and a few more of these days, and that slight amount of confidence will start to come back into the system. That there are marginal buyers who are ready to come in whenever there are dips, Nikhil. But are we playing here for a bit of a tactical rebound, and will the smart guys create cash at higher levels? Because the view is ultimately we are kind of ranged here, even maybe the range may be slightly higher from where we are. Or you think this is done and this is constructive and looking good?
Good afternoon, Prashant. In terms of our thought process, Prashant, whenever we see actually markets trading below 17 times 18 months forward earnings, that becomes a buy zone for us. The last time we spoke, we were almost close to that 17 times level, and nobody honestly expected that Iran will be able to give a tough fight for almost 35-36 days. So markets did have 3-4% more correction. Now, incrementally, if you look at it, things on the margin seem to be getting better. So if you just see the sort of crude tanker data, which is available on tankertrackers.com, when the wars just started, you had almost close to 120 tankers going to and fro through the strait every day. That number for the entire March was close to 2 or 3 because only Iranian tankers were going through. If you see that number as of yesterday, that number has inched up as high as 15. And today, Iraq officially has asked customers to give their oil loading plans. So therefore, my sense is, even if this continues for 10-15 days more, at least you are seeing some sort of de-escalation on the Hormuz side. Iran is willing to let some tankers go through. And that should bring down the geopolitical risk premium. If you look at the crude futures also, the current month NYMEX is today trading at close to 110. But if you look at the 3-month out futures, those are now quoting at close to 85 levels. So even the crude market in that sense is sensing that, 2-3 months down the line, the value of crude should be closer to $80 to $83 rather than what is there today. For us, the bigger problem was one currency. We've moved from 89 to 95. Given the recent RBI measures, we have pulled back to 93 odd levels. And if now crude also starts to come down, then I think macro will start looking good for India again, and we could have a very decent relief rally. The other data point, Prashant, that you have to look for is, India's overall market cap today is close to 420 lakh crores, out of which FIs hold close to 16%, which is 66 lakh crores. From October 2024 onwards till date, they have sold almost 4 lakh crores. That's almost 6-7% of the AUM that they have sold in the last 18 months, which has never happened after 2008. So from that perspective also, it seems that FI selling is coming close to exhaustion in my view. And therefore, as things stabilize, these markets can actually surprise on the upside as well.
Nikhil, we might see a relief rally, but what could be the extent of it? For instance, we were just chatting with Amish Shah of BofA, the strategist there, and he's saying that the FY27 earnings growth, according to them, their estimate, is just a paltry 8.5%. It was at 14% a couple of months back. They brought it down from 14 to 11 and now further down to 8.5%. So while valuations may be anchored at 17 times, but if the earnings growth itself is going to be in high single digits, what could be the extent of upside?
So, Rima, if you see FY28 consensus estimates just before this war had started, it was closer to 1450, 1460. And most of the reports that I have looked at, depending on 6 to 8 months of war, people are saying there can be 5% earnings downgrade to that. So assuming that number comes down to 1380 and we see some sort of valuation compression also, instead of 20 times, we start trading at 19 times. Then probably we are looking at something closer to 25,500, 26,000 on the Nifty in that sense with a 6-9 month horizon. But, these things are very difficult to predict because, if this gets over very soon, then probably we will not see that sort of earnings downgrade at the first place itself. And then obviously 26,500 will become the base case over the 9-12 months then.
All right. Hi, Nikhil. Good to see you, and you're sounding fairly optimistic. You seem to suggest that bulk of the bad news is in the price. Simple question then. What do you buy?
So, Nigel, I said the last time also, if you just look at the valuations of banking, we are getting them at price to book, which are almost close to where they traded during COVID time. So
private banks, right? Large private banks.
Yeah, large private banks. So if you just look at it, all of them were closer to 1.3 to 1.5 times price to book on FY28 basis. The quarterly updates that came over the weekend were fairly strong. And that's what's starting to reflect in the price move now. And the good part is, given that yields have moved so high, the next move will obviously be a rate hike by RBI. There's very little chance of a rate cut now. So we are not going to see incremental NIM pressure. So if you have 12-13% loan growth, some sort of positive effect of NIMs, then we can look at a 14-15% pre-provisioning profit growth for most private banks. And then if you look at the price to earnings on an FY28 basis, all of them are now close to 10-11 times price to earnings. So for a 13 to 15% earnings growth profile, I think a 10-11 multiple looks extremely cheap.
Any other sector or stock that you'd like to highlight which you're turning incrementally or you're very bullish on? Valuations are misaligned?
So, Rima, tactically, I think IT also, because even if, on CC basis, companies report between 1 to 2% growth this quarter, the point is there will be tailwinds of sort of rupee dollar movement in this quarter. When we ended last quarter, we were closer to 90 levels. We are today closer to 93, 93 and a half. So, you will have some bit of margin tailwind because of the rupee movement, and ultimately the rupee EPS conversion is a function of the dollar EPS multiplied by rupee. I think even IT could have a good tactical rally in the near term. A 10-15% tactical rally could come in the IT names as well. Post that, obviously, we will have to see the commentary from companies, what FY27 guidance most of them gave, because the street right now is building in anyways 3 to 5% constant currency revenue growth from most of the large cap names. So if we see some upside bias to that, some good commentary, then obviously there could be further upside to those names.
All right, thank you very much for that. I think this is the fourth bullish view we've had on IT. Tactically, though, just in today in this trading session, first was Conrad, then even BofA, where Amish said they're structurally negative, but there could be a tactical upside in IT names. Then Sandeep Suvilo, who's been so negative, Sandeep Agarwal of Suvilo, who's been so negative Indian IT, he said that they're incrementally turning from zero weight of IT in their portfolio to an equal weight or maybe a slight positive. And now even Nikhil Ranka of Nuvama is talking about a tactical play in IT, 10-15% kind of an upside.
Well, on IT, Rima, one more point. The rolls were very, very negative. The entire roll spread that you saw getting into this series was so negative that any kind of positive news flow will result in this index itself seeing a big spurt. So the index actually, after getting hammered in February, outperformed in March. But yet, if I look at the rollover, from March to April, it was extremely negative. So let's see how that goes. But, the odds are that if there is any semblance of good news when Rima's companies deliver, some kind of positive commentary, you could actually see an outsized reaction. So keep an eye out on that. In the last few days as well, it's fairly outperformed. Let's do a quick check then on the FNO market and how the markets are shaping up. The biggest positive today, as I've been mentioning, is the advanced decline ratio. Looking very, very good. The number of stocks, more than 2,000 stocks advancing. That's fairly good. So you look at the headline index, you'll say, well, we're up close to around 150, 200 points. But the breadth of the market is very good. The problem today is going to be Reliance Industries. That is seeing some kind of buying at lower levels, actually. But otherwise, there are plenty of shorts in the system. And that's the one that's dragging the index by close to around 82 points. If not for that one, we would have been above the 23,000 odd mark. So I'll keep an eye out on Reliance Industries. Knee-jerk reaction, it seems, in today's trade. The options data comes up for you on the screen, and there's clearly writing that you're seeing on options. 22,600 per. Just take a look at the premium. It's down to around 60 rupees from around 240 rupees. While on the upside, this 22,700 call, the premium did come down, but now that one as well has done a quick U-turn. From the midday, it came down to around 180 rupees. From there, it's moved to around 300 rupees. There's a mix of activity, mind you, at that particular strike. So we'll have to keep an eye out because there was some signs of writing at that particular strike as well. On the Nifty, the important mark is going to be the 23,200, which is from where we did a bit of a U-turn in the last few sessions. The Nifty Bank, that's in the middle, and it's getting closer to around the 20 DMA. You'll see a fresh burst up if, in fact, it can get towards the 20 DMA, both on the Nifty as well as on the Nifty Bank. The Nifty Bank, by the way, is 200 points away from that level. Blue Star is a stock that's been shorted in the last few trading sessions. Maybe the fear was that we're not going to see that good sales in comparison to what was expected. And because of the unseasonal rains, there were shorts in the system. Today, it appears there is a fair bit of short covering on that one. Keynes as well did pull back, but there has been some positive news flow, and that stock, in fact, has popped up in trade. Short covering being seen out there. Surprise, surprise, fresh buying being seen on Vishal Mega Mart in today's trade. And finally, Jindal Steel. There were some shorts earlier in the trading session, but it seems intraday, some of those shorts have covered out their position. That's why the stock has recovered close to 2% from the lows of the day. The VIX is still at an uncomfortable level, 25, 26 or thereabouts. You'll want that to gradually cool off. From the highs of the day, it's down close to around 7%. From the highs of last week, it's down close to around 20%. You want to see it drift towards the 20-odd mark. All in all, a good trading session. I'll keep an eye out for the data post-market as could be a big short covering bounce that we're seeing in today's trade. But we'll take a quick break, come back. Nimish is waiting for us on the other side. He'll tell us what he's picking up on Tearing Rooms. Stay with us. Welcome back. It's time for our favorite segment, D Street Chatter. Nimesh joins us to give us a bit of an insight in terms of what he's picking up in dealing room action. Nimesh, what's the buzz? Is it some buying? Are the shots running for cover?
It looks like more of a short covering rally to continue, Nigel. You know, again, especially in the banking names, that's clearly the trend that this rally is led by short covering. Broadly, overall in the markets, I guess small news of ceasefire, and we've seen a big reaction to the equity markets today. Even the crude has cooled off a little bit from the day's high. So some markets are reacting to it, but again, need to see as to really if that pans out. Having said that, this rally has still not been supported. Very strong buying. In fact, there is a lack of buying interest from larger HNIs as well. There is a bit of lack of faith to buy into this rally clearly from all sorts of investors, whether it's the FI investors as well. So even today, my sense is you'll see a small sell figure as far as the FI flows are concerned. As I said, the big sector move is in the financial names, largely on back of short covering because most of the Q4 update from banks seems to be positive. So that led to a bit of a short covering rally in the banking and in the NBFC names. But broadly, still this lacks a bit of buying interest from all sets of investors.
Okay, got that. Nimesh, what about individual stocks? What are you picking up?
So a couple of names, both the Adani Group stocks, Adani Green as well as Adani Power, big move on those names. In fact, the entire Adani pack is buzzing in trade today, but these two names specifically saw large blocks in the morning trade. I understand one of the leading long-only FI was a buyer in today's block. So any disclosures, if there are any, could be interesting to track in both these names, both Adani Power as well as Adani Green. That's the reason why they're buzzing in trade today. Second name is Delivery. Even that's buzzing in trade on very strong buy flows. Plus, Morgan Stanley had a tactical buy as well in the morning. They expect the stock to outperform in the very near term on the back of Q4 updates and Q4 earnings. So that's the reason why a bit of uptake in Delivery as well. The third name is PNB Housing. The entire, financial stocks have done well today, but PNB stands out in terms of buy flows. A leading domestic mutual fund is an active buyer as well. And remember, for PNB Housing, this quarter will be the first quarter under the new leadership, under the new CEO. So CETA anticipates a strong quarter and hence a bit of an uptick there. And the last is Bosch. Again, in buzzing in the last couple of days, there is a disclosure that there could be a fundraising board meet scheduled for 8th. But beyond that, the city is anticipating corporate development as well. The merger of potential two of the unlisted subsidiaries is the buzz as far as Bosch is concerned.
Okay, all right. Bosch has got news, or at least news which is expected in terms of a corporate development. Nimesh, thank you very much for that. That explains the move. I was mentioning Bosch earlier, but I think there is something behind that move beyond just, people finding it attractive at those levels. By the way, I just want to point out that oil has fallen a little bit more. We started 230 with oil at about 110. And now, 108. We are below 107. So we are now in the 106 handle, and we should put up a flash, which I think, there you go, 106.9596 is where we are at. So this is certainly good news. And at 8 in the morning we were at about $110. So that's a $3 kind of fall in the last 8 hours or so that we have been looking at this today. So certainly welcome news. Mitesh is back with us with what he wants you to do in terms of short-term trading ideas. Mitesh, what do you have?
I think, as I said, this bounce back could possibly extend. As of now, looks like, we will maybe just get past those levels of 22,950 and maybe the quarter closing over that. So we'll go with some long bias trades. I have BTST call on UPL with a stop at about 603 half and a target of roughly around 618. And Brent has had a good gap up opening and a good follow through. So for a BTST, it could be good. Keep a stop below 38.10 for targets of 38.70.
Okay. Got that. Thanks very much, Mitesh, for that. Ambarish Balika is with us with his perspective and things. And as always, he brings a stock or two, which he wants to discuss. Ambarish, good to have you with us here. And I think Action Construction Equipment is your stock today?
Absolutely. Action Construction is a manufacturer of cranes, construction equipment, material handling equipment, and agricultural machinery. A decently large product range, and dominance is there in pick and carry as well as tower cranes. Market share is over about 63% in mobile cranes and close to 80% in self-erecting tower cranes. Revenue comes mainly from sectors like infrastructure, real estate, manufacturing, and logistics. And these are the sectors where we are seeing huge amount of spending by both government as well as private sector. And they've also got into the defense sector, one order for more than 1,100 rough terrain forklifts from Ministry of Defense. This is worth about 420 crores. And export is about 7% of the revenue, but should soon see double digits, like revenue from exports, as they already have footprint in about 37 countries. The performance in the last couple of quarters was affected because of CEV Stage 5 emission transition and pre-buying which happened from customers in 2024. But now the management has confirmed that the price acceptability, in fact, the price has gone up. So that acceptability has been fully normalized. And there is a pickup in orders. So I'm expecting an EPS of about 48 for FY28 with a price target of 1104.
RPSG Ventures. Ambrish, do you look at that particular stock? If you pull up a fortnightly or a 1 month chart, on I think 24th to 25th of March is when that RCB deal of $1.8 billion was struck. At that time, RPSG Ventures was at about 700 rupees. And since then, in a span of a couple of trading sessions, it's at 1,123. It's gone up more than 50%. And every day you see that step up, that 10% upper circuit on RPSG Ventures. Have you looked at it?
No, I'm not looking at it very closely, but whenever you have a stock moving up like this, post some sort of an announcement, and that if we look at it, it's at possibly a 52-week high. So with this sort of a move, I think it's always prudent to at least book some profits.
All right. Another stock actually that's moved very, very well since in the last few days is Ganesh Ecosphere. We had the management who joined us on the show, and the stock, I think, has done 25 or 30%. It's just moved to the high point of the day, so that's why it's coming on the radar. I think we should pull up Ganesha Ecosphere. That stock as well has spiked up in the last few minutes. Any view on this one, Amrish? The recycling theme? Everyone got very excited when Gravita came. They raised some money. The stock re-rated from 200 all the way to 2,000 rupees. Then Gravita pulled back. The other recyclers, Jain Resources, Ganesha Ecosphere, do you like any of them?
No, in fact, I've not tracked this very closely, but then the recycling theme clearly is picking up. And in fact, I've also recommended Gravita in the past. So that's what we still like.
You continue to like Gravita at these levels?
Absolutely.
Okay, all right. Got that. All right, Amrish, we request you to stay with us. The rupee has made a strong recovery after the RBI instituted measures to curb speculative trading in the rupee. Let's hear out what Mitul Kotecha had to say on these measures and where the rupee could end up this year.
Structural issues that still are in place. And look, no one's really talking about growth. Indian growth is still very, very firm, still one of the fastest growing economies in the world. And at that, from that perspective, things are not where, we're not talking about a crisis here, even on the balance of payments, with a deficit on the current account, it's sort of barely around 1% of GDP. It's not a structural problem. But at a time when you've had massive capital outflows, when you look at the equity outflows in particular that have been so significant and have continued into April, it is a bit of a worrying picture in that sense. And of course, as you said, the longer that oil remains elevated above $100 a barrel will cause more pain for India's balance of payments position. The rupee will trade much more on underlying structural factors rather than these arbitrage trades or more speculative trading. And I think the RBI has succeeded or will succeed on that front. But, even these underlying trade pressures will keep perhaps the rupee under downward pressure in the months ahead. Look, so our forecasts, for the rupee, as I mentioned, we have currently rupee weakened 95, and again, that was ahead of the RBI measures, which have seen, as you mentioned, the 2% rally in the currency. So we will see whether we get there. But I do think, as I mentioned, the underlying pressures won't change, even if the speculative pressure has been eroded.
Well, let's get some more opinion on the macros, the market, the earnings, where crude prices are likely to be. Listen in to Amish Shah, the head of India strategy at BofA.
Stagflation risks are now real. If I look at the macro, we are already forecasting that the GDP growth will come down from 7.4 that we were estimating earlier to 6.5. Similarly, fiscal deficit is going to go up, inflation is going to go up. We are already forecasting for a 50 basis points interest rate hike this fiscal. Similarly, on the commodity side, we are now working with $92.5 per barrel of crude for the year as a whole on an average, $100 for the remainder of this year. On the 2nd of March itself, we had brought down our earnings growth from 14 earlier to 11, and now we are taking it down from 11 to 8.5. NBFCs, real estate, REITs, passenger vehicles, everything that's rate sensitive gets impacted. And obviously, if you're working with a higher crude, then downstream energy and the consumers of crude and crude products, those are the ones that get impacted the most. We believe that India will continue to underperform the emerging markets this year. Street is at 15, we are at 8.5. On our numbers, Nifty is already at long-term average. So we are on the higher end of the band during the crisis period valuations. And if these valuations sustain, we do think that there is a 15% upside to the markets from current levels. But in the bear case, if the valuations do go to the lower end of the band, which is -1 standard deviation, then we could potentially see a 8% downside. So even if we work with a -8 plus 15, we think that the risk reward is now favorable.
Welcome back. Almost at the 23,000 handle mark on the Nifty now. So many banks are doing pretty well. So RBL Bank Bank of Baroda, City Union Bank, Bandhan Bank, Bank of Maharashtra, all these banks are up between 4 to 6%. On the large cap screen, you've got Axis Bank surging with a 4% gain, HDFC Bank up 3%, and even Kotak Mahindra Bank, which started the trade a bit disappointed with the performance. The quarterly update is now back in the green. Amrish, any standout performers for you from the large cap or private sector mid-cap banks?
In fact, it was expected that because of the RBI restrictions, there could be some pressure on the banks, but instead we are seeing a better performance. So at this point of time, I would surely go with some of the private sector banks like Kotak or Axis Bank.
And Trent, is it a buy after the 7.5% gain?
Yeah, I mean, from a trading perspective, yes, because in these stocks. So from a trading perspective, I would buy a Kotak and Axis.
You buy a Kotak and Axis, not HDFC. Yeah.
HDFC would be more from a long-term perspective because of the sort of underperformance which you have seen. I don't see too much of a downside from here, but then I think the wait could be possibly next 12 to 15 months. So someone who has been wanting to buy HDFC for the last many years, haven't bought, I think this is a good opportunity.
You know, one area, Amrish, if I can ask you, insurance, right? I don't know if you have any thoughts here. This is a sector, if you remember, we've been constantly hearing, and I think it'll be followed by, I guess, some kind of action as well. But we've been hearing again and again, finance minister herself, ministry, and so many others really wanting to push the pedal on penetration. You know, do what it takes, but really push through penetration in a big way. You know, stocks have come off, like SBI Life, etc. Not that much, but have taken a 10-15% kind of knocks. Anything you like here, Amrish?
I mean, we have seen a huge amount of digital penetration. Despite that, the sort of penetration which you have seen for life insurance is still quite low. So I think there's a decent headroom for, this sector, maybe over the next 4, 5, 6 years. So, I mean, out here, I would surely go with some of the better private sector players like a HDFC Life or a SBI Life.
Okay, all right, Amrish, thanks a lot for giving us those thoughts. Well, as we start winding down, just pull up a few intraday charts. The street is clearly factoring in there's going to be big de-escalation from here. OMCs that have got hammered out of shape, they have spiked to the high point of the day. The hope is that Brent crude prices see a decline, which will be good for some of these companies that are making big losses at the margin as of now. So for intraday basis, these stocks, in fact, have recovered from the low point of the day. BPCL, HBCL, IOC, all of them have spiked up. Interglobe Aviation as well, the stock that was lower earlier on the trading session, that as well has spiked up. And the other names, some of these hotel names as well, have seen some kind of buying. While on the flip side, you have a stock like ONGC that would be a beneficiary of the spike in crude oil prices. Well, that one, in fact, has moved to the low point of the day. So let's wind things down then for the day. A solid trading session, 250-point gain on the Nifty. We recovered more than 350 points from the low point of the day. The standout performer today was the Nifty Bank. That did very, very well, led by HDFC Bank. HDFC Bank seems to be finding its form, and that was very, very good. Additionally, you had a couple of strong quarterly updates. Trent was the stock of the day, up close to around 8%. You had Avenue Supermarts as well that participated on the upside. From the banking names, Axis Bank got a thumbs up. HDFC Bank as well, quarterly update coming in there. The street did like that update. On the flip side, though, Reliance Industries, that dragged down a little bit. That was down close to around 3.5%. But without the star performer performing today, yet the Nifty went home with some solid gains. From the broader markets, plenty of stocks were doing a thing of their own. You had Senco that was up more than 10%. You had Bodal Chemicals that was up close to around 10%. You had Trent, I already mentioned that one. Refiners were under some pressure. Chennai Petro was down close to around 5%. Net, a super trading session. Number of stocks advancing were 5 for every one stock that was declining. The bulls will feel Easter Monday has changed their fortunes a little bit, and things could probably look up from here. Obviously, we'll be keeping an eye out on the geopolitical issues overnight, and hopefully that ceasefire talk does progress. Well, we'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting for you.
Market stage a sharp recovery on easing concerns around West Asia conflict, ending the session at the day's high. Frontline indices extend gains for a third straight day, with Nifty closing just shy of 23,000.
A flurry of business updates from banks and NBFCs point to strong advances growth in Q4, but sluggish deposits is emerging as a key concern, therefore nailing potential pressure on margins ahead.
And retail, major Avenue Supermart and Trent indicated near 20% growth in Q4 FY26. Fashion retailer Nykaa clocks growth in high 20s. Meanwhile, mature FMCG names like Dabur, AWR Agri are also reporting healthy volume trends. Hello and welcome to Markets Forward on CNBC TV 18. This is your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny Motiwala. With me is my colleague Vivek Iyer. Vivek, it's been a day where we started in the red. We saw a gap down start and then that recovery came in. 12:30 onwards, commentary came in. We could see some easing, maybe ceasefire coming in the war. And that's a positive sign, positive trend. And Nifty closing at the day's highest point.
That's right. Good afternoon, Vinny. Absolutely nothing to complain as far as markets were concerned. The Nifty Bank, flurry of updates, like we said, but that was what stood out, almost 2% higher as far as the Nifty Bank was concerned. Broader end of the markets did very well. And like you mentioned, reports of a potential ceasefire agreement between Iran and USA is something that drove the markets, especially in the second half of the trading session. On the back of that, we did see a sharp recovery, and the Midcap index ended higher by over 1.5%. But we've got you covered for the next 20 minutes with all the big news as well as updates for the day ahead as well as for the week forward. And here's the lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Hormaz. We will discuss why FMCG and bank stocks were buzzing in trade today. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But first up, to our first segment of the day, Hormaz now joins in from the big wall with all the top movers and shakers of the day.
We told you at the start of today's day that the Nifty Bank is going to be the index to watch out for. And boy, did it not turn out to be the index to watch. And it was the index that first led the Nifty lower at the start of the day and then took the Nifty higher at the end of the day. And take a look at this pitch. And you can see barring L&T and Bajaj Finance, HDFC Bank, Axis Bank, ICICI Bank, all of them leading the Nifty higher today. The HDFC Bank ending 3% higher, Axis Bank ending 4% higher, and ICICI Bank too contributing to the gains in today's trading session. Now, what is the segment? There's a flurry of business updates that came in and there were reactions to that. Trent was the top gainer on the Nifty today, 8% higher on the stock as a beaten down name doing well today. L&T Finance, Senco, NMDC, IEX, all of them reacting to business updates. Senco, in fact, among the top gainers in the broader markets today, 12% higher on the stock. And in reaction to Senco's update, all of the other jewelry stocks also did well. Look at Titan, look at Kalyan Jewelers, both of them gaining anywhere between 4 to 7%. And PN Gadgil too having a good day of its own, recovering from the lows of the day. In a market like this, it has started to rebound again from the lows. There were stocks that hit a 52-week high in today's trading session. Granules India was one such name, ending 5% higher. RPSG Ventures continues its move higher, now 10% in today's session as well. CCL Products and Prime Focus too hitting 52-week highs in today's session. Of course, there were names that did not do well in today's trade. Chennai Petro was one of them, and a 5% knocked off today. Hariom Pipes had a poor day, 10% down. IRB Infra, after turning X bonus last week, extending losses from last Thursday, another 5% shaved off today. And Latent View too, seeing some profit booking after a 20% up move last Thursday. Back to you guys.
Okay, Hormaz, thank you so much for the list of stocks moving around in the trading session today. But on that note, let's move on and talk about some of these specific names, right? Banks, NBFCs, they delivered an operationally strong performance in Q4 FY26, according to the updates that we've seen coming in. However, credit and funding picture raises some bit of a concern over margin sustenance. Let's go across to Ritu, who's here with the report card for the same as well. Ritu, over to you.
Well, banks and NBFCs closing out the fourth quarter with a fairly strong operating print, but the divergence between growth and funding is getting more visible. Now, starting with banks, the loan growth clearly was the highlight this quarter. Across the system, advances growth came in at a strong 7 to 27% year-on-year and 2 to 11% sequentially. Most of the banks beat estimates like HDFC Bank, RBL Bank, Ujjivan, Bank of Baroda, EU Small Finance Bank, Yes Bank, they all stood out. But on the flip side, IndusInd Bank saw degrowth both year-on-year and sequentially, while Karur Vysya Bank lagged expectations. Now, deposits, that's where the picture was a bit more mixed. Deposit growth ranged between 1 to 16% sequentially and up to 25% year-on-year. RBL Bank, again, Bank of Baroda, EU Small Finance Bank, HDFC, Yes, Union, Kotak, they all saw strong traction, but IDFC First Bank, Karur Vysya, Equitas, Punjab National underperformed. So what you're seeing is loan growth continuing to outpace deposits, and that is reflecting in the LDR or the credit deposit ratio as well. The CD ratio has inched up sharply, up about 11 percentage points year-on-year overall. The system-wide LDR is also now at an all-time high of around 83%. That tells you funding tightness is building in the system. IDFC First Bank reporting one of the highest LDRs at more than 102%, but HDFC Bank, Yes Bank, RBL Bank saw their CD ratio decline quarter on quarter. CASA trends were also supportive. Seasonally, growth came in at 4 to 26% quarter on quarter. Most banks also saw an improvement. Kotak, RBL, Yes Bank, HDFC Bank all reported healthy CASA ratio expansion on a quarter-on-quarter basis, though structurally, these ratios are under pressure for some lenders. The likes of IDFC, AU, CSB, they saw a contraction in the quarter. Let's also look at NBFCs now, where the fourth quarter growth was steady overall, largely in line with street expectations, supported by seasonal strength. Bajaj Finance reported an AUM growth of more than 22% year-on-year, but their deposit growth saw a decline both year-on-year and sequentially, which has worried the street. L&T Finance saw retail loans grow more than 25%. M&M Finance saw asset quality improving, stage 2 assets coming down, collection efficiency improving, while disbursements and assets under management grew by 10 to 11% year-on-year. In the housing space, Aavas Finance reported a strong disbursement trend, improvement asset quality, and higher repayment rates. So overall, good show across both banks and NBFCs, but the pressure is clearly shifting towards funding, margins, and liquidity.
Well, thank you so much for that, Ritu. And clearly, with the flurry of updates that did come in, the Bank Nifty taking a cue from the strong advances growth ended higher by over 2%. Well, to take the discussion forward and especially to discuss the banking pack, we are joined by Ambrish Baliga, who's an independent market expert, and Shrikant Chauhan from Kotak Securities. Thank you so much, gentlemen, for joining us. Well, Shrikant, let me come across to you first. Well, the Nifty ended higher by over 1% after a gap-down opening, and the Bank Nifty higher by 2%. Nifty, aided by the strong performance in the BFSI space, did quite well. Do you now feel a bottom is in place, especially for both the Nifty as well as the Bank Nifty? What can lead the market higher from here on?
Yeah, good afternoon, Vivek, Vinny, and everyone. So if we go through with the overall performance of the market in last 2 days, then one thing is very clear that the market had stopped falling, and the pace of the fall has reduced substantially. The intensity of fall has reduced substantially, and it is crossing all its important level with the broader participation. So today's breath, or if we consider the breath of Thursday, then it was much better than the expectations. And whenever we see such type of formation, we can see further more upside in the market. Today, the market has also managed to surpass the level of 10 days exponential moving average, which is positive. So based on overall technical picture of the market, I am of the view that we can see some more pullback in the near term, maybe 23,200, 23,500 on the higher side. But to consider this as a bottom, we need some more consolidation. We need either double bottom or higher bottom sort of formation. Then only we can say that the market is out of worries. But for the time being, we can expect some more pullback in the near term.
Okay, that's a view there coming in on Nifty Bank from Shrikant. Thanks for that. But Amrish, what's your thoughts coming in on the banking space as well? Private bank versus PSU banks. What's leading the charts for you right now?
In fact, we have seen an outperformance from the PSU pack in the last 12 to 15 months. Now, in fact, going ahead, I think the private sector banks should outperform. And it could be across, right from the larger ones like the Kotak or HDFC or Axis, and at the same time, the smaller ones. I mean, we already seen a major correction in IDFC First I think that's one stock which I think could outperform at least in the medium to long term.
Okay, that's a view there coming in. Let's move on and talk about some of these retailers today that were moving around the trading session. Actually, pretty high on the charts as well. Trent, Nykaa, Avenue, Supermart, Trent actually among the top Nifty 50 gainers as well. 7.9%, almost 8% gains that came in for Trent. Now, why? A good set of Q4 update that the company reported. 20% growth in terms of revenue for Q4 FY26. Best quarter for FY26 is what the company has reported. So Q1 was 19% growth. Q2, Q3 was 17% growth. And then Q4, 20% growth. Store additions are something that are supporting overall the growth for the company as well, whether Zudio store addition, West Side store addition. So that is something that overall supported the growth. For the year ended 31st March 2026, total stores came in at 1,286. So all in all, good numbers in terms of Q4 update that came in from Trent. Avenue Supermart, again, good numbers that came in from Avenue Supermart, healthy revenue growth, aggressive store addition and expansion plan is what they've seen as expansion is what they've seen, around a 19% revenue growth, what they reported on a year-on-year basis. And this has come in on the back of a strong base also that was there. Despite that strong base, reporting this good number is very good. Now, overall, something that could lead to a good growth seems like the growth momentum of the company has continued, more like improved. Some of the analysts even highlighted that maybe, because of the US-Iran war, there was some hoarding, which led to some bit of an uptick in terms of the demand over there as well, or volumes for the company as well. And they've added 58 stores in Q4 FY26, taking the total store count now to 500 for Avenue Supermart. Let's move on, talk about Nykaa. The fashion retailers, gross merchandise value growth for Q4 is above, it's in the late 20s range. The NSV growth is in the early 30s. The revenue growth for the company, net revenue growth that we talk about, is in the late 20s as well. So this is going to be the 14th quarter that the company is actually going to be seeing a revenue growth of more than 20%. Beauty segment, strong growth there. Fashion segment, a solid segment, still a very strong growth there as well, of around early 40s is what they are highlighting in terms of growth there. So all in all, Vivek, we've seen all these retailers actually managed to see a very good growth.
Well, absolutely right. And what a strong outperformance you saw across the sector. You've also been tracking Senco Gold, so jewelers too are doing quite well in this session. Right?
Senco Gold was glittering bright and shiny in the trading session as well. And no complaining there, 46% growth in terms of revenue that we saw coming in. SSSG growth of around 34% is what they reported as well in terms of SSSG growth. Apart from that, they highlighted lightweight jewelry that did well for them in Q4 FY26. And there was a lot of gifting because of Valentine's Day, Women's International Day, where lightweight jewelry was the trend that was picking up. And that's why they'll be focusing a bit more in terms of the lightweight jewelry as well. So Senco Gold, all in all, good update. FY27 outlook for that for them has also been strong. They've spoken about a 7.5 to 7.8% EBITDA range. Revenue growth in terms of value growth is what they're talking about, 20 to 25%. Store addition, they're looking at 20 to 25% store additions as well. So strong commentary, at least on outlook for FY27 is also positive.
Glittering bright as to end FY26. Well, Srikanth, if I could quickly come across to you, two stocks where I want your opinion. First one, of course, has to be Trent. The stock is corrected quite sharply from its recent peak. After a while, you're seeing a good quarterly update come by. Do you feel that particular stock has bottomed out? For the short covering, do you see? And also a quick view on Titan as far as jewelers are concerned.
Yeah, absolutely. I think the way the stock has fallen from the highs of 8,500 to almost 3,200, I think the stock has completed its corrective pattern. And now it is on the verge of moving towards its next important resistance level. So close to 4,400, 4,300 is not ruled out. And if it sustains over there, then we can say that the stock had started its pullback rally, which can pull the stock maybe towards the levels of 5,000, 5,500. So broadly, I am of the view that we should look for adding stocks like Trent as well as DMart to our positional portfolio. There we are expecting further more upside based on their technical formation. For Titan, there also the view is more or less similar, because whenever the stock has fallen to the levels of 4,000, we saw good amount of buying interest in the stock, and it recovered back to the levels of 4,200, 4,300. This time also, I am expecting the stock to move towards the levels of maybe 4,400, 4,500 in the near term. And again, any correction will be an opportunity to add some more.
Okay, Amrish, let me come across to you. Well, top line growth across the universe seems to be quite strong. Trent, DMAT, Stenco Gold. Will you look solely at the top line as far as Q4 is concerned, or will you also keep an eye on margins, especially given the kind of volatility you've seen across the raw material space, especially for FMCG names?
No, I think for the FMCG names, at least the volumes are better. That's what we know as of now. But I think margins would also be important. But I think the markets are reacting to the volume announcements which have come from the management of various companies. So I think from a short-term angle, yes, I think we could see a decent upside. But when we see the numbers actually coming, I think margins would matter. And more importantly, I think people would like to see as to what will happen in April to June quarter, because this is the one where I think it will be most affected because of the war situation in Iran. So I think one should be a bit cautious at this point of time. Maybe play this up move. It's a momentum play. But then buying for long term, I think one needs to see as to what happens in April, May, and June.
Absolutely agree with you, Amrish. Played the momentum, but keep an eye as far as the margins are concerned. Well, one particular stock that did quite well was the Indian Energy Exchange, and this was after the company went ahead and updated the exchanges as far as Q4, March, as well as FY26 volumes and operational update was concerned. Highest ever volumes as far as FY26 was concerned. Quarterly traded electricity volume went up 24%. That explained the up move that you saw in the stock price. Although the DAM up move in volumes was slightly low. When we say DAM, it's the day-ahead market. The other segments like the right-to-match market and the renewable energy certificate segment did very well. March 2026, you saw an uptick of almost 23.5% in volumes. The market clearing price in the day-ahead market fell almost 6% on a year-on-year basis. This trend continues given the fact that sell-side liquidity is quite high and demand, at least in the last couple of months, has been quite subdued compared to its historical average. Despite that, short-term volume trends are quite strong, Winnie.
Absolutely, Vivek. Point taken there for IEX, surely in focus in the trading session as well. Srikanth, what are the charts indicating for IEX? While obviously we wait out for market coupling data points coming out, that's something that always keeps moving the stock too much. But till then, IEX on the charts, any indication there?
I think, the chart is showing a lot of sluggishness. Whenever there is a rebound in the stock, we are seeing good amount of profit taking or liquidation of long positions. This time also, when the stock was around 150 levels, we saw good amount of distribution, and eventually the stock has broken its important level at 132, 133. So maybe from here, if there is any pullback, then we can again revisit the levels of 132, 133. But ideal strategy should be to look for reducing long positions from this particular stock. I think there are a few other stocks like maybe Torrent Power, or I can say NTPC, Adani Power. They can do really well in the near future. So at these levels, it is better if there is any pullback, look for reducing positions.
Well, thank you so much for that, Srikanth. Amrish, let me quickly come across to you for a view as far as IEX is concerned. And within the past space, last year has been quite subdued in terms of demand. Would you look to buy some of these stocks on the weakness that they've seen?
In fact, I would surely look to buy the power companies like NTPC or Tata Power, because there I see a decent upside if you're talking of the next 1.5 to 2 years. But something like a IEX, like what Srikanth also mentioned, that for the stock to go beyond 140, 150, I think it will be very difficult because the coupling issue will again come up. So right now it will move up because of the highest volumes we have seen. But the coupling issue, I think, will sooner or later come up and create pressure for the stock. So it's a trading bet up to 141.
Okay. Trading bet up to 141. That's a word coming in on IEX from Amrish as well. But Amrish, as well as Srikanth, thank you so much for joining us on the show, as always, giving us your insights in terms of markets and individual stock names. But on that note, we're going to step into a very short break. After the break, we'll get you the top market voices along with the key market events to watch out for in tomorrow's trading session. Stay tuned then.
Welcome back to Market Forward. Well, earlier today, we spoke to Bank of America Securities India head, and he told CNBC TV18 that India may continue to underperform compared to its emerging market peers. Meanwhile, Motilal Oswal cut its margin estimate for banks by a couple of percentage points. Let's listen in.
We believe that India will continue to underperform the emerging markets this year. Street is at 15, we are at 8.5. On our numbers, Nifty is already at long-term average. So we are on the higher end of the band during the crisis period valuations. And if these valuations sustain, we do think that there is a 15% upside to the markets from current levels. But in the bear case, if the valuations do go to the lower end of the band, which is -1 standard deviation, then we could potentially see a 8% downside. So even if we work with a -8 plus 15, we think that the risk reward is now favorable.
Into the preview, we have just cut numbers by around 2% for PSU banks and marginally 1% for private banks. And that is a reflection on how the bond yields have gone up, how the deposit rates have not been able to come down to the extent that one was looking at 3 months back. And now the wholesale deposit rate, the CD rates, they've all gone up quite considerably. So far, for this year, we are looking at a 13.5 to maybe range around 14% kind of credit growth for this year. And our estimate is that the growth will sustain at 14% CAGR over the next 2 years.
Okay, and before we wrap up this edition of Markets Forward, let's get you the key events to watch out for in tomorrow's trading session. For that, we have Upasana standing by with us for that list of the events. Upasana, over to you.
Well, certainly. First up, let me start with the global economic cues. Mind you, the services PMI data will be out for Europe and UK tomorrow afternoon, so we'll be closely keeping a track on. And now the most important, that is the West Asia war updates. Any signs of ceasefire, we'll be looking out for that as well. And most importantly, Trump has given the deadline for Iran to open the Strait of Hormuz tomorrow, that is 8 p.m. ET, which is early morning for us on Wednesday, that is 5:30 a.m. So certainly one of the key important events that we'll be tracking, and any updates out there. Also, Fed's president, that is Austin Goolsbee, will be speaking tomorrow to address any inflation and economic outlook. Also, in terms of global earnings, Samsung Electronics will be giving its Q1 pre-earnings guidance this week, and analysts say that tomorrow is the most likely the guidance day to be given. So we'll be keeping a track on that as well. Now, coming to the domestic cues, RBI MPC meet tomorrow marks as the day 2, and the final outcome will be out on Wednesday, that is 8th of April. And lastly, in terms of important board meetings, Sammaan Capital board meeting is going to be held tomorrow to consider and approve buyback of shares. So on and all, these are the counters that we'll be tracking on, and certainly seems like quite an eventful day tomorrow.
Well, thank you so much, Upasana, for joining us and giving us all of the key and important events to keep an eye out for in tomorrow's trading session. But with that, it's time to call a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The US and Iran receive a framework for a potential ceasefire. Reuters reports the plan involves an immediate ceasefire followed by a comprehensive agreement in 15 to 20 days. This comes after Iran warning devastating retaliation to President Trump's expletive-laden threat to reopen the Strait of Hormuz by Tuesday. President Trump set to address the media at 10:30 p.m. India time tonight. 34 people killed across Iran in fresh airstrikes by the US and Israeli military. Iran strikes a residential building in Israel's Haifa, killing 2 people. Iran also targets power, oil and water desalination plants in Kuwait and Bahrain as the war enters day 38. Crude oil prices remain volatile after President Trump warns that Iran should open the Strait of Hormuz or face hell. Saudi Arabia raises the price of its main oil grade to Asia to a record high as exports remain throttled. Ship tracking websites show 2 LPG tankers heading towards India. The Sensex and the Nifty recover sharply in late trade. The Nifty moves closer to 23,000. The Sensex gains nearly 800 points. Broader markets outperform the blue chips today on the hope of a potential deal between Iran and the US. Wipro seals a $1 billion 8-year contract with Singapore's food and agri major Olam Group. The deal includes Wipro acquiring Olam Group's IT services business for $375 million. President Trump imposes 100% tariffs on branded drugs and ingredients. Indian Pharma heaves a sigh of relief as generic drugs are spared from tariffs, but companies like Sun Pharma and Divi's labs with exposure to innovative medicines and global supply chains will be impacted. The Supreme Court refuses to accept a plea by Vedanta to impose a stay on implementing Adani's resolution plan for bankrupt JP Associates, but the top court adds a caveat saying any major decision by the monitoring committee will need the appellate tribunal's approval. The Supreme Court orders a CBI investigation into allegations of corruption against Arunachal Pradesh Chief Minister and BJP leader Pema Khandu. Petitioners allege the Chief Minister's family was awarded public contracts worth nearly 1,300 crore rupees for over 10 years in direct conflict of interest. The Delhi High Court orders the immediate restoration of the parody account called Dr. Nimmo Yadav on social media platform X. The tweets flagged by the government will remain withheld temporarily. Multiple banks cut rewards and perks for credit cards. Benefits lost include cashback, airport lounge access and reward points, among others. Well, let's start with the day's market action. The Sensex and the Nifty recovered sharply in late trade, ending near the high point of the day. And this was the 3rd straight day of gains. The Nifty is now close to the 23,000 mark. The broader markets outperformed today, 1% higher on both the Nifty and the Sensex. But what really happened today that led to this recovery was the report that came in from Reuters suggesting that Pakistan had sent a proposal to both Iran and the US, and there could be a possibility of a 2-tier framework, an immediate ceasefire and then a potential deal. That led to the markets recovering. But remember, we've seen this story play out many times over the last 38 days. Is this for real is the big question. Prashant Nair standing by now to take us through the market action. Prashant, that's the big question. Is this deal talk for real?
Well, today was 2 halves. It was just that the second half was longer than the first half. I mean, the first half was dull, it was down, it was out. And the second half, of course, was exactly the opposite of it. I mean, the dividing point between the first half and the second half were headlines attributed to Reuters, all sourced, of course, saying that there is a peace proposal which has been received by both US and Iran. And there is, a proposal for a ceasefire and then some sort of a negotiated settlement not far into the future. Of course, I mean, the same report also, again, sourced, said that Iran is not going to open the Strait of Hormuz based on a temporary ceasefire. It wants permanent end to hostilities and there are conditions involved, etc., etc., etc. But markets, as has been the case now for the last few days at least, wanting to believe that despite all the rhetoric, and we had enough and more rhetoric as we came into this week with threats and deadlines from President Trump, but the market wanting to believe that it is just that talk, and both sides have taken a fair bit of damage, and both sides want to work something out. And I think that is essentially the kind of trade that we really saw today. I think unless things get visibly worse, it'll be just on the basis of talk that we're going to do this, we're going to do that, we're going to escalate it majorly. Unless you see that on the ground, visible deterioration in a big way, perhaps things are going to look a little bit more constructive at the margin. We'll see. But on your screen, Nifty Bank, both up about 1.5%. And of course, from the lows, the Nifty staged a very, very smart recovery. Mid-cap and small-cap indices, 2% apiece here. If you look at the large-cap gainers, Trent, Shriram Finance, Axis Bank, Titan, Adani Enterprises, SBI Life. Remember, it's also earnings season. So we're getting a lot of quarterly updates from names like Axis, Trent, etc. And I think that's the reason why these names did quite well. On the downside, and that's a remarkable thing, today's sort of gains came with no help from RIL, which is a clear heavyweight. Reliance was down, not at the day's low by the end of it, but was meaningfully lower. ONGC and Max Healthcare were some of the other losers.
Well, Prashant, many thanks for joining us. And as we've been pointing out, it is day 38 of the war in West Asia. The airstrikes continue even amidst reports of a potential ceasefire. Now, let's talk about that. Reuters reports that Iran and the US have received a framework for a potential ceasefire. The plan reportedly involves an immediate ceasefire followed by a comprehensive agreement in 15 to 20 days. Iranian officials have said that they have received the Pakistan proposal. However, Tehran maintains that the Strait of Hormuz will not be reopened in exchange for a temporary ceasefire. The reports follow President Trump's expletive-laden threat to reopen the Strait of Hormuz by Tuesday. Now, remember, Trump threatened to attack civilian infrastructure, including bridges and power plants, if the strait remains closed after the expiration of his 10-day deadline. Iran mocked this ultimatum, dismissing it as, and I quote, helpless, nervous and stupid, end of quote. Iranian officials, including the foreign minister, Sayed Abbas Araghchi, have maintained any attack on civilian infrastructure will be met with devastating retaliation. Araghchi also spoke with External Affairs Minister S. Jaishankar about the situation in West Asia. The call happened yesterday. Trump told Fox News that he believed a deal could be reached before the deadline as Iran was negotiating with the U.S. However, he continued to threaten escalation, saying he's considering, and I quote, blowing everything up and taking over the oil if there's no deal, end of quote. Now, President Trump is expected to address the media at 10:30 p.m. India time tonight. Meanwhile, the U.S. has said that it has rescued the second airman caught behind enemy lines after its F-15 fighter jet was shot down. With this, both missing crew members have been rescued after a 2-day search plan in the border region. Meanwhile, sirens continue to sound across West Asia as explosions rock the Gulf and Israel. The UAE has said it is dealing with an Iranian drone attack on one of the country's two main telecom operators. Saudi Arabia also said the 2 drones were intercepted and destroyed. Several residential buildings and cars in Israel's Haifa were also damaged as 10 sites across northern Israel were targeted. Tel Aviv also ramped up its strikes on Iran and Lebanon. Airstrikes severely damaged the industrial zone of Iran, along with Tehran's Sharif University. The overnight attacks have killed nearly 34 people. In Lebanon, civilians continue to be caught in the conflict as Israel continues to bomb towns in the southern part of the country. At least 1,500 people have been killed so far in what Tel Aviv has called targeted strikes on Hezbollah infrastructure. The U.S. and Israeli forces also continue to target Iranian officials. In a press conference overnight, Israeli Defense Minister announced the death of Majid Kadami, who was the head of Iran's Islamic Revolutionary Guard Corps. The Iranian state media also confirmed the killing and called the death a terrorist act. Iranian officials have also vowed retaliation to attacks on Iran's civilian infrastructure.
Iran's reaction would be one of reciprocating any such attack. Our armed forces have made it clear that in case Iran's infrastructure is attacked, we would react in kind. Our armed forces would target any similar infrastructure that is owned or in any way or manner related to the United States, or contributes to their act of aggression against Iran.
And all of that impacting the stock markets, but crude oil prices remain volatile even after President Trump's Tuesday deadline to Iran on opening the Strait of Hormuz. Attacks on energy infrastructure continue across the region, Iran targeting oil and power plants in Kuwait and Bahrain. No casualties have been reported in both these attacks. Now, the explosions have caused a fire at an oil storage facility in Bahrain, which was later brought under control. Ship tracking websites show 2 LPG tankers heading towards India. Iran's ambassador to India said the country has adopted special measures to ensure the safe passage of ships from friendly countries, including India. With oil supply from the Gulf facing severe disruption, India is attempting to diversify its energy sources. But the issue is not just about finding oil, but finding the right kind of oil. Sonal joins us now to explain why this is important. Sonal.
Thank you so much for that. Now, about 45% of India's oil imports have been disrupted due to the ongoing Gulf conflict. Refiners are now looking for alternative sources to replace this supply. But the real issue is not just finding more oil, it is finding the right kind of oil. Not all crude oil is the same. Different types of crude produce different fuels when refined. Some produce more petrol, while others produce more diesel. India's fuel demand is heavily dependent on diesel. Diesel makes up to around 40% of the total fuel consumption in the country. Indian refineries are designed to produce a high share of diesel. This is why crude from the Gulf has been so important. Supplies from Saudi Arabia, the UAE and Iran are well suited for India because they produce higher diesel yields and match refinery configurations as well. Now consider the alternatives. Crude from the United States is mostly lighter. It produces more petrol and less diesel, which does not really suit India's demand pattern. African crude also has limitations. It is either too light, which again leads to higher petrol output, or it has too much sulfur content, making it less efficient to process. Russian crude comes closest to what India needs. Grades like Urals have similar characteristics to Gulf crude and are better suited for producing diesel. The key risk is this. Even if India is able to replace the lost crude volumes, it may still not be able to produce enough diesel. So the challenge is not just about supply, it is about a mismatch in crude quality, which could create pressure on diesel availability in the coming months.
Yes, those are all issues to consider. Sonal, many thanks for joining us. Now, India's services output has fallen to a 14-month low in March, according to HSBC India Services and S&P Global. Now, the Purchasing Managers Index fell to 57.5, down from 58.1 in February. The March reading was the lowest since January of 2025, and this was largely due to slowdown in sales and a pickup in input price inflation amidst tensions in West Asia. We've seen input cost inflation go up significantly. Now, Yes Bank has said that Binay Muralidhar Tonse has taken charge as the private lender's managing director and CEO today. This comes after Prashant Kumar stepped down from that role after completing his tenure yesterday. Tonse had previously served as the managing director for retail business and operations at State Bank of India. Now, shares of Wipro up over 3% in early trade. This after the IT giant signed an 8-year deal with Singapore-based food processing major Olam Group. This transaction is expected to exceed $1 billion in total contract value. Rima joins us now with more on the significance of this deal for Wipro. Rima.
Thanks so much for that. Let's get the news first. Now, Wipro has secured a multi-year strategic deal with Olam for $1 billion. That is the estimated potential of the deal. $1 billion in terms of revenues for Wipro. The guaranteed revenues are $800 million plus, spread over 8 years. As a part of this deal, Wipro will also be acquiring Olam's captive IT unit, which is called Mindsprint, and they will be paying $375 million for this. And this acquired company, Mindsprint, the IT business of Olam, had revenues of $135 million as of last year. But basically, what the takeaway is that at a time when organic growth, the growth for IT companies is weak, Wipro perhaps is using the M&A route to bolster the top line and get the revenues. The street is reacting positively right now because it's $1 billion of revenues over the next 8 years, at least minimum of $800 million. That is a positive. Olam is also strong in the food and agri supply chain, so they get a large client. So there is assured revenue, there is stickiness of revenues, which is what the street likes. But the negative, the potential negative of such a transaction is that it signals that growth is on the weaker side, which is why you need to use M&A to boost the growth. And plus, we don't know the kind of margins. Typically, when you take on a captive center, you will take the employees on board, and therefore the margins could be on the lower side. But for now, the IT sector itself is doing well, and Wipro has got $1 billion of a deal.
All right, Rima, many thanks for joining us. An online beauty and fashion platform major Nykaa reportedly in talks to acquire majority stake in Deepika Padukone's skincare brand 82 East. According to reports, this acquisition will be part of Nykaa's expansion plans with an aim to bolster its House of Nykaa portfolio. The report further says the proposed deal is under discussion. The move also aims to revive the brand, which has struggled to meet growth expectations. So perhaps a deal in the making. Venu Srinivasan, the chairman emeritus of TVS Motor, has resigned from the Bhai Hirabai Charitable Trust Sources say that he stepped down following objections over trustee eligibility. Srinivasan, who was brought on board by the late Ratan Tata, had been appointed after legal consultations were sought regarding the induction of R. Krishna Kumar. Sources indicate that Srinivasan stepped down after Meli Mistry raised concerns that trustees must be of the Parsi Zoroastrian faith and have permanent residence in Mumbai. Just for context, the Bhai Hirabai Charitable Trust is one of the smaller trusts under the umbrella of Tata Trusts, and the points raised by Meli Mistry apparently are part of the trust's clauses for eligibility of membership. We will head into a break, but up next, multiple banks cut rewards and perks for credit cards. That and more when we return. Now, the Supreme Court has ordered the CBI to conduct a preliminary inquiry into the allotment of contracts to the family members of Arunachal Pradesh's Chief Minister and BJP leader Pema Khandu. Petitioners allege that the CM's family was awarded public contracts worth 1,300 crore rupees over 10 years in direct conflict of interest. The Apex Court has directed the CBI to submit a report in 16 weeks. The Supreme Court has refused to accept a petition by Vedanta to impose a stay on implementing Adani's resolution plan for bankrupt JP Associates. However, the top court added a caveat saying any major decision by the monitoring committee will need the appellate tribunal's approval. Vedanta argues that its bid for JP Associates was higher than Adani's, but the committee of creditors approved Adani's bid as the company offered a higher payment upfront. And staying with courts, the Delhi High Court has ordered the immediate restoration of the parody account called Dr. Nimmo Yadav on social media platform X. Now, the tweets flagged by the government will remain withheld temporarily. Ashmit joins us now with more. Ashmit, take us through what the Delhi High Court has said and why this could be an important precedent in matters linked to other takedown orders.
Well, the Delhi High Court staying the direction passed by the government for blocking the account of one Pratik Sharma, who also goes on the social media platform X as Dr. Nimmo Yadav. Now, bear in mind that the government had passed for a takedown order against him for posts that he had made against the Prime Minister. The government had called it a false narrative, saying that this is portraying the Prime Minister of the country in bad light, and therefore had passed orders for taking down his order under Section 69. Now, Section 69 of the IT Act provides for takedown powers in case of national security. Now, this commentator, Pratik Sharma, had moved the Delhi High Court, and he was, in fact, seconded. He was supported by the platform X itself. X had also submitted that, look, these posts that have been flagged have got nothing to do with national security, and that appears to have weighed on the mind of the Delhi High Court. The High Court has said that for now, the account needs to be reinstated forthwith. That's number one. What the High Court has also said is that no hearing had been granted, and therefore principles of natural justice must be maintained. Pratik Sharma must be granted a hearing by the review committee. The only caveat that the Delhi High Court has drawn is that while the account needs to be reinstated, the posts, the objectionable posts, may continue to remain taken down. But this is, of course, an interim order. The High Court has said that the hearing, this case will continue before the High Court.
All right, Ashmit, many thanks for joining us. Now, the shortage of cooking gas is forcing many migrant labour to leave cities and head back to their villages. Delhi and Mumbai have seen a flood of migrant workers returning home. Rachna met with several migrant workers at Mumbai's railway stations to find out more.
ICICI has restructured. This is
migrants क्या होता है यार? Migrant workers
railway stations in the city of Mumbai. But what you're seeing behind me is not the usual scene. People are not coming into the city to look for jobs, but are actually heading back home. These are migrant workers who came into the city and worked as daily wage laborers on construction sites, painters, tailors in multiple sectors, but are now heading home as they can't afford to eat here anymore. These are migrant workers who didn't have registered addresses in the city, and they relied heavily on grey market for LPG cylinders. But now, as the prices have gone up given the LPG crisis, what costed them 1,300 rupees to get one cylinder is now up to almost 5,000 rupees, and so the economics is not making sense to them. Apart from that, they also relied heavily on informal food vendors, the food carts. But even for the food carts, to get the LPG cylinder for their carts, the prices have gone up 3 times. And so that price hike has been straight passed on to their plates, and so they think it is best to go back home.
अभी होटल से कितना दिन खाएंगे, इसके लिए जाना पड़ रहा है।
तो आपने कोशिश कहाँ किया गैस लेने का?
कोशिश तो बहुत की है मैम, लेकिन मिला नहीं किधर भी। तो जो बोलते थे 4,000 5,000, वो भी नहीं मिल रहा है। लॉकडाउन में भी ऐसे ही हुआ था।
तो अभी गांव जाके फिर वहाँ पे कमाई का क्या साधन होगा?
गांव तो चाय से खा के गुजार लेंगे, लेकिन यहाँ पर तो बिना पैसे के कोई खाना नहीं दिखलाएगा।
मैं लेडीज जीन्स का कटिंग करता हूँ, तो काम चल नहीं रहा था। वॉशिंग में गैस के लिए, वॉशिंग जो होता है कलर, उसमें गैस का लगता है, तो गैस आ नहीं रहा था, इसीलिए कारखाना बंद हो गया। तो अब जा रहे हैं गाँव।
जब तक पैसा था तब तक खाया, इसके बाद पैसा खत्म हो गया, गांव जा रहा हूँ।
मैं भी जा रहा हूँ बिहार, क्या करेंगे, यहाँ रहने का व्यवस्था भी ख़राब हो चुका, राशन पानी की दिक्कत हो रही है, पेमेंट नहीं दे रहा, सेठ बोल रहा कि पैसे नहीं मेरे पास।
मैं इसके लिए जा रहा हूँ क्योंकि गैस खत्म हो चुका है, इसके लिए मैं घर जा रहा हूँ।
तो आप ब्लैक में खरीदते थे?
ब्लैक में खरीद रहे थे, वहाँ से मिल नहीं रहा।
अभी क्या दाम चल रहा है?
अभी उसको 3,000 चल रहा है।
3,000
वो भी पहले 1,300 चल रहा था, अभी वो भी मिल नहीं रहा है।
जो खाना 500 का था डायरेक्ट 1,000 रुपये मांग रहा है। जो पूरी भाजी 25 रुपये की थी तो वो 30 रुपये मांग रहा है, मनमानी रेट मांग रहा है। इसके लिए हम लोग को जाना जरूरी है। एडजस्ट करेंगे, कर्जा वर्जा लेके लोन वोन लेकर के जो अपना खाएंगे फिर आएंगे तो कमा करके भरपाई करेंगे।
लेकिन इस टाइम पे तो वैसे भी घर जाते हैं ना, दोपहर गर्मी की छुट्टी के टाइम।
गर्मी के टाइम में जाते, मगर अभी हम लोग को नहीं जाना था, गैस की वजह से जाना है।
अभी जो चालू है ना ये ट्रेन, इसमें बहुत गर्दी रहता था पहले, अभी तो बहुत सही हुआ है, नहीं तो बैठने का जगह नहीं रहता था, बाथरूम में लोग बैठते थे जाके।
We are not seeing any exceptional crowd movement. We are not seeing any exceptional passenger footfalls. The ticket sale trends are also, in line with the normal gradual, shift that we see every year on year.
The data which is available with us does not show any kind of spike or any kind of sustainable increase. towards the previously available data or previously movement.
The government has urged households to move to induction cooking as the LPG shortage deepens, but that advisory to this workforce means very little. Also, this is the same blue-collar workforce that lived through the COVID-19 exodus, and the lesson that they drew from then was to get out before the situation gets worse, and that's exactly what they're doing. What we gathered from the station authorities today is that this exodus started weeks ago and is now in fact at its tail end. But even the tail end is quite substantial. In Mumbai, I'm Rakshana Thanajani.
Now, multiple banks have cut rewards and perks for credit cards. Benefits lost include cashback, airport lounge access and reward points, among others. Rachna has the details.
Well, 2026 has been the worst year on record for credit card holders in India. Banks are systematically dismantling the very benefits that made these cards worth holding. And in several cases, they're doing it overnight or even with zero notice. The latest blow came from Axis Bank, which removed 3 of its most valued miles transfer partners on April 2nd. These were Accor, Marriott Bonvoy and Qatar Airways. This was with no advance communication to card holders. Now, Accor alone was valued at 2.2 rupee per point. Now it's gone. 3 weaker partners have been added in their place, but with weaker transfer ratios. Then there's Airtel Access Card. 25% cashback on all Airtel bills. One of the simplest, most popular benefits in India's card market is now linked to how much you spend in other categories. So use it only for your phone bill and you could earn nothing on these. And lounge access has been removed entirely. Then there's Swiggy and Big Basket cashback, which is also gone. Zomato converted from bank cashback to wallet credit cards. Then there's IndusInd Bank, which has introduced lounge spend requirements for the first time, asking up to 5 lakh rupees per quarter. The SBI cashback card, which was one of the most widely used cards in the country, now caps monthly cashback at 4,000 rupees with a separate 2,000 rupee ceiling on online spends alone. Government transactions are excluded entirely, and this is effective April 1st. Then earlier this year, American Express halved the value of its platinum travel card, moving the Taj voucher milestone, which was the most attractive bit about this card. The milestone from 4 lakh rupees has been pushed to 7 lakh rupees in annual spend. The reward rate has dropped from 8% to 4% for mid-range spenders. Scapia Federal Bank, which is newest of the lot, has doubled its lounge access spend threshold from 10,000 to 20,000 rupees and has removed rewards on insurance and utility payments. Then there's HDFC that capped Infinia redemptions at 5 times per month and introduced a survival threshold. Spend 18 lakh rupees annually or park 1 crore rupees with the bank or risk losing the card. The fee waiver only requires 10 lakh rupees. Now, Infinia specifically had also introduced a cut in its smart buy programs, only to be reversed after the public outcry that we saw. ICICI has also restructured its entire portfolio in just one sweep, tying Book My Show benefits to a 25,000 rupee quarterly spend requirement, introducing reward exclusions. Apart from that, they've also added a 3,500 rupee fee on add-on cards, a 2% charge on gaming platforms and a 1% fee on wallet loads above 5,000 rupees. Overall, the message from all these banks is quite consistent. The era of picking one card for one high-value benefit is now over.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We've got plenty more lined up for you after this short break.
Welcome back. 1 Lakh 50,000 crore. 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 1 lakh Welcome. Under the most tumultuous of times, the Reserve Bank's Monetary Policy Committee meets to announce their decision on interest rates on April 8th. As always, the CNBC TV 18 Citizens Monetary Policy Committee meets to discuss the issues that lie before the Reserve Bank. And I have with me our MPC members, Soumyakanti Ghosh of SBI, Sajid Chinoy of JP Morgan, Samiran Chakrabarti of Citi, Sonal Verma of Nomura, and Dr. Pranab Sen, former chief statistician, our committee's chairman. Gentlemen and Sonal, good morning and thank you very much for your time. Very, very crucial, confusing times. Sonal, for starters, right now the 10-year is showing 7.06 and the OIS is showing a rate hike very soon, the forward rates, the swap rates. What should the Reserve Bank communicate on April 8? Should they communicate hawkishness?
Yeah, Lata, I think markets are completely unanchored right now, given uncertainty in terms of the duration of the shock and what the economic impact will be. From the RBI's perspective, I think it's important to communicate how they see the current shock. From our perspective, we think this is a fairly significant supply side shock, the duration of which could be short term, but given some of the damage that has been done to energy infrastructure, there will be some long lasting effects. So we settle at a higher point relative to pre-war on many of the energy components. Second is, what is the optimal policy response to this shock? Now, this is not just a price shock, it's also a volume shock. What we need as actually the first line of defense is management on supply in terms of rationing and some demand conservation measures, and fiscal, which has stepped in. Now, from a monetary policy perspective, if it is a one-time shock, then monetary policy can look through that shock. But the communication in terms of being fairly alert and nimble in terms of second-round effects, whether it's a pickup in core inflation or a pickup in inflation expectations, I think being alert to any of those risks is quite important. And third, in terms of anchoring market, as I said, things are fairly unanchored right now. And what would be useful is guidance in terms of what are the goalposts that the Reserve Bank will be looking at to identify whether it needs to respond on the policy rate front or not. Okay. And linked to that is the stance on liquidity policy as well. We cannot necessarily have very accommodative liquidity stance when inflationary pressures are building up.
Okay, fair enough. I am going to ask a liquidity question, but exchange rate. Shamiran, do you think the RBI should bring in exchange rate, although it is very clearly said in the Urjit Patel and in the management, the Monetary Policy Act, that the goal is only inflation and exchange rate is an input, not a goal. But at the moment, should exchange rate be a very important conversation for the MPC? And should we even reach a point where exchange rate should be used to defend, interest rate should be used to defend the exchange rate?
So Lata, I think this is the time for the RBI needs to show calmness without being unrealistic. And that's where I guess it's important to make two observations. One is with respect to the growth inflation trade-off, where the RBI can show some calmness in saying that the inflation part of the problem is getting tackled more by the government measures. So RBI can still focus on growth. And second is that they can reiterate this dualism that they've shown in the past, that the interest rate policy is more to do with inflation management and the exchange rate policy has to be done through other sorts of administrative and FX intervention measures. This has only been maybe twice in the history of RBI where we have tried some amount of interest rate defense of the currency. And those have been really, really extreme times. I don't think we have reached a point where we should be considering interest rate defense of the currency, because let's face it, that interest rate defense of the currency cannot happen just by 25 basis point of rate hike. Then we have to think of a serious hike in rates for that sort of a defense. I don't think there is a need for us to jump into that sort of a conclusion right now. But that messaging is going to be very important in the April policy, that the markets are running away with this expectation that an interest rate defense could be around the corner. So just to get the markets re-anchored to this hypothesis that interest rates are more for inflation, exchange rate, RBI has enough tools to manage otherwise. I think that's going to be very important to make that point.
Okay, and I think they have made that point with this very strict steps that they have announced for the foreign exchange market, quite unconnected with interest rate. Now, Sonal touched on liquidity. Shami Gandhi Ghosh, the Reserve Bank has given plenty of liquidity in the one-day market, in the call market, and call rate has often been below the repo rate. Now, do you think that since goods are going to be in short supply, putting too much liquidity will mean inflation? So do they have to change their liquidity policy, start a VRRR? What should they communicate on liquidity?
Yeah, thank you, Lata. I think that's a very important point. Taking aside the fact that in the new inflation targeting regime, the interest rate defense is not the option, but on the liquidity front, I think the RBI has infused significant liquidity in the last year. I think it did OMO and the swap operation injected around 10 billion. But at the end of the day, I think given the current uncertainty in the market and given the fact that the war actually, which is supposed to be short-lived, has now already crossed 1 month, and no one knows what could be the duration of the war. And also the fact that after the war, what could be the impact of how long it takes back to come back to the normal. Given these extraordinary circumstances, I think the central bank can just try to modulate the liquidity a little bit without disturbing the market, because at the end of the day, I think it is also important that in a situation when the rupee has been, the exchange rate has been depreciating, there is a significant pressure on the interest rate. The central bank needs to, without conveying any explicit message, just an implicitly can modulate the liquidity to some extent, so that once the situation normalizes, it can again think of getting back into the situation whereby it continues to provide liquidity. For the time being, without saying, I think an implicit recognition of the fact that there could be a scope to modulate the liquidity a little bit in the current scenario.
Okay, fair enough. So they might indicate or should indicate some reduction of liquidity is what you're saying. Sajid Chenoy, what will you watch out for at all? Will you watch out for even their exchange rate signals? Will you watch out for whether they're more worried? Just help me. What should I watch out for in this speech?
I think the reason this is so complicated for central banks all around the world is this is a daily stagflationary shock. And what that means is that at the same time, growth gets impinged and inflation gets pressured. So the question for each central bank is, what do you focus on, supporting growth or curbing inflation? And I think this is where this shock is quite different from previous energy shocks in recent years. The 22 energy shocks after the Russia-Ukraine war basically operated through prices. Inflation went up and the playbook for central banks were quite clear. What's different this time in all of Asia, Lata, is that availability of energy is becoming a question mark across many countries, right? And if after President Trump's speech, if this were to continue for another month and the Strait of Hormuz remains closed, then this will become a more urgent problem where you actually get a problem of lack of availability no matter what the price. That in a way will become a little bit like a COVID-like situation for some countries, because what it does is a sudden stop in activity. Right? You have a sudden industrial stop because of rationing of gas or LPG or crude in many countries. This is not just India specific, it's across Asia, which is most vulnerable. Why does that matter? It matters because then you begin to get non-linear outcomes from this shock, as we saw in COVID. Once a small business shuts down, very hard often to reverse it. Once a gig worker goes back to their village, very hard often to get them back. So I think what policymakers in India and what policymakers in Asia be watching very quickly are there non-linearities creeping up on growth in the near term? If that is the case, given very benign starting points, headline inflation this year before the shock was expected to print below 4%. core inflation has been running below 3%. So you can then be patient on inflation. Already the government has absorbed the initial impact by cutting excise duties. So at least we will not be seeing retail prices on diesel and gasoline go up. So my sense is what the RBI will be watching is, where do I focus more on supporting growth? Is that the bigger risk at the moment? Or is inflation picking up a bigger risk? And I would argue that at this point, the focus should be more on supporting growth, which is why I don't think the RBI should be or will be necessarily hawkish to alarm markets and amplify the shock in financial markets. And I think in that, if you worry about growth, then it's perfectly consistent to even have liquidity where it is and be accommodative, because that is consistent with your growth supporters. So I think it's the non-linearities over the next month or two that most Asian economies will be and central banks will be very focused on.
And this is very, very different from what the market is telling us. You look at the OIS curve. It is clearly pricing in 2-3 hikes as you look at the curve, as is, of course, the 10-year at 7% plus 7.05 as we speak. Dr. Sen, you know, what our committee wants is more liquidity, more concentration on growth, which is what the Reserve Bank should exhibit. But the market is priced very differently. So you tell me, sir, what should the Reserve Bank communicate? Should it clearly communicate that I will look through this inflation? Or should it hint another rate hike?
The inflation is a purely supply-side cost push effect. And there's very little that the RBI can do about it without pushing demand. And this is not the time. At the moment, I think
I think we have you on a bad line, sir. We will try after the break whether to get you on a better line. But I hope we can hear your vote. The market really wants to know how interest rates will move. So let me get the vote first out and then perhaps get Dr. Sen on a better line. The first question to all of you is, what will Reserve Bank do the repo rate on April 8th? I think that question is fairly simple. Sonal Verma?
On hold.
No change. Samiran?
No change.
Shaumya?
No change.
Sajid?
Hold, no change.
Hold, okay. Dr. Sen, if you can hear us, what will they...
Yes, hold.
Okay, unanimous. Now, I don't know if the next question is going to be unanimous. Do you all see a rate hike before 2026 is out? Sonal?
Not as of now.
You don't see a rate hike as of now. Samiran?
Same, no change right now, assuming that it's a short-lived conflict.
Okay. As of now, that caveat is important. Shaumya?
No change as of now.
Okay. Sajid?
This winds down over the next month or so. No change as of now. That's the key.
Okay. Dr. Sen?
No change as of now.
All right. Okay, so clearly the committee is saying as of now, there is no need to indicate hawkishness, and as of now, they don't see a rate hike in 2026 as well. But there are questions more that I want to ask them about what will RBI do to their growth forecast? How much lower will they keep it? What will they do to their inflation forecast? Because these are all signs of communication. All those questions after the break. Welcome back to the deliberations of CNBC TV18 Citizens Monetary Policy Committee. I've been speaking with the members of our committee, Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakrabarti, Sonal Verma, and the chairman of our committee, Dr. Pranab Sen. Gentlemen and Sonal, clearly you all are voting that there should be no change in the April 8 policy or hereafter, but the growth inflation forecasts are a very, very big communication. What's your sense, Samiran? Do you think, let me get this question from Soumya first. Soumya, do you think that they will have to lower the growth forecast? What's your expectation?
Yeah, thank you, Lata. I think regarding the growth forecast, of course, the assumptions which the RBI is going, the government has made up 6.8 to 7.2%, possibly will be in the lower end of the band as of now. But regarding the central bank, I think they might not yet revise the growth forecast significantly downwards, but they will, of course, a little bit, the inflation forecast may be a little bit on the upside. So my sense is that the April policy could spell out clearly what has happened in the past few months. And regarding the growth inflation trade-off, my sense is that while the inflation numbers will go a little higher than what was the earlier projections, the growth numbers may still be retained at the current point because the central bank would like to see through this shock as a temporary shock and therefore might not change the forecast yet, so as to give a signal.
No, 1 minute. Their GDP forecast for Q1 is 6.9. You're saying they won't lower that?
I don't think as of now they will going to lower the forecast.
Okay. Well, the more important question is, I'm sure in the press conference we are going to ask more questions on the exchange rate. Samiran Chakrabarti, what may be the Reserve Bank's, do you first think that they have handled the rupee position correctly because the rupee was in a one-way journey? And if it keeps falling, it becomes an important input into inflation. So what do you expect from the Reserve Bank on the currency front? Will these steps suffice or are you going to see more of the same?
So, Lata, rupee is more a derivative of the BOP problem that we have. So, I don't think you can address the rupee problem in a more permanent way till you address the BOP problem. And there, the issue is that our starting point on growth and inflation before the war was the so-called Goldilocks situation. But unfortunately, on BOP, we are entering this phase with 2 consecutive years of BOP deficit. And now, with this kind of oil price assumptions, there is a likelihood that even the third year could also turn into a BOP deficit year unless we find ways of improving the flows, especially on the capital account side. So I think most of the policy intervention now needs to happen on the BOP front to get some control over the exchange rate. So that's one part of it. The other part of it is that it will be useful to lay out the framework of valuation for the currency. We have for a very long time followed that 40-country RAR as a guidepost for valuation, but we have been outside that long-term range for a very long period of time. So some communication around that would also help settle market expectations to some extent. And last but not the least, I think the way to think about it is that in our estimate of 5% depreciation, even in the new CPI series, is about 35-40 basis point of impact on headline inflation, assuming that there is no pass-through on petrol diesel prices. If there is pass-through on petrol diesel prices, it could be even higher. So there is some impact of this depreciation on the inflation side also, but the steps should be more towards getting the BOP improved rather than focusing too much on the administrative measures because they have shorter term impact.
Okay. Well, these questions will be asked of the governor, of course. And Sajid, that's why I'm asking you. Do you think that the steps that taken of, divorcing the NDF market from the onshore market can actually discourage flows? Because FPIs, maybe bond FPIs who come will be worried that they can't hedge. Can this be negative? Alternatively, do you think that the policy itself, we always have non-interest rate announcements also come in. Do you expect even capital controls? Because the BOP has to be managed.
I think it's a balancing act for most central banks around the world. And here's what I mean. And I agree largely with what Shamaran said, that on the one hand, if you have a BOP deficit, right, and if you think about the current account, it depends where crude settles. But if crude settles, at $90 or $100 in the coming months, you have a correlated shock on the current account because crude prices are higher, gas prices are higher, concerns about remittances from the Middle East slowing down, concerns about the global economy slowing down and therefore exports slowing down. So the current account, of a very benign level will widen. At the same time, you're seeing a flight to safety around the world, and that's going to impinge on capital flows. So BOP pressures, we are seeing around the world are widening in many emerging markets. Now, in that environment, you do want the rupee to be some sort of shock absorption. Right? The alternative here would have been to intervene very aggressively, and the problem with that is you want to conserve your buffers, for many years because we're living in this shock-prone world. So you do want the rupee to take some of the shock absorption. Now the problem with that is, sometimes market expectations become self-fulfilling, and we know currencies tend to overshoot. So central banks are right to say that if they believe there's an element of overshooting, then you can use regulatory measures to curb if the central bank believes there's excessive speculation, that's understandable. But I agree with Shamaran that in the medium term, right, the fundamental issue is the fact that we need to attract more capital flows to close this BOP gap. The longer the BOP gap remains, the greater the pressure on the rupee for shock absorption. And then you also want to trade off, near-term measures to curb speculation with kind of ensuring that perception of market and market development in the medium term is not compromised.
Somehow I fear or I feel there may be some BOP steps, some capital steps announced. It can't be ruled out. Every day is a new day these days. But Sonal, the other big communication the Reserve Bank will make is through its inflation forecast. Do you think that they will have to indicate that inflation is going to be higher, even higher than the 4% mark?
I think that's quite likely given the widespread energy price shock and the weaker currency. And even as the pump prices are unchanged, actually there are multiple channels through which price pressures are already building up. One, this is not just about oil, gas prices, coal prices, everything is up. Second, with urea prices starting to pick up, there is a risk that we see, an increase in food inflation, particularly if it does turn out to be an El Nino year. And third, the supply shocks are also filtering through to a number of downstream sectors in the manufacturing. So that in turn will mean increase in not just the energy cost for companies, but also a lot of raw material inputs that companies take. So supply delivery times, for instance, are getting extremely stretched. So the magnitude of the shock is actually so substantial that initially, while companies will take some margin hit, they will ultimately have to pass some of this to consumers just to stay afloat. And fourth is even in the services bucket, things like higher airfares or increase in commercial LPG prices are spill over into multiple services inflation categories. So it's clearly higher. I think the only judgment is, the duration and the magnitude of the pass-through. We think in this policy, RBI will raise its inflation forecast to around 4.5%. And I think risks are still probably skewed to the upside. At the same time, it is important to flag that we are starting off in a situation where the core inflation is quite low. So there is some buffer for the central bank to, assess the situation before it decides whether it needs to act or not.
Okay. We've got Dr. Sen, and I hope the line works now, sir. So therefore, two questions for you since we didn't get you the first time. One, do you see that we are in a stagflationary situation? And usually post such stagflation that you may have seen in your lives, do you think it will be a growth challenge and not an inflation challenge? And therefore, what should the Reserve Bank communicate? Should it say, I am looking through this now?
As far as the effect of the global developments are concerned, the real threat is to growth. The inflation is going to be a byproduct.
Okay.
And you cannot address the core problem by addressing byproducts. So the question really hinges around what RBI says about growth prospects.
Okay.
And following from that, what it thinks will happen, or perhaps not think it will happen, what should happen to inflation. In the kind of situation we are looking at, and Shomira is absolutely right on this, growth is under serious threat. And this is something that we have to be very careful about.
Okay.
Because if this drags on for just a little bit more, we are going to start getting into a shortage mentality.
Yeah.
And that just aggravates the problem.
Yes.
So we need to be thinking very seriously that if I'm going to have a situation where global demand is not going to support me, then I have to look at domestic demand. Now that causes a interest rate conundrum.
Yeah.
On one side, we have accelerating inflation. On the other hand, if you don't permit that to happen, your growth is going to get badly impacted. So my take on this is that it should be that we are in a situation where growth is under threat. Our principal objective would be to support the growth process.
Got it.
We will deal with inflation as and when the time is appropriate.
Fair point.
This is not the appropriate time.
Message should be. Thank you very much, Dr. Sen, for that very clear message. And I think that's more or less what your committee also seems to be saying, that they should give a pro-growth message, which hopefully will alter what the curve is now indicating, the OIS curve, which is actually pricing in a rate hike. Let's hope the RBI will address and influence that curve. But let me add a final caveat. Things are changing by the hour, if not by the day. We do hope that what our committee says and advises will remain valid till April 8th, when the policy itself is announced. Thank you very much, members of the Monetary Policy Committee.
Hello and welcome to our special broadcast on West Asia tensions. I'm Ashmit Kumar. Now, US President Donald Trump has issued a renewed ultimatum to Iran, asking them to reopen the Strait of Hormuz or face strikes on power plants and bridges. Meanwhile, reports say that Iran, unwilling to engage in direct talks with the US, has formulated a response to the ceasefire proposals routed through intermediaries. Now, Tehran maintains that the Strait of Hormuz remains open for friendly nations, but closed to hostile ones, and has demanded compensation for losses before any reopening. Even as Washington pushes for negotiations, strikes on Iran have continued. Tensions across West Asia are escalating. US and Israeli forces have reportedly killed the intelligence chief of Iran's Islamic Revolutionary Guard Corps. In the past 24 hours alone, more than 30 people have been killed in US-Israel strikes in Iran. Iran, in turn, has intensified attacks on Israel and US allies in the Gulf region. In Israel, 4 people were killed after a residential building in Haifa was hit. According across the Gulf, Iranian strikes have targeted critical infrastructure, including power, water desalination, and oil facilities in Kuwait, and an oil site in Bahrain was targeted. Meanwhile, drones and missiles towards the UAE was intercepted, and a Ghanan official sustained injuries. Well, joining us now to help us decode these developments that we're seeing out of West Asia is with us Mr. Brahma Chelani, strategic affairs expert, as well as Ambassador Rajiv Dogra, former Indian diplomat. Gentlemen, firstly, thank you for sharing your time with us. Ambassador Dogra, let me come to you first. Courtesy a report coming in Reuters. For the first time, we're seeing public admission by the Iranian regime that it is open to sharing its proposals, its solutions for a resolution with the United States, albeit courtesy an intermediary. Is this perhaps the first signs of de-escalation that you're beginning to see, some form of ceasefire that you see developing over the next few days?
If it really leads to de-escalation, everyone should welcome it, because this is a war no one wanted except Trump and his colleagues. This is a war which has led to huge dislocation in the world, especially on the energy front. And who knows what happens to the agricultural crops if fertilizer supply keeps on at the low rate that it is now. So there's no doubt that all right-minded people would welcome this proposal. But coming from Pakistan, it seems that the proposal has been written in Washington, largely by Kushner, Witkoff, and was transmitted through Islamabad. So that is not a very positive sign, because there's nothing that is inspiring, despite Iran's, as you said, guarded response to the proposal. But this is not way to inspire confidence, because Hormuz Strait, in any case, is open, as Iran says, to all other shipping except those of America and Israel and its allies or sympathizers. So there's nothing that Iran needs to do any further, except if ceasefire is announced, the Hormuz Straits might be open also for these people and their allies. The second thing is sanctions. Sanctions were imposed illegally by America 40 odd years back. So lifting them now is no big deal. And the third is that after 15 days, Iran will promise not to enrich its nuclear material and so on. Now, all these are anathema for Iranian regime.
Ambassador, again, I just want to circle back to the same point that we've seen a flurry of posts coming in from the US President Donald Trump. We've seen a flurry of ultimatums as well, that he'll strike at civilian infrastructure, that he will bomb Iran back to the Stone Ages. But this, for the first time, is an admission on behalf of the Iranian leadership that there is an appetite, at least for a conversation to be had, even if it is via Islamabad. Again, I come back to the question that, is this perhaps indicative of some form of ceasefire that we may see? Is it? Would you bet on that? Would you expect anything to materialize over the next few hours?
You know, you are right to ask this question, because Iran, after all, has not rejected the proposal, if reports are correct. I keep saying if. But Iran has done the right thing, as it has been doing all along. Iran has not escalated. Iran has not rejected this proposal, because rejection means a message to the world that, look, Iran is not being accommodating to a possibility of peace. So Iran has done the right thing that, yes, send us the proposal, we'll study it and we'll respond. But I doubt whether the kind of language Trump has used in his latest message on Truth Social or whatever he calls it, is not quite appropriate for a president to do so. I mean, it is not the kind of language that any civilized country would use, even under extreme provocations. So I doubt whether this particular proposal, the so-called Islamabad Accord, would really be the result in ceasefire on a long-term basis. But as in every diplomatic situation, you always start with the maximum and perhaps come down to accommodation. So let's hope that this too is one of those every diplomatic negotiation, and that America does have a fallback position which might be more suitable to the Iranian demands.
Right, Ambassador Dogra, thank you for joining us. I'd request you to stay on. Let me just get a word in from Dr. Chilani as well. Dr. Chilani, thank you for joining us again. You had some strong comments to share yourself with respect to the use of profanity by the President of the United States, saying that it's a lack of impulse control, perhaps a lapse in executive restraint. Coming on the back of that, coming on the back of what we saw over the weekend, where there was a concerted effort, and if the U.S. claims are to be believed, for recovery of downed pilots, do you see any merit in some of these conversations that we are seeing around a ceasefire, or will you take it with a pinch of salt?
I don't know why you're focused on ceasefire, because there aren't any signs that a genuine effort is going to lead to a ceasefire at this time. Trump is talking about negotiations in order to present himself as being reasonable, despite his expletive-laden threat yesterday. The fact is that even as we speak, US and Israel are repeatedly targeting civilian and economic infrastructure in Iran. Last night, they destroyed Iran's MIT, Sharif University of Technology in Tehran. This is the latest of a series of universities and medical research centers in Iran that have been bombed by US and Israel. According to the Geneva Conventions, targeting objects that are crucial for civilian survival is a war crime. So destroying medical research centers, for example, or destroying power plants. Yesterday, for example, Israel destroyed a power plant in Mahsheri city of Iran. That power plant was supplying electricity to 500,000 residents of that city. Under the Geneva Conventions, that is unacceptable. And yet we're talking about what Trump might do in the days to come. What Trump and Israel are doing now against Iran, we are ignoring that by focusing on things that might come in the days ahead. So let's focus on what US and Israel are doing, not just against Iran, what Israel is doing in Lebanon, for example, destroying entire villages in Lebanon, or destroying apartment buildings in the heart of Beirut. This was never seen in the past, and yet the world looks away. And I think that I find the most troubling, that while these things are unfolding, all we're talking about is things that might happen later, rather than talking about what's happening today.
In fact, let me get your insight, Dr. Chilani, on that Israeli dynamic that you speak of. This entire conversation that we are seeing play out in the hands of these three major powers, Iran, Israel, and US, all conversations towards de-escalation. There's little or no mention of Israel. What role do you see Israel play, if at all there is any room for de-escalation? They have continued their attack, and any statement coming in from the official leadership is that the campaign against Iran will continue.
Israel is not operating autonomously. It's operating as a junior partner of the US. There is a division of labor between the US and Israel. US provides the intelligence to Israel, and it's Israel's responsibility, as the Washington Post highlighted in a front page story, it's Israel's responsibility to hunt down and kill Iranian leaders. So nothing that Israel is doing is independent of the US. The US and Israel are together in this war. While this war against Iran rages, Israel is on a, it has taken a different expansionist detour by trying to occupy southern Lebanon. It's repeating history. It occupied southern Lebanon for a number of years, and finally it had to withdraw. But this time it's gone deeper, and it's even attacking Beirut. So if the US tomorrow were to say hostilities are coming to an end, Israel will also follow suit. There's no way Israel on its own will be able to sustain a military campaign against Iran for sure.
Right. Ambassador Dogra, one quick closing comment to you that, again, in light of these continued hostilities between the two sides, the targeting of civilian infrastructure in what Iran itself calls a war crime as per the Geneva Convention, again, just using your analogy that as a diplomat you aim for the sky, you'll at least hope to hit the ceiling. Do you feel that even the ceiling perhaps may be out of reach, that some form of red line may have been crossed with the attack on such civilian infrastructure, which in turn may just prompt the IRGC to continue its assault on the Gulf region with respect to its civilian infrastructure?
Absolutely. In fact, if you see the parallel of the war in Ukraine, Russia has been careful not to target the civilian infrastructure and never to target universities and scientific establishments. On the other hand, Israel, supported by America, I choose the words very carefully, Israel, supported by America, has been targeting deliberately infrastructure like universities, hospitals, and even small children. 160 schoolgirls were targeted right in the beginning of the war. So I think the respect for rules and warfare has been given a go by. And why the peace proposals are being put forward at the present time, I think is largely because Iran is giving them as good as it is getting in terms of war, not in terms of infrastructure and so on, because Iran only retaliates when it has been hit on a particular side. The second thing is that Trump is desperate that the truth of American losses should not come out, because there is a fear that the body bags and the infrastructure losses of aircrafts and so on are far more than has been let out so far in the American media. Once the body bags start arriving in dozens, then Trump will be in trouble, personally and for the prospects of Republican Party in November.
Right. Well, it's interesting that even as we're having this conversation, there's a statement coming in from the Israeli Defense Minister, Israel Katz. He's very clear when he says that Israeli military has been instructed to continue striking national infrastructure in Iran with full force. So clearly, even as there are talks towards a ceasefire, the actions, however, seem to suggest no signs of de-escalation, at least as of right now. I'd like to thank both of our panelists for sharing their insights. With that, it's time now for heading into a very short break. But coming up next, an exclusive conversation with the RPG Group Vice Chairman and FICCI President Anant Goenka to understand the impact of the West Asia war on India Inc. and the expectations from the government. Stay tuned. Welcome back to this West Asia War special. Now, the ripple effects of the conflict are being felt far beyond West Asia. The region is a critical hub for key energy and industrial inputs like crude oil, LNG, LPG, fertilizers, sulfur and petrochemicals. Any disruption in the supply of these commodities can affect multiple sectors, including manufacturing, construction and healthcare. The impact is already visible. Fertilizer prices are firming up, supply chains are tightening and freight costs are rising. On its part, the government has set up interministerial and empowered groups along with a 24/7 control room to assess the evolving situation. It has regulated natural gas supply to priority sectors, tightened LPG distribution as well, and pushed refiners to maximize domestic production. At the same time, India is diversifying crude imports and securing alternate LNG and LPG sources. But with global markets on the edge, the big question is, how much of this pressure will India Inc. have to absorb? Now, speaking at an event, the Finance Minister Nirmala Sitharaman admitted that this year will be challenging. However, she added that India stands out, and thanks to its substantial forex reserves, which can provide import cover for 11 months.
India's foreign exchange reserves at over 688 US billion as of March 31st, that is 2026, just a few days ago, provide import cover for approximately 11 months. And I would think that's fairly a substantial buffer to hold.
Well, joining us now to discuss this is with us Mr. Anand Goenka, President of FICCI and Vice Chairman of the RPG Group. Mr. Goenka, thank you so much for joining us again. First quick question, that as far as this West Asia situation evolves, which are the sectors which are seeing the most amount of pain going forward, which are likely to need some form of government intervention or government support?
Yeah, so the sectors are very, very varied, all the way going from fertilizer, chemical intermediaries, paints, pharmaceuticals, automobiles, and really the impact is coming in because of second and third order areas of impact. What we're finding is even if you're producing something that may not be directly related to crude or LPG, but you may be using packaging material that is dependent on that, or you may be using steel. So the basic raw materials are getting affected, and currently we're finding many businesses are hand to mouth. But if the war continues for a longer period of time and we continue to see that uncertainty, certainly business will get more and more impacted.
Mr. Goenka, again, the situation that you mentioned is that there's a lot of pressure, especially some of the smaller participants of India Inc. What I want to ask is, from your conversations, are you beginning to hear that there are perhaps smaller companies which may not be able to handle such margin pressure, are having to resort to let go of people, especially contract laborers, migrant workers?
Yes, we are hearing of that impact. I mean, we did hear it from the various gig economy workers, restaurants at one time. We were finding unorganized workers getting affected. But I must say the government has also taken various actions, whether it was the relief support or whether it was the creation of the 7 empowered groups in fuel, in fertilizers, gas, supply chain, even fiscal and trade support that was given in the form of special excise duty reduction on petrol and diesel, continuation of RODTAP. So all of these are positive. But at some point, if the war goes on, we are seeing clear impact on business. Even in many of our businesses, we are finding just hand-to-mouth supply and demand kind of situation. But possibly in a month's time, 3-4 weeks' time, we may see factory stoppages. So the first area of focus for business is how do we make sure business continuity happens and we are able to really de-risk supply chain primarily on the raw material side.
The indications that are coming in from West Asia is that we're nowhere near some form of a workable resolution as far as freeing up the Strait of Hormuz is concerned. International energy experts also warn that the situation will get much worse before it begins to get better. So is there a longer-term picture that India Inc. needs to gear up for a tightening of the belt, so to speak?
No, absolutely. I think, as I said, the first area and short-term impact is supply chain risk. So increasing inventory buffers for critical inputs, analyzing your third order effects in some way, diversifying sourcing. If you're very dependent on a single geography or a single raw material source, how can we diversify? Even collecting our raw material purchases with multiple people so that there is better buying power is something that we can look at. So that is one. Second is financial security within each company. So I'd say one is avoid nice to do capex until some clarity is established. Secure additional funding lines from banks. Hedging of currencies. So I think all of these actions, we have created a report and are sharing this with our members to make sure that we also work on financial security. And thirdly, on energy security. So what can we do with our utilities? Use of multi-fuel boilers, moving more and more to renewable power, for example. Can we do something on economizing energy usage of non-essential, lighting, motors, heating? And looking at conducting energy audits to plug leakages, use of AI, use of digital to make sure that we are more economical on energy use. We're all going through budget cycles as well. Many of us had prepared budgets in January and February. None of that is relevant now. So we'll have to work on a here and now, month-on-month basis. And maybe once this comes to an end, we can have a slightly better longer-term view.
When we speak of measures in terms of conserving energy, is there an appetite? Are we nearing that stage where we need to consider restrictions such as perhaps work from home, such as restrictions on use of private vehicles? Is that something that you would propose or have already proposed to the government?
These are certainly options that we can look at. For example, in our canteens in factories, we sometimes have asked our workers to bring food from home from a single meal, and we provide one meal in our factories. Reduction of lights in some cases. So even work from home is a very easy option. Post-COVID, many companies and mentally we've all adjusted to that. So these are changes that we do see coming in, considering that there is no light at the end of tunnel, at least what is visible in terms of the war.
Speaking of visibility going forward, we're beginning to get indications that there is some conversation that is underway within the administration, within the leadership, for at least exploring options along the lines of a moratorium, along the lines of a credit guarantee scheme. Is that what is needed? Again, it brings back memories of the pandemic not very far back. Do we need efforts on that scale by the central leadership to ensure some kind of state support for the private sector?
Absolutely, that would be of big help. Particularly focus on MSMEs would help in terms of export credit insurance expansion, in terms of fast track approval of imports, in terms of ECGC schemes that are there. So high focus on MSMEs. Even public procurement contracts can be looked at for MSMEs. And clarity on what is force majeure can be one big area that can help is in terms of protection of penalties to MSMEs for delayed deliveries, because in case they've been impacted by war, that relief is given to them.
And one final question to you, Mr. Goenka, that in terms of policy measures that could be undertaken, you've listed out quite a few. What, to your mind, is the single most focus area that the finance ministry or perhaps the government should look at in terms of granting immediate short-term relief?
I would say primary focus on MSMEs. There is some work happening in terms of the relief scheme, but more of that. And I think I would say the force majeure clarity is something certainly that can have a large impact, because MSMEs are getting affected. And how do we give them clarity that if there is any impact with the war, there is some protection that could be given by the government.
Right, Mr. Goenka, appreciate you joining us, listing out those concerns and, of course, possible policy solutions to those issues as well. Again, no certainty in sight with respect to the crisis in West Asia. We'll continue our focus and bringing to our viewers the latest developments coming in from the region. With that, it's a wrap on this special broadcast on the implications of the West Asia war. More news and updates will continue on the other side. Stay tuned.
GLP-1 drugs, which are popularly known as weight loss drugs, are really transforming the way we manage our blood sugar as well as shed those extra kilos. Semaglutide is one of the drugs which has gone off patent in India and is going off patent in various emerging markets. The market size of that particular drug is estimated at around $34.5 billion, expected to expand to over $85 billion by 2035 or 2036. And we are in a facility which is manufacturing that particular GLP-1 drug, semaglutide. We're going to take you through how exactly this is manufactured and what the drug contains, how much is the size and the potential of this particular drug. Mr. Sharma, explain to us firstly why exactly are we dressed in this suits and where exactly are we?
So we are in these PPE extra simply because we are in a sterile manufacturing site. And by sterile manufacturing site, sterile, as you know, has to be no human contamination. In fact, we are now with PPE only in this corridor. The real sterile area is actually inside, which as you see, we don't have access to. And this is the machine which you are seeing is actually the isolator-based filling machine. This is really the first major step in the entire value chain of GLP-1s, where the drug which is formulated from the API is getting filled in this line.
So this is exactly what I wanted to ask you. This is the first step of the manufacturing process of semaglutide. So only certain people in a different PPE are allowed in. And tell us why and what exactly is taking place inside, because I can see there are cartridges which are being ready to get filled.
Exactly. So this is the first major step, although the first step is actually the formulation, what we call compounding of the product. This is when the drug is in the liquid form, the final liquid form goes inside the cartridge. And this is a filling machine. This is automatic German filling machine, which actually is able to do anywhere between 150 to 200 cartridges per minute fill. And you see these isolator means no human intervention. The only human intervention which is visible is only through these glove ports to ensure a complete sterility of the product, injectable product which the patient will be using.
Okay, so how many cartridges? You said 150 to 200 per minute. So how many do you possibly fill in a day?
So our capability is to fill way more. It's just that the limitation is the batch sizes. Most customers do a 200 liter batch size. In that, we are able to do anywhere between 50 to 55,000 cartridges per day. However, the capability is to do even up to 1.2, 1.3 lakh cartridges per day if the batch sizes can be increased.
Okay, all right, got it. So this is the first step. Then these cartridges go to the rejection center to see whether or not they are accepted or rejected, and then eventually they are put into the fill and finish assembly line.
So each single cartridge which gets filled goes through what we call visual inspection. In a traditional pharma, visual inspection is done by human beings looking at the cartridge. Obviously, you can imagine when the volume is so high, as you have seen, it's not possible for humans, or it will take significantly longer. We have automated that process through automatic visual machines, and every single cartridge gets inspected before it goes into the final assembly into the pen, which is what the patient will be injecting herself or himself.
A sterile facility, which we are not allowed
sterile
into.
fill and finish.
Sterile fill and finish facility. Now we're going to go over to the facilities where there will be that acceptance and rejection of the batches, as well as the assembly line.
This is the automatic inspection machine.
Okay. Can you tell us what's taking place here?
Yeah, so this is an automatic inspection machine. Every single cartridge which is filled within the automatic isolator machine which you saw, every cartridge has to be inspected. In a traditional pharma company, you see each cartridge has to be looked at by human beings. You cannot do that when we are making hundreds and thousands of millions of cartridges. This is the automatic machine, an Italian one, which actually does look at every single cartridge, so that every cartridge going into a pen, before it put into a pen, is inspected and approved by the machine.
Okay.
If it is any defect, it will the machine will reject that cartridge. And this is a new addition along with our all automatic assembly and filling machine. This is a new specific inspection.
So this is basically the rejected tray.
Correct, exactly.
This is the good tray and this is the second good tray.
Exactly.
So this is all of the material which is rejected, which is then discarded.
Absolutely.
Okay.
Absolutely.
Can I touch one of the
Yeah,
rejected
sure.
cartridges?
So this is actually the cartridge which looks like, you see, this is the glass, it's like a thin glass vial. And when
And it
we
goes
say
into
fill
the
finish,
pen.
this is what exactly goes into that white holder you saw.
Yeah.
And this is each seal and a stopper which is required, everything. So this cartridge is the drug. So the drug is
the drug
inside.
itself. Yes. So this is the drug inside, but why exactly would it be rejected?
So the multiple reasons. You see, that's where the difference is between a human. What a human eye cannot see, a machine can see. So if there are some thin bubbles, sometimes there are thin bubbles which should be there, sometimes not there. Those are the ones is rejected. It's not, there is no quality defect otherwise.
Yeah.
There is, but because this is such a sensitive machine, it is able to detect even an extra bubble which comes.
And what happens to the drugs that are rejected then?
No, then it's so obviously the subsequently whenever anything is rejected by the machine, it doesn't go through. That's the rejection complete.
taking place here?
So what we saw in the other machine which fills the cartridge, so that cartridge which is filled, eventually for a patient it has to go into a pen which the patient can inject. So this is where that cartridge is being assembled in a pen. And if you see these various components, you can see there is a various parts. That white holder which that's called a cartridge holder, in which the cartridge is there and the various parts of the pen. And this, if you'll see, come with me, then you will see these robotic arms are the ones which are actually assembling each of these, picking up each of these and assembling. And eventually coming out, if you would come, once each of these make sure that these are tightened, you can pick it up. You will see the arms assembling each component together, and then the final pen which comes out. And this is you can see this is the pen which each will eventually patient will use.
This is the pen which eventually reads
the patient will use. So this is exactly, if you will see, this is what it looks like. There is a needle which comes, which gets screwed on top, and this is what then the patient will actually be injecting inside. So it's a various. You open it. There is a mg. How many you want as you open? There is 0 mg, and then exactly. So patient moves it, and that's how it works.
So this is the final product.
This
which
is the final product. Of course, it is not yet labeled. So you will put a label on each pen. Each pen will go into a box. We'll show you the eventual box, what it looks like, because each box comes with a pack of needles, because patient also needs to inject, and that's what eventually
Okay.
Is what
So just tell us, many Indian companies have launched the drug, but the vials seem to be less expensive than the pen. So is manufacturing of the pen much more expensive?
Yes.
And why is that?
A, certainly it is much more expensive, but B, the point here is that the whole benefit of this product is patients' ability to inject themselves at home, which is what makes them, really usable product, which is to be used once in a week. So obviously, vial does not have that convenience. I know that, some companies have launched vials because, they may not have access to the pens or the capacity. But the whole idea here is that pens are the most user-friendly, patient-friendly form. And obviously, as you can see, it is a much more complex operation than just simply filling a vial. And that obviously also shows in terms of the total price of the product.
So what is the capacity that you have for the pens? Who are you manufacturing for as well at this point?
So what we have in one source, Ekta, as I told you, we are an end-to-end CDMO. So for every cartridge we fill, we have 1:1 capacity to include a pen. In fact, we have, because of our flexibility and ability to pack multiple different pen types, we are able to do for all customers. Today, we are able to handle 11 different device platforms in the site.
So when you mean 11 different device platforms, what is that?
Yes, so this pen which you can see is one type. So then we can handle different types of such pens from different suppliers. So we get pens from Indian suppliers, from American suppliers, from European suppliers.
But everybody gets this pen, right? You just label it different.
No, so it looks also different. The working is the same. Everybody will have a needle and top, but the pens look different because there are different, some different technology, some different ease. So there are different types of pens which we are using. So and for each pen you need to, as you can see, the complexity is, if you can see these, the chrome and the steel points, for every device you need a different one. So if we have to change the device, the entire machine has to be recalibrated and readjusted for those devices.
So who are you manufacturing this for?
So we are doing this for, let's say the global who's who. All the top companies, some of the names are in public domain already, Dr. Reddy's, Natco, and their customers, because all these companies are supplying in turn to many other customers in India. And I can tell you that many companies who have already launched in India or are in the process of launching in the next couple of days or weeks are getting their product made in this site.
What is life beyond semaglutide for OneSource? Because eventually, do you fear that there could be oral GLP-1 drugs which could come and possibly have more efficacy and more convenience to the patient, and hence maybe business would then possibly get impacted when it comes to semaglutide, which is an injectable?
So, Ekta, I can tell you that, of course, semaglutide and the other GLP-1s are going to be big volume drivers because if you see, the current penetration levels are still very, very limited, because till now, the access to these drugs were very limited, mostly in the Western markets, US, Europe, even in the large emerging markets, Brazil, Turkey, very, very limited supply. So the demand was actually constrained by the supply more than anything else. Now with generics coming in, we see the volume expanding significantly. Keeping that in mind, we have, we are expanding our capacity significantly. As I mentioned to you, $100 million of new capex, one line going into 4 lines. All that we are doing significant to get a share of the GLP-1 market. But having said that, all these capacities which we have are fully fungible, and we do multiple products. Even the drug device combination which we do, right now we have 10 different molecules, only 3 are GLP-1s. So you can imagine that there is a significant coverage beyond GLP-1s, including biologic drugs, because now most of the global R&D is on self-administration. You want patients to be able to deliver the drugs to themselves, administer the drug to themselves at home. And at home, you need a drug-device combination, and that is where OneSource comes in. So this kind of pen injector, as you see, is not only meant for GLP-1s, but also for biologic drugs, multiple other drugs. And we already have many of those drugs. You know, we already exporting to our customers in US and in other markets. So you will see that all our capacities are for multi-drug usage, way beyond GLP-1s, and in multiple formats. In fact, one of the new lines which we are getting is actually a combi line, which means the same line can fill cartridges also and vial also, depending upon how the overall market dynamics moves.
Okay. So just give us a sense that, you know, you're working on semaglutide now, but is tirzepatide, which is basically Mounjaro, an opportunity for you all? I know it goes off patent much later in the mid-2030s, but still, any work that you all are doing on that front?
Yes, completely, Ekta. So we have decided to be a very entrenched player as far as the GLP-1s are concerned. We are offering our customers all the molecules, starting with liraglutide, semaglutide, within liraglutide both the variants, within semaglutide all the 3 variants, and yes, also tirzepatide. In fact, tirzepatide, while you're right in saying that the patent is coming in in mid-2030s, but for US, which is obviously the largest market, the first to file, or the NC-1 date, as they say, is actually May of this year. So we are supporting multiple customers to be able to get that first to file status in the US.
Okay. How much do you think the semaglutide or the GLP-1 capacity currently exists globally, and how much of it are you possibly servicing at this point?
So, as I mentioned to you, right now, we say globally, for these products, the patient pool can be anywhere between 1.2 to 1.5 billion people, potentially, okay? Obviously, right now, the revolution is still not more
and
than...
And that is because the accessibility is increasing as patent goes on?
No, I'm saying the potential patient pool based on the diabetic and obesity, right? That's the potential patient pool. Now...
But there are more drugs with more efficacy, right?
Correct. So, no, I'm talking about the class of drugs. So, as a class of drugs...
For GLP-1 as a whole.
For GLP-1s overall, that's a potential patient pool, which is the largest for any drug type ever, right? So that, if you see, right now, a very minuscule fraction of that number is being serviced because the constraint has been the supply of products. So now, as the generics come in, obviously the access will increase. Whether that access is 10% or 50%, nobody knows. But the fact is, it will certainly increase. And that is what will lead to a very different and in my view, a healthier world, because these drugs are not just for diabetic and obesity, these drugs are way beyond that.
Yeah. So just quickly, wanted to get a sense that even in this particular facility and in the previous sterile facility, I think compliance would be top of mind. So how many audits do you have? How many regulators are you audited by? How many companies audit you on a regular basis?
So, Ekta, apart from the fact that we have a very, very, very strong capability in manufacturing, as you have seen, one thing which we are really proud of is our compliance track record. In fact, the compliance is in the DNA of the entire group which we have. And the same you will see here. So this site currently has approvals from all major regulators in the world, starting from US FDA. In fact, not only do we have US FDA CEDAR approval, we also have CDRH, which is specifically for drug-device combinations. We have approval from that. We have European approvals. We have approvals from Anvisa and all major emerging market agencies like Turkish agency, Saudi agency. So you can imagine that this is what we really are proud of. And repeated inspections. We have repeated inspections from FDA, repeated from Europeans, and that's what, every time we come out on tops.
Dr. Reddy's, you all are one of the suppliers to Dr. Reddy's. They are still awaiting that approval from Canada.
We are the only supplier to Dr. Reddy's.
You all are the only suppliers to Dr. Reddy's. They are still waiting for that approval from the Canadian market. It was expected possibly by May. So are they manufacturing for the Canadian markets? Have they built up inventory? Where do things stand?
So yes, indeed, that's what they have said very publicly, that they are expecting approval by May. And we are also working with the same assumption. Yes, there is manufacturing happening, at risk for some inventory build-up. But also it depends, Canada has a peculiar requirement that every single pen has to carry what we call a DIN number, which only you get once the approval comes. So after the approval comes, we have to do the full packing. So it's not the finished product, it's not that the approval comes in and we can start shipping tomorrow, because everyone requires a DIN number on it.
Oh, okay. So there's a certain amount of inventory build-up which is allowed.
Yes.
But there are many other emerging markets which are going off patent as well. So how is that working out in terms of manufacturing and business?
That's the benefit of having a global customer base. Because we've got customers who are global companies, we've got customers who are regional champions, we have customers who are country-level champions, including you saw our announcement of approval in Saudi Arabia with our partner Hikma. So, because we have got this multiple customer base, yes, our customers will be launching in all markets as and when the approvals keep coming in. And some of the largest markets, for example, Brazil, which is the largest market outside of North America, is going to be opening up. Turkey, very large market. Saudi Arabia, very large market. And of course, India. So as the approvals start coming in, you will see our customers launching in multiple markets.
Yeah. What is the price difference you think that would exist, or the sort of demand that would exist between, say, an emerging market in India?
So what I would say, two separate points. When it comes to demand, obviously, as you see, Canada is today the largest market outside of US. So from a purely volume driver, because the penetration levels are now significantly higher, and if once the generics come in, it will even go up. So from a pure volume driver, Canada will certainly be the big market, followed by Brazil, Turkey, and the others. As far as the price is concerned, Ekta, as I mentioned to you, as a CDMO, we are geography agnostic. We supply to our customers at the same price. It depends volume based. As the volumes go up, there are different pricing for us. But the geography is immaterial to us.
Mr. Sharma, just explain to us where we are, considering that it's extremely cold here at this point. Why is it so cold? Why exactly are there so many boxes here?
So we are in a cold storage chamber. You see the complexity, the added complexity of semaglutide and GLP-1s is that they must be kept under 2 to 8 degrees at all time, from manufacturing to storage to distribution and to the patient's house.
Yeah.
So that's what we do here. So what the products which are currently under work, which means that it is not fully packed, and this is what we have inside the site, work in progress or semi-finished goods which we keep, and that's what you will see. And then once the final shipper is made, they are temporarily stored till they go into the central warehouse, which is our large warehouse about 2 kilometers from here.
Okay, so after this is when they are labeled and packaged. So,
Some of these, the ones which are these would be a finished product inside. Okay. Absolutely finished product. The one which is on this pallet is finished product, which is ready to go.
Not, if we can just capture
so some
that.
of these are not. These are semi-finished products.
Can I pick up?
Yeah, sure, you can pick it up.
Okay, so
these
this
are
is the
semi-finished product.
And what's left to do with this?
So this is on this will be label. So each one will have. So you saw the one which we saw inside blue. This is different. This is different one. This is a different supplier, different supplier. So this colors also, if you saw, was different. Yeah. So again, needle will be coming. So this is on top. Each each device will have a label on top. So that is what will come. And this labeled pen will go into the box which you saw along with the needles and the patient information leaflet. That becomes the final box which patients will take.
Okay, so maybe we can just also capture the number of semi-finished pens here.
And there are rows and rows and still, and it keeps going. You know, we have every day we've got multiple shipments going out from this.
So how many shipments do you have on a daily basis, considering that now you have
multiple. Right now, it's multiple shipments because because we need to have the trucks which are all refrigerated. So each of these, I think 2 or 3 pallets like these, once they are filled, they will be moved out and put into the trucks, and those trucks will take it to storage chambers. So in the central warehouse which we have, it's again a newly built warehouse, and there we have got almost 7,000 pallets worth of cold storage, 2 to 8, and all these will go and be based there, and from there they will be picked up by various customers.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The US and Iran receive a framework for a potential ceasefire. Reuters reports the plan involves an immediate ceasefire followed by a comprehensive agreement in 15 to 20 days. This comes after Iran warning devastating retaliation to President Trump's expletive-laden threat to reopen the Strait of Hormuz by Tuesday. President Trump set to address the media at 10:30 p.m. India time tonight. 34 people killed across Iran in fresh airstrikes by the US and Israeli military. Iran strikes a residential building in Israel's Haifa, killing 2 people. Iran also targets power, oil and water desalination plants in Kuwait and Bahrain as the war enters day 38. Crude oil prices remain volatile after President Trump warns that Iran should open the Strait of Hormuz or face hell. Saudi Arabia raises the price of its main oil grade to Asia to a record high as exports remain throttled. Ship tracking websites show 2 LPG tankers heading towards India. The Sensex and the Nifty recover sharply in late trade. The Nifty moves closer to 23,000. The Sensex gains nearly 800 points. Broader markets outperform the blue chips today on the hope of a potential deal between Iran and the US. Wipro seals a $1 billion 8-year contract with Singapore's food and agri major Olam Group. The deal includes Wipro acquiring Olam Group's IT services business for $375 million. President Trump imposes 100% tariffs on branded drugs and ingredients. Indian Pharma heaves a sigh of relief as generic drugs are spared from tariffs, but companies like Sun Pharma and Divi's labs with exposure to innovative medicines and global supply chains will be impacted. The Supreme Court refuses to accept a plea by Vedanta to impose a stay on implementing Adani's resolution plan for bankrupt JP Associates, but the top court adds a caveat saying any major decision by the monitoring committee will need the appellate tribunal's approval. The Supreme Court orders a CBI investigation into allegations of corruption against Arunachal Pradesh Chief Minister and BJP leader Pema Khandu. Petitioners allege the Chief Minister's family was awarded public contracts worth nearly 1,300 crore rupees for over 10 years in direct conflict of interest. The Delhi High Court orders the immediate restoration of the parody account called Dr. Nimmo Yadav on social media platform X. The tweets flagged by the government will remain withheld temporarily. Multiple banks cut rewards and perks for credit cards. Benefits lost include cashback, airport lounge access and reward points, among others. Well, let's start with the day's market action. The Sensex and the Nifty recovered sharply in late trade, ending near the high point of the day. And this was the third straight day of gains. The Nifty is now close to the 23,000 mark. The broader markets outperformed today, 1% higher on both the Nifty and the Sensex. But what really happened today that led to this recovery was the report that came in from Reuters suggesting that Pakistan had sent a proposal to both Iran and the US, and there could be a possibility of a two-tier framework, an immediate ceasefire and then a potential deal. That led to the markets recovering. But remember, we've seen this story play out many times over the last 38 days. Is this for real is the big question. Prashant Nair standing by now to take us through the market action. Prashant, that's the big question. Is this deal talk for real?
Well, today was two halves. It was just that the second half was longer than the first half. I mean, the first half was dull, it was down, it was out. And the second half, of course, was exactly the opposite of it. I mean, the dividing point between the first half and the second half were headlines attributed to Reuters, all sourced, of course, saying that there is a peace proposal which has been received by both US and Iran. And there is, a proposal for a ceasefire and then some sort of a negotiated settlement not far into the future. Of course, I mean, the same report also, again, sourced, said that Iran is not going to open the Strait of Hormuz based on a temporary ceasefire. It wants permanent end to hostilities and there are conditions involved, etc., etc., etc. But markets, as has been the case now for the last few days at least, wanting to believe that despite all the rhetoric, and we had enough and more rhetoric as we came into this week with threats and deadlines from President Trump, but the market wanting to believe that it is just that talk, and both sides have taken a fair bit of damage, and both sides want to work something out. And I think that is essentially the kind of trade that we really saw today. I think unless things get visibly worse, it'll be just on the basis of talk that we're going to do this, we're going to do that, we're going to escalate it majorly. Unless you see that on the ground, visible deterioration in a big way, perhaps things are going to look a little bit more constructive at the margin. We'll see. But on your screen, Nifty Bank, both up about 1.5%. And of course, from the lows, the Nifty staged a very, very smart recovery. Mid-cap and small-cap indices 2% apiece here. If you look at the large-cap gainers, Trent, Shriram Finance, Axis Bank, Titan, Adani Enterprises, SBI Life. Remember, it's also earnings season, so we're getting a lot of quarterly updates from names like Axis, Trent, etc. And I think that's the reason why these names did quite well. On the downside, and that's a remarkable thing, today's sort of gains came with no help from RIL, which is a clear heavyweight. Reliance was down, not at the day's low by the end of it, but was meaningfully lower. ONGC and Max Healthcare were some of the other losers.
Well, Prashant, many thanks for joining us. And as we've been pointing out, it is day 38 of the war in West Asia. The airstrikes continue even amidst reports of a potential ceasefire. Now, let's talk about that. Reuters reports that Iran and the US have received a framework for a potential ceasefire. The plan reportedly involves an immediate ceasefire followed by a comprehensive agreement in 15 to 20 days. Iranian officials have said that they have received the Pakistan proposal. However, Tehran maintains that the Strait of Hormuz will not be reopened in exchange for a temporary ceasefire. The reports follow President Trump's expletive-laden threat to reopen the Strait of Hormuz by Tuesday. Now, remember, Trump threatened to attack civilian infrastructure, including bridges and power plants, if the strait remains closed after the expiration of his 10-day deadline. Iran mocked this ultimatum, dismissing it as, and I quote, helpless, nervous and stupid, end of quote. Iranian officials, including the foreign minister, Sayed Abbas Araghchi, have maintained any attack on civilian infrastructure will be met with devastating retaliation. Araghchi also spoke with External Affairs Minister S. Jaishankar about the situation in West Asia. The call happened yesterday. Trump told Fox News that he believed a deal could be reached before the deadline as Iran was negotiating with the U.S. However, he continued to threaten escalation, saying he's considering, and I quote, blowing everything up and taking over the oil if there's no deal, end of quote. Now, President Trump is expected to address the media at 10:30 p.m. India time tonight. Meanwhile, the U.S. has said that it has rescued the second airman caught behind enemy lines after its F-15 fighter jet was shot down. With this, both missing crew members have been rescued after a 2-day search plan in the border region. Meanwhile, sirens continue to sound across West Asia as explosions rock the Gulf and Israel. The UAE has said it is dealing with an Iranian drone attack on one of the country's two main telecom operators. Saudi Arabia also said the 2 drones were intercepted and destroyed. Several residential buildings and cars in Israel's Haifa were also damaged as 10 sites across northern Israel were targeted. Tel Aviv also ramped up its strikes on Iran and Lebanon. Airstrikes severely damaged the industrial zone of Iran, along with Tehran's Sharif University. The overnight attacks have killed nearly 34 people. In Lebanon, civilians continue to be caught in the conflict as Israel continues to bomb towns in the southern part of the country. At least 1,500 people have been killed so far in what Tel Aviv has called targeted strikes on Hezbollah infrastructure. The U.S. and Israeli forces also continue to target Iranian officials. In a press conference overnight, Israeli Defense Minister announced the death of Majid Kadami, who was the head of Iran's Islamic Revolutionary Guard Corps. The Iranian state media also confirmed the killing and called the death a terrorist act. Iranian officials have also vowed retaliation to attacks on Iran's civilian infrastructure.
Iran's reaction would be one of reciprocating any such attack. Our armed forces have made it clear that in case Iran's infrastructure is attacked, we would react in kind. Our armed forces would target any similar infrastructure that is owned or in any way or manner related to the United States, or contributes to their act of aggression against Iran.
And all of that impacting the stock markets, but crude oil prices remain volatile even after President Trump's Tuesday deadline to Iran on opening the Strait of Hormuz. Attacks on energy infrastructure continue across the region, Iran targeting oil and power plants in Kuwait and Bahrain. No casualties have been reported in both these attacks. Now, the explosions have caused a fire at an oil storage facility in Bahrain, which was later brought under control. Ship tracking websites show 2 LPG tankers heading towards India. Iran's ambassador to India said the country has adopted special measures to ensure the safe passage of ships from friendly countries, including India. With oil supply from the Gulf facing severe disruption, India is attempting to diversify its energy sources. But the issue is not just about finding oil, but finding the right kind of oil. Sonal joins us now to explain why this is important. Sonal.
Thank you so much for that. Now, about 45% of India's oil imports have been disrupted due to the ongoing Gulf conflict. Refiners are now looking for alternative sources to replace this supply. But the real issue is not just finding more oil, it is finding the right kind of oil. Not all crude oil is the same. Different types of crude produce different fuels when refined. Some produce more petrol, while others produce more diesel. India's fuel demand is heavily dependent on diesel. Diesel makes up to around 40% of the total fuel consumption in the country. Indian refineries are designed to produce a high share of diesel. This is why crude from the Gulf has been so important. Supplies from Saudi Arabia, the UAE and Iran are well suited for India because they produce higher diesel yields and match refinery configurations as well. Now consider the alternatives. Crude from the United States is mostly lighter. It produces more petrol and less diesel, which does not really suit India's demand pattern. African crude also has limitations. It is either too light, which again leads to higher petrol output, or it has too much sulfur content, making it less efficient to process. Russian crude comes closest to what India needs. Grades like Urals have similar characteristics to Gulf crude and are better suited for producing diesel. The key risk is this. Even if India is able to replace the lost crude volumes, it may still not be able to produce enough diesel. So the challenge is not just about supply, it is about a mismatch in crude quality, which could create pressure on diesel availability in the coming months.
Yes, those are all issues to consider. Sonal, many thanks for joining us. Now, India's services output has fallen to a 14-month low in March, according to HSBC India Services and S&P Global. Now, the Purchasing Managers Index fell to 57.5, down from 58.1 in February. The March reading was the lowest since January of 2025, and this was largely due to slowdown in sales and a pickup in input price inflation amidst tensions in West Asia. We've seen input cost inflation go up significantly. Now, Yes Bank has said that Binay Muralidhar Tonse has taken charge as the private lender's managing director and CEO today. This comes after Prashant Kumar stepped down from that role after completing his tenure yesterday. Tonse had previously served as the managing director for retail business and operations at State Bank of India. Now, shares of Wipro up over 3% in early trade. This after the IT giant signed an 8-year deal with Singapore-based food processing major Olam Group. This transaction is expected to exceed $1 billion in total contract value. Rima joins us now with more on the significance of this deal for Wipro. Rima.
Thanks so much for that. Let's get the news first. Now, Wipro has secured a multi-year strategic deal with Olam for $1 billion. That is the estimated potential of the deal. $1 billion in terms of revenues for Wipro. The guaranteed revenues are $800 million plus, spread over 8 years. As a part of this deal, Wipro will also be acquiring Olam's captive IT unit, which is called Mindsprint, and they will be paying $375 million for this. And this acquired company, Mindsprint, the IT business of Olam, had revenues of $135 million as of last year. But basically, what the takeaway is that at a time when organic growth, the growth for IT companies is weak, Wipro perhaps is using the M&A route to bolster the top line and get the revenues. The street is reacting positively right now because it's $1 billion of revenues over the next 8 years, at least minimum of $800 million. That is a positive. Olam is also strong in the food and agri supply chain, so they get a large client. So there is assured revenue, there is stickiness of revenues, which is what the street likes. But the negative, the potential negative of such a transaction is that it signals that growth is on the weaker side, which is why you need to use M&A to boost the growth. And plus, we don't know the kind of margins. Typically, when you take on a captive center, you will take the employees on board, and therefore the margins could be on the lower side. But for now, the IT sector itself is doing well, and Wipro has got $1 billion of a deal.
All right, Rima, many thanks for joining us. An online beauty and fashion platform major Nykaa reportedly in talks to acquire majority stake in Deepika Padukone's skincare brand 82 East. According to reports, this acquisition will be part of Nykaa's expansion plans with an aim to bolster its House of Nykaa portfolio. The report further says the proposed deal is under discussion. The move also aims to revive the brand, which has struggled to meet growth expectations. So perhaps a deal in the making. Venu Srinivasan, the chairman emeritus of TVS Motor, has resigned from the Bhai Hirabai Charitable Trust. Sources say that he stepped down following objections over trustee eligibility. Srinivasan, who was brought on board by the late Ratan Tata, had been appointed after legal consultations were sought regarding the induction of R. Krishna Kumar. Sources indicate that Srinivasan stepped down after Meli Mistry raised concerns that trustees must be of the Parsi Zoroastrian faith and have permanent residence in Mumbai. Just for context, the Bhai Hirabai Charitable Trust is one of the smaller trusts under the umbrella of Tata Trusts, and the points raised by Meli Mistry apparently are part of the trust's clauses for eligibility of membership. We will head into a break, but up next, multiple banks cut rewards and perks for credit cards. That and more when we return. Now, the Supreme Court has ordered the CBI to conduct a preliminary inquiry into the allotment of contracts to the family members of Arunachal Pradesh's Chief Minister and BJP leader Pema Khandu. Petitioners allege that the CM's family was awarded public contracts worth 1,300 crore rupees over 10 years in direct conflict of interest. The Apex Court has directed the CBI to submit a report in 16 weeks. The Supreme Court has refused to accept a petition by Vedanta to impose a stay on implementing Adani's resolution plan for bankrupt JP Associates. However, the top court added a caveat saying any major decision by the monitoring committee will need the appellate tribunal's approval. Vedanta argues that its bid for JP Associates was higher than Adani's, but the committee of creditors approved Adani's bid as the company offered a higher payment upfront. And staying with courts, the Delhi High Court has ordered the immediate restoration of the parody account called Dr. Nimmo Yadav on social media platform X. Now, the tweets flagged by the government will remain withheld temporarily. Ashmit joins us now with more. Ashmit, take us through what the Delhi High Court has said and why this could be an important precedent in matters linked to other takedown orders.
Well, the Delhi High Court staying the direction passed by the government for blocking the account of one Pratik Sharma, who also goes on the social media platform X as Dr. Nimmo Yadav. Now, bear in mind that the government had passed for a takedown order against him for posts that he had made against the Prime Minister. The government had called it a false narrative, saying that this is portraying the Prime Minister of the country in bad light, and therefore had passed orders for taking down his order under Section 69. Now, Section 69 of the IT Act provides for takedown powers in case of national security. Now, this commentator, Pratik Sharma, had moved the Delhi High Court, and he was, in fact, seconded. He was supported by the platform X itself. X had also submitted that, look, these posts that have been flagged have got nothing to do with national security, and that appears to have weighed on the mind of the Delhi High Court. The High Court has said that for now, the account needs to be reinstated forthwith. That's number one. What the High Court has also said is that no hearing had been granted, and therefore principles of natural justice must be maintained. Pratik Sharma must be granted a hearing by the review committee. The only caveat that the Delhi High Court has drawn is that while the account needs to be reinstated, the posts, the objectionable posts, may continue to remain taken down. But this is, of course, an interim order. The High Court has said that the hearing, this case will continue before the High Court.
All right, Ashmit, many thanks for joining us. Now, the shortage of cooking gas is forcing many migrant labour to leave cities and head back to their villages. Delhi and Mumbai have seen a flood of migrant workers returning home. Rachna met with several migrant workers at Mumbai's railway stations to find out more.
This is Lokmanya Tilak Terminus, one of the busiest railway stations in the city of Mumbai. But what you're seeing behind me is not the usual scene. People are not coming into the city to look for jobs, but are actually heading back home. These are migrant workers who came into the city and worked as daily wage laborers on construction sites, painters, tailors in multiple sectors, but are now heading home as they can't afford to eat here anymore. These are migrant workers who didn't have registered addresses in the city, and they relied heavily on grey market for LPG cylinders. But now, as the prices have gone up given the LPG crisis, what costed them 1,300 rupees to get one cylinder is now up to almost 5,000 rupees, and so the economics is not making sense to them. Apart from that, they also relied heavily on informal food vendors, the food carts. But even for the food carts, to get the LPG cylinder for their carts, the prices have gone up 3 times. And so that price hike has been straight passed on to their plates, and so they think it is best to go back home.
अभी होटल से कितना दिन खाएंगे, इसके लिए जाना पड़ रहा है।
तो आपने कोशिश कहाँ किया गैस लेने का?
कोशिश तो बहुत की है मैम, लेकिन मिला नहीं किधर भी। जो बोलते थे 4,000 5,000, वो भी नहीं मिल रहा है। लॉकडाउन में भी ऐसे ही हुआ था।
तो अभी गांव जाके फिर वहाँ पे कमाई का क्या साधन होगा?
गांव तो चाय से खा के गुजार लेंगे, लेकिन यहाँ पर तो बिना पैसे के कोई खाना नहीं दिखलाएगा।
मैं लेडीज जींस का कटिंग करता हूँ, तो काम चल नहीं रहा था। वॉशिंग में गैस के लिए, वॉशिंग जो होता है कलर, उसमें गैस का लगता है, तो गैस आ नहीं रहा था, इसीलिए कारखाना बंद हो गया। तो अब जा रहे हैं गाँव।
जब तक पैसा था तब तक खाया, इसके बाद पैसा खत्म हो गया, गांव जा रहा हूँ।
मैं भी जा रहा हूँ बिहार, क्या करेंगे, यहाँ रहने का व्यवस्था भी खराब हो चुका, राशन पानी की दिक्कत हो रही है, पेमेंट नहीं दे रहा, सेठ बोल रहा है कि पैसे नहीं है मेरे पास।
मैं इसके लिए जा रहा हूँ क्योंकि गैस खत्म हो चुका है, इसके लिए मैं घर जा रहा हूँ।
तो आप ब्लैक में खरीदते थे?
ब्लैक में खरीद रहे थे, वहाँ से मिल नहीं रहा।
अभी क्या दाम चल रहा है?
अभी उसको 3,000 चल रहा है।
3,000?
वो भी पहले 1,300 चल रहा था, अभी वो भी मिल नहीं रहा है।
जो खाना 500 का था डायरेक्ट 1,000 रुपये मांग रहा है। जो पूरी भाजी 25 रुपये की थी
तो वो 30 रुपया मांग रहे हैं, मनमानी रेट मांग रहे हैं। इसके लिए हम लोग को जाना जरूरी है। एडजस्ट करेंगे, कर्जा वर्जा लेके लोन वोन लेकर के जो अपना खाएंगे फिर आएंगे तो कमा करके भरपाई करेंगे।
लेकिन इस टाइम पे तो वैसे भी घर जाते हैं ना, दोपहर गर्मी की छुट्टी के टाइम।
गर्मी के टाइम में जाते, मगर अभी हम लोग को नहीं जाना था, गैस की वजह से जाना है।
अभी जो चालू है ना ये ट्रेन, इसमें बहुत गर्दी रहता था पहले, अभी तो बहुत सही हुआ है, नहीं तो बैठने का जगह नहीं रहता था, बाथरूम में लोग बैठते थे जाके।
We are not seeing any exceptional crowd movement. We are not seeing any exceptional passenger footfalls. The ticket sale trends are also, in line with the normal gradual, shift that we see every year on year.
The data which is available with us does not show any kind of spike or any kind of sustainable increase towards the previously available data or previously movement.
The government has urged households to move to induction cooking as the LPG shortage deepens, but that advisory to this workforce means very little. Also, this is the same blue-collar workforce that lived through the COVID-19 exodus, and the lesson that they drew from then was to get out before the situation gets worse, and that's exactly what they're doing. What we gathered from the station authorities today is that this started weeks ago and is now in fact at its tail end. But even the tail end is quite substantial. In Mumbai, I'm Rakshana Thanujani.
With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We've got plenty more lined up for you after this short break.
Hello and welcome to Startup Street. I'm Arundhati Ramlin, and with me as always is Shruti Mishra. These are the top headlines from the startup world. Circulate Capital has raised $220 million at first close of its Asia 2 fund, crossing 70% of its $300 million target and surpassing its previous fund. The fund will back circular supply chains and recycling in South and Southeast Asia, aiming to process 2 million tons of waste and cut over 50 million tons of CO2 emissions.
Early-stage investment platform Jito Incubation and Innovation Foundation has invested over 150 crore rupees across 100-plus early-stage startups in 2 years, recording over 15 exits and plans to deploy another 80 to 100 crores over the next 12 to 18 months. It has also entered a fund-of-funds strategy with a 26.5 crore rupee bet on Atomic Capital and is set to launch an APAC-focused accelerator targeting AI, fintech, climate and mobility startups.
Sathio Labs has raised $2.2 million in a seed round led by Unicorn India Ventures, taking its total funding to $5.5 million. The space tech startup will use the funds to advance its thermal satellite mission and AI-powered geospatial platform amid rapid growth in team and tech capabilities.
Meta plans to cut around 200 jobs in Silicon Valley, adding to recent layoffs across teams like recruiting and Reality Labs. Earlier cuts exceeded 1,000 roles, with more reductions possible. Despite this, the company continues hiring and had about 79,000 employees at the end of 2025.
Google will officially start the construction of its $15 billion data center hub in Andhra Pradesh on April 28th. The $15 billion investment will go into building 3 data center campuses near Visakhapatnam. The 3 data centers will have a combined capacity of 1 gigawatts and are expected to be operational by July 2028.
Well, those were the headlines we've been tracking for you this evening on What's Brewing. Full Life Healthcare, the company behind Fasten Up and Chicknutrix, has raised 300 crore rupees in a Series D round led by Elevate Venture Partners, marking its first bet in the D2C space. Already profitable and present in over 40 countries, Full Life is now gearing up to scale manufacturing, expand into newer categories like sleep and digestive health, and accelerate its global play. So what does it take to build a global wellness brand from India? Joining me now is Shilpa Khanna Thakkar, the co-founder of Full Life Healthcare. Also with me, my colleague Arundhati. Shilpa, welcome to Startup Street. 300 crore rupees in fresh capital and from Elevate's first D2C bet. What convinced Elevate to back you in an increasingly crowded space? And given you're already profitable, Shilpa, why raise capital now? And what's the next phase you're gearing up for?
Well, first of all, thank you for having me here. Looking forward to this conversation. The question regarding why Elevate decided to invest in Full Life, I think it becomes a very relevant question considering the acquisition that is happening in our space, and it's a very exciting space. I would say 3 reasons that would attract any investor in our space, and that's where we had a right to win. One is having a strong growth rate. Past 2 years, we have doubled up our revenue year-on-year basis. Along with it, we have come towards profitability. So we entered the fundraise with a very profitable balance sheet. Second would be our ownership right from ideation to commercialization. In India, in our space, I would say it's very rare for anybody to have full stack ownership in terms of R&D, formulation, manufacturing, and most of the brands outsource this. But we have that strength of having it all in-house, which also gives us the right to innovate at a speed which probably others cannot. Third would be the presence in international markets. So it's not just a tick mark. We have 25% of our revenue which comes from international market. And this shows that we are truly a global brand and not just a brand which is making good in India, but also in global markets. When
Absolutely.
it comes to...
Hi, Shilpa. Arundhati just stepping in here. You know, if you could quickly tell us, you're sort of building across 3 brands, right? Which is Fasten Up, Chicknutrix and Night Out. How do you sort of ensure each has a distinct identity without, you know, sort of cannibalizing the other? And with over 100 SKUs already, how do you sort of balance innovation with focus?
Well, all 3 brands, they are from House of Fasten Up. They focus on very different categories. So each brand has a role to play. So while they are in the space of health and wellness, we have ensured that they focus on a very particular category. So Fasten Up is focusing towards active and daily nutrition. Chic Nutrix is beauty from within. And Night Out is about social occasions and recovery. So they never cannibalize each other because they follow a very different space within the health and wellness segment. So there's no question of cannibalization over here. And I think it's a beautiful space to be in. We always say that we take care of your AM to PM needs, ensuring with all these categories.
All right. So, Shilpa, you are betting big on fast-moving health and wellness goods, or FMHG. How big is the shift from traditional FMCG? And are Indian consumers truly ready to move from reactive healthcare to proactive wellness spending? And what's driving this surge?
Definitely at this point, I would say it is a space where people are rapidly moving towards FMHG. FMCG is about daily consumption. FMSG is about your daily well-being. And today, people have become more and more aware. And COVID, of course, has accelerated this awareness. But as you see, Gen Z, millennials, they give priority to their health. They would rather spend on health rather than on other aspects. So I think this definitely is an upcoming area, FMHG, and we believe that we as a brand will play a very large role in this. People are considering it as not something niche. It's not reactive anymore. It is about having a daily routine. It is about having it part of your lifestyle. And I think Fasten Up has been very instrumental as well in educating and shifting this behavioral change as well. We have done a lot of education in last few years that health and wellness is not just reactive, but it is about taking care of your health, and it should be part of your routine.
Absolutely. And you started with effervescent formats, right? How has that sort of shaped your differentiation? And as you expand into digestive health, sleep, and protein, what is the next big breakout category for you?
Effervescent is a format we Full Life introduced India to. There was no format like Effervescent before. It was largely pills and tablets. And Effervescent gave us that edge because it also helped us make people believe that nutrition can be fun, can be convenient, can be tasty, and can be part of your lifestyle. And it should not be considered as something that you are sick and then you take care, but it is part of your routine. And like you have food, nutrition is something that you have to include in your lifestyle. We have been focusing on three major categories, and I would believe that we have created those categories, hydration being our number one and top category. When we started with this category 10 years back, I think people would just think hydration and would say water. And we have educated people that it goes beyond that.
Yes,
it's also about having the right electrolytes, hydrating the right way. And it's no more restricted to sports or, athletes. But today it has become a household need, be it a mother, be it a professional.
Absolutely.
Everybody needs to have it. Second would be modern wellness with metabolism as a core in the category. And third, I believe next phase that is coming up is also beauty from within.
Okay, very quickly, one final question. You have built a profitable business, Shilpa, in a category where many still are burning cash. What are your current revenue numbers looking like? And as you double down on omni-channel, what's working better today for you, online or offline?
While I don't want to divulge into revenue directly, but I would say that we have had a very strong growth past 2 years, year on year, doubled up, 100% growth. Channel-wise, we believe we need to be omni-channel and not look at just one channel, be it online or offline. Today, consumers want you to be across all channels, whether they want you to feel the product and then pick it up, or they want it in 10 minutes. Quick commerce, offline, they have become a really big category, big channel for us. They have also doubled for us in the last year, and we will continue to be omni-channel in the future as well with all our categories.
All right, Shilpa. So you will continue to be omni-channel with all your categories. But thank you so much for joining us on Startup Street today.
Thank you.
And moving on, India's space tech story is moving into its next phase from innovation to scale. Bellatrix Aerospace has raised $20 million in a pre-Series B round as it looks to ramp up manufacturing of its satellite propulsion systems and meet growing global demand. The company, which has already proven its technology in orbit, is now focused on cutting lead times, improving cost efficiencies, and positioning itself as a reliable global supplier in the fast-expanding space economy. Joining me now to discuss this further is Yashas Karanam, the co-founder and CEO of Bellatrix Aerospace. Yashas, thank you so much for taking time out and being here with us on Startup Street. You know, since we last spoke, you've not just validated your propulsion systems in orbit, but also moved towards commercial readiness at scale, right? So what were the key milestones of the past year, including recent in-orbit and partnership developments that sort of enable this shift?
Well, I think over the last few years, I think we have grown from a company which just built a product, qualified it in space, to a company which has been serving serious global customers now. And I think towards that, the major shift has been in terms of the mindset internally, both in terms of management as well as all our engineers and also the new production team which has come in. So I think we are now all geared up and looking at everything from a quality point of view, scaling up point of view, systems and processes. That way, I think we want to make a mark in terms of how quickly we can produce our products and trying to see if from India we could produce the propulsion systems at the fastest pace compared to everybody else. And of course, at one of the best like margins or best costs that we could make up compared to the global operations.
All right. You know, this $20 million round is clearly about scaling production, right? So what specifically changes on the ground now in terms of manufacturing capacity, timelines, and delivery commitments?
So I think so far we have been operating at scales of a few tens of propulsion systems a month. That is the kind of capacity. But again, going forward, we want to multiply that, scale up the production capacity to probably 3 times the current capacity. And Bellatrix has this DNA of developing as well as manufacturing things in-house. So we want to further amplify that, ensure that we are at the peak of producing almost everything within the factory itself, right? So that's one of the goals we are looking at. That really enables us to kind of have zero dependency in terms of production delays and be able to do things much faster. And also, like we are working on VLEO satellites. Basically, they're called very low Earth orbit satellites. Essentially, today's low Earth orbit satellites operate at around 600 kilometers to 1,000 kilometers. So we want to bring them further lower, see how far satellites can actually get to, and we are trying to put these satellites at 200 kilometers. But essentially, it's a R&D challenge there because at 200 kilometers, you still have Earth's atmosphere, and there's a lot of drag. So a satellite essentially keeps coming down because of the heavy drag there. So we have cracked that with a new type of propulsion system, which could actually sustain the satellite there for several years. And your satellites can operate at much lower altitudes than what they could initially operate, which means a new paradigm of applications come in, be it telecom, be it your defense surveillance or imaging or anything and everything to that matter. So this funding is also going to help us accelerate development of this technology, and we want to be the global first in demonstrating this in space. There is already a couple of missions lined up for that and a couple of partnerships as well. In fact, we have also tied up with Bharat Electronics Limited, BEL, on putting up a constellation of these kinds of satellites for Indian applications. So this is all coming up in the $20 million fundraise.
All right. So lots of plans that you've laid out there for this $20 million. You know, you've spoken about a strong and growing order backlog, right? How has demand sort of evolved over the last 12 months? You even pointed out some partnerships right now. But what has the demand sort of been like from global satellite constellation players? And how much is your order book at?
Well, that's a thing that I want to kind of have a separate press release on. But I think I would be happy to say that the last 14, 16 months have been super productive for us. And we have gone from probably just a few domestic orders to several like international supplier, supply contracts that we are executing right now. It's been super productive. And we are also like working on not one, but probably a couple of constellations right now. So it's pretty interesting time to produce propulsion systems from India.
So an interesting time to produce these propulsion systems. Now, you've sort of managed to bring down lead times to under 6 months. What operational or technological changes have sort of enabled this, and can you sustain this as volumes sort of ramp up?
Yeah, that's a very interesting perspective. So basically, if you look at a propulsion system company globally, right, be it in the US or be it in Europe or anywhere across the world, there is a supply chain in those countries. Say for making a propulsion system, you need a lot of smaller parts, smaller subsystems. For example, you need to make your own tanks, you need to make your valves, propellants, catalysts, the electronics which drives these things. So if Bellatrix was in Europe or Bellatrix was in the US, we didn't have to build all these subcomponents or subsystems. We had suppliers all across the continent which could actually supply these, and they're in that business itself. But for us coming from India, we had to import all of them. And importing something which is again a high value in a high value industry like space tech, right? It's going to spike up our costs so high that we would not be competitive in a global landscape. And India is still an emerging economy when it comes to space. So we'll have to look outwards towards selling our products, which means for us, it did not work out economically to actually import all the components, produce in India and sell it back to the same regions. So we had to take a very divergent route of taking a huge R&D initiative of building all the components, all the subsystems in-house, because India as an ecosystem still was not matured in having these products off the shelf. So we developed a lot of these subsystems in-house. Today, the advantage that we are seeing is just because we started from a new country which did not have all these capabilities built in. We are able to control the entire supply chain. We are able to control the timelines. We are able to control the costing. If I was in Europe today, my lead time would have been almost 18 months to produce propulsion systems. Because I'm doing everything in-house, I'm not waiting for 1 or 2 components which are long lead items. I have control over that, and I can produce all these systems easily in less than 6 months and sometimes even less than 4 months. That's the main advantage I'm getting here.
All right, so that's the main advantage you have building all of this in-house itself. But you know, Yashas, we're completely out of time, but thank you so much for joining us on Startup Street today.
Thank you.
Well, on that note, it's time for us to head into a short break. But coming up next, D2C fashion brand Lipas crossed 1,000 crore rupees in ARR. We interact with founder and CEO Siddhant Keshwani to know what's driving this growth. Stay tuned. Welcome back to Startup Street. Ultra-fast fashion brand Libas says it has become the first Indian D2C fashion label to cross 1,000 crore rupee annual run rate while continuing to remain EBITDA positive. From building its first 500 crore rupee entirely bootstrapped to now accelerating growth across both online and offline channels, Libas is doubling down on scale with plans to expand its retail footprint aggressively. To talk about what's driving this momentum and what lies ahead, joining me now is Libas's founder and CEO Siddhant Keshwani. Siddhant, welcome to Startup Street. 1,000 crore rupee ARR, a big milestone. What are the key levers, Siddhant, behind this 1,000 crore rupee run rate? And you call it a milestone in motion, not a finish line. So what's the next big target from here?
Firstly, thank you for having me here. So I think one of the major growth drivers for us is that there was a huge gap in the Indian wear market. We are the first Indian wear fast fashion brand in the country. And in the age of social media, where people are looking for trends really fast, really quickly, I think our core forte is to bring that to our consumers really, really fast. I think for us, one of the major growth drivers to reach that ARR is the speed at what we execute new things, new trends, and new fashion that has worked extremely well for us.
All right. Siddhant, you claim you are growing at nearly 30% while staying EBITDA positive. What are your current revenue numbers? Also, if you could share with us some of the revenue targets that you've set going forward.
Yeah, honestly speaking, currently our revenue numbers is something that we've still not closed, and the year's books are going to close in a couple of months. But it's definitely somewhere upwards of 700 crore rupees, and we've already touched an ARR of 1,000 crores for this, so that this gives us a clear view of how much we're going to end. Hopefully, should be 1,000 plus by the time we close the year if the markets stay as strong as they are currently. And major growth drivers is opening a lot of new stores and driving our global expansion as well. So these are a few levers which are going to help us grow in that direction.
Okay. Siddhant, in a market that's crowded with both global and domestic players, what's your core differentiation and what does it take really for an Indian D2C fashion brand to truly compete with the global fast fashion giants?
See, today, like I said, our core differentiation is fast fashion. While we have the best product and we are really good at what we do, I think our best forte is that we do everything really fast. So speed for us has been our moat since the beginning. And how we are competing with global brands is because we're in India, there is no dearth of supply chain here. I think just utilizing that and getting the best of fashion and infusing that with technology, I think that is something that we are really good at, and that has always acted as a differentiator for us, in a crowded space like fashion.
Okay, so speed clearly has been your moat. Your offline play is accelerating. 28 stores this year and 50 plus planned for next year. In fact, your exclusive brand outlets have already crossed 100 crore rupees in sales. Siddhant, how important is offline to your overall strategy? And what's working better today, online or offline? And what does the revenue mix look like?
See, honestly, online, we are a digital first brand, and being an online first brand, it's extremely, online, our strengths are extremely solid. While we don't look at online, offline as really separate channels, we feel that India is moving to an ecosystem where, as brands, we are trying to build an ecosystem for a consumer because the same consumer is actually buying or probably consuming from different touch points. For example, the same consumer buys online, then probably goes out to malls or high street with the family on a weekend, or maybe wants to repeat buy quickly from quick commerce channels, right? So as brands, we have to look at it as a whole ecosystem where we are trying to kind of scale up all platforms simultaneously, and we have to be available where the consumer wants us. So that has been on the top of mind for the longest time. If you ask me today, e-commerce is the strongest channel for us, but offline is also now almost contributed to about 25-30% of the business. It can go up to 40-45 this year.
All right. Siddhant, fashion is a tough business, inventory, trends, margins. So how are you managing supply chains without overextending? And how do you ensure consistency in quality and brand experience as you scale this fast?
See, I think we live in a day and age where technology is at the forefront, right? At the forefront of everything that we do. So once you infuse that, automate things, and especially now with the age of AI, right? I mean, we're using AI in so many different ways to forecast the new fashion, understand demand planning, forecasting of what kind of SKUs do you want and how much of it do you want. So that just helps the whole planning process, which used to take weeks and months and used to happen with just 50-60% accuracy. Today with technology, we're able to do it within hours. And and it's much cheaper. You don't need like 100 people to do it. So yeah, I think that's the core of the technology. Yeah.
Siddharth, do you see Libas evolving into a global brand, or is India still the biggest opportunity? And if global is on the cards, which markets are you targeting next?
No, absolutely. So we already have started our global or international operations through our own website, and the mission and has always been to create a brand from India which is celebrated all over the world, not just in India. That is always the vision, and we definitely want to be one of the first brands to reach global markets through a product which has Indian roots as well as Western and Western aesthetics. So that's definitely on the cards for us.
Okay. Now, before we wrap up, what's in store, Siddharth? What new offerings can the consumers look forward to? Also, any plans to raise funds anytime soon to fuel the next phase of growth?
So I think what people should watch out for us is, of course, going to be a global expansion and how we are modernizing Indian wear, which has not been done in the past. That is definitely one. Future fundraise, if markets allow, things go well, we might be looking at an IPO maybe sometime early next year. So that is our projection at the moment, but still too soon to comment anything. Markets have been a little volatile lately, so it keeps on, kind of changing and delaying our plans. But I think business-wise, we're going strong, and if we continue to do so, maybe IPO is the best way to go about it. So. Yeah.
All right. So you're eyeing an IPO by next year. With that, it's a wrap. Thank you so much, Siddharth, for joining us on Startup Street, and wish you the very best with all your aggressive growth plans.
Thank you. Thank you.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. From Shruti and me, goodbye and many thanks for watching.
We do have a very special guest today, Warren Buffett, the chairman of Berkshire Hathaway, former CEO of Berkshire Hathaway. And this is the first time that we are sitting down with him since he stepped down from that CEO role. Warren, welcome. It is wonderful to see you this morning.
It's fun to be on.
Warren, this is the first time that we're sitting down with you since you stepped down from the position of CEO of Berkshire Hathaway.
Yeah.
It was a long, long run, very successful run. How is your life different today?
Well, it's not much different, except for I mean, I go in every day.
To the office?
Yeah, I go in every day to the office. I don't accomplish hardly anything. I mean, in terms of, it just takes me way longer to do things, and Greg is so good. It was kind of embarrassing how good he is, because he has covered, we've got about 200 businesses within Berkshire, that came about. And I can't name the managers' names or their wives' names, and I haven't seen them, in a long time. It was easier just to write the letter once a year and kind of do my own thing. Greg covers more ground in a day than I would in a week, even when I was at my peak, let alone my present condition. So it's a move that, in many ways, I could have done it earlier, and Greg would have been better than I was. But I can still contribute just a tiny bit. But
well, are you still involved in making investments at all?
Yeah. But I won't make any that Greg thinks are wrong, and he'll run. He's starting to get a few calls, and he'll call me about them, and like me, he doesn't like them, but
calls for deals, you mean?
He'll keep me posted. Yeah, well, it's investment bankers calling him, and they'll sell them. They'll try and sell anything, but I cut him off in about 10 or 15 seconds, and he spends more time with them, but I don't know where he gets this time, because he plays hockey with us. I mean, it isn't like he's as fanatic as I was, in terms of running the place. But with no more apparent effort, he just covers so many bases.
In terms of what you're doing with investing, I mean, it's a huge amount of money. How much cash does Berkshire have on hand at this point?
I don't know the exact number, but it's not much different than before. So, it's probably north of $350 billion in cash and treasury bills.
Yeah. So
we bought $17 billion this week.
$17 billion of T-bills?
Of T-bills.
Berkshire's the largest owner of T-bills?
I think we're probably the largest bidder, and ironically, I got involved in Solomon because they bid for too many bills, and I don't think they'd get mad at us now if we bid for too many. But you're not supposed to go over 35% or something in the auction, and of course you bid through the primary dealers. But I don't even know the mechanics that well. But one fellow in our office handles all the mechanics of the stocks and bonds we buy.
Mark Millard.
Yeah, exactly. Yeah. And any place else, they'd have 25 or 30 people. And he loves what he does, and I love what he does. And he's down the hall about 20 feet, and about every hour or hour and a half, he brings me in what we've done. And
what Berkshire has done just in terms of the markets that day?